action on Wall Street.
U.S. markets closed slightly lower on Wednesday ahead of the start of big tech earnings season as traders monitored growing tensions in the Middle East. The Dow fell 6 points, the S&P 500 was down 10, and the Nasdaq dropped 146 points. The plaintiff in a social media addiction lawsuit against Meta has dropped its case, ending a trial set to start with jury selection in Los Angeles on Monday. The other 3 defendants in the case, TikTok, Snap, and Google, already settled with the plaintiff in this suit that alleged that social media companies were negligent about the addictive nature of their designs of their platforms. No word on the terms of those settlements. And OpenAI says that its own AI models went out and hacked another company during a planned test run. It was experimenting in a closed sandbox and didn't have internet access, but still managed to hack the startup Hugging Face. OpenAI now says that it's investigating the incident, and Hugging Face says that it was trying to use American models to fix this breath, but it was blocked by guardrails and was forced to use an open-source Chinese model, ZAI. That's what's happening here in the U.S. Back to you in Mumbai.
All right, thank you so much, Angelica, for that update. Now, here's some opinion from Stephen Parker, co-head of Global Investment Strategy at JP Morgan Private Bank, on the U.S. market and earnings outlook. Listen in.
The conversation that we were having back in December was this is all about the Mag 7 and the hyperscalers. And then look what's happened this year. The Mag 7 is down and the market continues to move higher. Well, it's all about the tech sector. And then we saw disruption in the software space. And now we're seeing a big pullback in semiconductors. And yet, through all of that, the market is near all-time highs because we are seeing a broadening. Earnings are continuing to deliver. A lot of that is tech. But you look at industrials, utilities, financials. This is a broader story, and that, I think, is really healthy. The early results look fantastic. Almost 90% of companies are beating expectations. And so I do think the results are going to come in strong. What we have to recognize, though, is because of what we've seen in markets, because of higher expectations, companies that do miss or don't beat by enough are likely to see a lot of downside. You have to be prepared to manage around that. And frankly, look for some opportunities because volatility can be your friend when you get a little bit of this volatility.
Take a short break. All the updates from the world of AI in our special segment, the AI Pulse, on the other side. Stay tuned. Welcome back. The big result of the day comes from Infosys today, mostly after market hours. Rima is here to tell us what the street is expecting. Rima.
So expect a good quarter from Infosys this time. Expectations are for a 1.8% revenue growth. The broad range is 1 going up to 2.5% constant currency quarter-on-quarter revenue growth. It's likely to be better than peers. So barring a Tech Mahindra, which had a 2.6% growth, Infy's growth is likely to be better than a TCS, which was at 0.4%, and HCL Tech and Wipro this time were negative growth quarters. The reason is the 2-month contribution from the 2 acquisitions that they did, Stratus and Optimum. But remember, this is going to be the 5th number that comes out. All the other large cap IT companies have already come out with their numbers. So in that sense, it's not going to give us more color maybe on the industry. But what's going to be critical for Infy, which the others don't give, is the guidance. Infy is the only large cap Indian IT company to give you a guidance. Now currently for FY27, it stands at 1.5 to 3.5%. Some analysts believe the top end could be shaved down. It's hard for the company to hit 3.5%, so maybe they bring down the upper end of the guidance. But if you add the acquisitions that they've done, the 2 I spoke about, then the guidance could look at 2 to 4 to 2.5 to 4.5%. The stock, like the rest of the pack, has struggled this year. Year to date, Infy is down 35%, but from the 1st of July 52-week low, it's managed to recover about 7-8%. So July per se hasn't been a bad month.
Rima, thank you for that update there. The big number from Infosys later this evening. And now getting you the world of tech in our AI Pulse segment. Rachna has hopped over to the wall to tell us just that. Rachna.
Well, first up is Alphabet that beat second quarter revenue estimates with $119.8 billion against $116.9 billion expected. Now, Google Cloud rose 82% to $24.8 billion, its fastest growth in many years. The stock still fell after hours, with capital expenditure guidance for 2026 raised to as much as $205 billion. That spending is flowing to chip makers, and AMD will invest up to $5 billion in Anthropic, which deploys 2 gigawatts of Instinct MI450 GPUs from the first half of 2027. It follows similar deals with OpenAI and Meta in a market that still is heavily dominated by NVIDIA. Then there's IBM that went the other way, cutting its full-year revenue growth forecast between 4 and 5%. Second quarter revenue was $17.16 billion against $17.58 billion expected as per LSEG. Now, the CFO said clients are shifting budgets towards AI hardware, not away from software. China's Moonshot AI that released K3, a 2.8 trillion parameter open weight model, it said it rivals Anthropic's Fable. Now, days later, the White House Science and Technology chief alleged Moonshot distilled Fable to build it. The Treasury Secretary is weighing a blacklist and sanctions. The Chinese embassy calls these claims unfounded. Then the Secretary of State Marco Rubio that told diplomats to push back on talk of an American tech kill switch after June's block on foreign access to Mythos and Fable, as per a cable reviewed by Reuters. There is no government magic button, he said, the report quoted him. Amazon has confirmed layoffs in its AGI unit, its model, silicon and quantum team, without giving out the numbers. Now, more than 30,000 roles have already gone this year by Amazon. And after a rogue agent built on OpenAI technology breached Hugging Face, the startup used Zifu open source GLM 5.2 to analyze the attack because leading American models refused the work. They had to turn the Chinese way. That's all we have from the world of AI for now. We'll get you more updates through the day.
Rachna, thank you for that update there. Take a leave on this edition of Power Breakfast from Rachna and me. Thank you so much for watching. Bazar Morning Call on the other side sets you up for the day's trade.
Every morning, the countdown begins for the markets with meticulous research and analysis designed to help you capitalize on the trading day. Beaming live from the CNBC TV 18 Motilal Oswal studio.
Good morning. You're with us here on a fresh new edition of Bazaar Morning Call. We are coming to you live from the CNBC TV 18 Motilal Oswal studios. I'm Prashant with me, my colleagues Rima and Nigel. Guys, good morning.
Hi, morning.
Hi, good morning. So markets are staring at the fourth day of declines. The GIFT Nifty is down more than about 100 points, so extending the slide below yesterday's close of 24,000. And the problem now seems to be banks are under pressure. HDFC Bank, IT was rebounding, but that's sort of gone flat. And yesterday you had Pharma come under pressure. So the question of leadership is now kicking in.
Well, that's right. The cues that we wake up to this morning ain't great, and crude oil prices as well holding above $95 per barrel mark. That's a macro risk for us, and hopefully, you're hoping for some tweet or some kind of, comment from Trump that he spoke to someone. Till now, that's not happened. Let's hope we're due for that.
No, absolutely. 95, right? I think, or is it 94 still? But I think 95 almost. So let's take it from the top, right, in terms of where we are at with regards to the setup. 96, yeah, there you go. Almost 96, 95.86 on Brent oil. And, yesterday 4%, that is during the Asian session, and another 2% this, from that point to today. So this is not great at all. I mean, actually, net, if you look at from the lows of July, oil prices are up 30%. That is big. The 12th consecutive night of, bombing happened. That is, it's quite, it's been tit for tat, but there was some indication that perhaps it will, it's escalating. And, since this has started, markets have been waiting and watching, well, how does it de-escalate? But the point is, it is still in that escalation phase and not going the other way. And that's the reason why oil prices are up. So just a couple of things, right? Houthis, the Yemen-based group, which is widely seen to be supported by Iran, essentially said that they've hit 2 Saudi oil tankers in the Red Sea. I don't think there's independent confirmation of it. The traffic through the Red Sea is down 80%. That is, Saudi oil going through their pipeline to the port of Yanbu. But then, they've got to navigate through the Red Sea, and then, you've got Yemen and the Houthis right there. So the Houthis essentially said, well, we're blockading Saudi shipment through the Red Sea channel. And it looks like, they've acted. But as I said, we'll have to wait for confirmation. But I think many have said that traffic is already on day one after it's just the threat is enough. You don't have to hit. No one's going to take the risk. And that's the point. Insurance companies are not going to take the risk. That's the point. And which is what we saw with the Strait of Hormuz, and now, of course, with this important waterway as well. Much lesser busy as compared to the Strait of Hormuz, but important enough. President Trump yesterday, and this is, of course, a post which came through, threatened to destroy, and that's the Truth Social post, destroy an Iranian bridge, power plant, each time Iran attacks a ship in the Strait of Hormuz. And of course, after that, you had the Iranian foreign minister saying that, well, it's an eye for an eye, and if civilian infrastructure is hit, we'll escalate even more to attack U.S. bases and countries from which attacks are being launched. So we're still in that phase of escalation and not walking back. There was a Reuters report which said that the U.S. is probing possible Russian role in how Iran has been able to strike CIA strikes. Have locations been provided, and so far it's just been U.S. as the principal actor. None of the other big powers have been involved in that sense, at least not overtly. But this is, in that sense, an important data point. So there's 2 legs to this, right? One is, of course, oil, and oil is not looking all that great. So that's the macro screen. And then, of course, you got the U.S. markets, which corrected sharply, bounced the day before yesterday. So small down. Nasdaq was down about 0.57%. And there we got earnings which are coming through. So Google posted numbers. During the regular session, Google was down just about 1%. But post in the after session, it's down 3.5%. Numbers are a beat. Search, YouTube, cloud, all have beaten expectations. In the call, they've increased the capital spending forecast, which perhaps is what the market doesn't like. We'll talk more about this. ServiceNow also posted results, and analysts are calling the numbers that they're pretty steady. in that sense. Software stocks, I just did a quick check, and they've been coming off in the US. So Accenture, Cognizant were not down much, but stocks like Globant and EPAM were down much more, 3-4% last night. Tesla also missed profit expectations. The stock was down about 3% yesterday. So that's a bunch of earnings in the US. But I mean, you got a bunch of earnings here in India, and it's been, as I said yesterday, extremely earnings heavy. Lots of big reactions, actually many big reactions. The top Nifty gainer yesterday was an earnings reaction, which is Bajaj Auto. The biggest casualty yesterday was an earnings reaction, which is Bandhan Bank, and so on and so forth. So today I see it no different. You got the indices numbers, you got many others which have reported post-close, which we will discuss in a bit. The market structure naturally has weakened over the last many sessions. We are now making lower highs and lower lows, which is not great news. It's possible that, we were tracking an upward sloping channel, but now it's a, because we're making lower highs and lower lows, it's a downward sloping channel. And we'll see if we, slip straight through to 23,800, which is the first support. Or there is a bit of a bounce and then that gets sold into. On the upside, 24,200 is the upper end, is basically the lower low. It also meets the point on the downward sloping channel. So those are levels that we are working with this morning. GIFT Nifty gives you a sense of how we start. It's another 100 points lower. So I think, if you get that, you're in the vicinity of the 23,800 kind of zone, which has acted as a support from which the markets bounced previously as well. Nigel is walked across to the wall with the F&O positioning. The cues, Nigel, take it away.
Well, risk off, it seems, in today's trading session yet again. And the bears will be looking at making it 4 in 4 down days this week. Brent crude prices remain elevated, and that's what's going to be backing them to make it 4 out of 4. And for the starters, as you mentioned, we're likely to start with a cut of around 120 points or thereabouts. Remember, despite the good response to the FCNRB deposits, the rupee has remained at the lower end of the range because of the macro risk that's coming about, owing to the crude oil price spike that we have seen. For yesterday's trading session, it did manage to claw its way back below that 96-odd mark. But with crude oil prices remain elevated, that's going to be a bit of a issue. Yesterday it ended at around 96.5, and today, in all probability, you'll have the rupee weaken yet again, moving closer to around that 97-odd mark, which is very discomforting. The dollar index, that's holding at around 101-odd, but that's been more or less stable over the last few days. Institutions yesterday didn't support. You had both a little bit of selling from the FIs as well as the DIs, and put it together, close to 1,200 crores of selling is what we saw from the institutions. The FIs, they went ahead and they did what they do best. They went ahead, they added shorts yet again, and a large amount of shorts in a single trading session. 24,000 contracts were added on the short side. The short positioning is holding at around 92% or thereabouts. So a good amount of shorter addition that we saw. Sometimes you want shorts in the system and hope for that there is going to be some kind of de-escalation. So that wish has been granted. Now we'll have to wait for some kind of good news, because these shorts, they're a large amount in just a single trading session. On stock futures as well, no different. 20,000 contracts were added on the short side out there. And basically, the FI setup yesterday in the F&O market was fairly defensive, because they added shorts. They wrote close to 2 lakh contracts on the call side. That was in the ratio of close to around 2 calls for every 1 put. So defensive positioning is what we saw in yesterday's trade. And the PCR, a couple of trading sessions ago, it was at around 1.1. Now, because of the call writing that's come about, we're seeing that the PCR come down to around 0.84. In terms of an overstretched level, normally when it goes to around 0.65 to around 0.67, that's when we see a bit of a bounce. So it's got some distance to go, actually, before we go to that mark. And in trade yesterday, the call writers, they were very active. Just take a look at that. The same strike, but their open interest built up on the 24,000 call is close to around 40 lakh shares more than what we saw at the same strike, that is at the put side as well. So that's telling you the kind of aggression we're seeing on the call side. And the premium on both those two in the vicinity of around 150 to around 160 rupees. Which brings us to the levels. Now, in terms of resistance mark that you're looking at, going by the options data, going by from where we have done a bit of a U-turn, that's the important mark, on the upside. But for the time being, the bulls will have their eyes on the lower end of the range, because the 50 DMA comes in at around 23,834. And in the past, we've gone ahead and we've seen some kind of a bounce. This is around 23,800 or thereabouts. Going to the Nifty Bank, well, the earlier supports now becomes a resistance. So you'll have that 20 as well as 200 DMA that are important in the near term. This will be the resistance zone that you're looking at. So a bit of a risk-off day is what we're looking at, for the bulls. The bears will be eyeing to make it 4 out of 4. 3 sessions lower this week, and in all probability today will be a bit of a challenge, unless be some kind of de-escalation comments from the global markets. So let's see how that goes.
Well, risk off for the Indian markets perhaps, but it's pretty much risk on for the Asian markets as well. Look at the Korean markets rebounding. That's up close to about 2.5%. The Taiwanese market is a gain of 1%. Hang Seng is inching up. You've got the Japanese markets building on the gains that we had over the last 2 days. So this week, the Nikkei has added close to about 3.5%. So it's green across the screen. But for our own markets, it's also the Sensex weekly options expiry. So generally, option writers will dominate the action. It's also a major earnings day. So amongst the Nifty names, it's Infosys, Cipla, Interglobe Aviation, but lots of F&O numbers as well. So Motilal Oswal Financial Services, Vishal Mega Mart, Emphasis, Sona BLW, IEX. The most important will be Infosys and whether there is any change in their organic revenue guidance for FY27. But let me tell you the interactions that we have for you on our show today. So 8:35, we've got the management of CSB Bank to discuss the Q1 numbers. It's a slate of earnings on the show today. 9 a.m. the management of Arvind Fashion will join in. 9:20 we get our market master in, Manishi Ray Chaudhary of Emma Capital. At 9:30 the management of Indo Mim, whose issue opens for subscription today. Following that, the management of JSW Energy will chat with us at 9:40 on the Q1 numbers, the outlook. 9:50 we'll tell you what to expect from the capital goods sector in Q1. And we'll take the discussion forward with PL Capital's Amit Anbani. Towards the end of the show, another earnings conversation. This time we get to the management of IndusInd Bank. Stay tuned for that.
Let's take a quick break, but we've got a lot of stock-specific action to track today. We get to that in just a bit. For the time being, I'll run you through the list. IndusInd Bank, Schaeffler India, Oracle Financial, IFL Finance, NTPC Green. They'll all be reacting to positive news flow. Add to the list, HEG and Sona Comstar. On the flip side, Dr. Reddy's, United Spirits, and HPCL will be reacting to negative news flow overnight. Take that break, come back. We'll tell you about all these individual stocks on the other side.
Welcome back. It's an earnings heavy day, so straight away let's get to it. The stocks you need to have on your radar this Thursday morning. Our team is joining in for CNBC TV 18's list of top stocks for the day. Iqbal, let me begin with you. What did you learn from the Dr. Reddy's conference call?
Well, yes, Dr. Reddy's, came out post after market hours, and it was a weak performance this time. The revenue was down around 6% The margins came in at 12.5%. The street was anticipating around 16% and the profit was down around 69% on a year-on-year basis. Remember, there was a 240 crore semaglutide API provision which hit the numbers. The adjusted margins came in at around 15.4%. The key culprit, North America, was down 35% on a year-on-year basis. In fact, it came in below what they did pre-Revlimid generic, so that was a bit of a concern according to analysts. India, however, did well. It was up around 17% year-on-year. So the key culprit this time was the North America business, which underperformed as compared to what the street was anticipating. The company says US-based business is up in double digits. They're looking to resume the semaglutide supplies by November in Canada, so that should be a positive. They're guiding for double-digit growth or a pickup in the second half with 20% margins. And hence that commentary should possibly assuage a little bit of concerns, but overall you can expect the stock to be weak today. They also said with regards to the tariffs, it's not a practical move to move manufacturing to the US with regards to Trump tariffs, and right now it's a tweet, so let's see how things pan out.
Okay, all right. Ekta, thanks very much for that. Well, that is DRL for you. IndusInd Bank reported numbers. It's a bit of a it's been a bit of a turnaround candidate for a while, but the first quarter numbers were not bad. Ananya has got details here. Ananya, morning. Ananya, can you hear me?
Yeah, I can. Yeah.
Go on, IndusInd Bank, please.
Yeah. So it was better than expected quarter. Obviously, it was a recovery quarter, and it was a comfortable beat around like all the expectations. Now, here NII, if you see, was broadly stable, while lower operating costs supported an 8% rise in PPOP and a 72% jump in PAT despite a higher tax provision. Now, here advances returned to sequential growth and deposits also improved, although the decline in CASA remains a key monitorable here. Now, here asset quality was the key positive with lower slippages, easing MFI stress, improving GNPA to 3.25% and a sharp fall in provisions and credit cost. Reported NIM improved to 3.57%, though the underlying margin was softer after adjusting for the tax refund benefit. Now, here management maintained its 1% exit ROA guidance. Expect some margin pressure in Q2, followed by recovery in the second half, and sees retail and MSME as the key growth drivers. So overall, it was a very good quarter for IndusInd Bank.
Thank you very much for that. Mangalam is now joining in to tell us how United Spirits numbers looked.
Well, for United Spirits, the revenues were mildly ahead of expectations, but I'm going with a slight red on the stock, largely because the EBITDA and net profit were shy of expectations. So if you look at the revenue, it's grown by about 6.5%. The street was working with a number of 5% revenue growth, 2,700 crores versus a poll of 2,662 crores. The EBITDA has grown by just 2.5%. Here, the expectations were there of over a 4% growth, and the margins as a result of which have contracted. But that largely is on account of increased ad spends. In fact, the gross margins have increased by about 200 basis points, which is a positive. So let's see how that goes. The net profit is lower year on year, largely because of an exceptional loss of 81 crores. The important part, however, the stock ended at the high point of trade yesterday, and the street was expecting a good set of numbers. These aren't the best set. Just keep an eye out on two things, though. Any decline in the stock would be bought on account of two things. One, the conference call is at 4 p.m. today, and we're awaiting volume details. And secondly, the triggers of the RCB deal payout along with the UK-India FTA are still to play out. So maybe a mild dip is what I'm going with.
Okay, got it. All right. Thanks a lot for that, Mangalam. Well, let's go across to Sudarshan. He's here to tell us about HPCL as well as Schaeffler. Morning, sir.
Morning, Nigel. So first talk about HPCL. It was a forgettable quarter for entire OMC basket, all the three names, SPCL, BPCL and IOC. And more than the earnings, what's the important cues for these OMCs are how the crude behaves. So as of now, crude remains elevated, sharply higher from the recent close, almost 30 to 40%. But just talk about the earnings, it has reported losses both on the bottom line and also on the EBITDA front. So reports loss of more than rupees 11,000 crore, but good party, it's lower than expectations. Revenue revenue growth though remains healthy. It has grown by more than 23% on a sequential basis. On EBITDA front, it has reported EBITDA loss of 15,500 crore versus EBITDA of rupees 9,400 crore sequentially. One positive part is gross refining margin. It has risen to $23.80 per barrel, and it's 2% higher than expectations. But because of crude remains elevated, I'm going with green for HPCL. Schaeffler India, double-digit growth continues for all the segments that company operates in, and overall revenue has increased by 18%, EBITDA has jumped by 16%, and margin too continues to hold the levels above 18%. So I'm going with green.
Thank you very much for that. For Oracle Financial Services, it's a very strong quarter, super strong actually. Revenue growth up 51% quarter on quarter, year on year, it's a revenue growth of 68%. But the beauty in the numbers are the margins. EBITDA margins have hit 60%, and these are easily the highest margins that I've seen at least in the last 7 or 8 years. For a very long time, margins for Oracle Financial Services were between 40 to 50%. But that's a product company. As operating leverage, as revenues surge, you get that kicker in the margins. And this comes at a time when many of the services companies are struggling to protect their margins. You remember Wipro, there was a big margin decline. So very strong margins coming in, and even the company going on to say the backlog is also higher in double digits. There is a change in management. The current CEO will be stepping down, and the CFO of the company, Mr. Avadut Ketkar, will be the new MD and CEO of the company. The stock yesterday was down 6.7%, though on a year-to-date basis, the stock is up 40%. It's been a rank outperformer, and this quarter, numbers are very strong on revenues and on margins. So that's the stock to watch today.
Okay, got that. We'll keep an eye out on that particular name. Let's hop across to Ananya. She's here to tell us about IIFL Finance. Ananya?
So it was a good quarter for them. If you look at the AUM grew 38%, healthy growth, mainly driven by the gold loan segment, which remain the key growth engine here. Now, core operating performance, if you look, was robust with healthy growth in the NII and operating profit, while net profit more than doubled, aided by stronger margins and sharply lower provisions and credit cost. Now, asset quality remained healthy despite a marginal seasonal uptick in NPAs, while return ratios improved meaningfully. Now, housing finance witnessed a seasonally weak first quarter, although disbursement remained strong, and management expects growth to pick up from Q2 onwards, while the microfinance business continued to stabilize here. Now, your management reiterated its FY27 guidance of around 25% AUM growth, ROA of in the range of 3.1 to 3.3%, and credit cost of around 1.5 to 1.7%. Although the key monitorables will be the housing finance business and the concentration in the gold loan segment.
Got it. Okay, all right. Thanks a lot for that, Ananya. Well, let's hop across to Vivek. He's here to tell us about NTPC Green. Vivek?
Well, that's right. So NTPC Green, a healthy quarter driven by good capacity addition, almost 595 megawatt of capacity addition. On the back of that, you saw revenues jump up over 62% on a year-on-year basis, and correspondingly, EBITDA too grew over 63%. Margins on a year-on-year basis, down 60 basis points, but still very strong at over the 89% mark. When you're talking about the net profitability, higher by another 38% on a year-on-year basis. In terms of the total capacity, on account of the 595 megawatt addition, total capacity now stands at almost 10.7 gigawatt, quite healthy, and the company says that they have an additional 3,424 megawatt worth of projects in the pipeline. Now, along with that, the company says that in the future, 30 gigawatt plus of portfolio is in the pipeline, both in solar as well as wind. And in the quarter gone by, ONGC NTPC Green Energy, which is a JV between ONGC as well as NTPC Green, acquired Diana Renewable Power, with a capacity of almost 4.1 gigawatt, thereby aiding and adding to the operational capacity of NTPC Green. A healthy quarter for the company.
Okay, all right. Thanks a lot for that, Vivek. Well, let's keep an eye on HEG. They delivered actually a good performance. So the revenue from operations, that popped up at close to around 11%. And on a sequential basis as well, there was a good pop-up of close to around 13%, which is good. We'll have to wait by to hear what's the commentary with regard to realization, if in case there was any kind of realization pop that we saw. But that top line growth is indicating probably realizations could have improved a little bit. And as the street is expecting in the latter part of this year, we'll see further improvement in terms of realizations. The EBITDA number, calculated one, is up close to around 40%. That means that the margins have come in at around 22.1% or thereabouts. However, remember, they have that stake that they have in Graftech. And because of that, there is normally a notional loss or profit. So X of that, the EBITDA number actually looks even better, because there's a notional loss this time around, M2M loss. So that's why, in fact, the EBITDA number is much better. The margins are a tad bit better, around 23.5%. Net profit number as well, up close to 20%. We'll try to get in the management in the next couple of hours on the channel and get further clarity with regard to the utilization levels, what about realizations, and what's the trajectory from here on. So we'll get a sense on that. For the time being, I'm going with green on this one. Let's hop across to Sudarshan. He's here to tell us about Sona Comstar. Sir?
So Sona BLW has announced JV with Japanese company Denso, and it's for electric and hybrid powertrain system. They have formed two joint ventures. First one is for four-wheeler, more than four-wheeler applications, and second one is two-wheeler and three-wheeler applications. So first talk about four-wheeler, it's for electric and hybrid passenger vehicles, commercial vehicles, and other high voltage applications. In this JV, Denso will hold 51% and Sona 49%, and management control will be with Denso. Second one is for two-wheeler and three-wheelers. It's and company in this JV, Sona Comstar, will transfer its existing electric traction motor and controller business to the JV, and Denso will acquire 49% stake in this JV for rupees 1,750 crore. What's the impact of this JV's announcement? So in four-wheeler plus, Sona gets access to one of the most important segments of EV powertrain, and for two-wheelers and three-wheelers EV traction motor business, some of the opportunities unlocked is access to Japanese companies like Motor, Honda and all this. Otherwise, these orders would have been very difficult for Sona to get if it would have been a standalone business. So in this JV, it would become easier. I'm going with green, but do remember this stock is up more than 50% in 2026.
Thank you very much for that. A quick recap then. Stocks with positive news flow are IndusInd Bank, Shriram India, Oracle Financial Services, IIFL Finance, NTPC Green, HEG, Sona BLW. Stocks with negative news flow are Dr. Reddy's, United Spirits and HPCL. But that's equities. Let's talk commodities. And it's all going up, 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 whether it's crude prices, precious metals, aluminium, copper. Manisha, what's happening in your world?
Oh, well, absolutely. As you said, it's strong gains continuing in case of across commodities here. But I'll start with the crude oil prices because we're looking at a new 6-week highs onto this one. We are now trading above 96 to a barrel. And with those gains, we are up 14% on a week-on-week basis. And with that, when you look at the month of July, it's up nearly 31% for the crude oil prices. Well, gasoline prices are trading at a 2-month high, heating oil at a 16-week high. So everything that has to do with crude and crude products is doing quite positive right now. With the Iran-backed Houthi militants now attacking 2 Saudi oil tankers in Red Sea, it is more than Strait of Hormuz. Now you're looking at other waterways as well. There also are some concerns at Panama Canal where they are cutting the ships that can pass through the strait. That also seems to be adding to the prices here. And with the U.S.-Iran escalation entering day 13, you are looking at higher highs continuing in case of crude oil prices. But well, absolutely, as you put it, gold, silver are trading at a new 2-week highs. You have aluminum trading at a 2-week highs as well. Copper is trading at a 1-month high. Markets are looking at zinc, steel. All of these commodities actually trading at a multi-week to multi-month highs. The street is also looking at a 70% probability now of a rate cut in the month of September, and that seems to be adding to the prices.
Okay, all right. Well, everything is up, and oil prices also at the margin pushing things higher. I mean, the costs go up, and prices for a lot of these things also higher. I mean, actually, I was mentioning earlier that Brent oil prices are up 30% from the July lows. It's not 30, it's almost 40%. I mean, I checked, the low was about $70 on Brent. That was on the 2nd of July, and we're at 96. So that's a massive move, near 40 coming in very, very quickly. We'll take a quick commercial break here. We'll come back. Deepan Mehta will be with us, and we'll ask him about some of these earnings we've been discussing. We'll also have the management of CSB Bank, which sold off sharply after first quarter earnings. Stay tuned, coming up.
Welcome back. Hope you're having a good morning. Well, to help us out with some stock-specific, analysis, we're now joined by Deepan Mehta, who joins us on the show. Hi, Deepan. Good morning. Hope you're having a good one. Looks like a bit of a tricky one for our markets, given that Brent crude prices have spiked up. Let's talk about a couple of earnings reactions. Then, Eternal actually was the one that came late with its numbers, towards the close of market. Initially, the stock sold off, but then the fine print didn't look so bad. In fact, to some, it looked quite positive going by the growth that they saw, though margins were a little bit, lower than expected. Your view on the stock at around this 280, 290 rupees?
I think, Nigel, first of all, good morning and thank you for having me on your show. It's a company in which we have invested, so have our clients as a measure of disclosure. But, these are long-term stories and you will have these aberrations quarter by quarter. Also, the business has become quite complicated with quick commerce as well as with the food delivery business, and then they have other allied businesses as well. So rather than looking at this company on a quarterly basis, I think it's better to just let the management have the kind of comfort to run it on a longer term basis, because there are huge consumption shifts happening, which is clearly benefiting Eternal. And also the competition keeps coming, going. That was another challenge. But on the whole, I think I would remain invested in the company and maybe at corrections also look at adding the stock. But this is truly a nice long-term story. It's a perfect play on consumption. And rather than buying the FMCG stock, I would prefer to buy something like an Eternal, which is gaining market share in terms of their pricing power, and also market share in terms of the actually what the services they're offering.
Deepan, hi, good morning. The other one is indices this morning, right? Numbers are all great, an all-round beat across the board. But the point is, the stock's done well from the lows. Valuations are not cheap. And, every time indices comes up, you can either play the turnaround or you can play, stocks, the bigger ones, well settled, doing well, which are already, those are not turnarounds. Those are steady performers, like ICICI Bank, for example. I mean, some would even say HDFC Bank. HDFC Bank perhaps is a turnaround candidate at some point. What's your sense?
Oh, I think IndusInd Bank has done so much of damage to investor sentiment with continuous one after another over the years. Some problem or the other with NPA or with some other accounting issue or something or the other. That I think, and considering that you have so much of choice in the banking industry, from my point of view, we have avoided IndusInd Bank. At some point of time, we were investing in a company for many years, but the returns were highly substandard because something or the other would keep going wrong. So from an investor's perspective, I would avoid IndusInd Bank. Eventually, I would give it a lower valuation than even than HDFC Bank or ICICI Bank or Axis Bank for that matter. And from time to time, it does get cheap. There's no doubt about it, but that's simply a value trap. And I think that it's best avoidable. Then the banking industry, they have a lot of choice. I think the PSU banks, the mid-cap, small-cap PSU banks, they have delivered exceptionally good results. And to an extent, I think the results are better than private sector banks also. So I prefer those companies. And then, of course, there is the multi-product NBFC, where I think they're again gaining a lot of market share at the expense of banks because of their flexibility. So you have to play the entire lending business highly selective.
Yeah. No, although I must say that with IndusInd, there is top management change, basically, right? I mean, corporate banking is about the people who run the business, who give out the loans. So Rajiv Anand is now, of course, heading, and a fair bit of cleanup has happened, but it'll take time. Q1 has been good, but as you say, perhaps there is a lot of choice, no doubt about it. Look at what's happened with names like Bandhan, etc. I mean, that was the other one, right? New management at the helm. Maybe, that, as they say, turnarounds rarely turn, but maybe a bit unfair also to make that generalization. It's just the timeline seemed to be stretching out from what one assumed earlier. Any thoughts here?
Prashant, banking industry is not as easy as it was maybe 5 years, 10 years ago or so, where every bank, could go and get that 25% top line net interest income growth. Net interest margins were healthy. NPAs were getting covered by strong pre-provisioning profits. That's not the case just now. It's a complete red ocean. It's highly competitive. So if a bank tries to grow too fast, then it is compromising on the quality of its assets. And if it becomes too conservative, then the growth comes to single digit or so. So unless you have a very strong USP, a very strong position, could be geographical, could be in specific products, I think it's going to be very difficult. And from time to time, you will have such, I would say minor disasters within the banking industry. And Bandhan Bank is just one of them, where they now say that because of the competitive intensity, I think that's the underlying reason they have to reduce their return on assets. So we have to be very careful in this industry. And either you go with the bluest, the blue chip, the SBI, the HDFC Bank, or ICICI, or then you diversify into smaller banks. Our preference will be for banks like AU Small Finance Bank, IDFC First Bank. But those also have had their own set of challenges. So as I said, I think the best way to play is to be highly selective and look at the NBFCs, I think, where I think there's better scope for growth.
In moments from now, Dipan, we'll get chatting with the management of CSB Bank, so you'd want to stay tuned in for that as well. But any thoughts on Oracle Financial Services? Now, this is a company which doesn't do conference calls, so there's scant details available. We only get the quarterly revenue numbers, margin numbers, but very, very strong this time, and EBITDA margins hitting 60%. What are your thoughts on OFSS?
No, I think it's a great story, and it's got a clearly highly differentiated business model. And these numbers come through because whenever they sell licenses, that have got very high operating profit margins. And then these licenses also get tertiary revenues, which kind of grows the business from time to time. But, last 2-3 quarters have been exceptionally good because license sales have been very strong. But you should be prepared for a quarter or two where license sales also may dip. But on the whole, on a longer term basis, I think Oracle Financial has a much better sort of opportunity to grow and deliver better returns than some of the large cap IT services companies or a few mid cap IT services companies as well. So I would prefer that within the software industry, if you have to be selective and you have to be invested, then certainly Oracle is one of the companies you could consider.
Dipan, what about MedPlus? Yesterday the stock got absolutely pummeled, but it came off the lows a little bit. And I was just reading a couple of notes. Post market hours, in the con call, the management says that they're pulling back on that capex guidance. What the street didn't like was that the numbers were disappointing. And what they didn't like was diversification, putting some money in an unrelated business. And that's why the stock pulled back. Now they're pulled back on that capex. Do you have a view on the stock?
No, what I didn't like was that the gross margins have come down. And in a stable business, in a trading business like this, why should the gross margins contract? So, that's very surprising. I'm sure there was an answer for that. I may have missed it. But on the whole, I think that it was a company which I was looking at quite positively till we got this quarter's number. And that was very disappointing. And that kind of, wants you to reassess the entire business model and the growth prospects and the growth dynamics of the company. So I would just wait and watch MedPlus for some more time, really understand what is the way forward for the company. Because at the end of the day, I think scale is coming into play and base effect is coming into play. So it becomes more and more difficult to have higher growth when you've already covered so much of territory. So I would just wait and watch and keep it on the sidelines for the time being.
Okay, Nigel, I didn't see that. You're saying that they're saying they won't spend 100 crores.
There was a con call at 4 p.m. yesterday. In the con call, I can't see it on the exchange, with regard to a comment, particularly on this capex. But I've confirmed that, a couple of notes that have come in early this morning, they have pulled back on that capex because the street was unhappy about it. So the private labels, obviously, that was lower. The margins were lower.
We don't know exactly how much they're scaling back.
I think
completely cancelled.
They've cancelled it.
Yeah, so I'm reading the Nomura note, the capex plan that was approved by the board yesterday for investment in food park and the oil extraction unit, 40 crore, and the concierge health wellness service, that's 90 crore, has been put on hold due to negative reaction from the investors.
Okay, I think let's put this information out. We'll have this up at the bottom of the screen in terms of flashes. So this is material and this is important as well. By the way, the management joined us pre-market, I think at about 8:30, around this time yesterday, when they actually laid out all that. Basically a miss on numbers, but we basically focused on this capex and where this is going. And that is essentially what the market is not liked. And the company reacting to it, put on hold. As I said, we'll put some of this up in just. But maybe, why don't we try and reach out to the MedPlus management as well for a quick, interview, so that we're able to clarify some of this stuff.
And even on margins, what the Nomura note says that I think the management told us this. They have adjusted their discount structure. So effective 7th of July, the company has reduced the discount rate to 19% from 20% for sales over 1,000 for non-UPI payments. This should aid margin improvement. The management has stated that it should be able to meet or exceed its target of achieving 440 crore of operating EBITDA in FY27. So allaying some concerns, even on the gross margin decline.
Okay, we will try and put the MedPlus management on once again to understand what they've done. We will take a break. We are back. Deepan is with us, CSB Bank Management, after first quarter numbers also on the other side.
Welcome back. As promised, let's get straight to the management of CSB. Yesterday, the stock, in fact, reacted negatively to its numbers. There could probably be a couple of one-offs. Well, let's welcome on the show Mr. Mondal, the MD and CEO at CSB Bank. Hi, Mr. Mondal. Good morning. Good to see you. Ben, couple of quick factors. NIMs, they contracted on a sequential basis, and the street was a little bit disappointed on that. And the credit cost perked up as well. What's the trajectory on both these two?
Good morning, Nigel, and good morning to our viewers. Yes, on sequentially, we had a slight drop in NIM, but on a year-on-year basis, we have done well, both on growth as well as NIM, as well as on credit cost. So we are a slightly seasonal kind of, if you look at our Q1, Q2, Q3, Q4, every year this happens. And that way, it's not too much of a surprise. We generally look at a YOY as a number, but specifically for this quarter, there are two reasons for the NIM contraction a little bit on a quarter-on-quarter basis. One is some of the deposits we took in end of March. We didn't get those costs in March, but they flowed through to the next quarter, which was Q1. And also, we had slight slippages in this quarter compared to last year. We had a lot of upgrades and recovery, so which was significantly low, and especially low in last quarter in credit cost and slippages. But this quarter was a little more normalized, and that also got linked to the NIM. So I think these are the two reasons. However, we are pretty confident that our overall guidance on the 3.75 for the whole year is intact, and probably we'll be able to see it getting better next quarter itself. Okay. On the asset quality, yes, there had slightly elevated slippages compared to, again, quarter on quarter. But when you look at year on year, this was lesser than what it was Q1 last year. Even Q2, Q3 were slightly higher than this. So to that extent, not a challenge. And we know 2-3 accounts we slipped will get kind of regularized or upgraded next quarter or next to next quarter. So not too worried on that front.
Okay. Got that. Sir, just another issue which is plaguing the markets, and then we'll get back to the numbers. Fairfax is the promoter of CSB Bank. They have about a 40% stake. But reports suggest that Fairfax has also emerged as the front runner to acquire an IDBI stake. And according to the RBI rules, if you're one promoter, you've got to have your stake only in one company, one financial services. So have you had any communication from Fairfax to the board about a potential exit, an intended timeline and the route?
Good morning, Rima. No, we didn't have any conversation either with Fairfax or with the board. And I'm not aware of Fairfax having any conversation because yesterday itself we were at the board meeting and there were representations from Fairfax. We didn't even have a conversation there. Whatever I'm hearing from the media. So I think it's a conversation with Fairfax, not with CSB. With us, the communication consistently has been over the last year and a half, as long when this kind of a buzz is going around, is we focus on our job, we focus on BAU for us, and that's how the tech transformation happened, which was slightly different to some of these banks because our core system is different. So to that extent, I think we have been told to charter our own path, so we are working on that. Eventually, if the hypothesis 1 and 2 happens, then we'll see how it plays out. But right now, no conversation.
Nothing at all. Pralay, hi, morning. Just a quick word on just to go back to the credit. I remember starting the last quarter conversation because credit costs were looking pretty well behaved, and that is Q4, right? So just want to understand what has happened. How did it flip from where we were Q4 to what's happened in Q1?
So Prashant, we must understand that we have a strong balance sheet. So 1 or 2 accounts here and there can create both sides, but so we try to keep it normalized for the full year. But quarter on quarter is always a challenge, especially on credit costs, because 1, 2 accounts slipping in and 1, 2 accounts upgraded. That's what happened last quarter. So suddenly it looked very good. And I never claimed that we have that kind of a credit cost is also normalized credit cost. I've always guided that our credit cost will be below 50 basis points, gross NPA below 2, gross NPA below 1, net NPA below 1. We are well below those margins at this point of time. And on a whole year basis, I don't see how we'll have any challenge in the credit cost compared to last year. 1 quarter here on a smaller balance sheet, 1 or 2 accounts, it can always happen.
On yields and cost of funds, what's the guidance?
Cost of funds, again, I think if you look at the yields, we are slightly better than Q1 last year. And as we go ahead, I think the guidance is very clear that if our NIM has to come back to 3.75 and above, which is our guidance, and we are pretty confident about it, then cost of funds has to come down. But yields, I think, will remain kind of a similar kind of a yield. Maybe it can come down a few basis points here and there because the business mix is changing. But overall, as long as we are able to protect our NIM around 3.75 level, and as long as our cost of funds, we can keep bringing it down, I think we are comfortable.
All right, Mr. Mondal, what about the FCNRB deposits? What are you all factoring in?
So FCNRB, see, again...
we have a large NRI base, I think, so.
We have a base, I mean, not as large as some of the other Kerala-based banks. But, FCNRB leverage is something for which you need gift city arrangements, you need to have interbank arrangements with banks, foreign banks, or Middle East banks and things like that. We are working on that. We have got some limits set up, so we are working on this. But am I depending too much on leverage deals? No. So, but on a one-on-one basis, we are doing well so far on the FCNRB based on our appetite.
Okay. Sir, on gold loans, it's about 54% of your overall book right now. As a part of your 2030 guidance and strategy, you want to get it down to 20%. With gold loan book going so fast, do you see that as a possibility, say by end of FY27? What's the glide path from 50% plus to get it down to 20%? Gold loans as a percentage of your portfolio.
So, Rima, good morning again. I think I had given a guidance of 25 to 30 in the last few meetings, because we are seeing that gold loan opportunities are getting bigger in India, and it's not just the smaller ticket sizes. There are very large ticket sizes which are coming in gold loan. That's why we are launching products which are more targeted towards SMEs and income generating kind of assets. So to that extent, we have given our guidance that we will be doing around 30% of our gold loan by as a portfolio mix by 2030. The glide path, we are very committed to that, going from 50 to 30. And as the wholesale, SME and retail starts growing, it's not that we have to degrow the gold loan business, but the other growth will ensure that the mix we achieve in that range. So we are firmly on our glide path because this year itself we'll see that as a percentage mix, gold will start coming down because wholesale and some of the other businesses will pick up. And with the technology transformation which you have done, now we will be able to scale the retail and SME a lot more. So we are pretty much committed to that.
Okay, Mr. Mondal, always a pleasure having you on the show. It's going to be interesting to know what Fairfax's plans are, whether or not they want to go ahead and, grab a chunk of IDBI Bank, and what happens after that, because you can have only one banking license. So do they merge the two, if in case they're interested? Or will they look to pair stake in the smaller one, which in this case will be CSB Bank? Interesting times. Thanks for giving us the operational details. We'll keep a closer track in terms of what is the promoter likely to do after this. Have a good day ahead.
Thank you, Nigel. Thank you. Thank you.
Well, time to move across to Hormuz, who joins us to tell us about all the big movers in trade and some of them backed by delivery. Hey, Hormuz, morning.
Morning, Nigel, and plenty of them actually. Result reactions predominantly, and broader market names dominated the most traded stocks yesterday on the Nifty 500. Data patterns, and if you take a look at the revenues, at the turnovers as well, data patterns for Bandhan Bank, all of them significantly higher in comparison to their 20-day average, and that was, of course, because of the price action that they have seen as well. But take a look at data patterns. It was the biggest single day gain since the start of the year for the stock, was up 11%, and over the last two sessions the stock has gained 20%. The stock had snapped a 6-day losing streak on Wednesday when the stock had gone up in the second half. Volumes were the highest since March of 2025. The 70 lakh shares were traded yesterday. The 20-day average is only 6.5 lakh shares. 14% of those were marked for delivery, so close to 10 lakh shares for delivery. The 20-day average here too is just 1.5 lakh, and it was the most traded stock on the Nifty 500 in yesterday's trading session, nearing record highs, and is up over 80% on a year-to-date basis. Of course, Bandhan Bank was the casualty of yesterday's trading session. The biggest single day fall in 6 years for the stock. Fifth straight day of losses. The premiums on the 170 put option saw a significant jump in significant jump yesterday. The volumes also were the highest since March of 2020. 15 crore shares were traded yesterday. The 20-day average is just 1 crore, and a third of those were marked for delivery. So 5.5 crore shares were marked for delivery. The 20-day average is only 45 lakh shares, and second most traded stock on the Nifty 500 yesterday, now down over 20% from its 52-week high. Incidentally, before yesterday's trading session, the stock was up well over 45% for the year. And lastly, a stock that did well was Bajaj Auto, the top Nifty gainer yesterday, outperformed in a very weak market. The biggest single day gain since October of 2023 for the stock, gained in fire the last 6 sessions. The 11,000 call option was the most traded yesterday. The premiums went up over 400% as well. Volumes were the highest in over 2 months. 14.5 lakh shares traded, 3x its 20-day average, and nearly 40% of those were marked for delivery as well. So 5.5 lakh shares for delivery. The 20-day average is 2.5 lakh shares, and the stock is at a 52-week high as well.
Well, biggest gainer yesterday, Hormuz. Thanks very much for that. 6%, by the way, on the Nifty as far as Bajaj is concerned. I mean, what a performer. Actually, autos are having a field day. There is Bajaj, there is TVS, which has done phenomenally well. In auto angs, Nimesh put it out in his D Street chatter, Sona Comstar and the Denso joint venture, which of course now has come through post-market hours. There's enough and more which has been happening there. I don't know if you have a view on any of these, a strong view rather, Deepan. So come in there. But I want to also ask you about SBI Funds, which is now, after yesterday's, yesterday was day 2 post-listing. It's about 10 rupees away from its IPO price of 574. So yeah, autos, if you have any thoughts on this one.
Yeah, Prashant, I think autos continue to surprise. I really wonder how long such growth rates can last, because end of the day, it's a bit of a mature industry as well. But for the time being, I think numbers have surprised us. And especially, I was very impressed with TVS Motors. TVS Motors is gradually expanding the contribution from exports and from EVs. And I think that's becoming a new growth engine. And one advantage which TVS has over the other auto companies is its subsidiary company, which is into lending, and that business also scaling up really well. So although it is expensive, I think TVS Motors for the last 5-10 years has outperformed on all parameters versus its peer group. So that is one company which is our preference. Again, disclosure over there. And the second thing you were asking about was, I lost the question. It was about?
SBI Funds, Deepan.
SBI Funds, yeah.
Back to basically, yeah.
Yeah. So I think SBI funds is a good steady investment opportunity. But look, there are so many AMCs already listed. Again, it's a highly competitive industry. And if you want to play the financialization of savings investment theme, we have to go for stories where the competition is less or where there's monopoly situation. So prefer the exchanges. Of course, we have NSE also will get listed soon. Prefer some of the R&T agents and registrar companies like, we have Carby and we have CAMS. So those also, I think, can provide steady growth. And then you have the wealth managers, where I think that because of the wealth effect and because of flexibility of the business, I think they should do well. The insurance companies and the AMCs are all the way down in the pyramid because of the competitive intensity and also because of regulation threats. But nonetheless, I think they're steady performers. You will get your returns which are in line with the broad market index.
Deepan, I want to ask you about IT also. Infi reports later today, and we'll ask Rima to put out the preview in terms of street expectations. I think there's some 2% constant currency growth expected, but we'll see. We have to take a quick break here, though, so allow me to do that. We'll also come back with the management of Arvind Fashion on the back of their June quarter numbers and the road forward. We'll have technical trading ideas, Sudarshan and Mitesh with us in just a bit. Stay tuned. Okay, well, MedPlus is in focus, as I was telling you earlier. There is change of plans with regards to the capex which was announced yesterday. Remember, we had the management first here before markets opened yesterday. They announced capital expenditure into a wellness venture, a health center in Hyderabad. The stock was down sharply. After market hours, as we understand it, that plan has been put on hold. Mr. Gangadhi Madhukar Reddy is MD and CEO at MedPlus Health Services. He's with us. Mr. Reddy, thank you very much for joining us on the program. Prashant here. Could you tell us what has been the change?
Obviously, Prashant, while we look at the long-term interests of the company, we also take feedback from the shareholders and all. And the market reaction was not quite what we expected. So we have taken the feedback. We are going back to the board. We have, for temporarily, we put it on hold. but it will only be formalized after we go to the board and we'll discuss it.
You said that yesterday in the morning, you said that you're investing 100 crores to set up a health center in Hyderabad, right? So this is not happening anymore.
So this, as I said, and as I said on the investor call yesterday, we actually have decided to keep it on hold for now, but it has to be formalized by the board. We will be discussing it in the board meeting. And then
will you revisit this, Mr. Reddy? Mr. Reddy, hi, good morning. Nigel on this side. Good to see you, Ben. So you have taken the feedback and for the time being, you put it on hold. But will you revisit this plan at some stage?
I cannot really speak about that right now, Nigel, because, it is obviously a board decision, the strategy part. So we did decide that it is going to be something good for the company's long-term interest and all. But, we will revisit it and then think about it at a later date.
Right. Mr. Reddy, obviously, and let's put out what, Mr. Reddy is saying. We'll have the flashes come up. Mr. Reddy, so obviously there was opposition, right? I mean, you heard from investors and you've been responsive to the feedback that you've gotten since through the course of the day yesterday, I'm assuming?
That's right, yes.
Right. And what exactly was the apprehension? I'm just trying to understand what you heard from investors and what made you take the step.
I don't want to go into that. See, this is always I would say nothing is like 100% this way or that way. There's two sides to almost everything. We took the very strong feedback and decided that we should basically look at it once again, and hence we are revisiting it.
Any other changes that you're making apart from this?
No.
Nothing else.
All right. Mr. Reddy, one final question before we let you go. The stock has pulled back considerably, and yes, you took a harder knock. Your market capitalization is around 8,000 crores. You have cash in books of a good amount, right? What is it?
I think we probably have in the range of around 600 crores.
600 crores, right? Is the probability, because of the kind of carnage I've seen in the stock price, go ahead and maybe do a bit of a buyback? Is that something that you could consider?
No, I don't want to talk about it right now. This is not the forum for it before we have...
We'll wait by for that then, sir. Thanks a lot for joining in, telling us and clarifying. As of now, this plan is on hold right now. You're sitting on a good cash in books. That's close to around 8% of your current market capitalization. We'll wait by to see whether or not there is some kind of buyback or some kind of announcement that comes about to support the investor interest. But we appreciate you speaking to us first on CNBC TV.
Nigel, talking about company promoters doing different things. If you remember, we had, this is about a year and a half ago, maybe 2 years back, Policy Bazaar, PB Fintech announced that they're going to invest in hospitals. Right. And I remember that conversation with Yashish when we had him. He said, well, the investors, but it's as I think Mr. Reddy also, I don't know if Mr. Reddy, you're there. Are you there, sir?
Yeah.
Right.
Yes, I am. Yes.
I mean, I'm just narrating this. This is, I don't know if you know.
I of course know the story. I
remember what he said. Yashish Dahiya was one of the founders of Policy Buzz. He said, well, the early investors have all made money with me, betting on me and what I would be able to create on the insurance marketplace. So now I think this is a great idea. This is a great business. So why wouldn't they back me here? So they took a bet on me. This is what I think will do well, and I think it's got a great opportunity. So yeah, I mean, but as you said, it's not this or that. And anything you want to add there, Mr. Reddy?
The only thing one could basically say about what we wanted to do against it is not exactly pharmacy, right? It is healthcare. It is an adjacency. But yes, strictly speaking, you could say it is a diversion. A long-term thought could be, this is where the entire healthcare is going to go, which is, everyone will become horizontal at some point of time. You want to seed some of these things and, build yourself up so that you are ready for the future. But at this point of time, if you look at it strictly, it will definitely look like it is a digression from your path.
I remember Yeah, I remember, asking you many years ago whether you want to be like the Walgreens of how that operates in the US, right? Thousands and thousands of stores, and I think you answered in the affirmative. You said yes, but this model, as you said, doing everything but without being in hospital, does this model exist outside? Do these companies in the US, for example? I'm not saying you model after them, but you...
No.
Yeah.
We don't necessarily have to just follow the overseas models.
Exactly.
This is where I think the entire industry will head eventually. But the thing is, if you look at CVS has got the key clinics, the minute clinics, I think. CVS also is there in wholesale, distribution, retail, is there in insurance, is there in several other things. And that's what actually makes them a much more stronger company out there. I guess one could also argue that, they did it after their market cap went through the roof, after they've been in business for several years, much longer than MedPlus has. So maybe MedPlus is not quite there, or maybe it is. That's something which we can, is you could argue about. But for now, I think based on the investor, kind of feedback, it is going to be a pause, but we're going to, kind of discuss it in the board meeting and then decide later.
Got that. Appreciate you joining us, Mrs. Reddy, and we wish you all the best of luck. These things happen in the course of a company and the corporate journey. Thank you very much for being here. 3.5% higher this morning. So the reaction is coming through in terms of a bit of a recovery. And by the way, it's not an easy day for the broader market. It's a tough day. So 717 on MedPlus. But I think we have the Arvind.
But I'm just saying it goes to show the pressures of a public market, of a listed companies, right? You want to take long-term strategic bets, but then it gets colored by investors, wanting short-term returns and showing up.
I think, Rima, the important differentiation, I should have said it earlier, with PB and with MedPlus. And maybe MedPlus will do, and we wish them all the best of luck. But PB's made a lot of money over a period of time. So you're sitting on accumulated gains and, goodwill and all of that. And then you're venturing into something new. Whereas MedPlus, since listing, if you look at what it's done, it's not made those kind of gains for shareholders. So you are, in that sense, starting from a position of not weakness, but, you need perhaps, I think, gains in the bag, then you're able to do a lot more.
Yeah.
That's essentially, I think, the point. That's the difference between those two situations.
I remember one more, Map My India, which is the India equivalent of Google Maps. And they wanted to, the son, Rohan Verma, had stepped down because he wanted to start a separate B2C consumer business. And they had announced, I think for a 10%, he'll put in 10 lakhs and get a 10% stake. There were some convertible warrants. And then there was a lot of investor pushback and the company had scaled back. So that's another example of investor activism. But we've got the management of Arvind Fashion now joining in. They reported a mixed set of numbers. Higher depreciation, finance costs hurt the profitability despite a good growth in the company's revenue and EBITDA. We have with us Kulin Lalbhai, Vice Chairman, Non-Executive Director of Arvind Fashion, here with us on the show. Thank you very much for joining in. Let's just begin with the performance on the margin front, Kulin. What can we guide going ahead? Because you are facing higher costs on account of the West Asia crisis. In many states, minimum wages have been mandated. So all that's hurting the company's margins. And then there is general raw material cost inflation. What's the call on margins as the year progresses?
Actually, Q1 has been a very strong start of the year for us. We had an acceleration in growth to 15.5%. And even our EBITDA margins have been up by 45 basis points. So that's very much within the guidance. We've been guiding 40 to 50 basis points operating leverage since we are increasing our marketing investment. So in spite of adding 50 bips of additional marketing, we have almost added 50 bips of operating leverage. So I think this shows the resilience of our business model. And I'm quite confident that in spite of the raw material challenges, looking at the strength of the franchise, we do still believe that the 40-50 basis points guidance that we've given on EBITDA gains every year, we should be able to hold to that.
Okay. So every year, margins will go up by 40 to 50 basis points, and you are reiterating that. Will there be a further increase in marketing spends?
Yes. So for the full year, we are expecting significant investments. We want to double down on growth. We want to ensure that the desirability of our brands goes up. So we had indicated to the market 50 basis points plus kind of additional marketing spend on a pretty large base. So we are approaching 6,000 crores in turnover. So this will definitely be a year where we are looking to further energize the platform and further accelerate all our growth drivers.
What is the spend on marketing? Since you're doubling down on it, how would it compare with what you've spent in the last couple of years? And since it will help you grow, what is the growth that we're looking at year after year? How much will it accelerate by?
No, so if you use a 50 basis points additional indication, I think the marketing budgets will grow by more than 20% this year. On a reasonable base, we spend close to 4% of our turnover on marketing. And so it will slowly move up and go beyond 5% in the years to come.
Okay, got that. And you've been growing in mid-teens. With this kind of a marketing push, can you move towards a high teens kind of a growth, Kulin?
No, so we are looking to kind of look at various growth drivers. I think to the markets we maintain that, around the 15% growth mark is what we believe on a sustainable basis we should be able to achieve with our current growth drivers. Beyond marketing, obviously, we are adding square footage. We're adding 15% net square feet every year on our 1.5 million square feet of real estate. So that's a great growth driver. Our online business is doing exceedingly well. Our consumer-led online grew by 38% this quarter. And our adjacents, which are the new categories like footwear, women's wear, innerwear, and kids wear, grew by 25%. So there are a lot of exciting growth drivers. So we are feeling positive that the momentum on growth should continue.
Thank you. Kulin, out of time. We're just approaching market opening. Thank you very much for that. That's Arvind Fashion, India's branded apparel retailer, home to brands like US Polo, Calvin Klein, Arrow, and many others, Tommy Hilfiger. But we've got our technical experts waiting by, Sudarshan Sukhani, Mitesh Thakkar joining in. Sudarshan, you've been holding the faith. We've been calling for long positions. We get another gap down. Should one buy?
No, not really. What happened was yesterday the Nifty drifted below 24,000, which was our benchmark for exiting long positions. So now we'll just have to wait and see what the markets are wanting to do. This is not a good time to trade in the Nifty, not today.
Your trades, Sudarshan?
Well, I have a long and short mix. Asian Paints is a buy with a stop under 26.35. Hind Liver is a buy with a stop under 21.15. Petronet is a buy with a stop under 295. The reason why I'm buying in spite of avoiding the Nifty is that there may be stocks which are worth buying on dips, and Bandhan Bank is a sell with a stop above 190.
Mitesh, your Nifty call and stock-specific ideas?
Yeah. So on the Nifty, yesterday I said that if we start trading below 24,000, we might go to 23,800. Now that's an important support area. Hoping that it produces some kind of a reversal, but that's still ever to watch. Having said that, on the stock side, I have a mix of buys and sells. On the buying side is a couple of FMCG names like Colgate and Nestle. So Nestle is a buy around 1485, 1480, so about 8-10 points lower from the yesterday's closing. Keep a stop at 1459. Look for a target in vicinity of 1530. Colgate is a buy with a stop below 2080 for a target of 2160. Then a sell on Cochin Shipyard with a stop at 1392 for targets of 1320. And Adani Green is after a long time showing first signs of correction. So that's a sell with a stop at 1497 for targets of 1425.
Okay, all right, Mitesh and Sudarshan, thank you very much. We'll talk again soon. But I think we should just take a quick look at where stocks are opening this morning. I think we'll have that up. IndiceSend is starting about 3% lower. Schaeffler, Oracle are the other names which are also reacting to numbers. These are all, of course, stocks which we've discussed from 8 o'clock in the morning. Schaeffler is 0.25% lower. Oracle is about 4% in the green. IIFL Finance will come up. NTPC Green should come up on your screen. HEG is the next set of names. IIFL is starting about 2% in the green. NTPC Green is about 3%. And HEG is about 2.5% higher. Sona Comstar, which was part of our chatter, confirmed. And Sona is, again, down about 0.25%. All, problem with positive and negative, actually most positive stocks is that the run-ups have been so strong into this. Dr. Reddy's is down 7 There's a very large cut coming through on Dr. Reddy's. United Spirits is the other one, and then I think we should put up HPCL, which I think will give you a quick sense of the OMC basket, about 2.5 lower. But it's a tough morning anyway with oil prices spiking to 96. So, I mean, the immediate stuff which gets sold is oil marketing companies during oil spikes, and of course add to that the numbers, etc. As well. I think we've got many more smaller names, but they're at the bottom of the screen. Tanla Platforms is up 5%, and many others. Satvik Green Energy. So, I mean, that bunch, of course, is rotating, and we'll look at some of those as we get into open. Just a couple of seconds to go. We'll look at the Nifty, then we'll get into broader markets, as we always do. What do we have? The first rates are there, 23,800 and 23,900, by the way. So about 1/3%, 0.4% lower. The Nifty Bank is down about 0.8%, 56,650. You've got the mid-cap index, which is down about 1/3%, and the small-cap index, which also starts. I mean, it's a broader, macro overlay, which is negative. And oil, up to 96, 40% from the lows. It's a serious amount of jump and cannot be ignored beyond a point. 2 days back, we were at, just think about it, 86 or so, and we're about 96 right now. So big jumps. Eternal is the big gainer. Actually, it's the biggest gainer on the Nifty. Tata Consumer, ONGC are some of the other names. There's Nestle, Bajaj Auto, once again, day 2 of gains. And on the other side, you've got Dr. Reddy's, Indigo, SBI, Cipla, Ultratech, which are starting. Like yesterday, it's about 14 lower and about 10 stocks which are higher at this point. Prima.
Well, sectorally, pharma is the biggest drag today. The Nifty Pharma Index is down 0.8%. Actually, it's tied with the oil and gas index as well. So both these indices are inching towards a 1% loss. Interglobe Aviation is weak, other than Dr. Reddy's, which is now trimming its losses, but it's still a fresh 52-week low on Dr. Reddy's today. You've got a Cipla under pressure. In IT names, Infosys starts soft ahead of its numbers later today. Banks have been declining now for the 4th consecutive session, and this week, the Nifty Bank is down nearly 3%. When you add the 400-point cut, or 0.7% decline today, it's SBI, Axis Bank, HDFC Bank. Reliance Industries is another heavyweight under pressure. On the way up, it's Eternal, which is going strong. Brokerages are bullish. CLSA has a high conviction outperform. Their target price is at 506, and the stock today is still below the 300 rupee mark. For JP Morgan, it's 390. So the sell side analysts like the story. Tata Consumer is moving up well, and then you've got HUL and ITC. So the only defensive play today are the consumption names. But outside Nigel, while the mid-cap index is down 0.5%, I can see an Oracle in the green. Gandhar Oil Refinery, big volumes it just came out with their numbers, very strong set of numbers, but the stock has surged 14%, and so many more such mid-cap, small caps.
Well, that's right. Gandhar, in fact, massive numbers is what we're seeing. But keep in mind, that's a stock that's already rallied close to 40% from the recent low. The numbers look good. The revenue is up by 90%. The EBITDA number, I think, is up 5 times. And the PAT number is coming at around 200 crores. Margins as well at around 16%. We'll have to see whether or not there is any kind of one-off. But exports as a percentage of their revenue mix have moved to close to around 50%. That compares with around 37%. So explains why that stock has opened up bombastic, up more than 15%. The other one I'm looking at is Azad Engineering. They've delivered the first expandable indigenous turbojet engine to DRDO and the Ministry of Defense. Basically, the company has moved from a precision component supplier to the propulsion system supplier. And that's why the stock is bid up. It's up close to 3.5%. Goldman Sachs, in their note today, they are quite optimistic on the prospects, the way the company has evolved into a propulsion system supplier now. And remember, this delivery has been done in around 2 years and 100% indigenous components. So that's why that's the big data point. And that explains why the stock is flying away today. NTPC Green Energy, that one as well is up close to 3.5%. And HEG, I think, started off in the green, but the stock has flattened out a little bit. We'll try to get you the managements both of Wakefit Innovations as well as HEG, in the next hour or so on CNBC TV 18 exclusively. But, those are a couple of big movers. What else is moving? Well, I think Tanla, I think you already pointed that out, 8.5% higher. Savita Oil, that as well is doing very, very well. That's up close to 6.5% in the recent past. That stock as well has seen a big rally. But the short point is, what's weighing on sentiment today is definitely the spike in crude oil prices. Explains why the Nifty is down. Explains why the breadth of the market as well is firmly in favor of the number of stocks declining. And I don't think anyone's going on a cruise as of now. Waterways, leisure, that's down 7.5%. Sharp pullback from the top.
Okay, well, I think 100 points lower, 23,900 is where we are at. Sona is down 2.5. I mean, this is the thing. Indices is down 4. It's just so much gets built into events nowadays. But it's always been true, but maybe a little more true with the sentiment returning to the broader market in a big way and people looking for ideas and chasing ideas, etc. But lots get built into, and I think it's important and instructive to remember this when you're trying to, especially if you're trading and trying to trade around events, etc. What else? You've got car trade, which is down about 2.25%. Vari is down 4.5%. Nippon Mutual Fund is down about 4% as well. I just want to take a quick look at where SBI Funds is opening. Maybe a quick look and we move forward. Where do we have it at? Almost 574 was the IPO price. Stocks at about 580. And look at this Bluestone Jewelers, right? Bluestone Jewelers is now up 50% for the month.
Yes.
So it's just actually 35% for the week. I mean, it's not the month, but the week which has mattered for Bluestone. Every day it's gone up, and it's gone up big. So 4.5 today coming through as well. So yeah, I mean, lots happening, and we will come back and discuss some of these individual names and triggers. Manishi Chaudhary is with us, CEO at Emma Capital Partners. Manishi, good to have you with us here. 40% rise in oil from the lows. I mean, I think it's pretty clear that it's negative for if you're a large oil importer, even if it's temporary. I mean, you can't say, well, okay, it'll eventually be down, so let's just sort of trade through all of it without any impact, right? There will be some impact, and who knows which way this is headed. Just your thoughts to kick this off, Manishi.
Well, thank you very much, Prashant, for having me here. A very good morning to you and your viewers. As you rightly point out, this 40% spike in oil prices is a huge dampener. I mean, all across Asia, because Asian countries are big importers of Gulf oil, but particularly for India, which is the third largest oil importer in the world. And the impact is not only on the oil marketing companies. Remember that this is not just about oil. If we do have the constrictions in the Strait of Hormuz and in the Red Sea also now, it would impact fertilizer prices, which can also lead to a spike in food prices at some point of time. So this expectation that inflation can remain higher for longer is bound to ignite expectations of rate hikes also by the central bank. There are 3 central banks in Asia which are already walking down that road. They are Indonesia, Philippines, and Korea. Who knows? India might have to join the bandwagon at a later date this year. So I think all these factors, including the weakness in the currency, they're all playing. It is something that investors, unfortunately, will have to brace for.
For today, it's a subdued start. It's not panic selling, but you can see the markets drift lower, and now it's down for the 4th day in a row. Manishi, so since this Middle East crisis hangs like a Damocles sword over India, would you look to pare down your holding in India, reduce it?
Well, I mean, we've been neutral on India for a while, and I think it's a marginal overweight because the benchmark weight has declined so much. In Asia ex-Japan, India is about 13%. We have had about 14 to 15% on India. I'm not looking at, kind of cutting down that weight, much at the present point in time. I think there are stock-specific choices which, investors can bank on to ride over this crisis. There are a few companies and sectors which are having an earnings upgrades, an earnings estimate upgrade, which is actually a departure from the trend of last 2 years. We are seeing that obviously in the oil explorers, but also in the basic materials like steel, aluminum. We are seeing that in select industrials, and we are seeing that somewhat surprisingly maybe in the consumer services like the e-commerce companies. So there are some of those pockets where investors can focus on to ride this crisis. And, I wouldn't be surprised that many of these, and I forgot to mention utilities in that pack, that many of these are actually defensives. So that I think can help investors for the time being. But it's like it's something that when we're in a situation where the AI story is being questioned, and at the same time the Middle Eastern crisis is also hanging like a sword, to borrow your phrase, over many other markets. So for investors who have to remain invested in Asian equities, there's not much of a choice.
Hi, Manishi. Good to see you, Win. Manishi, I think one of your top bets was private sector banks, right? The larger ones, unfortunately, we had a bit of a disappointment coming in from HDFC Bank. That's been the biggest drag this week itself. While ICICI Bank has done pretty okay, in terms of performance. How are you approaching the banking theme? And is private bank still your top bet? Would you look to get into HDFC Bank post this recent correction?
Right. Now, that's an important question. As I have highlighted on your channel over the past few months, that private banks is something that we like, and structurally we think that if you have a 3 to 5 year time frame, private banks are likely to do well in India. The most recent data points, if you look at last 2 to 3 months, you would see that the bank loan growth, what's called the non-food credit in India, that is now back up to about 17 to 18% growth, and that's quite spectacular. Private banks are likely to gain market share over the public sector banks. So obviously, that's a pack which is likely to do better compared to many other sectors. Now, of course, within that, you have certain companies which have demonstrated that they're able to reduce their the credit cost, as we call it, the non-performing loans, and they're also able to kind of maintain their margins. ICICI Bank is one of the examples. So one has to be selective, no doubt, but the broader theme of private sector banks outperforming public sector banks and the rest of India would stay.
All right. Okay. Manishi, thank you very much for that. Just a point about ICICI Bank. Despite good numbers, ICICI Bank is absolutely flat this week. So that macro overhang is playing. You've got an HDFC Bank, which is down 8% week to date. Axis Bank, 7%. Kotak Mahindra Bank, 2.5%. But Kotak Mahindra Bank also fell post the CEO succession uncertainty. And ICICI Bank, despite stellar numbers, and all these numbers came out with, all these companies came out with numbers on Saturday. So week to date will tell you the picture of how the earnings reaction has been, and ICICI Bank has been flat. But let's talk about the biggest earnings reaction today, and that is Dr. Reddy's, still down close to about 3.5%, fresh 52-week low. The problem for Dr. Reddy's has been the gross margin contraction of nearly 700 basis points year on year. Profits too have fallen 69%. Revenues are down 6% on a year-on-year basis. Earlier, we had a chat with the CEO, Erez Israeli, on Trump's tariff threat and the margin outlook going ahead. Listen in.
It's absolutely not practical to move all the production from India to the United States. First of all, not in 2 years. It's something that takes much more time. Second, it's not practical in terms of return on investment, the prices of this product, and the level of investment needed in the United States don't make it practical. I believe that it's probably a way to strike somewhat of a deal. That's why, obviously, as I don't know what is a deal, if there will be a deal, that's why we cannot react. But yeah, so we found that in the scale-up of our API, impurity that is degraded in the drug product. And obviously, as a company that is very keen on the right practice of GMP and quality, we immediately announced the market. The remediation should take us, if successful, until the 3rd week of September. And at that point of time, we can supply back to our partner, one source in Bangalore, the API to continue to make the product. And so it means that by November, we should be back to the market with the remediated product if all the activities that we are doing now will be successful.
All right, moving on. We've got a very interesting company here with us in the studio. It's Bangalore-based precision engineering company Indo Mims, and their 3,800 crore IPO opens for subscription today. The price band has been fixed at 461 to 485 crore. It's a combination of a fresh issue of 500 crore rupees plus an offer for sale of about 3,800 crore rupees, which the company will use primarily to pare down their debt. And we have with us here in the studio Krishna Chivukula, the whole-time director and CEO of the company. And we also have Mr. P. Balasubramaniam, Vice President Finance and CFO. Gentlemen, thank you very much for joining in. So, Casey, is that the way?
KJ.
KJ, all right. So tell us a little bit about the company, right? Your position in the market, who are your big clients, the financial size?
So Indimim is a precision component manufacturer. We specialize, the core group is what's called metal injection molding, but we also do precision investment castings, super alloy investment castings, aerospace machining and special processes, and fine powder production and automation services. So in terms of the technology, it's a small net shape component technology used for very demanding applications, you know, parts for jet engines, turbochargers, anywhere you've got a lot of, where you need demanding material properties and high precision, and a lot of component complexity. In terms of our customers, you know, our customers are very global.
Sorry, can I just the basic process first? How is this different from the regular, I mean, we speak with companies who do die casting, who do machining, CNC machining. So how is the process different? Because
this technology is sort of in between machining. I mean, it's not a subtractive technology like machining where you're removing metal to achieve the shape. And it's not like a casting or die casting technology where you're melting and pouring and filling a shape to get a geometry. Here, what you do is it's more like a marriage between what's called powder metallurgy, which maybe you're familiar with, and plastic injection molding. Right? So you use very fine powders and then you mix it with things, plastics and different types of things, so that you get a paste which you can put in a molding machine, and then the metal and plastic flows together into a complicated die, where you could have maybe multiple cavities, so that when you take the part out, it's a combination of metal and plastic, right? And then you remove the plastics and then sinter the part to a very high density, much higher than, say, what you would get out of conventional powder metallurgy. And then depending upon, you know, the customer's requirements, maybe you might have to heat treat it, or you might plate it, or maybe do a little bit of machining to hit the dimensions. But you end up with like a part that is very net shape. It looks like the final shape.
And I'm assuming this is important because, and these are for more complicated
very complex geometries.
But smaller things? I mean, not...
Small parts.
Small parts.
The powders are expensive, so it puts a limit on a little bit of a cost. Technically, you could do bigger parts with this, but the powders are very expensive, right? Because you have to first make the bars, then you've got to melt the bars again and atomize the powder. So the powders are more expensive. So it's sort of limited to, you know, the ideal weight range is somewhere between, you know, 0.04 grams up to maybe 100 grams.
So, and metal injection, right? Which is... but you do a bunch of other things as well. And how much of this? How much is this as a part of the business overall?
This is about 65% of the business. Okay. So still dominant, but we have, you know, we do what's called investment casting. That's a lost wax process. Okay. So you make a wax tree with like little shapes of parts that are in wax, and then it's like the ancient statue making. Right? You have got a wax impression, you coat it in ceramic, you dip it, you dry it, melt the wax out, and then you've got this impression, fill that with molten metal, break it, and now you've got the part.
Sure.
Of course, now maybe we do it with some more, you know, advanced stuff than 2,000 years ago, but it actually is still basically the same process of creating a shell around a wax, emptying the wax and putting metal in it. Okay. And we do that for automotive, for the aerospace industry, land-based gas turbines, and you know, other consumer applications where they need castings.
All right. Hi, gentlemen. Welcome to the studio, and thanks a lot for coming down. Now, as you said, metal injection molding is a very specialized business, right? I think globally, if I read it correct, I think the industry size is around $4 billion.
4 to 5, depending on what you look at.
And y'all would be doing around 2,500 crores from this particular part of business, because it's 60% of the total mix.
Roughly 60%.
So you'd be roughly around what, 5% of the global market?
That's 6.8 to 7.
6.8%. And is there an aspiration that y'all are growing faster than what your peers are doing, so you get to double digit at some point of time?
We can't talk too much about the future, but strategically, we do a couple things. One, there's a couple things that I think distinguish us from other metal injection molding companies globally, which would explain why we have been able to achieve such a leadership position, not just in India's metal injection molding market, but globally. One is, we look for parts all over the world. We export to 45 countries. 50 countries. We've got sales and marketing resources in various regions. So we have access to all of the MIM programs that are out there globally.
Correct.
The other aspect is we don't just look for the MIM programs, we convert other technologies where appropriate into MIM for our customers.
Got it.
So that expands the pie. So that's sort of what's allowed us to grow historically faster than the industry.
Yes, please, sir.
First is a good index at the present.
Yep.
Last few years, if you see, our growth has been plus 15% year on year.
Faster than the industry.
It is faster than the industry.
And your market share currently, global market share 6.7%.
7%
From around what? Say around...
The market itself is expanding.
Okay.
So there is no reliable statistics of what the number is.
Got it.
But it is always around 5 to 7% is what we have been doing.
All right. Got it. All right. So $4 billion industry, and you all are maintaining a market share around 5 to around 7%. I was reading up on, what you all have put out. And I believe in terms of a capacity utilization levels, you're at what, around 50 to around 60% on an average across various segments.
That is right.
So at peak revenue levels, what can you do without any, further investment? If you could help us out with that.
Actually, we have 3 different segments.
Yes.
In metal injection molding, our capacity utilization is 40%.
Okay.
With that, we do about 2,600 crores turnover. So you can make an arithmetical calculation as to what it will be.
So effectively, I think you can double your revenues from the number that we have of around. So you can do at peak close to around 7,000 crores of revenues without any big capex. That would be fair, right?
That is right.
That is fair.
Got it. And part of this money that you are raising is going to be coming into the company. So there'll be some debt repayment, I think. So
Correct.
What is the debt number post this repayment? And effectively, I guess it'll be 40 crores of interest saving. Would that be fair?
Correct. That's a good calculation.
Why is utilization 40%?
We have done too many good things too fast. In the last few years, we have done a lot of productivity improvement measures, because of which the capacity utilization is going down, even though the turnover is going up. And it's a good effort to make, because in these times, if you make it, the day on which the business keeps growing up, you don't have to keep on adding additional capacity.
Because generally the feedback is that manufacturing is back around the world, right? Everybody wants to. And all kinds of industry. Here in India, for example, it's
we are also experiencing
in the last 6-7 years. All sorts of stuff happening here. Just one quick question is, the way you described it, Krishna, the manufacturing process, is 3D printing
question?
Does it? Because this is smaller, complex things, right? But 3D printing is supposed to solve that problem, and it's getting better as a technology.
It is.
Is that a challenge? Is that a disruptive threat at all?
Yes and no. There's a lot of different flavors of 3D printing, ranging from things like polymerization, stereolithography, laser powder bed fusion, binder jetting, direct energy deposition. They've all got sort of some unique features, but we are a sinter-based process, right? And that has a lot of advantages in terms of microstructure control and material properties that maybe you wouldn't get out of laser powder bed fusion. But the real way to look at it is, there's things like binder jetting. And if they become productive enough, then yeah, maybe down the road, instead of molding and sintering, we'll binder jet and sintering. But these processes are also very expensive, so that you need to really, and the productivities are very low. MIM, they'll develop and they'll have their own range, right, or envelope, if you want to, in the so-called, whatever you want to call it, the component space, which is the available set of forming technologies that could make the part that you want, right? But that won't all be at the same price points. So for additive processes for it really to be a win, it's got to be designed for additive. You've got to be doing something in that process that can't be achieved cost effectively through other processes. So it's not, in my book, a disruptor for our industry. It's more complementary and synergistic, right? So, I'll give you an example. We do use additive printing, laser powder bed fusion and binder jetting, and stereolithography. And we do a lot of prototyping in those technologies, which allows our customers to not invest in a prototype tool or not spend the money on a bigger tool to figure out if their design is right or if they even want to use this technology. So we'll print for them, ship the parts, charge them for the samples, and then we'll work with them maybe with the printing, and then they convert it into MIM. So you see, it's very complementary. Now, if the productivity improves, then yeah, maybe down the road, you could replace the molding machine with the printing machine, but you still have to sinter. So it's complementary in my book.
Not a big disruption risk in that sense. Got it. Just I know you can't talk about growth rates, but we had to ask it. I mean, what should we expect? Growth, I mean, what you've done over the last many years to continue in terms of just future growth rates? You want to take
We can only tell you the industries in which we are in. Those industries are growing. You know, we said that 60% of our business is MIM. MIM business all over the world is set to grow by about 9%. We have always grown above the industry average. As far as casting business is concerned, we feel that the land-based gas turbine business is growing significantly. We are seeing year-on-year growth of 50% in the entire marketplace, and we are no different. And in the machining business, aerospace machining business, we are seeing year-on-year 40% growth in all the companies.
We speak with some of the companies, and it's been absolutely.
I'm sure this is an evidence which is there in the market.
Well, we wish you all the best of luck. I had more questions, but we are on a clock with more companies. So thank you very much.
Thank you.
And good luck.
So
we'll
much.
speak again.
We'll see you, Casey, as well as Bala, on the listing day, first year on CNBC TV 18. All the best, and we keep in touch.
Thank you so much.
All right, well, let's get across to our next management. We have JSW Energy. That's the management on our radar. They reported a tepid set of numbers, actually, in the first quarter. We have with us Mr. Sharad Mahindra, the joint MD and CEO at JSW Energy, who joins us on the show. Hi, sir. Good morning. Good to see you. Whether there are some concerns with regard to the renewable energy capacity addition. Could you give us some kind of trajectory in terms of capacity addition? What are the timelines you're looking at? And what will the quantum of the capacity addition look like? I think you've achieved only around 35-36% so far.
See, the thing is, knowing that the practicality and what are the execution challenges, I think keeping all the factors in mind and also the connectivities, availability, commissioning of the new connectivities or the existing one, I think it is very prudent to take that the guidance we have given of 3 gigawatt, we are on track in the current fiscal. And as we are talking against 873 megawatt commissioned in quarter one, as of now, as on date, it is including the July commissioning of 225 megawatt. We have already commissioned close to 1.1 gigawatt. So we are well on track. Again, if we especially compare with last full year, the inorganic capacity addition, what we did was close to about 1.3 gigawatt. We are confident that in H1 only, we'll be definitely surpassing that number.
Okay, all right. Got that, sir. Well, summer was actually rather muted. You have seen generation decline. What was the merchant capacity and how are the pricing trends? If you could help us out with that.
See, merchant capacity, as we have said, after our Utkal plant, which has gone under the power purchase agreement long-term 25 years with Karnataka for 400 megawatt capacity, and capacity of additional balance available capacity of close to about 115 megawatt with the state of Assam for a 2-year power purchase agreement. So the merchant capacity has reduced to 4% of our total capacity, which maybe with the addition, this was as on 31st of March. And when we have commissioned close to a gigawatt, so it is now under 4%, which is in merchant, which is available. And I think generation part, if we see, the quarter has been phenomenal, especially starting May, when the demand has growth over last year has been in excess of 8.5%. And full quarter, if we see, the quarter one, the demand growth has been about 8.4%. So it looks to be, and we know the reasons of the extreme weather conditions, delayed monsoons, onset, and the weak monsoons which are prevailing. These have been the factors. And increased demand in the urban market, especially with the appliances usage in the urban segment, residential segment. So that these have been, and agriculture demand also has been significantly higher, which was witnessed a negative growth last year in quarter one.
Mr. Mahindra, you have been very, very aggressive on capacity addition in the last few years. Will you look to slow down a little bit? Could you give us a broad number in terms of what is the capex for this year? Because there are worries about this high capex projects over the next few years. So break it down for us.
See, if you see that after this fundraise, and as we have reported in our quarter one numbers, our debt, which was the year closing debt of FY26, was in excess of 65,000 crores, is now slightly above 61,000 crores. And our debt to EBITDA, if we exclude the construction work in progress related debt, we are at a comfortable 4.95 level. So we have been successful in deleveraging our balance sheet, strengthening our balance sheet to ensure and fund the future growth. This year, we have given a guidance of a capex of 20,000 crores. And if you see that the cash we are generating and also which is the available which is there, we can comfortably go for 12,500 crores is what is there. Rest is all which is going to come from that. So we are very comfortably placed to ensure our growth journey toward 30 gigawatt in terms of the capex going forward, and also maintaining the net debt to EBITDA guidance, debt to equity guidance, what we have given, debt to EBITDA guidance, sorry, of FY30 to 5 or below.
Okay, got that. Now, debt has dropped sequentially. Any further debt reduction plans? Any kind of stake sale that you'll have planned?
See, we have been successful in reducing our finance cost, and we are at a level of 8.36% of our overall finance cost, which is there. And going forward with the refinancing and the other some resets which are pending, we are looking for a slight reduction in our overall interest cost during the current year below 8 point from present level of 8.36. So we are saying regarding fundraise, I think we are right now, as I told you, that at 4.95% net debt to EBITDA, we are very comfortably placed for this capacity addition in current year capex of 20,000 crores from our internal cash accruals plus what we have. So I don't think that immediately we don't need, but as and when we feel that maybe we need to accelerate our growth plan, we'll be open to that, but presently not.
Okay, let's move on then. Now, what about ramp up and the performance at the wind turbine business? Also, could you tell us how is Q2 power performing?
I'll start with maybe KSK. KSK, if you see, when we acquired, we had given the guidance of, despite knowing a year back when we acquired in the month of March 2025, that effective April 26, the tariff is going to be revised downward, significant revision in case of UP and marginal in case of Tamil Nadu. Despite that, we had said that the run rate EBITDA of 2,650 crores will be maintained, which was the operating EBITDA that time when we acquired. If we remove the other incomes, what they were getting from the deposits, interest income, the plant has been operating at a EBITDA level of around 2,600 a year and a half. So we had given the guidance, despite tariff reductions, we will be bringing in efficiency controls, operational cost reduction. I'm happy to say last year numbers are known, and this year also the EBITDA numbers, in case the way we have started the year, we are absolutely confident that with the efficiencies we have brought in and the fuel cost reduction optimization leading to reduced cost, we have all brought in. We are confident that it will be significantly higher than the benchmark of 2,600 we have given. And maybe I can say maybe in the range of around 3,000 crore is the EBITDA, what we expect at the Mahanadi plant. So this has been a wonderful acquisition, not without forgetting that the capacity expansion at a significantly lower cost LCOE is what the work has already started at Mahanadi, which will also be at least a 25 to 30% lower cost per megawatt of capacity addition than a greenfield plant will be doing. So this is a very, very attractive acquisition which we have done, wherein we'll be doubling the capacity going forward in next few years. Regarding wind, as you said, wind cost, as I told you, that we have successfully commenced our Halol blade manufacturing plant in Gujarat, and the next other plant with double the capacity than this in Chitradurga, Karnataka, will be commissioned sometime in Q3. So we are confident that these two things commissioning will bring in significant reduction in the project cost for us, which will give an advantage in terms of the returns.
All right, Mr. Marinder, let's wind this down then. Give us a guidance for sustainable EBITDA run rate.
See, in terms of EBITDA, when we say that we have given a guidance of maybe capacity addition of maybe 3 gigawatt or 2.5, 3 gigawatt, a benchmark per gigawatt of or per megawatt of EBITDA in RE business can be clearly seen as what we are getting in under JSW Neo. With that, maybe it can be, we don't normally we avoid or we don't give the forward guidance in terms of EBITDA, but that is what the estimates are. It is very easily calculated if what we achieved last year, what we have started the year with a certain capacity, what we are saying that we'll be achieving quarter 1 performance will give an idea that where we are going to end. There are consensus estimates which are already there. So we are confident that with EBITDA equivalent to about 2.5, 3 gigawatt of capacity addition every year will lead to incremental EBITDA. There will be an increase which will be there when in FY28 towards the end when we commission the first 600 megawatt of thermal unit in Mahanadi, which will start giving from FY29 full year the EBITDA. There will be the incremental EBITDA from thermal, which will also start adding up to, and also the energy storage business.
Thanks a lot, sir, for stopping by and speaking to us here on CNBC TV 18. All the best for the remainder of this fiscal. Time to slip into a short break, but on the other side, we'll focus on what to expect from the capital goods sector. We'll take the conversation forward with PL Capital's Amit Anwani. Stay with us.
Welcome back. Markets, I think, are off the lows, 77, 80 odd points lower. 23,900 is where we are at. Well, it's quarter to quarter, Tuck, and we get you earnings expectations. A sector a day, and capital goods is in focus this time around. Vinny standing by to give us a quick sense of what the numbers could look like for companies in that space. Vinny, take it away.
Hi, morning. So for, capital goods space, we'll expect a bit of an uneven quarter for the capital goods sector in Q1 FY27. While obviously the headline order inflows are spiking, execution still remains a concern, and that's a tale of two cities or two halves that you could say, given the geopolitical constraints that are coming in for some of these companies. Now, what are we looking at sector-wide in terms of a revenue growth? Revenue growth for the sector is approximately at 11 to 13% in that range. EBITDA a bit tighter, 6% to 10%, that's the range. And let's dive further into the numbers now. Q1 FY27 numbers, break it down. The theme is going to be execution divergence this time. While order books are at record high levels, the PNL is telling two different stories. One hand, you're seeing power T&D names, the heavyweights like GE Vernova T&D, Hitachi Energy, which are essentially in that super cycle phase of theirs. So they're expected to post very strong revenue growth in the range of 29 to 30% with best-in-class margins as well for both these companies. Then move on and talk about the short cycle names. The companies that come in are ABB India. That is expected to manage a steady double-digit growth of 10%. But the concern comes in because there is some increase in terms of inflation. Copper prices are higher, zinc prices are higher as well. So that is something that could impact the margins. Margins are expected at 13.8% for ABB India. Moving on to some of these EPC names, KEC International, Kalpataru Projects. Now, what's the story here? They're navigating through a tougher quarter. There are labor shortages that they've spoken about as well, geopolitical tensions that are affecting them a bit more on that Middle East side front as well. So that is something that could cap the top line growth, and that is why that single digit growth, 5%, 4%, low single digit growth is what is expected. Execution still remains a concern, and that is expected to be uneven across the sector as well. So the order book visibility, where is that lying? That's the real story now. GE Vernova T&D is going to be the standout one. Order inflow is expected around 1,800 crores. They have an order backlog that would go up to almost 20,000 crores as well. They have the HVDC Kharwar project also which came in, so that is supporting their growth in the last 2 quarters. Now Hitachi Energy, that's the next one. Order inflow for the quarter is expected around 2,400 crores. It is continuing to ride on that T&D super cycle as well. And alongside with that, you have GE Vernova also. That is also in terms of a good order book that is expected here. ABB India, Siemens, all of them also expected to see a bit of an order deferral. So let's watch out for some commentary on that. ABB India order book is expected, an order inflow, I beg your pardon, is expected at 3,600 crores. Some private capex decisions that also expected to be pushed, and that is some bit of a concern that's coming in here. CG Power order inflows are estimated around 4,500 crores. That's reflecting the strength that comes in from the power system segment for the company. Industrials is expected to be a bit muted. On the EPC front now, Kalpataru and KEC International, we are expecting the order books to come in at around 5,000 crores for Kalpataru. KEC International, a wide range coming in between analysts, 4,100 to 6,600 crores. So let's watch out for that, whether this picks up momentum. What is going to be picking up for these EPC players will be key. And PGCIL order, the ban that was there on KEC International, that has been lifted. So where does it go from here on? Now, as we get into the numbers, what are we watching out for in terms of factors that we should keep an eye out on? 5 things. Execution slippage. Is there any delay in terms of that because of West Asia? Then move on, talk about the margin trajectory, commodity pass, inflation, are they passing it on? What is happening on that front? Order mix, especially private capex, what is that happening? What is the story on that front? As well as exports, that's also something that we'll watch out for. Labor shortage, is that normalized for some of these players? And lastly, we'll also talk about Chinese players in the T&D side. They've gotten some exemptions coming in. Has that affected the companies in any sort of a way in terms of commentary is key to watch out for. Valuations continue to be stretched, right? When you compare it with 2-year historical averages, they're much higher than that as well. So it'll be key to watch out for because they're still very expensive here.
Thank you very much for that. You've given us a perfect segue to, ask the questions to Amit Anwani, Vice President, Institutional Research, PL Capital. Amit, let me begin with Hitachi Energy's GE Vernova. Very strong numbers, as Vinny was telling us, best-in-class revenues, 30-35% year-on-year, strong margins. But are these peak margins? Question number 1. And 2, what are the valuations currently, and what is the headroom for valuations to go up from here?
Right. Good morning and thank you. So I think first, as summarized, broadly we are expecting T&D space to have a very strong numbers this time as well. GE, we are building 25% growth, Hitachi more than 38% growth. Now, few of these companies are already at the peak margin. GE is already at about 26.5% margin. But company continues to guide mid-20s in terms of EBITDA margin, which is there. So GE, probably there's a good scope still till the new capacities comes in, that these companies will still have some leverage. Plus, the mix is more tilting towards the product supplies in the book. They're already carrying very strong book, and the lead times for especially for the HVDC projects has been keeping high till the new capacities comes in. So these companies, I think, are able to have a better mix and the operating leverage, where I'm expecting GE at least to maintain minimum 26-27% margins. But for the other companies, there's some operating leverage which we are building in, including Hitachi and Siemens Energy, where we're building in the margin improvement since the book, the very strong book is coming in execution, and they still have a good headroom in terms of the operating leverage as well. So overall space will continue to have a strong growth. And at least for few companies, good margin improvement as well on YOY.
Right. Sorry, you did mention Hitachi and GE Vernova, right? You, Amit, hi. I think GE globally reported numbers yesterday, right?
Yes.
And anything from there which kind of is like a read-through look ahead for the company here?
Right. So if you see globally, even we saw from past 2 quarters, GE, ABB, many global companies continue to, at least few of them continue to revise upward their guidance. So same happened with GE in the recent call, that they revised their guidance by 5 to 7% higher than what they were having till the quarter before this. So definitely quite encouraging in terms of the global companies, positively surprising, and they're led by, as we hear, the data center boom. Many of these companies, including GE, supplying turbines and transformers globally also. And we have seen the Indian arms of these global companies, the exports have also done substantially better. So I think some positivity definitely from there, but I think the domestic players, especially and Hitachi, they're riding on one more order which is expected to come in the domestic energy market. And that will be again making their books and much stronger growth visibility to any one of the two companies where the order will come. Definitely is also buying on them. Yeah.
Amit, what about the valuations of companies? For which companies are you comfortable with the valuations? Where do they currently stand at? And what would be the target valuation?
Yes, so in our space, if you see, valuations have been, as I said, since I'm expecting very strong numbers, for example, in Hitachi is trading at about 60x on my number. Hitachi is again on 63x. But I would recommend probably buy dips on G, where I have a confidence, at least in terms of margin sustainability. Our estimates indicates that, and they have equal probability for the new orders, which will again boost the earnings prospects further. So there's no clear-cut buy at this moment, but considering that 60s valuations, probably these companies will have elevated valuations to sustain going for the way transmission pipeline continues. So, but I would add dips in G. There are few stocks, G, APAR, where I can recommend buy dips in the space at this moment. Yeah.
Any sell calls that you have, Amit? Complete avoids?
Across the board, I think because of the Middle East impact, there's a direct impact which will be then on the EPC companies like KC, Kaltu, L&T, where the growths will be lesser this quarter. Probably there could be some negative surprise in, for instance, companies like KC. I think in terms of elevated versions, I find Thermex, where we have a reduced call, which is trading in 52x earnings CAGRs. The visibility is something which is slightly, I would say, lesser than the other transmission companies, which are at elevated valuations. So I would give that as a short call.
Out of time completely, Amit, but thank you very much for joining in. We look forward to chatting with you once the numbers also come out to get your take on the performance. But Sensex expiry today.
Well, that's right. Sensex expiry, and things will get a little bit volatile. And as we normally see, when you have 3 straight days of a downtrend, then there is that attempt that the bulls want to believe that maybe, in fact, at lower levels, there'll be some support that comes in. So the immediate reaction is go ahead and buy the dip. I think that's what's taken place in today's trading session, because there's a good recovery that we've seen from the lows. Now, the things will particularly get volatile in the second half of trade. But let's run you through a couple of data points since it's Sensex weekly expiry. The 76,400 put. The premium out there has come down to around 90 rupees. Now, you'll see I've got the direction right because the Sensex is down close to 200 points. There's an element of writing actually that's taking place. Yesterday, the premium closed at around 112 rupees, and that's come down to 90 rupees. So premium writers, that's put writers, they're looking to eat into that premium out there. And if you look at the upper side as well, the 76,500 call, the premium yesterday was close to around 380 bucks. That's come down to around 160 rupees. So there is writing being seen at higher levels as well. So just punching in these two data points and looking at the trends this morning, the lows of today are going to be important, which came in at around 76,300 approximately. That's going to be one support zone. Besides that, if you go a little bit lower down, then it's the 50 DMA. And for a closing basis, you don't want to see that level violated on the downside. However, on the upside, since there is action being seen at around the 76,500 call, with the premium currently at around 160 rupees. That tallies in with the 100 DMA. 76,500 plus around that 160 rupees, which is ballpark around 76,650 approximately. So is this zone of around 76,650 to around 76,700, the bears will want to defend this mark. For the time being, we're seeing a bit of a dip from the lows. The problem is crude oil prices remain elevated, and that's why resistance will, in all probability, be a little bit firmer than normal, though the bulls are making that attempt to see some kind of buying from lower levels. So keep an eye out on the screen. The Sensex has recovered close to 300 points from the low point of the day. We're approaching that crucial resistance mark of around 76,700 or thereabouts. Mitesh Thakkar is back with us. Mitesh, what do you make of this morning's action? Not too bad, right? Last three sessions we've ended lower. The bulls are, backing themselves, it seems, from the day's low. At least the initial reaction is by the, the lows. And also the rupee is more or less stable, despite crude moving to around $95, $96 per barrel.
That's right, Nigel. I think it's slightly encouraging today. The good thing is that, one, we didn't kind of threaten to break 23,800. Now that's an important level. We got a closing low of 23,824 on the 23rd of June. Then 23,805 was a low, intraday low on the 8th of July. And we also had a low of 23,829 on the 30th of June. So I think good that, we are bouncing back from support levels, which basically means that we are still in that range, 24,400, 23,800, 850 broadly. And with that, I have two buy calls right now. United Spirits is something, which has weathered this decline well and is now making a fresh swing high. So buy here with the stop at about 1,400 for targets of 1,470. And the other one is PI Industries, which I would recommend buying with a stop at 2,700 for a target of around 28.25.
All right. Well, Mitesh, thank you very much for that. So, stuff moving. Broader market is lower, Nifty is lower, but there's enough happening on the other side as well. Manisha is going to be here with a focus on commodities on the other side. Stay tuned, coming up.
Welcome back. As promised, let's talk commodities. Manisha is talking about copper, which is at a one-month high. Hi, Manisha.
Well, it is. Thank you so much for that, Rima. Copper prices have been gaining for quite some past. If you look at the last 1 month or a couple of quarters for that matter as well, we've been on the higher side. All-time high in the US markets were hit in the month of June, and we are trading very close to those levels there. But in the last 1 week, we've seen 3% of gains come in for the copper prices. It's 9% up in last 1 month, and it is trading at a 1-month highs as well. If you look at the overall copper prices in 2026 and take both the important exchanges, US is gained up by 16%, while LME is up by nearly 10% as well. There is supply in sense of sulfur, and that's a bit of a concern coming in from Middle East, which is keeping the copper prices on the higher side, at least the concentrate therein. And then the top financial institutions have been bullish also in case of copper because of the kind of demand that we are seeing from conventional areas, but also from AI, renewable energy and transition as well. So that is where the demand seems to be coming in from. In the meanwhile, you also have seen speculative money come into this market. So when you look at the long positions that have been created from speculators in the US markets, that has been on the higher side. And this is as the markets are anticipating that the US perhaps could come out with tariffs on copper. The US copper, in the meanwhile, is trading at a premium of around $600 a ton to the international markets. The premium also has continued when you look at the COMEX warehouses, which are holding at around a record 630,000 tons of copper therein, which is an increase by almost 35% in this year itself. So as I said, the premiums are not just in the US markets. The tightening physical market in China also has led to premiums coming in for this one. So you have China copper premium trading at around $100 a ton. The LME cash to 3-month premium also is trading at $340 a ton. So that tells you with all the important international markets trading at a premium in copper means that immediate physical availability of copper clearly is not there into the markets. Take a look at the deliverable copper stocks in warehouses since the month of May, and that has been a considerable decline. Shanghai, 82% of a decline. LME has seen 28% of a decline. And the Chile, which produces 50% of global copper, also is looking at a capacity decline of around 25.4% therein. The lower output is something that major corporates also seem to be flagging off. Rio Tinto second quarter output was 7% down. You also have Glencore saying the same thing. Antofagasta said 9.5% of a decline in copper output. BHP says that Chile production is expected to decline this year and the next year as well. Let me also bring on board on what we've seen in sense of copper production and consumption in last 2 years. 2024, the production was 23 million tons, but the consumption was at 27.5. 2025, we've seen an increase in production slightly, but the consumption seems to be going up as well. And 2026 is anticipated higher in sense of both of those numbers there. And finally, when you look at the global copper demand, well, that seems to be increasing as well. And the fastest growing market within this is India at less than 1 million tons. Take a look at China, 13 million tons, 14 million tons. European Union and North America, anywhere between 2 to 3 million tons. And India is the lowest in sense of per annum, per capita consumption as well. But the markets believe that all the incremental marginal growth right now seems to be coming in from India. Let me take you finally through the price views as well going forward. BMI has come out with a report where they're suggesting that 15,000 and 15,800 by 2030 is what they're looking at in sense of prices. Bloomberg did a survey, $17,000 a ton by 2035 because of the ongoing structural deficit that we are looking at in sense of copper prices. UBS has talked about 13,000 right now, while Traxys talks about 15,000 in the next 2 to 3 years. So when you look at all of this price forecast expectations, everybody believes that the copper prices, at least for the next 3 to 5 years, are only going to grow in sense of prices because the supply will not catch up and the demand will continue to run up. Cochilco talks about 12,250 for this year, JP Morgan 12,000, Citigroup 13,000 with the possibility of $15,000 a ton going forward in next 2 to 3 years. So as I said, almost everybody very, very bullish in copper prices going ahead.
All right, Manisha, thanks very much. As always, interesting data to chew over. Look at the markets. They've staged a very, very smart recovery, and we're down only about 30 points now, 23,960. So, you could call this almost a full recovery from the lows. And the Nifty Bank has come up about 200 points as well from the day's lowest level. That's about a little over a third of a percent. We'll take a break. We're back, Lata, in conversation with the management of IndusInd Bank. The stock's down. I mean, numbers were good, but a fair bit of positioning coming into the earnings, I guess, responsible for the 5% knock that you're seeing out there. But it'll be an interesting conversation. Stay tuned. Coming up.
Welcome back to our earnings analysis. IndusInd Bank beat market estimates on practically all parameters: net profit, interest income, and asset quality. In fact, asset quality was particularly impressive, with slippages, gross NPAs, and credit cost, all of them down on a quarter-on-quarter basis. But growth has been slow. It has picked up slowly quarter-on-quarter after a very long lean patch. Even now, year-on-year advances are still lower, so there is a long way to go. The stock is down today, but as Prashant just said, this is more because there was a huge up move, almost 15% in the past month, and maybe that's, a buy on rumor, sell on news kind of event that's happening at the moment. To discuss the results in greater detail, Rajiv Anand, Managing Director and CEO, joins us. Rajiv, good morning and thank you very much indeed. I know you've had a long year of very hard work put in. First up, what is the plan to reach the, industry standards of credit growth, which is what you said in your post-results call? I mean, that's 18% yard. You all are sitting at year-on-year lower advances compared to a year ago. So 18% is a long climb.
So thank you, Lata, for having me here. Absolutely. I think I see this quarter as, in a sense, the inflection point from repair to renewal. And so therefore, to that extent, you've seen a quarter-on-quarter growth, first to some degree driven by the corporate side. And I think that machine is beginning to chug nicely. And the retail side takes a little bit of time, but I think if you look at it from a dispersal perspective, dispersals even on the retail side are up 16% Q on Q. And so therefore, to that extent, you will see over the next couple of quarters the recovery that you're talking about on the overall asset side of the balance sheet. I also should call out the seasonality on our microfinance business and the vehicle finance business, which is typically slow in Q1. We do expect those machines to kick in as well. We've invested on the SME side of the business from a leadership, technology, and process perspective, and so therefore that should start to kick in the next couple of quarters. So net, what I'm saying is there are a lot of engines which are in a sense work in progress, and I'm very confident that the expectations that we should be growing broadly in line with market and delivering a exit ROA of 1%. I think we are fairly confident that we will get there.
Okay. Since you referred to retail and lending, that is where I actually have the problem. Your loans have grown quarter on quarter, lending to corporates, which may be safe, but they're not going to give you much money. And actually in retail, where we always thought IndusInd does very well, vehicle financing, you'll have actually brought it down. Even I looked at the number of outposts you'll have. It has fallen by 105. For vehicle financing. That is a little surprising. Your SME, your slippages also are more in vehicle financing. Why? That was your strong point. Should it not be the bread earner now?
It still continues to be a strong point, and I think if you dig a little deeper into that, I think one of the things that we have slowed there is our two-wheeler business, and I think we've had idiosyncratic issues which we are working through at this point in time. So vehicle finance business growth has actually degrown, and that is obviously showing up in the overall numbers. But actually, if you look at it on the CV side, the MHCV, etc., we continue to gain market share. As far as the closure of some of these entities that you spoke about, what we've actually done is we've had specialized asset branches. We are actually consolidating them along with our overall IndusInd Bank branches and converting them into full service branches. And so therefore there's a bit of a lead lag there. You will see a branch opening going forward to be able to adjust for some of this. And you've also seen that some of the loss-making or unviable BFIL branches have actually been shut down. So therefore it's just a reorg of our overall distribution architecture such that we're able to drive better productivity and better customer experiences from these outposts.
And I'm telling you, because even MHCV, you refer to that actually is lower quarter on quarter. It's higher year on year, but quarter on quarter it's lower. And June commercial vehicle sales were actually higher. Auto sales have done well, especially, including commercial vehicles. So that was what surprised me. But I think your investors will want one reassurance. Will you all go down the corporate path? Because that is not margin accretive.
Look at it this way, Lata. I think if you look at it from an overall perspective, despite the fact that corporate has grown, ROAs have actually improved.
Yes.
So therefore, while to some degree they may be NIM dilutive, they're positive from an OPEX perspective and a credit cost perspective. So I look at the business from an ROA and the fact that we do corporate. And in addition to that, we get balances, FX, etc. And we drive the ecosystem around it. May not necessarily be in the very short term, but it is an investment into that business as we go forward. But to answer your question, I think broadly speaking, we're about 35% on the corporate side. I don't see that going up anytime soon.
Fair enough. No, I agree with you. In fact, I was going to ask you the secret behind your lower OPEX. So that's probably explained by this as well. Before I forget, you'll have taken permission to raise capital as well. And the buzz on the street is you're coming out very soon with something. Is the capital raising anytime soon?
So if you look at our capital position, continues to be very strong, both at the CET level and at an overall
Why did you take
capital
permission?
position level. This is just an enabling provision which we had last year. We have just renewed it. We will take it to the shareholders at some appropriate time when we think we will need the capital. We will raise, but today it is just an enabling clause.
Okay. Actually, Nimesh was the one who said that the street is abuzz, and he told me, "Aap puchoge to wahi bolega ki ye enabling provision hai." He wasn't expecting you to answer, but I have to. Nimesh's sources are usually very good. But the Hindujas do want to increase their stake. So even that was a reason why one thought that probably, a capital raising will come. Anything in terms of their getting a permission to raise stake that you can enlighten us?
So I have no new information as far as that's concerned. Okay. But as and when we do raise, I am sure they will participate. They have always participated in the issuance of the bank, and I see no reason why they wouldn't do so this time as well.
The other niggling question for the bank, the unfortunate position at when you took over. Anything more we have to expect from the EOW or ED? Or the fraud, the SFIO, anything which may impact the numbers of the bank. It may affect past individuals, that's another thing. But any outstanding inquiries?
You have correctly articulated, Lata. All the historical issues are now behind us from the perspective of disclosure, financial impact, staff accountability, etc. internally. It is now moved into the law enforcement space, and in that, obviously they're going through their processes. I'm sure it will take its course, but what I can confirm to you is that there is no financial impact expected, from any of those law enforcement investigations on the bank.
Okay, so the investors don't have to fear. Now, the inevitable question, my producer is already screaming that I'm out of time. FCNR, where are y'all? Y'all have a decent NRI, investor crowd, depositor crowd. Any targets, anything already achieved?
So we're looking at all three structures. One is pure retail, which is actually very attractive. We have a rate of 6.75% for 5 years. For retail NRI, that rate in dollars is a very attractive number. 2 is our own leverage from Gift City, and 3 is leverage from partner banks. We are working on all three structures. Like I said to analysts yesterday, we have a 3.6% market share on the NRI side. We do expect to protect our market share, meaning that whatever the money that comes in, we should be able to get at least 3.6% of that.
So very quickly, therefore, can you be reasonably sure that your NIMs for the remaining 3 quarters is going to be better than the current quarter because you possibly will get lower cost deposits? Any number you can give for current quarter or next quarter?
So firstly, I think I want to put to rest that the FCNRB money is not that cheap.
Okay.
But having said that, I think there could be some margin pressure in Q2 because of the fact that some of this liquidity will come in and we will need to. It will take a little bit of time for us to deploy. But I do believe that that we have enough engines of high yielding growth for us to be able to protect margins over the next 3 quarters.
Okay, unfortunately out of time, but not out of questions. I have so much to ask you on your lack of a big gold loan portfolio, on your OPEX, which has come down so dramatically. All those questions. I'll take a rain check from you, literally, given the day we are meeting, and ask you those questions.
Happy to do that.
Congratulations anyway. Today, the results are impressive, and I guess the market will come to terms with it after the position adjustment. Wrap up on Bazaar. Chart Purchase after the break.
West Asia flashpoint deepens. Houthis say they targeted Saudi tankers while Washington steps up its rhetoric against Iran. Crude climbs on supply worries. Meanwhile, Indian stocks open weak. The Nifty falls below 24,000. Autos and metals defy the broader sell-off.
Dr. Reddy slips in early trade as weak Q1 numbers disappoint. A 240 crore semi-glutide API provision drags profits. North America business slumps 35%. Meanwhile, the India business delivers a better than expected 17% growth.
IndusInd Bank gaps down despite stronger than expected June quarter results. A 350 crore tax provision overshadows profit of growth of 72%. Net interest margin excluding interest on tax refund contracts. Management warns of continued margin pain in the second quarter. Brokerages divided on the counter.
Oracle Financial Services reports a blowout June quarter. The revenue climbs more than 50% year-on-year with operating margins touching 60%. Additionally, the Chief Executive Officer steps down and we have the CFO who will be taking charge. The stock, however, comes in for some profit taking, had opened up 5% up, moved into the red and now more or less flattish.
Strong double-digit growth in the first quarter sends shares of Tanla soaring. Growth largely led by digital platforms and enterprise communication segments. The stock up 15%.
Well, hello and welcome to Chartbusters. We are coming to you live from the CNBC TV 18 Motilal Oswal studio. I'm Nigel. With me is Mangalam. And we've got a lot of earnings to go through. So let's get straight to that. HEG posted actually a strong set of numbers. The revenue was up by close to 11% year on year. On a sequential basis as well, it was up 13%. The margins expanded. Net profit as well did come in higher. To help us out with how the quarter was and what's the way ahead, we're joined by the Vice Chairman of the company, Mr. Riju Jhunjhunwala, to break down the numbers for us. Hi, Riju. Good to have you on the show. Thanks a lot for joining in. Let's get some clarity going then. It appears that you're bouncing back. In terms of this growth of around 11%, how much of it was volume-led? How much of it was price-led? And if you could tell us, what is the utilization level for the past quarter?
So the volumes are approximately 24,000 tons.
Okay.
Price would be 7 to 8% higher on the whole. And going forward, I think we need to maintain this kind of operating number.
So 7 to 8% on a sequential basis higher?
On a sequential basis, yes.
Pricing has started improving then?
Pricing has started improving and we are seeing good trends moving forward because the two leading companies like, Graphtech, Tokai, etc., they've already announced price hikes because of raw material increase, ocean freight, etc. So I think it's a matter of time before maybe it takes another 3 months, but the prices have to go up from here.
So the utilization levels for the past quarter was close to 95%?
91%.
91%. All right.
It should be probably the highest in the industry, if I can safely say that.
Okay, 91% was utilization levels. Got that. Give us a few more details. How were needle coke prices moved? Because price hikes are good, but if your input costs are moving up as well, that's what could offset each other. So how much are needle coke prices higher? And what's the margin trajectory from here? When you're mentioning your margins, you could tell us either you're including the Graphtech investment or X of that, because that's an MTM. So what kind of margin should we look at?
So needle coke prices have been stable so far, but they will be increasing to a little bit, around 10 to 15% from here. I mean, obviously that has a time lag of 3 months for us. But also, like I said, that the second half onward, we see a significant price increase in the overall spread between the needle coke and the graphite prices. About the Graphtech investment, that's of course like a mark-to-market loss or a gain. And we still stand firmly behind our belief that ultimately if the whole graphite industry has to do well, 120 million tons of EF being added in the next 3 years, then graphite companies should do very well, including Graphtech, for which we continue to hold the shares that we do.
So this 600 to 650 crore EBITDA plan for FY27, that's on the cards?
I mean, I can't comment on the exact number, but I think going by this quarter's results, I think we should see a better result than the quarter for the year as a whole.
So 150 crores is what you've done in the first quarter. If that improves the trajectory, you are not ruling out a possibility of going above 700, 750 crores in the entire year as well.
I mean, if the price increase sticks and the price increase has happened, then yes, definitely that's a possibility.
Tokai just went ahead and increased prices, right? So your contracts come up for revision by when? By September, October, we should see a price revision?
These are all rolling contracts, like for 3 months, 6 months. It's no longer a period where you used to book the entire volume for the year. Of course, as we are booking new contracts on the back of Tokai and Graphtech also increasing, if we are getting an increase in price by the customers because of that, we are very happy to take that.
So when are these price hikes due and when are these renovations due? If you could give us a sense of what proportion of your overall contracts go in for renovation in the next 2 quarters?
So you can say a 3-month time lag between the price increase between today and when it happens next.
Okay, Riju, give us...
H2 being the real price hike quarter.
Right. Riju, just to give us some few more details, how much of your sales are done on spot? how much of them are done on contract basis? And within that contract basis, is there any contract monthly or everything is quarterly or 6 monthly? Break it down for us. A rough number will do.
So, Nigel, there's no one rule to something. Earlier, 5 years back, if you were asking me the same question, then I would say that it was almost booked for the year as a whole.
Yeah.
Now there are a lot of spot contracts because of there's so much volatility because of the Middle East war, oil prices, gas prices. So even the customers and us are going in for more shorter contracts on the whole. So let's say, I mean, if 5 years back it was a 10 to 12 month kind of contracts, right now it would be safe to assume like on an average, a 3-month kind of price contract with all the customers.
Sometimes you take me back 5 years and all. I remember 8 years ago, the way you all were dancing to the bank, you know, the market got surprised and HEG was on everyone's radar. HEG and Graphite India is one. That's when, in fact, I paid greater attention to the graphite electrode sector. You're making margins of 60-70%, Riju, at the peak. Now that's come down to around 20%.
I mean, those are abnormal times, let's admit. Like, those are abnormal times.
What are the normal times then? 25%, 30% margin is doable? 25 to 30%?
Yeah, I mean, this quarter also, if you see, we've done around a 29% EBITDA margin.
Yeah.
And for the year as a whole, we should do better than that.
Okay.
Right. You know, you did allude briefly to the Middle East conflict and that impacting your business as well. I think it's about 20% of your volumes. Could you quantify the impact in the first quarter and have things...
Yeah, I mean, overall Middle East, especially Turkey, etc., they contribute to around 15% of our overall margins. But our sales have not suffered. As you can see, we have still sold more than 22,000 tons this quarter, which means obviously there are other places in the world that we are selling to. And USA is one of the main drivers for that, because of the large steel capacities actually coming up on ground there.
What you're saying is that the 15% sales that you would do to Middle East is not happened because of the war, and you've redirected that 15% volume to other places.
Yes, yes.
Right. So that also means that once, the war situation normalizes, this is additional 15% sales for you?
So which is why, I mean, we are doing this expansion from 100,000 tons to 115,000 tons, because we are quite sure that, globally, the kind of market reach we've developed over the last few years is going to help a lot. And, this 91% capacity utilization is on 100,000 tons, which used to be 80,000 tons till 18 months back. So I think we are quite well set on that particular.
You also said that you redirected a large part of that to the US, which is now your largest market. Is there any tariff-related trouble out there?
No, there's no tariff-related trouble over there. I mean, it's the same tariff that everyone has, that 10% tariff for everyone.
All right, Riju, you're putting an exciting prospect, but before the viewers, the stock is at the high point of the day. But the way ahead, the crucial triggers, what about the demerger? By when do we see this demerger? When is the next hearing date, if you could tell us? And in the next 3 years on the green tech business, you can do an EBIT of around 1,000 crores. Is that possible?
So, Nigel, I'll tell you quickly, the demerger, the NCLT has already reserved the order. Now we're just waiting for the formal papers to come in. And if I speak in terms of timeline, sometime in the month of August, the delisting will happen.
Demerger.
And the demerger will happen. And the HEG graphite business would move out of the main company and would be delisted around 60 days later. So things are totally on track. And as far as the demerged entity goes, I mean, we are totally on track. Our largest in India, the anode plant that we are putting up, that's almost 60% complete. That will hit production by June of next year. No, sorry, I mean May of next year. And we already have a lot of contracts and samples that we've already done with many international companies, auto OEMs, etc. I can't take their name, but we are very, very happy about the way that company is going, and also developing some new products, large R&D base, 60 people working in the R&D sector.
Okay.
So good times ahead for that. And yes, I mean, in the last interview also, you had held me accountable by saying that by 2030, we are looking at a 4-digit EBITDA. Okay. I can safely confirm that, and that it will be definitely more than that.
All right, Riju, we're going to hold you to these numbers. You're talking about a business in the core business, current core business, which is graphite electrodes, could do around 650 to 700 crores, very, very broadly going by the trends that we've seen. And in the business, the green tech business could do 1,000 crores by 2030. So as always, I hold you to the numbers and we look forward to delivery. For the time being, the street likes what you've said. Stock at the high point of the day. Time to slip into a short break though. We've got another management that's waiting for us on the other side. SmartWorks co-working spaces. The stock has been on fire. We'll understand from the management what's the trends on this one.
Welcome back. The stock on our radar is SmartWorks. A big up move is what we've seen on the stock. Good numbers coming in for the company. And it's a strong growth on the revenue in particular, 44%. That's reflected in the EBITDA growth as well, 74% jump, and profit nearly tripling to about 39 crore rupees as well. The founder, MD Nitish Sarda, joins in to break down these numbers. Thanks a lot. Congratulations, Nitish, for this performance. The obvious question, you guys have majority of your revenues already locked in because of the contracts that you've signed. The first quarter, you've done about 44% in revenue growth. The last time we spoke, you had guided for 28 to 30%. With the first quarter being the way it is, do you want to up your guidance? Or are there any challenges that you see in the second half of this year because of which you are maintaining this conservative 28 to 30% revenue growth guidance?
Good morning. Thank you for having us today this morning. How our business model currently is positioned is that we're in a very high growth stage. We've already grown to over 10.4 million square foot of active space, but we have more than 2.5 to 3 million square foot of space which is already under construction, identified, already under construction, and will hit the market within this year itself. With the high increase in the footprint and a 30% increase in our footprint within this year itself, we are fairly confident of achieving that 28 to 30% growth for the year, considering the significant demand or significant expansion.
I understand you're fairly confident. The first quarter, you've done 44% already. So the question that I'm asking is, how much beyond 30% can you do? Why are you so conservative in your guidance versus what you're delivering? You want to up the guidance itself for the street?
So essentially, it also depends on the new centers. The new centers that are hitting in pulls our margins down a little bit in the initial days. And that's the reason that we think that it'll take some time for these centers to get updated. Also, if you look at our current inventory, we're already at a committed revenue of about 92%. It means that our current inventory doesn't have a lot of room left for us to sell. So the new inventory which comes in, which will get live over the next 5-6 months, and by the time the revenue starts getting contracted, might be the last quarter of this year. And that's why we are fairly confident of achieving that 28 to 30% number. But yes, if we are able to fill in certain centers a little earlier, then we'll definitely beat those numbers. But this is something that the management is very confident about.
Nitesh, I'll tell you what Mangalam is saying is, SmartWorks has come out to bat, okay? The power play has been phenomenal. The first 15 overs, you're in top form, scoring at a big run rate. Now the thing is, are you going to be slowing down from here? Because 20 to 30%, when you're growing at 45% in the first quarter itself, either you're looking at pacing out the innings or, and slowing it down a little bit, or you're just being a little conservative and you're telling us 28 to 30% and suddenly the slog overs, again, you'll come back into form and SmartWorks will smash it out of the park. Are you being conservative? Should we look at 35 to 40%?
We are not being conservative at all. We're being as aggressive as possible. If you look at our space take-up, we've signed up spaces worth 16.9 million square foot, right? So we've locked in a lot of supply. We are being cautious about how much supply is going to hit the market, which we are going to be ready. As I said earlier, our committed revenues already stand at 92%. So for us to get more out of the existing buildings are going to be a little difficult. And it is very difficult to predict whether the 3.2 million, which is under construction, it might get delayed by a month or two. So you can't really bake it in. I'm fairly confident that 28 to 30% is something that we will achieve. But you will see this number significantly increase in the last quarter of this year, because most of the supply that we have taken, which is under construction, after the 4-5 months of construction, will hit the market in the end of this year, which is quarter 4.
All right, Nitesh. So, it's like the team at the start of the 2000-2005. You get a super start with Sehwag, Tendulkar, Ganguly at the top, but then you need Dravid to come in there and stabilize the innings. So it appears that you're being cautiously optimistic and 20 to 30% is a given. We won't push you more on that. Tell us about GCC contribution. I think it was around 15%. It's moved around 21%. Where is this number headed in terms of contribution? You could correct me on that number as well.
No, you're absolutely right. It hit up to about 21% in this quarter. You will see these numbers jump not just from 15% in the last quarter, but these numbers were, in the early teens, 10, 12% last year. We've already doubled this year to get to about 20%. I think GCCs are driving about 35, 40% of growth of commercial real estate in India. And that is being reflected in the growth that SmartWorks is also getting. They were a very small base. So on a total number, you'll see it to be 21%. But if you look at the incremental revenue, they're almost 50% of SmartWorks is incremental revenue, which is where you're seeing that almost 50% of the deals that we are signing are now coming through GCCs. So we are very bullish, and we are actively launched our own platform called Smart Vantage. We're seeing a significant amount of uptake of not just the space, but even the services that SmartWorks has to offer through its platform. And you will see again in the next probably end of this year or early next year, the accruals of the services will also start hitting our margins. And that's why we have always positioned SmartWorks as a compounding machine. Despite high growth, despite growing at 44%, EBITDA margins growing at 74%, our base is also growing at almost 35 to 40%. Right? So we are here to scale. We are in a power play mode, as you said right now, and we will continue to be in a power play mode at least for the next 3 to 4 years, for which we have pretty much got visibility to both supply as well as demand.
All right, take that point. Just a final question before we let you go. You said that as new supply comes in, as occupancies take time to, fill, you would see an impact on the margins in the very near term. But at the same time, you have, some of the middle offices getting mature as well, and mature offices giving you a lot more. So what is the margin range that we should be working with even as you grow faster? Does operating leverage take your margin further higher, or new supply put it or constrain it to a range? Should 19 to 20% be nominal, or should we look at beyond that as well?
we're not saying that the margins are going to take a hit. We are fairly confident because of the pre-filled demand that we have. We are fairly confident that the margins will sustain. If you look at our margins, it stood at 16.2% year on year. Last year, it was in the same first quarter, it was at 16.2%. Last quarter, we reported 19%, and we have already increased to 19.6%. So we're not saying that the margins are going to increase in the same ratio as it has increased in the last 12 months, because we have a lot of supply coming in. Margins are not going to go down. Margins are going to be stable, but you will see the effect of this new 3.2 million square foot coming in probably in the last quarter of this year and early next year.
Got that. So if we had to look at your business on a steady state basis, margins would normalize around that 20-21% mark, right?
Currently, with the high growth stage that we are in, it'll stabilize at that mark. The day that the base effect kicks in, where our growth slows down as a percentage, which means that we still add 3 million, but the base is already at 12, 13 million, then obviously the margins will keep increasing. But currently, it takes us about 12 to 14 months to fill up a building. So if we have 3 million square foot coming in, for the initial 12 to 14 months, it drags the overall margin of the company. But the mature centers are now pushing up the margins significantly. So once the overall base becomes bigger, you will see these numbers go up. But currently for this year, since we're adding almost 35% of our capacity, we're pretty confident of maintaining the margins where they are.
Take that point. Thank you so much for joining in. The street likes what you've said. As you spoke, there was a movement that we saw in the stock price as well, up at the high point of trade, near 500 rupees per share on SmartWorks. We'll take a short break, come back on the other side, more on the markets and a lot of stock-specific action. Stay with us.
Welcome back. The stock of HEG, clearly the street has heard the interview because the stock, from being up 4-5% is now up close on 10%, a massive move that we're seeing on HEG. But let's shift focus to an exclusive on HDFC Bank. Sources tell us that the lender has wound down a builder loan book worth over 1 lakh crore, inherited from the erstwhile parent HDFC Limited. Furkan joins us to tell us what is he picking up from his sources. Furkan, what was the size of this exposure and why has the bank done this?
We are picking up from the sources is that this builder loan book, as it is called, was around 1.2 lakh crore rupees in March 2023, just before the merger. It belonged to the parent entity HDFC Limited. Now, 3 years since the merger, HDFC Bank is learned to have pared it down. Sources say a large portion of this loan book had already been run down and the remaining was sold to the rival banks and a gamut of NBFCs. The reason behind this move, we are given to understand, is that the management of HDFC Bank wasn't very happy about this loan book, especially the kind of low visibility it offered on the asset quality side. Now remember, at the time of the merger, this was a high yield book. HDFC Limited enjoyed a 3.62% spread on the non-retail loans and a relatively lower 1.92% on retail loans. And this builder loan book, which essentially involves the loans given to the real estate companies, builders and the developers, made up around 20% of the total loan book of 6.2 lakh crore rupees for HDFC Limited. Sources tell me that though this the spread was high, the bank's management was not comfortable with the high risk that came with those high returns, because the risk of the default was also higher. We are also given to understand that the total non-retail exposure in March 2020, for the total non-retail exposure in March 2023, the default rate was at 16.1%. That includes roughly 15,000 crore rupees at stage 2 default, when the repayments are more than 30 days past due, but less than 89 days. And around 4,500 crore rupees was at stage 3 default, which is overdue by 90 days. Also, we learned that HDFC Limited, which was a housing finance company, had exposure to many defaulting realtors like Radius Developers, DN Realty, and Nirmal Developers. Keeping these factors in mind, the bank's management decided to do away with the loan book entirely. And this process, we are given to understand, has now been completed. CNBC TV 18 reached out to HDFC Bank for the official response on this information, and the response is awaited. We will get back to you once this response comes in. Back to you.
All right, we take that point. Furkan, thanks a lot for that. There has been a notable recovery in the market as well. Nifty's deficit down now just to 20 points. What we'll do is take your leave on this edition of Chartbusters with the promise that trading hour takes the market action forward. Nigel, me, thank you so much for watching. Good morning. You're watching us here on Trading Hour. We come to you live from the CNBC TV 18 Motilal Oswal studio. I'm Mangalam Malu. With me, Ritu Singh. And for the market, there is remarkable resilience that we've seen. We had all the reasons for the market to stay lower after having opened lower, but between the 23,850 to 23,900 mark is where there is strong support of both the 50 and the 100-day moving average on the Nifty, and there has been recovery. The Nifty is recovered over 100 points from the lows and now sitting at just beneath the red line. In fact, if we speak a little more, the Nifty may perhaps just move into the green as well. What is it that has led the recovery? We have auto stocks which have done well. There has been recovery from the banking pack as well, and the IT pack too has cut its losses. FMCG has been doing well. Metals as well is the index which is largely in the green. So the top contributors from autos as well as FMCG, along with some of the metal names. A lot of the broader market names as well buzzing around. We have a few more number of stocks advancing than the number of stocks which are declining. Ritu.
Good morning, Mangalam. That's right. The markets may be in the red, but you look at the stock action and you have about 1,600 stocks that are advancing versus about 1,300 that are on the decline. So that ratio looks marginally better, gives you some hope. The IT back still in the green, though. Bank Nifty, of course, continuing its cuts and now below 57,000 as well. So the recovery there is something we'll keenly look at. But, for the macros as well, you have crude at 96, and that's clearly adding to the pressure. Rupee, although it's a bit stronger today, just a few basis points, but it's not too far off from that record low that we'd seen, currently at about 96.53. What's not doing so well, apart from these, is, the energy space, seeing some downward pressure there. The pharma space as well. What's doing relatively better, though, like you pointed out, was auto, FMCG, metal, and some of these particular names. But let's get you specific stocks to keep your eye out on. And Hormaz joins us now with a list of top movers and shakers. Hormaz.
There'll be optimism. There will be some of it, at least, considering the fact that the dip has been bought into, at least for now. 23,900 was the low. They've managed to hold on to that support. That's what the analysts were also mentioning as well. So fairly okay first half of the session so far for the Nifty. The Nifty Bank too was on the verge of breaking below the mark of 57,000, and it has done so in today's session, but again has managed to hold on to some support at 56,700 and then is now trying to recover from the lows of the day. The macros, as you just pointed out, don't look pretty positive as of now. Crude now is at 96 and it continues to do so, continues to move higher, especially considering the situation in West Asia does not look very positive as of now. What is positive though are some of the result reactions in the broader markets today. And take a look at Gandhar Oil, which is up in a 20% upper circuit. NTPC Green is up 8, HEG is up 8%, and Eternal, after some positive brokerage commentary, with most of the analysts continuing to retain a buy rating on the stock, 4% higher on Eternal, nearing the mark of 300 yet again. On the flip side, IndusInd Bank's results were better than what the street was fearing, but the stock is down 5% because the stock had already run up significantly in the lead up to the results. CIE Automotive is down 9. That's the worst performer on the Nifty 500 today. And HPCL too. Vari Renewables was the stock that I wanted to mention, not Vari Energies. And HPCL, of course, after that 11,500 crore rupee loss, is now down another 3%. Auto stocks were doing well yesterday. They continue to do well today as well. Then Hero MotoCorp is up around 3.5% now in today's trading session. Bajaj Auto adding to yesterday's 6% move, another 2.5%, and Mahindra too trading with gains of close to 2%. The paper stocks is a theme that's done well today among the small cap space. Quantum Papers, Orient Paper, JK Paper, all of them seeing gains of anywhere between 5 to 7% in today's session. And lastly, stocks like Chennai Petro are at 52-week highs in today's session. Another 2% added to the tally, a 2% gain for Bosch as well. Steel Strips Wheels has extended its gains up 5% now, and Savita Oil as well, the 5% higher on that stock, that too at a 52-week high.
All right, Hormaz, thanks very much for running us through that list. Let's invite our first management on the show. UCO Bank, now they've posted an operationally strong set of first quarter numbers. There's good loan growth, healthy net interest income as well. Asset quality has also improved, but there was a sharp jump in provisions, which has dented the profit growth for the quarter. So let's put that into context and invite our guest, the MD and CEO, Rajendra Kumar, is with us now. Mr. Kumar, thanks very much for your time here on CNBC TV 18 today. I'm just looking at the first few pages of your presentation. Your guidance for the full year for deposit growth was 10 to 12%. Credit growth is 12 to 14%. And you've delivered better than these guidance numbers on both fronts in the first quarter. Deposit growth almost 11.3, credit growth 21%. Are you going to look at revising these numbers now?
Good morning and thanks, madam, for inviting us on your channel. So, as you have said, yes, we have exceeded our most of the guidance parameters which we have provided earlier. Our loan growth has been 21.18% as against our guidance of 12 to 14%, and our deposit growth is also 11.28%, which is within the guidance range of 10 to 12%. So as of now, we are not revising our guidance. We are sticking to those guidance only. But yes, going forward, midterm review we will do after the second quarter numbers, so that we have to ascertain whether the growth momentum continues. And keeping in view the other factors also, we will see whether we need to revise the guidance or we may continue to that. But I hope that yes, we may have scope to revise the guidance for betterment.
You may have scope to revise the guidance for betterment as well. So that's something that we'll monitor after the next quarter. That's on the loan growth front. Can you give us a sense on the kind of deposit mobilization that has happened because of the FCNRB scheme that was announced? If you could give us some color on that, and also give us a sense on how NIMs are likely to move going forward.
So, yes. On deposit growth front, we have done quite reasonably well, like 11.28% growth is there in this quarter of financial year. And we now have reached to a CD ratio level of 82%. And we will now more focus on deposits growth, particularly on CASA growth, to maintain our credit growth also. As far as the FCNRB and OFCB fund mobilization is concerned, we have started mobilizing the funds under FCNR. We have a very small base of NRI customers, but we are reaching out to all those customers and trying to garner maximum amount of FCNR deposit. Also, we are in talk with certain banks for raising our OFCB funds from our overseas branch. We have Singapore and Hong Kong overseas branches. So we expect that, yes, by the window is there up to 30th September for FCNR and for OFCB even beyond that, we will be able to raise at least 500 million US dollar through both of these measures, like FCNRB deposit as well as OFCB. So we are planning for that and we are working on that also.
So, Mr. Kumar, with $500 million that you'll raise through the FCNRB, are you baking that into the deposit growth guidance? And secondly, won't that be a bit dilutive for your margins? You're at 3.05% now. It's a 5 basis point sequential improvement we've seen. In the near term, by the September quarter, some impact there on account of these FCNRB raises?
So we have mix of both FCNR and OFCB. So we may raise funds as per the availability and as per the rate of interest which is available to us in the market. But I don't see any impact of FCNRB deposit on our margins, because we have been raising foreign funds earlier also. And we find that, yes, if we can raise the funds at competitive rates in FCNRB and OFCB also, our cost of deposits we will be containing. As you have seen that our cost of funds has been maintained, and we will continue to maintain at that level only. And I am sure that, yes, the guidance of NIM is 2.8 to 2.9% we have given. So we will be maintaining that guidance and maybe exceeding that little bit.
Might be exceeding your guidance as well. Currently, you're at a little over 3.2, 2.8 to 2.9 is what you've accounted for, but you haven't ruled out the possibility of upping your guidance after the second quarter. Let's speak a little about the asset quality as well. No real problems when we see your GNPAs or your net NPAs, both of them actually quarter on quarter and year on year have seen improvement. Where do they end by the end of this fiscal? And what's your credit cost guidance?
Yes. So our GNPA ratio is 2.08% as of now. And we have given guidance of bringing it down below 2%. So we are sure that going forward by March, we will be below 2% in GNPA. As well as in net NPA also, we have given guidance to bring it down below 0.20%. And as of now, we are at 0.25%. So I'm sure that, yes, we will achieve the guidance by March end and bring down our net NPA also to below 0.20%. Our credit cost and slippages also are within the given range. So our slippages has been 0.63%, that is annualized slippage percent, and we have given guidance of below 1%. So I think we will be maintaining that, and credit cost as well, 0.39% is less than our guidance of 0.75%. So we will be maintaining that guidance as of now.
Mr. Kumar, provisions have doubled. I just wanted to understand what's happened there and what are you expecting in terms of a hit as you transition to the expected credit loss guidelines, how much more will you have to provide?
Yeah, thank you, madam, for this question. Because you can see that our operating profit grew around 80%, but our net profit have grown only by 8%. So the issue here is only the shift in the taxation regime. Earlier, we were in the old regime of taxation where we had to provide at the rate of 35% approximately. So our DTA has now been recalculated, remeasured. Because of the taxation shift, now we have measured our DTA at the rate of 25% approximately. This has resulted in a one-time charge of 1,237 crore on DTA basis. So if you see in our provisions, the provision for taxation has gone up to 1,919 crore. So major part of this is 1,237 crore is one-time DTA charge that has been taken up, and 625 odd amount is for the current quarter profitability taxation charge. Going forward, this will not be there, and we will reduce the provisioning accordingly.
All right. Mr. Kumar, thanks very much, for joining in, with a commentary on what the quarter gone by has been like and what to expect going ahead. Thanks very much for your time. We'll slip into a short break on that note, but when we return, we'll get you all of the bond market action with Manisha Gupta. Welcome back. As promised, let's get you all of the action from the bond markets. And Manisha Gupta joins in as always to fill us in. Manisha.
Well, thank you so much for that. As has been the global cues coming in, the yields have gained slightly in the US markets there, and that's exactly what we are seeing mirroring in the Indian markets as well. The US 10-year Treasury yield is now trading at around 2026 highs. It is about the Middle East and the Ukraine war, which seems to be squeezing markets at various fronts right now. Also, when you look at the Brent crude oil prices, we are looking at $96 a barrel holding. The low of July has been 70, and we are trading at 96 right now. So that clearly has been almost $26 of a gain, which is 42% of a jump up for the crude oil prices from its July lows. And that clearly seems to be impacting global equities, the currencies, and of course, the bond and the yield markets therein. This is something that the street will continue to watch out for. And then, of course, you have the US Fed meeting as well on 28-29 July. The guidance, the statements, the tone that there is what will drive the markets further from there. Apart from that, there also are a lot of private bond issuances which just about continue into the Indian market. For the day, it is about Aditya Birla Capital, which is looking to raise up to 12.5 billion, and they're doing it via reissuances of the 2 bonds with different maturities. And then you have Best Capital Services as well, which is looking to raise something around 300 million. They're doing it via issuances of 3 bonds with different maturities as well. But there are a lot of long-term bonds as well, which are into the market, which you can make use of. One is from IFCL, which they have said they are going to raise $1.3 billion. And this is in span of 2 to 3 months, and they are doing it via external commercial borrowings. ONGC has been into the market. They're looking to raise 44 billion via NCDs. And then you have IDBI Bank long-term fundraising via bonds to the tune of 100 billion in FY27. There also is SBI looking to raise 10 billion in FY27, and IDA is looking to raise 400 billion in FY27. They're doing it via debt markets as well.
All right, Manisha, thanks a lot for that. So that's about the bond market action that has played out so far. But the earnings, that's something that we'll be tracking today. And in key earnings, IT earnings, Infosys is scheduled to announce their first quarter results today. Rima joins in with the key expectations. The stock off lows. Rima.
Thanks so much for that. So for Infosys, it's expected to be a good quarter. We're working with a revenue growth of 1.8% quarter on quarter. The broad range is about 1% at the lower end, going up to 2.5%. But this will not be pure organic growth because there will be a 2-month contribution from the 2 acquisitions that they did, Stratus and Optimum. Margins are likely to be maintained around 21%. Amongst the lot, Infi is likely to do better. But remember, Infosys is also the last of the large cap IT companies. We already have numbers from TCS, HCL Tech, Wipro, Tech Mahindra. Tech Mahindra has been the leader, the rank outperformer with a 2.6% growth. But relative to the others, aided by the acquisitions, Infi is likely to perform better at 1.8%. But Infi is, so directionally, we know what the industry is doing. We've heard the management commentary from all the other IT companies. But where Infi is special always, it's the only IT company to give you a long-term, an annual guidance. So currently for Infi, the guidance stands at 1.5 to 3.5%. This is organic revenue growth. But some analysts believe that the top end of the growth looks difficult to achieve. So maybe on an organic basis, the company could scale it down. But Infi is likely to now just change the guidance, taking into account the acquisitions. So the new guidance may look at 2.5 to 4.5%, but this will include about 100 basis points of the inorganic move. But again, these are all estimates that the street is working with. From an industry color, qualitatively, we've already heard from the other large cap IT companies. So in that sense, less important, but Infi's guidance will be critical to track. Back to you.
Right, Rima, thanks a lot for that. So that's about all the expectations from Infosys. We'll take a short break, come back on the other side. Market Technicals with Ajit Mishra of Religare Broking. Welcome back. You're watching us here on Trading Hour. The market continues to see some supply as we move towards that 24,000 mark, even though we're off lows. And the stocks that take it lower are some of these large private banks. Pull up ICICI Bank for one, or something like the others as well. Axis Bank has moved off the highs. But there is important breaking news at the bottom of your screen. Sources tell CNBC TV 18 that a troubled global major may look to sell a material stake in its Indian listed entity to tide over a cash crunch. What's the company? Well, it's up for you on the screen. Vivek.
Well, that's right. What we are learning from our sources is that Oracle Corporation, that is the parent company or holds majority stake in the Indian-listed Oracle Financial Services or Oracle Financial Software Services, has sent out feelers to go ahead and garner interest as far as the potential material stake sale in its Indian-listed company is concerned, looking to sell a portion where they will go ahead and garner funds as far as its own operations are concerned. Now, what we understand from our sources is that initial feelers have been sent and a couple of investment banks have been approached to go ahead and garner investor interest to see what could be the likely size of such a stake sale in case it does materialize. What we also understand from our sources is that the size of the stake sale will then be decided upon gauging the investor appetite. Now, just to give some perspective, Oracle Corporation in Oracle Financial Services held almost 72.4% stake at the end of Q1. Now, one of the likely reasons for this particular stake sale, what we understand from our sources, is that Oracle Corporation, the US company, has been facing financial distress. In fact, S&P recently downgraded Oracle Corporation's credit rating to a BBB minus, and they call it just one rate above investment grade, and one more notch downward means that this particular credit rating is a junk rating. So on the back of that, S&P has also noted that rapidly expanding AI infrastructure business is what is increasing the company's overall credit risk. Now, along with that, they also expect weaker free operating cash flow in fiscal 2027 than in their previous forecast. What we've done is we've written both to OFSS India, to Oracle Corp, we've written to the Media Corporation or the Media Relation team in both of these companies. We are awaiting a response. As and when we do get a response, we will go ahead and update our viewers. But at this point of time, we understand that there could be a likely stake sale in OFSS India, where Oracle Corporation owns over 72% stake.
All right, Vivek, thanks very much for bringing us that exclusive Oracle Corp looking to sell stake in Oracle Financial Services. Let's move on and get you the latest trends from the F&O space. Manglam has those for us.
Well, we've seen a recovery from the lows for the frontline index, though at higher levels we are seeing supply come back once again as well. So that's telling you the story of the day. We have the Nifty, which is doing reasonably okay given the macros, down about 40 points. The mid-cap index is down by about 0.4%. It's the Nifty Bank which is most worried, down by about 0.75% after having broken the 200-day moving average yesterday. The India VIX is lower, which tells you that the bulls do see some support at lower levels, and there is contribution which is coming in from the auto pack, so that's something that we will be tracking. The important part, today's low now becomes a level to track as we move forward, largely because it stands right in the middle of the 100 and the 50-day moving average. So there's support which is expected to be between this 23,850 to 23,900 sort of zone, very close to where today's low is, and that is likely to hold out. But at the same time, as we move higher, we are likely to see some supply, which is what is reflecting in the kind of option writing that we're seeing. Yes, 23,900 put writers fairly active in trade, but 23,900 call writers equally active in trade as well. So the 23,900 call comes up for you on the screen. You see a premium of 95 rupees on that. That tells you that levels upwards of 24,100 thereabouts is where you will see some supply. And that coincides with the 20-day moving average on the Nifty as well, which is 24,120. So after having broken below the 20-day moving average, that's a level of resistance on the way up. And similar is the case for the Nifty Bank. We've been saying that so long as it holds the 200-day moving average, it's okay. But yesterday, the ferocity with which it broke, now it will become a resistance on the way up. So crossing 57,400 on the Nifty Bank will be crucial for the bulls to track. But amidst all of this, fresh longs added on Eternal. Stock continues to do well after its numbers yesterday. So from lows of close to 280 yesterday, the stocks moved to about 293 right now. And DMart, that's coming in for some purchase as well. Shorts out here have been caught on the wrong side. So that stock's moved higher.
All right, Manglam, thanks very much for setting that up for us. Perfect time to invite then Ajit Mishra from Religare Broking, who joins us for a quick technical check of the market. Ajit, the selling pressure continues. We've broken below the 24,000 mark for the index, for the Bank Nifty as well, 56,690 as we speak. I mean, Where does it go from here? And your top stock calls for today?
Hi, good morning. So yes, we are again seeing that index has been facing pressure after retesting the recent swing highs. In fact, the consolidation has been almost over a month now that index has been hovering in this band of 23,800, 24,400. So after the failed attempt, again, we are inching towards the lower band. Today, after the initial downtick, we are seeing a bit of a recovery. But overall, the banking has reached to its critical support area, the long-term averages on the weekly daily chart. So in case if we fail to hold this level close to around 56,400, 500, and IT, we have Infosys result also scheduled, which is really under pressure. Probably we might see an attempt of breaking below 23,800 mark, which could push the index further lower towards 23,600 or lower. So as of now, the index texture from sideways to negative is intact. But at the same time, when it comes to stock-specific move, yesterday also we were seeing that FMCG auto counters were doing well. And we are seeing the continuation of the move. So basis that Eicher, which has already spent roughly around a month in a tight consolidation range, has witnessed a fresh breakout. So here one can look for long position with 7,600 as a stop loss and 80.50 as a target area. And then from the healthcare basket, we have Medanta, wherein we are seeing fresh traction after the consolidation range break. A tight pivot formation, 1340 is the stop loss area for the positional target of 1470.
All right. We get your calls as well. Thanks a lot for joining in. Meanwhile, there is some important data point coming in on the SRF con call. Those lines are coming up for you. Early signs show price and trend moving marginally upward for the company. Post results, remember the stock was down about 5%. Let's see how that goes. And just before we take that short break, pull up the intraday chart of Oracle Financial Services. Vivek, at the start of the segment, told us that the parent is looking to pair stake in the company. The street's taking note of that. There's a sharp decline that we're seeing. It's down about 7%, fears of supply from the parent. Them, looking for some interest in the company for their stake, has the stock lower by about 7.5% now as we speak. Take a short break. On the other side, market fundamentals with an expert.
Welcome back. Now, Blinkit's EBITDA growth of over 100 crores in the first quarter, and now the company is leading the quick commerce race. Let's go across to Mangalam Malu now to understand Blinkit's Q-commerce dominance. Mangalam.
Well, if you look at the quick commerce category, a lot has been spoken about it. And as it's been spoken about the opportunity here, the disruption and all of that, the one thing that really stands head and shoulders above everything else is Blinkit's dominance. And at scale with profit, it's way ahead of all the other peers as well. So if you look at the first quarter numbers itself, their net order value of 17,132 crores, total orders of nearly 33 crores with over 3 crore transacting customers, a store network of 2,400 dark stores with a total retail footprint of almost 19 million square feet is comparable to any large consumer company, and doing that at a scale in which it's become profitable over the last 5 quarters. The inflection point has been seen, and now the profits are only increasing exponentially from 4 crore in Q3 to 37 crore in Q4. Now the quarterly EBITDA has crossed 100 crore mark, and that's the milestone that we're speaking about. The company has actually spoken about steady state margins of 5 to 6% as well, with robust NOV growth continuing for them. Not just that, they've also spoken about the unit economics. Even as capex per store has increased from 1 crore to 2.5 crores, the NOV per store, or net order value per store per day, has also increased to 11 lakhs with working capital investment of 3.3%. So you add about 2.5 crore plus the 3.3%, your pre-tax ROCE target is close to 41.7%, and that's how profitable this model is at even scale. The company's strategic moat here is 3,000 crore rupees worth capex, which has been invested over the last 4 years. They've retained nearly half of their customers, and retained customers spend nearly 3 times more after 12 quarters. So that's a metric that they're tracking. The model choice, transitioning of the model to their own inventory as against third-party inventory, has also aided their margins. And at the same time, the next 30 cities, along with gourmet assortment, would be growth drivers for them. Amidst all of this, where do they stand if you look at peers benchmarking? Remember, Blinkit had reported their first quarter numbers yesterday. We are still to hear from Swiggy on their first quarter numbers and Zepto's DRHP. So in normalizing it over FY26, they've done nearly 1 billion orders, store count of 2,200, and orders per day 2.5 or thereabouts. Add all of these together, Blinkit is actually almost at par with all the other peers. So this space, while everyone's jostling for some opportunity here, the large disruption, Blinkit's scale, size, and profitability stands above everyone else, which explains why the valuation that Zomato gets or Eternal gets is contributed a lot more by Blinkit than it is for all the other listed peers.
Mangalam, thanks very much for running us through that. An interesting piece there. But let's invite our guest on the show. Next one, we have Anirudh Garg, who's the partner and head of research from Invasset PMS, who joins us now to discuss market fundamentals and his top sectoral picks. Anirudh, thanks very much for being here. Your portfolio is fully 100% in cash. You've deployed nothing in the equities. In your notes, you say this is not an absence of conviction. It's a process-driven stance. Help us understand, what's going to get you back to deploy? What are you watching out for? Because earnings in some pockets have been pretty strong. Some, of course, have been weaker. But, what will get you back?
Of course. See, for a fund manager, taking a cash call, it's the most difficult call to take. As fund managers, we only have to lose from it. Clients, they want to be invested all the time. That is what the nature of the equity markets. And that is what we all have been taught. The longer you invest, the better the return is. But we are seeing something else, which we have seen in Indian markets for a very, very long period of time. I've been in the market since 2006. As a firm, we have been since 1992. So we have seen a lot of cycles. What we are seeing here is something which have resembled in the past to the end of the asset cycle. See, this asset cycle started in 2020 March, post-COVID, when the US Fed opened its gates with the funds. Now, I think somewhere we are seeing signs of asset classes giving up, which are the very early shoots. We have seen gold give up. We've seen silver give up. We have seen, the tech, AI tech bubble, which was being made in US and the Asian tigers like Korea and Taiwan and Japan now gave up. So somewhere asset classes have started giving up, which is a very early sign of an impending bear market. I think it is very, very difficult for us to answer your question to get into the market again. Of course, we are tactical right now. We will buy into capitulations, and by capitulations, we mean stronger losses in the market. When the markets have stronger losses, we will get in. And I think it's more of a buy on a fall and sell on a bounce type market for us going forward. Somewhere our focus has shifted from capital appreciation. We've made very good CAGR in the past 5-6 years. I think everyone has. Nifty has grown by around 14%, 16%, I suppose. We have grown at around 28 to 30%. And I think as a duty of a fund manager, sometimes when your systems tell you, you should shift to capital preservation than capital appreciation all the time.
Well, Anirudh, let's say you did have to deploy money in the coming quarters. Sectorally, what looks stronger from a risk-reward perspective at the moment? Of course, you say you'll buy on a fall. Perhaps you're expecting a further fall. But, what would look attractive from, what you see at the moment in the market?
See, in the market right now, let's divide into on the market cap basis first, so that we can we can funnel it down to what we would like to buy. Okay, so when it comes to the valuations of the small and mid caps, I think Nifty small cap is at around 36, 37 multiple, which is around 25% premium to the median and highest it has ever been in the past few years. So small caps and mid caps right now are out of the question for us. If something had to be bought, it would be the large caps. Okay, and in the large caps also, I believe if I have to deploy my client's capital right now, the world has seen a capex run, and I believe capex and the cyclicals are something which has shot up a lot in the past 6 years, and the valuations are not supportive. So all the cyclicals and the capex sectors would be out. So what we remain is with the defensives like pharmaceuticals, I was very bearish on Indian IT, but right now I believe that, okay, the valuations have also come to a place where they are not that bad. So something in IT may be all right, but of course, we've not bought IT for the entire run since 2021. Maybe we will not buy it right now because we are seeing some very, very big changes happening in this sector. So auto is also expensive right now. Very difficult for me to, I think it will only be B2C. So FMCG, consumer durables, maybe some two-wheelers and pharmaceuticals.
All right, take that point. FMCG, consumer durables, some of the two-wheelers. Two-wheelers are doing well today. Hero MotoCorp and Bajaj Auto, both of them are up between 3 to 4%. Bold calls here. We will obviously keep monitoring how this goes along, especially at a time when, a lot of the fund managers that we speak to are finding a lot of favor in the small and mid caps after the correction that they've seen over the last 3 years or so. But take your point, Anirudh. Always a pleasure listening to your views. We'll take a short break, come back, get you more of the markets and a lot of stock-specific action. A couple of broader market names are spiking right now as we speak. United Spirits up nearly 2%. The revenue actually beat expectations, even though the margins and net profit were below. We've seen some traction in Page Industries. That's been quite a stock. It's seen a remarkable recovery from its lows, almost 35% higher from its 52-week low on Page Industries. A lot of it coming in this year itself. And Whirlpool is the other one, which has also seen an up move of nearly 3.5% at the high point, giving company to Bosch, which too is sitting with a gain of a similar level, around 3.5%. But let's get you some exclusive conversation. It's with the global investment firm Temasek, which remains bullish on India and is not slowing down on their investments here. The company's India head, Ravi Lamba, signals more capital is headed towards India and they're betting big on healthcare. Here's a slice of the conversation that my co-anchor Ritu Singh had with their India head.
AI is clearly not just the flavor of the day, but it's the future in terms of how enterprises and people will interact with artificial intelligence. And I think what we're doing is currently, as you said before, we are looking to double our portfolio globally, but more importantly, it's just the beginnings. From an India perspective, we see the opportunity in India around the application layer because adoption is needed. Adoption takes time and adoption needs certain skills. And we think India will play well when it comes to the application layer for AI.
Just zooming into India then, because India has been one of your strongest performing markets in the last decade, but still its share has eased a bit from 8% to 7% now. Is that simply because of what's happening on the currency front, or are valuations here making it harder for you to find attractive opportunities?
Sure. Let me give you some perspective on that. I think firstly, we had said a few years ago that we would try to deploy between $9 to $10 billion in India over the next 3 years. And we're on track. I'm happy to report that, in the last 3 years, we've deployed close to $9 billion. And it's not like we're slowing down. We are happy to keep looking for opportunities and deploy more capital. What happened last year was actually quite specific. We were approximately $50 billion US in exposure to India in 2024-25. In 25-26, we had two events. One was the exit of our investment in Schneider, India, which was north of $6 billion. And then there was, of course, some sell down by Singapore Telecom. From our perspective, we keep looking forward to deploy what we said we would. And if opportunity presents itself, we can even deploy more than what we said in India because we like the thematic. India has been a great performing market for us despite all the headwinds we've seen on the currency. And we're very happy with our portfolio performance in India.
So if you were to, Ravi, then deploy your next $1 billion in India today, what are the top 3 or 5 thematic or sectoral themes where you'd put your money? Perhaps a theme that's still underappreciated by the market you'd like to call out?
I mean, given what we own today, we would like to double down on what we own firstly. So, we own stakes in financial services, in healthcare, in consumer, in industrial. So I think those are all great sectors, and we will keep finding more investments in that.
You spoke earlier about healthcare, and that's become one of your biggest India bets from Manipal, Medanta, Dr. Agarwal's that you were just telling us about. Would you say that is now India's next structural compounding story? And as assets like Manipal, they prepare to go public, how are you going to balance on one hand, monetizing what's been a successful investment or, staying invested for the next phase of growth in the long term?
Yeah, I think healthcare services we see fundamentally very attractive as a sector, and I'll tell you why. Because there's the population in India grows. You need good quality healthcare. You need medical excellence, and you need scale. So if we can be invested in a platform in healthcare services which caters to all of these demand requirements, then it's a no-brainer. The question is, can you scale? Can you scale profitably? At the same time, can you provide the best possible medical care? And what inputs do you need to provide that? And that's where we are very focused right now. In everything we own, we want to try and see how we can use the data that we have, improve the quality of healthcare, improve the output of healthcare services so users will benefit, use AI so we can improve the interaction and the way healthcare is provided. And we see that as another big driver of growth. So it's a great sector to be in. We have doubled down often in the companies that we own, and we will continue to do that as we see the opportunity expand. And the opportunity is coming from both ends. It's coming from organic expansion and inorganic expansion. So when opportunity presents itself, we will be happy to back our portfolio companies to do M&A as well.
All right, bullish on healthcare is Temasek. More capital coming towards India's way from them. With that, we'll take a short break, come back. On the other side, Ritu will give you an interesting macro insight on the sectors that created India's affluent customers are no longer delivering the same momentum. What does this mean for the country's consumption story? Stay tuned. Welcome back. You're watching us here on Trading Hour. Let's go across to Ritu now, who's standing by at an interesting precipice of a lot of graphics, which gives you an insight into the sectors that created India's affluent consumers and why they're no longer delivering the same momentum. Ritu.
Well, you know, for years, IT and financial services, they were the twin engines of India's affluent consumption story, the two sectors that have actually created this spending class in India in the first place. But these engines seem to be losing power now. Look at the data. Wage growth at the NSE 500 companies has more than halved, and a lot of that slowdown is concentrated almost entirely in these two high-paying sectors. So salary growth in IT and financial services has slowed down. even as it has accelerated, if you look across your screen, in almost every other sector. And it's not just salary growth that is slowing down, even the headcount has stagnated. I mean, India's 5 largest IT services companies have added almost no net jobs in the last 3 years after they were growing steadily for over a decade before that. GCC hiring, which had been offered as the offset, that's also cooling down with large centers under pressure to do more with fewer people. The banking side also tells a similar story. Large private banks have added employees and branches aggressively through FY22 to 24 to chase that credit growth. But that expansion has also now reversed, and headcount at the top banks has actually shrunk in the last 2 years as well. Now, importantly, some of this slowdown is also now starting to show up in the lenders' loan books. 2 large lenders, Piramal Finance and LIC Housing Finance, have actually both independently flagged stress that is linked to IT sector borrowers in their most recent earnings calls. Look at Piramal's Jairam Sridharan. He says it's early days, but the IT sector is the one that they're going to be watching very closely. And then you have LIC Housing Finance's Tribhuvan Adhikari, who flagged the direct exposure to IT hubs as a genuine worry going forward, saying the lender will have to be on their feet and their toes to assess the implications. So the macro signal is this: India's most closely watched consumption story, the rise of the affluent, the IT and the BFSI salaried households, that is showing its first cracks in wages and in headcount. And when you have 2 large lenders starting to name cities and sectors in an earnings call that they're cautious on, that's usually the market's earliest warning system.
Take that point entirely, Ritu. Thanks a lot for that. A lot of the consumption stories, the themes, etc., are being backed by the data that you're speaking about, the optimism around that. It seems like there are cracks appearing out there. On that note, from Ritu, me, thank you so much for watching. We wrap up on this edition of Trading Hour. Stay tuned. Halftime report comes up next.
Stocks come under renewed selling pressure as supply routes in the Gulf close down. Heavyweights feel the heat, but mid-caps bear the brunt. Autos and FMCG managed to touch some bit of green, while IT and pharma drag.
Dr. Reddy slides on a sharp dip in U.S. sales and profit margin. A provision for semaglutide also weighs, though the pharma major expects supply resumption by November. Most analysts turn cautious.
IndusInd Bank MD and CEO Rajiv Anand tells CNBC TV 18 that the bank is at an inflection point and its retail book will build with a lag. The bank also retains its ROA target of 1%, but a recent run-up in the stock draws selling on valuation concerns.
Oracle is pressured by rating downgrade, maybe looking to trim its over 72% stake in Indian arm Oracle Financial Services software to mop up some resources. Sources tell CNBC TV 18. The company is yet to respond to CNBC TV 18's query.
Copper scales to a one-month high and aluminium to a two-week high. Fear of U.S. imposing tariffs on refined metals and tight supply support copper, while low inventories and supply disruption concerns lift aluminium.
Hello and welcome to Halftime Report live from the CNBC TV 18 Motilal Oswal studio. I'm Ekta Batra and with me is Vinny Motiwala. Well, it's turning out to be a down day for the markets. We do have the Bank Nifty, which is underperforming as well. The likes of IndusInd Bank pressured in today's trading session. In fact, we do have the Nifty Bank, which has lost over 3% in terms of its market cap this week. We have the Nifty Private Bank Index, which has underperformed that as well, with a cut of around 4% at current reckoning on a week-to-date basis. But the PSU banks have done better. It's still down, but it's resilient as compared to the cuts that we're seeing for the private banks. So that's basically what's taking place in terms of the markets today. We do have the Nifty, which is pressured, like we mentioned. However, we do have the Cipla numbers on your screen. So it's a revenue growth of around 2% this quarter. The street was anticipating around 6% growth this time. We have the net profit, which has declined around 39% on a year-on-year basis, and the street was anticipating around a 29% cut in terms of the profitability. Margins too have come in below estimates, so that's coming at around 16% in terms of margins this time versus an estimate of around 18.7%. So yes, it's a top-down miss which is coming for Cipla, and there is an operating pressure which has come through for Cipla this time. Remember that we were expecting single-digit revenue growth, but that single-digit revenue growth has come in at just about 2% this time. There is expected to be steady growth in the domestic business, but the key pressure point for Cipla is going to be the US business. Now, that's for two reasons. One is because of Revlimid generic, the base impact will come through. So the street is going to look at the US business X of that. But separately, we do also have the pressure from lanreotide, which is one of their key drugs in the US, which they now do have supply issues with because the company that was supplying did have some issues with regards to the plant that they were supplying lanreotide from. So they're looking at alternate supplies right now, but that would be the key pressure point for Cipla. We'll wait by and see what the India business growth is. For example, Dr. Reddy's did very well with a 17% growth. So what exactly would Cipla do this quarter will be something that the street would watch out for. So this is prima facie what Cipla's numbers look like. It's a top-down miss, you'd have to say. The margins have come in just about at around 16% versus estimates of around an over 18% growth or margin picture for Cipla.
Okay, that is for Cipla as of now. Stock down 1.5% approximately in the trading session. While we're seeing the broader end of the market also continue to see a bit more of a pressure in today's day. So that is something that we will watch out for. But a whole host of stocks which are buzzing around in the trading session. For that, we have Vivek to take us through that list. Afternoon, Vivek.
Well, good afternoon. Another session where, the benchmark indices and, the broader end of the markets are completely different, especially in terms of the kind of volume activity that you're seeing. A lot of volume activity, especially in the broader end of the markets. In terms of individual stocks, have a look at Gandhar Oil Refinery. Extremely strong Q1 for this particular name. Stock perched at the upper circuit and, on very good volumes as well. The other stock, of course, is Tanla Platforms. Year on year, as well as on a sequential basis, very strong growth coming about. The stock high by over 14% today. NTP NTPC Green, after a while you're seeing very good capacity addition, something that the street has been worried about in terms of execution, higher by 7%. Remember, this is a very high market cap company as well, and one of the top gainers as far as the NSE 500 is concerned. HEG, another name, we also had the management earlier today speaking about price hikes going into H2, one of the top gainers on the NSE 500 index. Eternal, very strong commentary coming in from the management, whole host of brokerage going ahead and upgrading this particular name in terms of their estimates, stock higher by close to 3%. In terms of stocks that aren't doing so well in the session today, can't look beyond Dr. Reddy, one of the stocks that disappointed in terms of what the street was anticipating, has recovered quite a bit from the day's lowest point, but still down by over 2%. Data patterns, remember, last 2 to 3 trading session stocks up by almost 15 to 20%. That stock today seeing about a profit booking. IndusInd Bank, very strong Q1, but the street didn't like the management calling out some margin headwinds as far as Q2 was concerned. So that is something that has led to almost a 6% fall in IndusInd Bank. And looking at CIE Automotive, prima facie his numbers look quite good, but the CEO resignation coming in as far as the iron casting division is something that has led to almost 11% sell-off in CIE. So very outsized moves coming in, especially in terms of news flow as well as stock reactions after results.
Okay, Vivek, thank you so much for that. But on that note, we're going to step into a very short break. After the break, we'll focus on the Indian pharma's R&D push as BCG Health Course reports as patent filings are up over 4x, and we'll focus on this, take this conversation forward with BCG's Priyanka Agarwal. Stay tuned in. Welcome back to Halftime Report on CNBC TV 18. Nifty as of now is at 23,950 levels. Keep an eye out on that. Obviously, we saw that recovery coming in from the day's low. Then it went to the day's high and again a bit of a fall. Now it's seeing a bit of a zigzag. So let's watch out for that. But let's focus and talk about the pharma pack, right? The BCG Health COIS report is saying that the patent filings are up over 4 times and biotech startups nearly 60% higher. Adds that Indian pharma is finally moving up the innovation curve. Ekta is here to bring us more details on this one. Over to you, Ekta.
India's pharma story is turning a page. From copy-paste to create, a new BCG Health COIS report out this month says innovation activity in Indian pharma and life sciences is picking up pace. And the numbers back it up. Patent filings, for example, are up more than 4x over the last decade. The innovation pipeline has grown 1.5 times and biotech startups have jumped 1.6 times from 1,500 to 2,400 in the past 10 years. Meanwhile, PE and VC money flowing into pharma and R&D has more than doubled in 5 years, touching $731 million in FY26. More than 10 novel drug assets have in fact come out of India in the past 15 years, from NCEs, CAR-T therapy to even AI-discovered molecules. Some of the achievements include first drugs for treatment of liver disease, NASH by Zydus in India in 2013, to ImmunoAct's first CAR-T therapy, which is 10 times cheaper than imported therapies, to Glenmark's $700 million licensing agreement with AbbVie, India's first AI-discovered drug candidate out-licensed to Review Therapeutics, to Wockhart's novel antibiotic Xenic approved by US FDA. The report flags 4 enablers driving the shift forward towards R&D. Roughly $5 billion in government funding, stronger academia-industry links such as BioPrip, National Biopharma Mission, and tech transfer offices, regulatory reforms, and shared R&D manufacturing infrastructure such as Genome Valley. But widen the view, and India's still playing catch-up. R&D spend here is just $2 to $3 billion compared to that of around $70 to $75 billion in the US, $55 to $60 billion in Europe, $15 to $20 billion in China, and despite carrying 15% of the world's disease burden, India runs just about 4% of global clinical trials. More so, while there is around a 4 times increase in pharma patents in India, the grant rates and quality lags global peers. So where does India actually have a right to win? The report zeroes in on 3 areas: cost-disruptive innovation that re-engineers advanced therapies for affordability at scale, India-specific biology and data for precision medicine, and science-driven platform plays that leverage talent and cost efficiency. India's edge lies in combining cost, data, and talent, not in competing on frontier science alone. But the constraints are real. Only 10 to 15% of Indian VCs have deep biotech expertise versus 60% in the US. Bench-to-bedside translation from academia remains weak, and clinical trial and regulatory execution still lags. Bottom line, the next 5 years will decide whether India becomes a genuine innovation originator or stays a sophisticated development hub. The ingredients are there, the execution isn't guaranteed.
Absolutely, Ekta. Thank you so much for giving us a roundup in terms of the Indian pharma, the R&D side, what's happening here. But we're going to take this conversation forward with BCG's Priyanka Agarwal, but we'll come back with that conversation after a short break, so stay tuned in for that.
Welcome back. You're still tuned into Halftime Report on CNBC TV 18. Just wanted to point out that Cipla has now become the top loser on the Nifty after IndusInd Bank. So that one has exaggerated in terms of losses. So it's down around 2.5% post its numbers. It's at the low point of the day after what has been a disappointment. The revenue growth is only around 2% versus estimates of around 6%. And there's around 150 basis points miss on margins versus estimates as well. But let's stick with the entire pharmaceutical space to discuss more on R&D and where India stands. We have with us Priyanka Agarwal, who's the leader healthcare practice at BCG India and Southeast Asia, joining in. Priyanka, thank you very much for taking the time out. If you could just give us a sense in terms of where India stands when it comes to innovation, because that's probably needed far more after the developments which have taken place this week with regards to tariffs on generic drugs in the US. Give us a sense in terms of where India stands and where do you see the pathway for the next 2 to 3 years?
Thanks, Ekta. We had recently published this report, and that is a theme of where I would say India stands on innovation. I think for a couple of decades, Indian pharma has been very well known and established for being the pharmacy of the world, supplying 40% of the US generics, 60% of the vaccines. But over the last few years, we feel that there's an inflection point now where Indian companies are also investing significantly in innovation, and we can see the results of that as well. So we now have at least 10 plus original assets, molecules, which have been discovered. So, the entire journey of discovery, development, and now several of them are also commercialized. The patent filing numbers have gone up 4x in the last decade. Also, a lot of investment which is needed to go into R&D. PE, VC has also contributed. That has gone up 2x. And therefore, we now feel that these are the green shoots of innovation we can see. And this is not just coincidental. It's built on a full stack approach. I think point number one, a lot of government funding is now available, for early assets, both biotech companies, which are starting, through different approaches on discovery, also larger companies that can draw on government grants from BIRAC, from RDI, from some of the other programs that are available. A lot of regulatory reform has also happened. So the time that it used to take for the government to approve phase one, some of the other, assets which reach the clinic, it has got dramatically shortened. The government has also digitized a lot of its operations, so there's more transparency, and they're strengthening also their scientific cadre and recruiting a lot more specialists. So that is the second aspect. The third, there's a lot more of academia industry collaboration that we now see, something that is a model in US and West that we always saw. It's also beginning to now take place in India. There's translation happening between what's happening in the labs, in the academic institutes, and that then finding a way to get scaled up and commercialized. So we feel that, this is somewhat of what we call a full stack innovation engine. The building blocks are coming in place. And that's where we feel quite optimistic that over the next decade, these 10 plus could be multiple fold. And the ambition that was set that we should have 100 NCEs coming out of India as a part of Viksit Bharat 2047 is potentially a stretch goal, but not impossible. We can see a line of sight to that.
Sure. Priyanka, you mentioned about these patent filings as well, right, which have gone up 4x. But that's more like an intent, right? For the conversion into novel IP, how much of them would, you believe that is a conversion that comes in here also towards the novel IP side from the patent firm?
Yeah, so I think certainly patent is only one of the indicators. It only shows the energy and enthusiasm of a lot of the researchers who do want to also do original IP work. But I think the real proof of the pudding is the fact that there are now assets, molecules which are in the clinic. So not just in discovery, of course, we all, a few weeks ago saw the announcement by Wockhardt of a novel antibiotic, Zinich. At the same time, also we have Zydus, which has a couple of assets in the US. So global clinical trials, not just Indian, which are, almost about to be launched. Glenmark, everyone has seen, that's a true validation, where they were able to out-license their molecule to AbbVie for a large upfront payment. $700 million is, pretty significant. And then there is a lot more also happening on the biotech side, where, either through AI or different approaches, even biotechs are now able to bring assets to clinic. So the real proof is that these are not just discovery. They have gone through the discovery, the early mortality. These are assets in the clinic, phase 1, phase 2, even commercialized.
Okay. Just quickly, Priyanka, before we wrap up, just wanted to understand where India stands when it comes to R&D in context of the globe. Because, you know, as compared to the US, Europe, China, we are still significantly lagging behind. So do you think that the catch-up would be too much and the gap would be too wide?
Yeah, I think, you know, obviously India, you know, if you compare even to China, leave alone US. So US spends as much as $70 to $75 billion on R&D. India still spends about $2 to $3 billion, and China spends about $20 million. So obviously there is a large gap that still there is. But the positive and the good news is to see how much India has progressed versus where we were. I think Indian pharma, just in terms of talent, the ability to actually do discovery science, discovery biology and chemistry was always there. But now the risk appetite is there, grants are there, regulatory pathways are there, and therefore we can see some of the assets, coming to the market. So I wouldn't say it's a complete story. There's more work to do in terms of even faster regulatory approval, bridge funding being available between what the government gives us grants and finally when you can get royalty payments and so on. When you're in the clinic, there's a large amount of bridge funding still required. There's probably still, more work in terms of supply chain and labs and the chemicals being available more easily. So there are many aspects in which this can go further, but it's really fantastic progress and something that inspires the next generation of companies also to say, listen, India can do original innovation, both from big pharma, but also from smaller companies, and it inspires a whole ecosystem to do more.
Absolutely, Priyanka, thank you so much for joining us this afternoon, speaking to us about the progress of where Indian pharma R&D side is moving as well. So thanks so much for joining in. But on that note, let's focus and now bring on board Manish Athiramani, proprietary trader and technical analyst at Deen Dayal Investments, to talk to us about the levels to watch out for in terms of the markets. Manish, hi. Good afternoon. Thank you so much for joining us on the show. Nifty, as of now, back towards the 23,920 levels, around that mark. We've come off also significantly in the last few minutes. What's your view in terms of levels?
Good afternoon, Vinny. Thank you so much for having me on the show. Well, there was a temporary sigh of relief on Friday when the Nifty took off and got past that 24,250 level. But that jubilance kind of was very short-lived, and we've again got trapped in a range. This new range is now 23,800 to 24,400. And that is now going to be the new periphery. And unless we don't get past either, we will not see a meaningful move. The same goes for the Bank Nifty as well. Here too, we are now in a range of between 56,500 to 58,600. 56,800 again is a level I'm very closely watching on the Bank Nifty, because if we close below this level, we can drop down to 56,100 and then 55,600.
Okay. All right. What about stocks, Manish? Any specific stocks that you're looking at in today's trading session?
I'm working with two buy calls. My first buy is on Bajaj Finserv, which is for a target of 2,000, stop loss of 1810. This stock has got a good structural breakout on the upside with healthy volumes, and we are now trading above the resistance levels of 1875. The second one is on Eternal, which is for a target of 320, stop loss of 270. We have rested at the support range of 230 to 240 and then thereafter broken on the upside. The stock is currently trading above the resistance levels of 285.
Okay, Manish, thank you so much for joining us this afternoon, giving us your individual bets as well as in levels in terms of the market as well. On that note, we're going to step into a very short break. After the break, we'll come back and we'll have a Commodities Corner segment where Manisha Gupta will connect with the management of NK Proteins on edible oils and the impact of El Nino on Kharif sowing. Stay tuned in for that conversation.
Welcome back. Joining us on the show now is Shriram Patel. He's MD at NK Proteins. Shriram, hi, thank you so much for joining in. And top headline clearly comes in from the fact that the sowing is slightly delayed. This is an El Nino year. How are you looking at the volatile prices and how are you really balancing your input cost, profitability, margins, and ensuring there's affordability for consumers as well?
Hi, good afternoon, Manisha. El Nino has been affecting the Kharif crop this year. So initially in June, we were seeing quite a bit of slowdown in the monsoons. First half of July was a little bit helpful, but then we had again a dry spell for a week or two. But I think the way the monsoons are going on right now, especially in north and northwest of India, I think we should see our rainfall this year at approximately what the IMD had projected, 94% below LPA. So that's the outlook on El Nino, especially related to Indian crop. Now, the price affordability, I think the way the import costs are increasing, the cost of the rupee depreciation, the overall macroeconomic factors like the Iran war, over and above. Today also we saw some news about new bombing on Ukrainian ports. So there is a lot of volatility in the macroeconomic factors, but I think that has become a part of the edible oil industry, and I think we will have to live with it. So that is how the journey is.
Priyam, as you mentioned, the import is becoming, expensive. But when you look at the Indian markets as well, would you say that the crushing really has come down and we are heading into a peak demand season right now? So what are we really looking at in sense of demand and supply? And would you say that the prices can go higher from here?
See, the overall situation right now is that the indigenous crop availability is quite low heading into August, and festive demand is going to be high. Fortunately, we've seen this month it's a very good amount of import, so it should help us stabilize the prices a bit. But I don't see a major downward pricing as of right now. But I think eventually going forward, as we go into OND October, November, December with the new crop coming in, I think we should see some price cooling down. But till then, I think the macroeconomic factors plus your local crop availability will keep the prices at these levels.
Let's talk about the cottonseed oil then, and it clearly has been more of a Western staple edible oil. How are you looking to take the brand now to various other parts of the country? What are the plans?
So cottonseed obviously has been a major dominant oil for the western part of India. I think going forward, I think mustard and groundnut oil are the bigger oils which are really picking up. And as a Western Zone chairman for SEA, we are also working with a lot of mustard farmers and doing model farms. How do we increase the overall acreage of mustard and improve the yields for farmers? So our import dependence is low, and we can slowly and steadily increase the local crop availability. And for NK Proteins, if I'm to say, we are going to expand more into the indigenous oil categories rather than going more towards imported oils.
Point taken. That sounds good. In a world that we live in right now, Priyam, not too many people talk about edible oil, especially when the younger generation wants to eat lesser oil. But what really needs to work on also is perhaps branding, the storytelling that the brands are doing, marketing, transparency, sustainability, something that appeals to this younger demographics. How are you approaching that?
See, oil is an essential commodity. We are talking about health being a big factor, but we are talking about a very small percentage of the population. I think still in India, there is a majority of population which does eat good amount of oil, and it is required for nutrition. It is required for their daily energy. So I do not see a big shift in the majority of the population. Having said that, I think there is a niche being created where people are taking into account, rather than traditional oils, they're wanting to look at cold press oils or filtered oils more than refined oils. But I think that is also a fad. I don't think every few years you'll have something come up and it's just a fad. But I think overall, if we see the edible oil industry, India is still lower in per capita consumption compared to the Western world. And as we become a more developed economy, I think the consumption per capita is only going to go up. Now, how do we balance the consumers? There is a segment of consumers who are health conscious. and who are preferring to eat more of healthier oils. And I think the entire mindset of having one oil is something which is going to change. I've been saying this for a long time. We are not going to be looking at one oil kitchens, but multiple oil kitchens, multiple oils for different uses. And that's the future for Indian consumers and for Indian brands to really tap into and cater to that market.
Okay, Priyam, thank you so much for joining us this afternoon. And Manisha, thank you so much as always for taking us through this conversation as well. Thank you both of you all for taking us the highlights. But on that note, we're going to slip into a very short break. After the break, we'll come back and we'll get you more on stocks, more stock-specific action, more on markets. Stay tuned. Welcome back to Halftime Report on CNBC TV 18. You have PVR, which has just reported its numbers as well. Revenue are up by 12% for the company. The company is also reported a profit this time. So that is something interesting. EBITDA is up by 30.8% as well. Stock is spiked up in the trading session. But let's move on and to another story. Sources are saying Adani Group has written to AAI seeking review of regulations which restricts operators to start airline business. Yash is joining us to give us more details on this one. Yash, over to you.
Well, this purely means that Adani Group has, in a way, expressed its desire to enter the commercial airlines business, the civil aviation business. What we've been given to understand from our sources is that Adani Group has written to AAI, which is the Airports Authority of India, seeking a review of the regulations, the current set of regulations, which restrict the entry of airport operators into the business of running commercial airlines. This is what Adani Group has written. According to our sources, this letter was written from Adani Group to AAI in the first week of June itself. And of course, the demand has been to review the regulations and make the changes which can allow the group to enter the airlines business. As far as other details that we are given to understand from our sources are concerned, Adani Group is also open to exploring a model under which the Airports Authority of India holds certain amount of equity in the commercial airlines business, the civil aviation business, and part of that holding is held by the Adani Group. From both the Airports Authority of India and the government, a response on that particular letter seeking review of those regulations still remains awaited. As far as our response is concerned, we've written to Adani Group on this particular story. A response from the group is still awaited at this point of time.
Okay, important story there, Yash. Thanks very much for joining in and giving us all of those details with regards to that story. Well, just want to point out that the Cipla US revenue has come through, and that is below what at least the street was anticipating. So it's coming at around $162 million, and the street was anticipating around $173 million. So do watch out for Cipla. That stock's still down around 2.4% at this point in time. The US sales too not looking great this time. We'll take a short break, but up next we'll connect with the management of PVR Inox, who will break down the quarter gone by and the road ahead for the company. Stay tuned. Welcome back. PVR Inox is surging trade after reporting what was a good set of numbers. We have Ajay Bijli, who's the managing director of PVR Inox, joining in to discuss the quarter gone by. Mr. Bijli, thank you very much for taking the time out. Well, 15% revenue growth, which has come through. So tell us what worked this quarter. What was the content that actually contributed this time? What were occupancies, ATP prices in terms of a hike on a year-on-year basis?
Well, the good thing about this quarter is that no blockbuster as such came, and it's only the momentum of the people, which have brought people back to the cinemas, which has been, it still continues to remain the number one out-of-home, entertainment option for people in India, which is very heartening, and PVR's own positioning as the number one out-of-home entertainment venue. So if you look at it, we had Bhoot Bangla, we had some Hollywood movies, which were sleeper hits like Obsession, we had Project Hail Mary. The good thing is these are not even franchise movies. These are movies which have been made for the first time, and yet they've done very well. We had regional films doing very well. We had Marathi films going up by 400%. So, and the growth has been both by volume and value. So the occupancies have been 25%, which is 8% more than last year. And even the ATP has grown by 8%. So both volume and value has seen a growth. So it's very heartening to see, people coming back, and not necessarily the movies have to be blockbuster. And yet, we're getting these kind of results.
I would take that point, Mr. Bijli. During the quarter, I caught Michael at a theatre after a very long time myself as well. But what I want to understand is beyond the first quarter, now as we speak, you have a couple of other growth engines as well. One, Odyssey is doing extremely well in the theatres. That's what we read. And, we hear from all the third-party booking apps that speak about the numbers. If you could give us a sense on how the second quarter is panning out for you, and alternate sources of revenue for you, which include the likes of specialized F&B products that you're selling, and even the FIFA World Cup, etc. If you could give us a sense on how much they contribute to your numbers?
Like I said in the previous question, that I think India is a movie crazy market. It's a volume-driven market where 1,500 films go through the system. Just last Friday, 23 films got released on one single Friday when Odyssey released. So I think we have to take the narrative away from movie by movie to saying that overall, because so many movies are coming, something or the other has to click, and people will. And the momentum is not just about a particular movie. It is about people wanting to go out and having that fatigue factor of staying at home and just enjoying themselves. So that's really heartening to see. But of course, if you want to know the lineup, of course, Odyssey is a big one, which is released recently. Which is doing exceedingly well on both IMAX and non-IMAX screens. Today, the big Tamil movie got released in down south, which is doing exceedingly well. We've got Toxic coming later on. We've got Batwara coming. The August 15th weekend is always very big for our cinemas. And I think, but we are like, I think what I want to talk about is how the tier 2, tier 3 markets are opening up for our brand, and how we are now sweating the brand rather than just sweating the asset, and looking at growth of close to about 1,000 odd screens in the next 5 years. That's how bullish we are about the business and about the Indian consumer going out and watching movies on the big screen. So I think, as I said, content is not a problem. Something or the other is always clicking. And I think the good thing is that the momentum is back, and people do want to watch movies on the big screen. And the commitment from the film fraternity also to release on the big screen is quite heartening.
Okay, Mr. Bijli, good afternoon. What I want to understand, and Mangalam was also asking, was about the FIFA or the alternate content that you have as well. How was that? FIFA seemed to have done well. How was it for you? And in terms for the margins for this alternate content, what is there in terms of the difference between ticket prices, movie ticket prices versus this alternate content pricing margins?
I put alternate content in two buckets. One is the re-releases that we do. There the margins are very good, because obviously these are old films which are just also available on various formats, and we bring them down. Of course, the margins are much better there because these are not brand new movies, so we don't have to pay film hire, which is brand new. FIFA was just crazy this Sunday. We had 64,000 people who came on a 12:30 kickoff, which is quite remarkable. And the ATP average ticket price was over 400. And even the SPH was people, obviously were having popcorn, Pepsi, everything. That was also close to 200 rupees. So it's incredible. And it ran from in a show, 12:30, there's no show that starts. So it was literally sweating the asset at a very non-operational hour, which was fantastic. So alternate content is margins are better. And it's now the doors have opened to it. So whether it's a World Cup final or cricket being played or NBA, whether it's a Taylor Swift show or a BTS show or a live performance by so many artists who can't fill up a 10,000, 20,000 seater stadium, but they can easily fill up a 200, 300 seater cinema. So I think it's 1.6% of our occupancies last year came from alternate content, and it's a very big focus area for us just now. That we will obviously continue to show movies, which is mainstay, but the whole positioning of the company has become movies and more. So as I said earlier, it's out-of-home entertainment destination of 15 million square feet that we have got across 113 cities and in about 365 locations. So we're looking at our destination to be an out-of-home entertainment and not just be like, movie driven.
No, we understand that point, and that repositioning post COVID and post every alternate source of in-home entertainment as well has come about. I just wanted to understand a couple of things from you, and which seem interesting now. One is you monetized one of your assets earlier by selling stake in 4700 BC. The other thing that I wanted to know is your balance sheet. That's improved. For the first time, you've become a net cash company as against a net debt company. So what's the deployment plan as we move forward? And when you say movies and more, movies will still be the mainstay. How much will that more account for over the next 3 to 5 year period?
Like I said, last year was 1.6%. And I mean, this year, our target is close to 3%. So it'll keep increasing. But let's not forget that the momentum of movies is also so strong. So to fill up these pockets of non-movie is also challenging. But we have a separate team working on it. And as I said, FIFA and the IPL and so many sporting events and musical events have paved the way. Then suddenly it is being noticed by everybody that this is another place which is close to next best thing to watching something live. So I think this will keep increasing every year. This year our target is 3%. Your other question was about debt reduction. Yeah. Extremely happy with the way we've been able to manage our capital allocation. And this is again testimony to the brand, because on one hand we're sweating the asset, on the other we're sweating the brand. People in tier 2, tier 3 cities and even in main cities are ready to contribute capital. So we have an asset light model with which we have grown last year. And we also have a FOCO model where complete money has been spent by the franchisee. So I think that helps our ROC improve. All the management fees that we get, like hotels get, restaurants get, so many retailers get, that comes to the bottom line. So our growth is not getting compromised. We have an outlook of about 100 odd screens opening this year. And I think this will only increase to 250 odd screens next year, simply because of the penetration into the tier 2, tier 3 cities as well. So without spending that kind of capex, we are still, increasing our momentum of growth, and which is the reason why we're able to save capital as well and repay a lot of our debt and now become cash positive.
All right, Mr. Bijli, we're going to leave it on that note. Thanks very much for joining in and speaking with us, and congratulations on a good quarter, and we hope the content pipeline is strong enough for you as well as for the benefit of all of us. Thanks very much for watching. Well, thanks with that, it's a wrap on Halftime Report. Business Lunch will take all of the action forward. Stay tuned.
Stocks come under renewed selling pressure as supply routes in the Gulf close down. Heavyweights feel the heat, but mid-caps bear the brunt. Auto and FMCG manage a touch of green, while IT and pharma drag. Dr. Reddy slides on a sharp dip in U.S. sales and profit margin. A provision for semaglutide also weighs, though the pharma major expects supply resumption by November. Most analysts turn cautious on the stock. IndusInd Bank MD and CEO Rajiv Anand tells CNBC TV 18 the bank is at an inflection point and its retail book will build with a lag. The bank also retains its ROA target of 1%, but a recent run-up in the stock draws selling on valuation concerns. Oracle Corp, pressured by a rating downgrade, may be looking to trim its over 72% stake in Indian arm Oracle Financial Services Software to mop up some resources, sources tells CNBC TV 18. The company is yet to respond to CNBC TV 18's query. Copper scales to a one-month high and aluminum to a two-week high. Fear of U.S. imposing tariffs on refined metal and tight supply support copper, while low inventories and supply disruption concerns lift aluminium. Hello and welcome to Business Lunch, live from the CNBC TV 18 Motilal Oswal studio. I'm Arundhati Ramanan. Good afternoon, guys. Escalating tensions in West Asia and oil prices at $98 a barrel is weighing on market sentiment. The Nifty is now below that 23,850 mark. It's down over 150 points. The Sensex down nearly 500 points. The mid-cap index feeling the pressure. It's falling more than the blue chips, over 1% lower. The Nifty Bank is what is leading to the fall in the Nifty. That index 1.3% in the red. As I pointed out, leading the fall are the PSU banks. That index is down nearly 1%. If you take a look at the stocks, SBI, Union Bank, Bank of India, all of them down over 1% in trade as we speak. The pharma names, they continue to feel the pressure. Cipla falling over 2% after its Q1 numbers. Dr. Reddy's as well falling in tandem, also feeling the pressure after its Q1 numbers as well. Divi's Labs also 1.3% lower. We've got private banks that are extending their losses. IndusInd Bank falling over 6% despite profits soaring in Q1. We've got Bandhan Bank, HDFC Bank, both of them feeling the pressure as well. But what's bucking the trend? We've got those auto names that are seeing a bit of green on the screen. Bajaj Auto 2.5% in the green. Hero MotoCorp about 3.7% higher. And M&M as well gaining nearly 2% in trade. And that's how the markets are shaping up this afternoon. But a lot of stocks are buzzing on the back of their Q1 numbers. Ananya is joining us with all of those updates. Ananya?
Well, yes, a lot of numbers following their business updates, a lot of stocks buzzing. Let me first start with NTPC Green Energy. The stock is among the top gainers today after reporting 63% revenue growth and 38% profit growth. Now, it is supported by stable margins and a strong renewable pipeline. Now, coming to HEG, they also surged after delivering 43% EBITDA growth with sharp margin expansion, reflecting a significant improvement in their core operations, if you look. Now, on the flip side, IndusInd Bank came under pressure despite reporting a 72% jump in their profit. Now, this is because as investors book profit gains after the stock's recent rally. Nippon Life AMC also traded lower with higher operating expenses overshadowing a profit beat and raising concerns over margin pressure here. So that will be a key monitorable also going forward for the investors. Now, Cipla was another stock which was down after missing street estimates with 16.7% EBITDA margins falling short of expectations here. Now, numbers just coming in for PVR Inox. They have reported its quarterly numbers. The company posted 15% revenue growth, 32% growth in EBITDA. Margins expanded to 33% and it returned to a profit of 52 crore compared with a loss a year ago. And the stock is reacting positively to the numbers. So these are the stocks buzzing in trade following their, their Q1 results.
All right, Ananya, many thanks for taking us through those details. Now, sources tell CNBC TV 18 that a troubled global major may look to sell a material stake in its Indian-listed entity to tide over a cash crunch. Vivek joins us now with all of those details. Vivek?
Well, thank you so much for that. So, the company that we're looking at currently is the Indian listed OFSS, Oracle Financial Software Services. What we understand from our sources is that the company's promoter, which is the global listed Oracle Corporation, has sent out feelers to go ahead and look at monetizing part of its stake that it holds in OFSS India, and this is mainly being done given the fact that the US listed entity is facing a bit of a cash flow mismatch. Now, what we are understanding from our sources is that they've sent out feelers to garner interest in the Indian listed arm, where they're looking to sell a small stake. Now, the size, the price of this particular stake and the timing of the stake sale will be decided and finalized once they get a good idea and a good sense of what the investor keenness is to go ahead and absorb the shares of Oracle Financial Services that is listed in India. Remember, OFSS listed results yesterday, and it was a good set of numbers from this particular product company. Now, another important thing to note is that the parent Oracle Corp held a little over 72% stake in the company at the end of Q1. But Oracle Corp, remember, is going through a bit of a stretch in itself. S&P, the global rating agency, went ahead and recently downgraded Oracle Corp's credit ratings, and they've downgraded it to a level that is just one notch above junk rating. What did S&P note? They said that the company's rapid expansion AI business infrastructure spend is something that is weighing in on the financials, and they're expecting weaker free operating cash flow in FY27 or in fiscal 27 than their previous forecast. In fact, they say that they could go ahead and further lower their rating in case Oracle is unable to meet its financial leverage obligations that it currently owes. Now, remember, Oracle Financial Corporation or Oracle Corporation in the US has seen a 60% fall from its recent peak in September 2025, while on the other hand, from March 2026, you've seen the Indian listed arm do very well and is up corresponding 60%. We've reached out to the Indian arm, OFSS, as well as Oracle Corporation. We are awaiting a response from both of these companies, but at this point of time, a marginal stake sale or offer for shares from the global company in the Indian arm is something that we're keeping track of.
All right, Vivek, many thanks for taking us through those details. Now, Dr. Reddy's is the top loser on the index today. The company missed street estimates in the first quarter. Net profit saw a sharp fall of 69%, while revenue also declined 6% on an annual basis. The company's US revenue also has come in sharply lower. Earlier, we spoke to CEO Erez Israeli on semaglutide impurity issues, and here's what he had to say.
Yeah, so we found that in the scale-up of our API, impurity that is degraded in the drug product. And obviously, as a company that is very keen on the right practice of GMP and quality, we immediately announced the market. The remediation should take us, if successful, until the third week of September, and at that point of time, we can supply back to our partner, one source in Bangalore, the API to continue to make the product. And so it means that by November, we should be back to the market with the remediated product, if all the activities that we are doing now will be successful.
Infosys is scheduled to announce its first quarter results today. Rima Tendulkar is here with the key expectations for this quarter. Rima?
Thanks so much for that. So for Infosys, it's expected to be a good quarter. We're working with a revenue growth of 1.8% quarter on quarter. The broad range is about 1% at the lower end, going up to 2.5%. But this will not be pure organic growth because there will be a 2-month contribution from the 2 acquisitions that they did, Stratus and Optimum. Margins are likely to be maintained around 21%. Amongst the lot, Infy is likely to do better. But remember, Infosys is also the last of the large cap IT companies. We already have numbers from TCS, HCL Tech, Wipro, Tech Mahindra. Tech Mahindra has been the leader, the rank outperformer with a 2.6% growth. But relative to the others, aided by the acquisitions, Infy is likely to perform better at 1.8%. But Infy is, so directionally, we know what the industry is doing. We've heard the management commentary from all the other IT companies. But where Infy is special always, it's the only IT company to give you a long-term, an annual guidance. So currently for Infy, the guidance stands at 1.5% to 3.5%. This is organic revenue growth. But some analysts believe that the top end of the growth looks difficult to achieve. So maybe on an organic basis, the company could scale it down. But, Infy is likely to now just change the guidance, taking into account the acquisitions. So the new guidance may look at 2.5 to 4.5%, but this will include about 100 basis points of the inorganic move. But again, these are all estimates that the street is working with. From an industry color, qualitatively, we've already heard from the other large cap IT companies. So in that sense, less important, but Infy's guidance will be critical to track. Back to you.
So it'll be critical to watch what the numbers are for Infosys when they come out. Thank you so much for those details, Rima. Let us now focus on the commodity space. Metal prices surge, with copper and aluminium leading the rally amid fears of US tariffs on refined metal. Manisha Gupta joins us now with all of those details. Manisha?
Well, it's strong gains continuing for the metal as a sector, where you are looking at copper prices trading at a 7-week highs, aluminum is trading at a 1-month highs, the West Asia conflict leading to supplies yet again under pressure, and then the sulfuric acid is yet another thing, which is a raw material input for mining of copper and aluminum, also under threat, is where the markets are taking deal from. Having said that, the best of the gains clearly have come in for zinc and then copper and then aluminum. It is about individual fundamentals as well, where markets are looking at stronger demand expectations going forward. And all the studies that have come in show that while the consumption will continue to gain strongly, the production perhaps may not be able to catch legs with that. Copper, especially when you look at the overall market, we are looking at 9% of gains in the last 1 month. And for this year, it's nearly 15 to 16% of gains that we have seen in case of copper. Copper actually is trading at premium in US, in London, and in China as well. China is trading at $100 a ton premium. US is trading at around $600 a ton premium, and it's nearly $250 a premium also coming in for the London markets therein. That tells you that immediate availability of copper clearly is under threat, and that's exactly what we have seen come in from the major miners, whether it has been Glencore, Rio Tinto, BHP, Antofagasta, saying that the previous quarter has seen lower production, and the next couple of quarters could be looking at lower production in sense of copper, clearly supporting prices going forward from here as well. All of these markets will now take cues from the US Fed FOMC meeting on 28th, 29th of July. For the cues for the macro markets will come in from that.
Right, Manisha, many thanks for those details. On that note, it is time for us to head into a short break, but more news and updates on the other side. Stay tuned. Welcome back. You're still with us on Business Lunch. Market at the day's low. Nifty below the 23,830 mark, down 170 points, and Brent continues at near $98 a barrel. Moving on, Bangalore-based precision engineering company Indo MIM's 3,811 crore rupee IPO opened for subscription today, with the price band fixed at 461 to 485 rupees per share. Sudarshan now joins us with the latest details. Sudarshan?
As you have told, it's a Bangalore-based company has announced the IPO opening, and it's basically they have three businesses. First one is metal injection molding, second one casting, third one machining. But metal injection molding is the biggest business, contributing almost 60 to 65% of their total revenue. Now, IPO opens today, closes on July 27. If you talk about the total size, it's of 3,811 crore, and it's a mix of OFS and fresh issue. OFS is of rupees 500 crore, fresh issue is of more than rupees 3,300 crore. IPO price company is given 461 to 485 rupees per share. And now what exactly company is going to use the IPO proceeds for? First, repayment of debt, and second, general corporate purposes. Pre-IPO promoter holding was at 92.9 crore. After that, after IPO, holding will come down to 77.7%. If you talk about the growth, company has been seeing a healthy growth. Even in FY26, revenue growth was in the range of 25 to 26%, and the margin is also significantly higher. In FY26, it was 28.6% versus 29.3% in the last year. They mainly have both domestic as well as export segment, but exports form major chunk of the business. In FY26, the contribution has risen to as high as almost 80%. And some of the major clients are from India, United States and Europe, and exports to customers in North America, Europe and Asia. And they operate in the very niche segment. So as of now, they are getting a good demand. Let's see how the next 2 days pan out.
So we'll have to wait and see what happens over the next 2 days. Thank you for all those details, Sudarshan. Earlier today, we also spoke to the management of the company to understand the business model and the outlook ahead. Here's a slice of that conversation.
Last few years, if you see, our growth has been plus 15% year on year.
Which is faster than the industry.
It is faster than the industry.
And your market share currently, global market share 6.7%.
7%.
From around what? Say around...
No, market itself is expanding.
Okay.
So there is no reliable statistics of what the number is.
Got it.
But it is always around 5 to 7% is what we have been doing.
All right. Got it. All right. So $4 billion industry, and you all are maintaining a market share at around 5 to around 7%. I was reading up on, what you all have put out. And I believe in terms of capacity utilization levels, you're at what, around 50 to around 60% on an average across various segments.
That is right.
So at peak revenue levels, what can you do without any, further investment? If you could help us out with that.
Actually, we have three different segments.
Yes.
In metal injection molding, our capacity utilization is 40%.
Okay.
With that, we do about 2,600 crores turnover. So you can make an arithmetical calculation as to what it will be.
So effectively, I think you can double your revenues from the number that we have of around. So you can do at peak close to around 7,000 crores of revenues without any big capex. That would be fair, right?
That is right.
That is fair.
India's affluent consumption story, built on IT and BFSI salaries, is showing its first cracks. Ritu breaks down that data for us.
For years, IT and financial services were the twin engines of India's affluent consumption story, the two sectors that actually created India's spending class in the first place. But these engines are now losing power. Look at the data. Wage growth at the NSE 500 companies has more than halved, and the bulk of the slowdown is concentrated almost entirely in these two high-paying sectors. So salary growth in IT and financial services has slowed down, even as it has accelerated in almost every other sector. And it's not just salary that's slowing down. Even the headcount has stagnated. Now, after growing steadily for more than a decade, India's 5 largest IT services companies have added almost no new net jobs in the last 3 years. And GCC hiring, which had been the offset, is also cooling down now, with the larger centers under pressure to do more with fewer people. The banking side also gives you a similar picture. The large private banks, they added employees, they added branches aggressively through FY22 to 24 to chase credit growth. But that expansion has also now reversed, and the headcount at the top private banks has actually shrunk in the last 2 years. Importantly, some of this slowdown is also starting to show up in the lenders' loan books. You have 2 large lenders, Piramal Finance and LIC Housing Finance, that have both independently flagged this stress linked to the IT sector borrowers in their recent earnings calls. Piramal's Jairam Sridharan says It is early days, but the IT sector is the one that they're watching closely with some early signs of stress. And LIC Housing Finance also flags direct exposure to borrowers in the IT hubs as a genuine worry going forward, saying they will have to be on their feet and their toes to assess the implications. If you look at the RBI's own financial stability report, it tells you Indian households are increasingly using debt to keep up their spending, even as income growth for this affluent segment slows down. So unsecured loans that don't really have any collateral and depends directly on the income holding up now makes up more than 58% of all the household borrowing and more than half of all retail loan slippages. So India's most closely watched consumption story, which is the rise of the affluent, the IT, BFSI salaried households, that is showing its first cracks in wages and headcount. And when you have two large lenders naming cities and sectors on an earnings call, that is usually the market's earliest warning signal.
All right, Ritu, many thanks for those details. But on that note, it is time for us to head into another short break. More news and updates on the other side. Stay tuned. Welcome back. You're still with us on Business Lunch. On to the latest updates on the West Asia war. The US bombs Iran for the 12th consecutive night as Iranian media report explosions in the cities of Bushehr, Awaz and Sirik. CNBC's Dan Murphy gets us all of the latest updates from West Asia.
Iran-aligned Houthis claiming they've struck 2 Saudi oil tankers as part of their continued naval blockade on Saudi Arabia and the Red Sea, and also putting continued pressure on critical energy routes out of the Middle East. According to shipping data, 5 tankers changed course in the Red Sea to avoid the Bab el-Mandeb Strait on Wednesday. 3 tankers with Saudi oil, which were headed towards China and India, had to make U-turns. Meanwhile, the U.S. just completing a 12th straight night of attacks on Iran, President Trump vowing the U.S. will destroy a bridge or power plant for every time Tehran tries to strike a ship in the Strait of Hormuz. The U.S. and Saudi Arabia have signed a landmark deal, allowing the kingdom to develop a civilian nuclear program. The agreement, which has been in the works for years, will provide access for American companies in the Saudi nuclear energy program, according to a statement by the U.S. Energy Department. The U.S. Energy Secretary, Chris Wright, and his Saudi counterpart also signed a bilateral safeguards agreement alongside the deal. The agreement will also allow Saudi Arabia to enrich uranium and reprocess nuclear waste, 2 technologies that could potentially be used to produce nuclear weapons. A similar deal signed by the UAE and the US back in 2009 did not have those 2 additional components. The US says the deal is aligned with US non-proliferation rules. It now goes to Congress for approval.
And with that, it is a wrap on this edition of Business Lunch. Mid-cap radar will take all the market action forward.
Good afternoon and welcome to Mid-Cap Radar live from the CNBC TV 18 Motilal Oswal studio. I'm Vivek Iyer and with me is Hormaz Fatakia. Good afternoon, Hormaz. Well, a choppy session, that's what we expected. The market's expected to be weak after the weak handover we received. And that's precisely what's happened, and earnings reaction, very, very volatile.
Earnings reactions have been more on the downside even today compared to the upside, and the biggest determinant of them all, Brent, is now up past the $98 a barrel mark. We'll get to that in just a bit, but these are the headlines that we are tracking at 1:30 this afternoon. The market see a sharp fall and trades at the lows of the day. The Nifty is now at the key 23,800 level, dragged by financials, pharma and metal stocks, while autos buck the trend. The broader markets underperform.
Strong double-digit growth in Q1 sent shares of Tanla soaring, growth largely led by the digital platforms and enterprise communication segment.
Gandhar oil skyrockets and hits an upper circuit following a blowout show in the first quarter. Net profit quadruples sequentially. EBIT margins more than doubles to 15% compared to 7% in the fourth quarter.
Despite a strong Q1 show, Oracle Financial failed to capitalize on the earnings momentum. Sources tell CNBC TV 18 parent Oracle Corp explores a partial stake sale in the Indian listed entity, sounding out potential investors. That's the CNBC TV 18 exclusive.
A steady second quarter show from CIE Automotive fails to impress. Inflation on account of geopolitical tensions triggers an 80 bips fall in the India business margins. The iron casting CEO Rajendra Vadlapudi resigns after a 16-year stint. The stock is languishing at lunch hour.
Well, that's the state of the market at midday. And when you're looking at the mid-cap index, the small-cap index, all of them languishing, but relatively better compared to what the benchmark indices are doing. But despite that, if you look at the advanced decline ratio, very much skewed in favor of the advances. What's actually taking a bit of a tumble today? Have a look at a name like IndusInd Bank. A strong set of earnings as far as Q1 was concerned, but a weak margin outlook for Q2 is something that the street hasn't liked. And post the conference call hosted by SRF, that particular stock has tumbled quite significantly near the day's lowest point, almost a 7% fall for SRF in the session today. But moving on, this is our special segment, Mid-Cap Movers. Riyaz standing by the big wall with all the mid-caps that are moving around in the session.
Well, yes, let's start off with the gainers first. Graphite India is seeing strong gains in today's trading session, as well as HEG, which is reacting to its quarter-one earnings. Whirlpool also seeing a big gain today, although the stock is down nearly 45% in the last 1 year. CE Infosystems as well, similarly down nearly 40% in the last 1 year. And Nuvama Wealth also seeing a big jump today, but this stock has been increasing in the last 4 months. It's up nearly 75%. On the flip side, looking at the losers in today's trading session, there's CIE Auto reacting to its quarter-one earnings. Acutaas Chemicals also taking a hit today, although the stock is up nearly 200% in the last 1 year. Chem India Projects as well as Newgen Software, these two also taking a hit today. Chem India, in fact, has doubled in the last on a year-to-date basis, and Newgen Software also is down nearly 40% on a year-to-date basis. Data Patterns also seeing a correction today after gaining nearly 20% in the last 2 trading sessions on the back of a potential order win. And also looking at the top sectoral loser today, which is the Realty Index, continues to tick lower, down nearly 1.5% today, and the top losers on that list are Sobha Realty, Anand Raj as well as Brigade Enterprises.
Yeah, thank you for those updates there. Still trying to hold on to that 23,800 mark on the index. A couple of results that just came in before we go to Vinay Rajani. Chennai Petro was one such name. Numbers came in just a few minutes earlier. The stock at one point was down 9%, has recovered sharply from the lows, still holding on to losses of around 5%. And pull up Vishal Megamart as well. That one too was recovering from the lows after a 10% same-store sales growth figure that was reported during the quarter, and still down around 2%, but has recovered around 50% from that post-earnings drop. Vinay Rajani from HDFC Securities is now joining in for a quick chart check and some trading ideas as well. Vinay, good afternoon. Thank you for taking out time. 23,800 now. Does the index look weak enough to break below that level? And if that happens, what are the next levels you're watching out for? And your trading ideas as well for the afternoon.
Yeah, good afternoon. So last consecutive week, we have seen that out of 4 weeks, Nifty took support near 2,300. So it was every analyst was watching for this support level. it is on the verge of taking that level. And another negative point is that the broader market, which was doing good previously, now seems to losing its strength. And now we can see that micro cap, mid cap, and small cap indices have lost their levels below 20 days EMA. So that time. So overall, broader markets as well as the benchmark indices are losing strength. 23,800 is very near to that. There is a good chance that we break that level the way oscillators are seeing and the broader markets are developing. I think technically Nifty is getting weaker and weaker, though it is a fourth consecutive session of. But yes, 23,780 to 23,800. This should be a loss in trading long position. Any level below 23,780 definitely will be considered a negative sign. And after that, we can expect a level of 23,100 also in a couple days. So definitely this level is important. We need to work keenly. On the higher side, the 4,050 will act as a strong resistance for the Nifty. So unless we see a close above that, one should remain on the bearish side. As far as ideas are concerned, I would pick two short ideas. So first short idea is the electronic July future, which is looking weak and breached the strong support also. So Bharat Electronics, the July future can be shorted around 402. Stop loss can be kept at 408. On the downside, I'm expecting a target of 390. The second stock from the real estate just done except well in last weeks, but now seems to be entering a current profit booking phase. So Lodha July future can be shorted here because I can see that lower top, lower bottom formation on the chart. So July future shorted around 1136. Stop loss kept at 1150. On the downside, I'm expecting the immediate target at 1105.
Okay, Vinay, thank you so much for your views on the markets as well as your individual trading call. Well, we'll now slip into a short break. Up next, we'll be joined by Pranav Bansal of Bansal Wire Industries on their Q1 earnings. Welcome back to Mid-Cap Radar. Well, it was a weak, muted quarter as far as Bansal Wires was concerned. It saw a 48% dip in profits while margins contracted to below the 5% mark from 7.6% that the company used to enjoy a year ago. Finance cost too has seen a 29% uptick. To discuss their Q1 earnings, we are joined by Pranav Bansal, MD and CEO of Bansal Wire Industries. Good afternoon, Pranav, and thank you so much for joining us. Well, last time you met us, you did tell us, and you had hinted that Q1 could be a bit subdued, especially given the fact that almost 45 days the conflict was still ongoing. But despite that, when you're looking at Q1, what has led to the kind of downtick as far as profitability is concerned, and has there been an improvement in operations in Q2?
Sure. So I think the main impact has been a sudden increase in gas prices and other consumable prices. And as a company, we took a conscious decision not to pass that on to our customers, at least not in the firm rate of orders that we have, which is about 30 to 40 days. So in Q1, if I break this into two parts, the first half till about maybe 15th of May, we took a hit of our margins by up to the tune of 5 rupees a kg from the total 7 rupees a kg mark. We reduced our margin to 2 rupees a kg in the first 45 days to absorb all the cost. But after that, we are back to normal. That is why you see a blended decrease of only 50%. So the second half of the quarter, we were operating at 7-8 rupees a kg EBITDA margin.
Okay. When you come to FY27 volume growth guidance, you had guided for close to 20% volume growth. Q1, what you've done is 7%. In fact, market expectations were that, there could be a decline as far as volumes are concerned. So on that front, you've done better than expected. But still, 20%, in terms of all of the guidances that you've given for FY27, do you stick to the guidance?
So our target today is to grow at 20% in the remaining 3 quarters. Not for the full year, but at least for the next 3 quarters that we have. On a quarter-to-quarter, on a year-on-year basis, we are still targeting 20% growth. What we couldn't do the first quarter is something that we'll not be able to regain. But at least the rest of the year should be like that.
So fair to assume that the year will end at around 15 to 16%?
Yeah, if you take the first year into account, yes. Otherwise, the next 3 quarters, 20% is the target.
Are you moving in that direction, at least in the first few days of this quarter? Pranav, we are almost about to end July, and the situation in West Asia has started to deteriorate yet again. But is the demand on ground giving you enough indications that you will be able to do 20% this quarter?
So honestly, even last quarter, if you see the second half, we have been able to achieve our internal targets. The first 45 days were challenging, or maybe the first 2 months were challenging. The third month, already we were back to our normal level. That is why you see that we've still been able to maintain some volume growth. And this is what is continuing today. As of now, we do not see a challenge. But so we'll have to see how this situation goes. But as of now, we are comfortable.
Okay, Pranav, a couple of hygiene questions from our end. Number one, utilization at Q1 was 66%. Q2, where are you running at? Number two, gas prices, RM costs, steel prices, all of which were headwinds in Q1. Has there been a marked decrease in these costs on a sequential basis?
So first, on the cost front, we do not see any decrease in cost. Maybe % here and there, but nothing meaningful, honestly. So we're still operating at an escalated cost. That is definitely there. In terms of capacity utilization, we had headroom to grow at 20% from the starting of the year. So I think this is what capacity-wise, we are comfortable. So 75-70% capacity utilization is something that we should be able to achieve in the first from the start of the year.
Okay, so capacity utilization in the range of 70 to 75%. Now, what you've mentioned is that RM costs, as of now, there's not been any decrease. So for the rest of FY27, what is the EBITDA margin guidance that you're currently working with? Because that is going to have quite a significant impact on a year-on-year basis. It's been quite a bit of a sharp dip. So FY27 could see a bit of a washout as far as EBITDA and PAT margins are concerned?
So again, the next 3 quarters, we should be able to maintain a 20% absolute growth in EBITDA as well. So our margins are already, back to normal, and we should be able to maintain that.
What about
on a blended
Sanand?
basis? So you would still see.
When you say normal margins, what is the guidance you're working with for FY27?
So if you see last year, we were operating at about 7 rupees a kg, which is what we would want to operate at this year also. Right now, we've entered this quarter at a higher margin base. But yeah, I mean, for us, the target is that 7 rupee kind of mark.
What about Sanand? Pranav, how's the expansion progressing there? How much of capex have you already spent on that? And what's the timeline for this now? And how are you funding this capex?
So as far as funding goes now, I think our cash flows are, working for us. Even in the last quarter, after decreasing my PAT by almost 45-50%, we were still able to generate 110-15 crores of cash flow. So yeah, I think right now, we are comfortable when it comes to expansion. We should be able to fund everything through our internal accruals without taking on debt. In fact, this last quarter also our debt levels have decreased. Our total capital base has also decreased. So cash flows are good. On terms of expansion, Sanand is progressing well. We should see some meaningful numbers coming in. And, the good thing again is that most of our equipments are made by us ourselves. So we are quite flexible in terms of, expanding capacity. So whenever we see a need for that demand, we will be there. Overall thought process is the 20% kind of growth. So this is what we will make.
Pranav, one last question from our end. Last time you spoke about a trial order coming in for the steel cord wire segment, and this is from a tire manufacturing company. So what is the status on that? Has it converted into a full order? Also, as far as IHT tires is concerned, what is the update over there? Are you setting up fresh capacity? And versus the current margin of 6.5 to 7.5% range that you're working with, what will be the margins that these particular projects will be sold at?
Sure. So in terms of steel cord, we've started supplying the trial order. So yeah, but this will not directly convert into a bulk order. There are 2 to 3 stages here of trials that we have to go through, after which we can expect some meaningful quantity. That is from this one customer. And other than that, also we are working with at least 3 or 4 other customers from whom we are expecting an order or some good progress very soon in this quarter. So that is steel cord. On IHT line is progressing quite well. We are ahead of our internal estimates, and right now we are looking at an optimum capacity utilization within this year itself. So yeah, IHT has done well for us.
Pranav, thank you.
They are obviously higher margin products, so higher return on capital as well as percentage margin. So that is good for us.
Pleasure having you today, Pranav. Thank you so much for sparing time and joining us today. Wish you good luck for the rest of the year as well. Just pull up Ujjivan Small Finance Bank before we go into the break. They have raised their guidance for their FY27 ROAs to 1.8 to 2% from the earlier guided range of 1.6. And there has been a very sharp recovery from the lows of the day. The stock was down around about 2 to 3%. Now the stock has moved higher and is trading 4% higher now is Ujjivan. So a 10% recovery from the day's low for Ujjivan Small Finance Bank after it has raised its FY27 ROA guidance to 1.8 to 2% from 1.6 earlier. Take a short break. Back with more on the markets on the other side. Stay tuned. Welcome back. There is a slight recovery in the market, if you could call it that. From 23,830 odd, we are now at 23,860. So there is about a 25-30 point recovery from the lows of the day. The bulls would be hoping that this trend A sustains, and B, the fact that the Nifty closes above the 23,800 mark at least. In our mid-cap spotlight segment, Devyani is now joining us to put the spotlight on the AMC stocks. Devyani.
Well, the top AMCs have all come out with their earnings, and the main takeaway from here was that the core operations have remained soft on a quarter-on-quarter perspective, but profit was largely led by the mark-to-market gains. Now, AUM increased across most AMCs on the back of a 6% plus growth rise in Nifty, except ABSL AMC, where AUM fell roughly around 2% quarter-on-quarter. Systematic flows have weakened for most AMCs, with Nippon being the key exception. Revenue growth has remained modest across the industry despite stronger markets. Now, costs have outpaced revenue across most AMCs, compressing margins, but UTI AMC is a key exception here, with an 11% decline in expenses leading to a sharp margin improvement. Now, quarter-on-quarter profit growth was driven primarily by the mark-to-market gains as a result of the stronger markets rather than the core operations for the companies by themselves. Nippon was an operational standout this time around, delivering the highest AUM growth out of the lot and market share gains as well. ICICI and Canara have held market share, but HSBC, UTI and ABSL all lost market share on a quarter-on-quarter perspective. ABSL was the weakest performer though, with declining AUM, weaker SIP flows and continuing market erosion that has plagued the company over the last couple of quarters as well. Now, the key takeaway though was the next growth driver, which is expected to be alternatives as per what the managements have highlighted all throughout. AIFs, PMSs and SIFs are all on the radar, and they are expected to be the next growing engine for all of these AMCs going forward.
Well, thank you so much, Devyani, for a neat wrap or a neat earnings scorecard on the entire mutual fund space or the AMC space. Well, one particular stock that's taking it on the chin today is SRF. Remember, the earnings were a handsome beat to street estimates, but the conference call is something that has spooked the street. Ria joins in with the key takeaways.
Well, yes, SRF is tanking sharply in trade today after weak management commentary in the earnings call. Now, despite a good set of results that we saw yesterday, in fact, the revenue that we saw had increased by nearly 32%, EBITDA went up by 49%, margins also increased substantially to 24.6%, and the net profit also went up by 76% compared to the previous year. And all of these numbers were also ahead of what the street was estimating. But if you look deeper into the segment, the results were led by the performance films and foil segment and not by the chemical segment, which still continues to see a significant pricing pressure. Now, for the performance films and foil segment, the EBIT came in at nearly 508 crores, with the margins expanding to 17.3% versus just about 10% compared to Q1 of last year. And in fact, the revenue share of this segment has gone up to nearly 40% versus 37% compared to Q1 of last year. And even the EBIT contribution has increased sharply to 31% compared to 20% last year. But today in the earnings call, the management has said that for the overall business, Q3 and Q2 are also expected to be softer than what we saw in Q1. And in fact, they've highlighted that Q2 and Q3 are generally softer quarters from a pricing and volume perspective. But on a year-on-year basis, they will see better performance nonetheless. But based on this commentary, the stock has been taking a sharp knock in today's trade. And apart from this, on the refrigerant gas segment, the company has also said that post the commissioning of their new HFO plant in Odisha, they will be one of the top 3 to 4 refrigerant gas manufacturers globally. So that is a key positive that remains. But due to the weak commentary, we are seeing a sharp knock in the stock today.
The biggest single-day fall since May of 2021 for SRF, 8% lower now on the stock. Ria, thank you for that update there. And just before we call time on the show, look at Ujjivan Small Finance Bank now. It's up 10%, and that is after recovering from the lows of the day. There's a very, very sharp move that the stock has seen after it has raised its guidance, and the numbers too look to be on the healthier side. So 9% higher now on Ujjivan Small Finance Bank. A very, very sharp up move in just the last few minutes. Take your leave on this edition of Midcap Radar from Vivek and me. Thank you so much for watching, and news and updates continue on the other side with MF Corner.
afternoon. You've tuned into MF Corner on CNBC TV 18. I'm Vinny Motiwala, and thank you so much, as always, for tuning in. Now, we're back with our Know Your CIO segment, and where we talk about how fund managers, CIOs navigate through different market cycles. They generate alpha. How do they generate this alpha? What is their growth strategy as well? And for an investor, what is the strategy you all should follow to create long-term wealth in the mutual fund industry? And this time around, we have with us Anup Maheshwari, co-founder as well as CIO at 361 Asset Management. Anup, good afternoon. Thank you so much for joining us on the show. And we are back at a time when the war risk factor is again back on the table. As a mutual fund investors, while we talk about long-term focus, long-term strategy, but there is a fear that comes in. How should one be analyzing the current scenario, especially for their mutual fund portfolios, and how should they be factoring in terms of maybe what is a possibility that they should look out for in terms of the markets right now?
So great. Thanks for having me on the show, Vinny. So very quickly, to be honest, what we're seeing right now is something that we've seen many times over in different shapes and forms of the last couple of decades. I think, the one certainty about markets is there'll always be something that is uncertain in the world. So this war is another such feature. But I think the bigger question to ask is how much of this will have a permanent effect on earnings and how much would be temporary. That really shapes your view as far as markets are concerned. So in most cases, it's really just noise. None of these really have fundamental long-term impacts as far as earnings are concerned. I think in this particular case, the war as well, in the first time something unusual happens, obviously everybody is caught a bit unawares. But after some time, even though there are ups and downs even now, the fact of the matter is people have sort of adjusted their minds to it. Companies reorganize some of their supply chains. So all of that sort of gets taken care of, and you're back into a more normal, more visible earning scenario. So we sort of ignored this noise in the short run. I know it's something that every day there's a sort of different statement coming out. I think that's a bit of the world we're living in at the moment. But the best thing to do is really ignore it and just ask the basic question that is, does this impact corporate earnings in any dramatic fashion? If it doesn't, you just pretty much stay the course.
Point taken there, but at what point of time maybe a mutual fund investor, long-term investing, surely that is there. But as a fund manager, as a chief investing officer, you have to manage with that fast-changing pace of the world as well, right? So how does one actually define long-term at such a time, even from a fund manager's point of view or an investor's point of view?
Yeah, it does get tricky. I mean, we're living in a much more complex world, and I think geopolitics is a new additional uncertainty that has been injected in the market in the last few years. Yes, from our point of view, our job is very, very simple. We've got to find decent businesses, assess the managements, and in fact, I would say, we have to look for managements who can adapt to these type of situations, who are, who can deal with these level of uncertainty. And that's our bigger selection challenge, that you find businesses and managements who can navigate through these type of challenges. So for instance, maybe you're focusing a little more on domestic businesses rather than international businesses that could be a little more vulnerable. And then you sort of readjust marginally your portfolio. But we try and avoid reacting to too many of these things in the short run. As I said, most of it is noise. So you don't want to end up changing or maybe even selling out a good stock in the portfolio that you're going to regret later on. A lot of good value in investing comes from doing nothing after doing your core selection well, and really relying on managements to be able to navigate some of those challenges while you stay put with the position.
Anup, at such times there's so many queries that come in, and especially this has been going on for a while, right? We had Russia-Ukraine, then we had tariffs and something or the other, like you mentioned in your opening comments as well, right? We had something or the other that kept coming. As a mutual fund investor, what if something that you're holding is not performing? At what point of time do you know that it's time to maybe get out of this one? Whether it's your mutual fund investment, your stock holding, how does one decide on that factor?
Again, it's a very, it's tough to generalize an answer to it, but what I would say, Vinny, two things. One is typically, actually, if we have a situation where something is underperforming in the portfolio, but you're convinced on the core business or its ability in the past to generate value, but for some reason it's underperforming now, that is actually, you have to see that positively as an opportunity to maybe add into a position. But if something is underperforming because fundamentally things are changing, it's losing competitiveness or earnings are falling or not performing consistently for many quarters in a row, then you could probably, take a look at something better or exiting that in the portfolio. And we do that at a stock level as well. If our core thesis isn't happening, then at some point in time, we take a call and move on. I think it's the same for an investor in a mutual fund. So normally, actually, we normally ask investors to think in terms of the reverse logic, which is if a good fund manager or a good fund over a long period of time is underperforming for some reason, you should probably be adding into it rather than removing out of it, because you're getting the portfolio at a better valuation. But if something structurally has changed, the manager has changed or the process has changed or something, then maybe you need to reevaluate.
At such point of times also, there are a lot of opportunities that individually come in different sectors. You can never time the market, but how do you identify maybe which sectors to look at? And when a mutual fund investor is looking at it, does it merit maybe looking at sector funds in a similar way that you identify a sector as well?
So how do you identify sectors? You're typically looking at these growth curves that can tend to emerge. There's sudden periods where activity picks up in a sector. There's a structural change. We saw that in defense, for instance, a sector that used to perpetually underperform. And then there was a change towards the government wanting to do things indigenously, and a huge sea change in terms of order flow, visibility, and economics for the sector. So that's a structural change, and then it's matched by growth and order books and all of that. So those are the things that you have to sort of identify early enough and then participate into that. As far as thematic products are concerned, generally I've seen thematic funds tend to get raised when the theme is already has progressed quite deeply. And as a result, you're not really getting the best valuations. You're buying the momentum of the theme, which is not necessarily the best time. I mean, if I go back in time, most sector funds are raised when a sector has already done well, because then it's much easier to raise capital. The challenge in our business is when a sector is not doing well, and probably it's the right time to invest into it, it's toughest to raise money at that point in time because people need to have a specific reason to buy. So thematic funds, I would generally stay away from. I think we always prefer more flexi cap type of strategies where you leave it to the fund manager to figure out what sectors and themes they'd like to go overweight, underweight, but just participate at a broader level.
Flexi cap, that's the key word right now. Everyone loves it, whether it's flexi cap or multi cap, and investors are looking a lot more in that side as well for investing, whether through SIPs or even lump sums. But at such a time, we know small and mid caps in tough times may underperform, but then outperformance also comes in faster when they start to recover. Small and mid caps now have managed to still outpace that large caps on a wide margin. What is your thought right now on this one, and what is your flexi cap strategy right now for investing?
So Vinny, I mean, the universal truth is markets tend to follow earnings. Markets are slaves to earnings. And wherever earnings growth is higher is where capital tends to flow and re-rating tends to occur. I mean, we've seen this at a global level. India has underperformed for the last year and a half, primarily because our earnings was very weak compared to what we've seen in some of the developed or emerging markets. Within India as well, we're seeing exactly the same dispersion where small caps, mid caps have created higher earnings growth relative to large caps. And as a result, small caps and mid caps have performed better. So it's really, whenever large cap earnings come back in a more robust way, that's when large cap ideas will do well, or that segment will do better. But right now, for the next year or so, it still looks like selective small caps, mid caps seem to have slightly higher earnings prospects compared to large cap. So again, as I said, it's really a function of where earnings are and then related to that, where valuations are.
Mhm. Okay, point taken there, Anup. But on that note, wait on, because we have to slip into a very short break. We'll come back after the break and continue this conversation on Anup's thoughts and strategies on the industry, the markets. Where is it headed for the mutual fund industry? Stay tuned in. Welcome back to MF Corner on CNBC TV 18. We still have with us Anup Maheshwari of 361 Asset Management. Anup, let's talk about a first-time investor who is maybe just started off right now or beginning their journey, the mutual fund journey. What is the best category right now you would tell them to look at?
As I mentioned, Vinny, I think it's best to start A, with a mutual fund, B, with something that is flexible. So a flexi-cap fund, I think, pretty much gives fund managers or the fund manager that you're investing with enough flexibility to manage across sectors, across market caps. So it's best probably to start in that segment and then pretty much leave it to the manager.
Okay, absolutely. FlexiCap, look at it and then leave it to the manager there. But SIFs, Anup, that's been picking up pace. We've seen so many new launches coming in as well. You all also have an SIF as well. Even though the minimum investment threshold that comes in is higher, but there is still a lot of interest in the category. How are you seeing it here right now? And maybe if you had to tell an investor what sort of an investor maybe should look at this category right now?
Sure, Vinny. So it's an exciting new category from our point of view. I think it's a very forward-thinking category by the regulator as well, which sort of increases it a bit of, it's a little more complex than a traditional mutual fund, but it has a lot of the advantages that mutual funds offer. The complexity comes from the fact that there's derivatives. You can go short up to a certain percentage of the fund. So there's controlled risk, but it's a very different type of risk. And like you correctly mentioned, it's 10 lakh rupees is the minimum. So therefore, it's not really an absolute retail product. It's meant for somebody who understands the risk reward of introducing derivatives into the portfolio. So a slightly more sophisticated audience. Sorry, I'm not sure if
I can hear you. We can hear you.
Okay. So it's a slightly more sophisticated audience. And I would say, as a category, it's worth exploring a little bit, but give it some time for it to show its returns. This is a very young category. So what we're advising people to do is, of course, we'd like to see flows into it, but also track performance. And as a track record builds up, I think you get more and more comfort in terms of investing.
Mm-hmm. Anup, there's this one question that always comes in from an salaried individual. They always want to know, while you have your active funds, but passive funds, and they have picked up pace as well. Passive funds versus active funds as a category. With passive funds increasing pace, is it more time, or is it time to look more in terms from that point of view as well, more in terms of ETF point of view as well?
So you're speaking to a biased party here. I obviously will recommend active funds. We ourselves have now almost a 30-year track record of creating alpha against the index. I think, most Indian managers are able to create some degree of alpha. India is still an alpha market. Alpha means outperformance over the index. And that's largely just because of the nature of our market. We have so many sectors to choose from, unlike most of the markets, which tend to get dominated by a few sectors. India has a very nice breadth. It has a breadth of market cap as well as sectors, and that allows a manager to be a lot more active, find differentiated ideas relative to the index, and therefore create that extra performance. So I would still be a proponent of active funds over passive funds. If it gets to a point like global markets where a few companies are dominating the entire market or a few sectors, at that point in time, perhaps passive funds will be more relevant.
Anup, what's also become exciting in the last 1 year for mutual fund houses is the opportunity now to invest in InvITs and REITs. Have you all looked up at it? Are you all aggressively looking to invest here?
So as a firm, actually, we have a parent company, which is a wealth management firm. We're actually one of the largest investors in the listed REITs and InvIT space. It's a space that's attracting a lot of interest for high net worth individuals and generally for a multitude of investors. It's a relatively new category again, but people have seen handsome returns. It's a nice combination of yield with an element of growth. So it does fit quite nicely into a portfolio somewhere between equity and debt, better returns than debt but lower risk than equities clearly. So I think REITs and InvITs are an interesting category. We'd like to see the breadth of the market increase. It's still a limited market in size, but I'm sure more and more will come to the market and should be an interesting area.
Absolutely, it should be an interesting area, maybe that one could see going forward as well. Anup, what's also becoming interesting now as an investment opportunity or a pathway or a passage to the international market is the GIFT City. We have a lot of fund launches that have come in on that front as well. Will this, or do you see this becoming maybe a go-to for investors from here on?
So GIFT City is clearly a big initiative by the government, and I think the whole idea, I think the basic premise was to attract foreign capital in. I think, for now, at least Indian investors are also keen to take capital out and explore other markets, just given a bit of relative performance and opportunities. I think it'll be a two-way flow, both ways. There will be products overseas that Indian investors will find interesting through their LRS, the remittance that they're allowed to do, as well as some large family offices. But at the same time, funds like us, others are very keen to attract foreign capital into India with some sort of tax advantage for those investors. Nobody likes paying capital gains tax generally. And therefore, a lot of foreign investors that we're talking to are also exploring the GIFT City route as a way to participate in Indian market. So it's a good initiative that allows people to participate in India without the friction of tax.
Anup, let's talk about investors who are always wanting to create wealth, much more wealth than what they return actually comes in from the industry, right? As an investor yourself, maybe, what would you suggest a first-time investor to look at in terms of proportion? You said flexi cap, sure, but how do you divide your money if they want to divide their portfolio right now?
Again, give a very precise answer, but I think I would say, the core has to be flexi cap. On the margin, first of all, an investor should play a little bit to their strengths. I think a lot about investing is first understanding yourself, understanding, where you might have an edge, or an understanding what your temperament is. Are you somebody who has the ability to navigate volatility or not? Your risk tolerance levels, and then sort of position your portfolio accordingly. Sure, if you want to try and create excess return while also obviously carrying excess risk, you can explore some of these thematics that you briefly touched upon, in addition to your core flexi cap sort of allocation, so that you can try and see if you can juice out some extra returns from that. But by and large, I guess it's really horses courses for horses type of thing. I think you've got to see your own risk appetite and then decide where you want to be. But the core should be a core compounding sort of flexi cap type approach, which hopefully can add a couple of percentage alpha over the index performance.
Okay, point taken there, Anup. Everyone has their individual way that they need to understand, set your own goals before you invest as well. What is the purpose of your investment? How long do you want it as well? All that is going to be key, and it's not that everyone's style could fit everyone. So that is something that we should keep an eye out on as well before investing. But Anup, thank you so much for joining us on the show this afternoon, explaining us what your thoughts are, what your strategies are, and how you all invest as well. So thanks so much for that. And viewers, thank you so much for tuning in as always. This is all the time that we have on this edition of Mutual Fund Corner. Up next, if closing well to take you through the last one of trade.
Go beyond market headlines to understand the reasons for the day's movers and shakers. And get your portfolio ready for tomorrow. Beaming live from the CNBC TV 18 Motilal Oswal studio.
Yeah, the Taiwanese index are 0.3% higher. The Hang Seng is up 0.75% as well.
Net, if you look at from the lows of July, oil prices are up 30%. The first rates are there, 23,800 and 23,900, by the way.
It's not practical in terms of return on investment.
I want to put to rest that the FCNRB money is not that cheap.
We are picking up from the sources is that this builder loan book, as it is called.
So currently for INFI, the guidance stands at 1.5 to 3.5%.
Initial feelers have been sent and a couple of investment banks have been approached.
R&D spend here is just $2 to $3 billion.
Choppy session, that's what we expected. The market's expected to be weak after the weak handover we received.
Well, the choppy session has now become weak. The markets have extended the fall as the days progressed. It's 23,860 on the Nifty, 140 points lower. At the day's low, we almost went down to the 23,800 mark. From there, there's been a mini bounce of about 50 odd points, but we still have 1 hour to go. It's the Sensex weekly expiry, and across the board, the tape is red. The mid-cap index is under pressure. The index is down 1%. The advanced decline ratio at 1:2. Other sectors like realty, weak in trade, commodities is selling off. Few places to hide, but you've got a couple of auto names holding up in the green and lots of earnings, a slate of earnings to track today. Hi.
Well, that's right, Rima. And, a few stocks actually are doing very, very well in today's trading session. Ujjivan will explain in just a bit. That a bit of a rarity, a financial institution company going ahead and upgrading their guidance. So we'll explain to that in just a bit. Oracle Financial, just take a look at that. There is that overhang with regard to our colleague Vivek reporting that probably there could be some supply that's coming in there. But the stock has moved into the green, so that intraday dip actually has got bought into. And a few other names, Gandhar Oil, one that was losing out big time, that's bounced back. Suntech as well, that was up close to 10% at some point of time. So individual stocks are doing pretty okay. And Rima, given the fact that crude oil prices are at $98 per barrel, to have just two stocks declining for one stock advancing is pretty okay. It's not that bad.
I agree, and now it's 97.5 on Brent crude prices. It's been a very sharp surge. At the beginning of July, crude prices were closer to $70, $71 per barrel. From that level, there has been a massive increase of close to about 50%. Given that, keeping that context, the macro headwinds in mind, I think the fact that markets are still holding on to the lower end of the trading range, which has been about 24,300 on the way up to 23,800 on the way down, is not a bad outcome. But as I said, 1 hour to go. So let's unpack that and tell you what we have for you in closing bell. Crude prices continue with their upward stride, surpassing $97. Soaring oil prices have sent stocks lower. The Nifty has slumped virtually to the day's low. All sectors in the red, barring autos. A whole host of stocks reacting to earnings: Ujjivan Small Finance Bank, Chennai Petro, Gandhar Oil, Tanla Platforms, and more. A deep dive coming up. Innocent Bank bleeds despite stronger than expected June quarter numbers. Brokerages mixed. We'll get you a bull and bear analysis. And Oracle Financial has recovered from the day's low, but sources tell us that parent company Oracle Corp may offload part of its stake in the company. And this is a CNBC TV 18 exclusive. And not to forget, IT major Infosys is all set to report its Q1 numbers after the bell. We'll tell you what to expect. For now, let's get in Mitesh for a few last hour trading calls. Mitesh, would you take comfort from the fact that 23,800 has held? Will it hold? Or do you think a breach is coming?
I think yes, this holding of 23,800 is important. Will it hold? I, as of now, don't know, because the price is below its short-term averages, 10, 20, 30-day averages, but the indicators are yet, above their trigger lines. But in case, we don't capture 24,000, 24,015 a day or two, then I think there'll be a real danger of us breaking below 23,800 with the first target close to about 23,600, then on the downside. And in a bad case scenario, even 23,350, 300 could be tested. So it's not a very healthy situation, but good that the important level, as of now, 23,800 is kind of, that's the level where the bulls are trying to fight back. And I have right now one buy and one sell call, and the buy is on TCS. Tech stocks doing slightly better today. TCS is a buy with a stop at 2214 for targets of 2290. And Adani Enterprises, I think after a long time, has given first signs of profit booking and selling. So sell here with a stop about 3056 for targets of 2930.
Got it. Okay. All right. Thanks a lot for that, Mitesh. Well, since we mentioned there are a lot of earnings reactions, and individual stocks on the broader markets are doing a thing of their own, Vinny has put together a nice, neat list, and she's going to run us through some of those stocks that are grabbing your attention. Vinny.
Hi, afternoon. So let's start with the first one is coming in from the banking side. Ujjivan Small Finance Bank just reported its numbers a short while ago. Net interest income of the company has seen a sharp improvement. 1,187 crores is what the net interest income is at. Revenues of the company have almost tripled as well. Now, gross NPA, what does that stand at, right? Gross NPA for the company is coming, and we're seeing a better improvement in terms of gross non-performing assets, 2.17% versus 2.27%. Overall, the interesting part is FY27 guidance that's been raised for the return on asset ROA guidance that has been raised to 1.8 to 2%, reflecting the confidence that they have in terms of the profitability. The next one is Chennai Petro. Weak results that came in from the company. Overall, the profits of the company are seeing a decline. 1,000 crores approximately is what the profit stands at versus last quarter of 1,400 crores. Revenues of the company, that's seen an increase for the quarter, but on a quarter-on-quarter basis, margins, that's where the sharp fall also comes in for the company. So margins have seen a very sharp contraction, and obviously a lot of factors that come into play for Chennai Petro, but weak set of numbers in Q1 FY27. Tanna Platforms, again on the flip side, a very strong set of numbers that came in from the company. The stock has been one of those best performance on the Nifty 500 side as well, and revenue seeing a very strong growth. The EBITDA margin has seen an expansion as well. Profits of the company seeing a very strong performance. Overall, strong double-digit growth continued for the company in this quarter as well, and digital platforms that also did well for the company, along with enterprise communication, which managed to see a decent growth on a YOY basis. Lastly, Gandhar Oil, that's another one also. They reported the numbers yesterday post-market hours, and that also is doing well in trade. Very, very strong performance that came in from the company in terms of revenue growth. Margin performance also has seen a very stark and sharp improvement as well, and that is why Gandhar Oil also is buzzing in trade.
Okay, and so many more. I know we have positive time, but there's SRF as well. Q1 numbers look good, but then there was a management conference call earlier today where the company's commentary was a bit subdued. They're talking about Q2 and Q3 being softer than Q1. And generally, there is that macro headwinds which are impacting. So SRF has taken a bit of a downturn. Mahindra Life Spaces, those numbers were just flashing for you on your screen. The stock has surged close to about 8% Route Mobile is up 8%, and that is ahead of numbers which are expected. So we're still awaiting those numbers. So Vishal Mega Mart numbers look okay, but the stock is slightly lower in trade, and that's down nearly about 2%. But we've got Deven Choksi now joining in on the show. Deven, afternoon. Thanks for joining in. Which number, mid-cap, small-cap number catches your attention? Which are the stock that you're most bullish on today from the numbers?
Yeah, good afternoon. Well, I think the number which stood out very well is SRF. Definitely, I think it is one of advantage they have got in this particular quarter in all the three verticals where they are operating. Wherein I think the lower input cost to higher selling price, I think advantage, typical one, I think for the particular quarter that they have got it. Of course, I think they are normalizing it by way of putting it across in subsequent quarters. I think this particular growth is likely to get moderated given the kind of normal input-output or the delta that we are talking about. So from an overall perspective, results are good, definitely. Company holds a lot of potential and promise at the same time. But yes, I think with the coming down in the price, I think this could possibly become relatively a better choice if the market gives opportunity for the lower price.
Okay, all right. By the way, there's a bit of a recovery actually we have seen from the day's low. And I think the stock that's catching your attention is actually Cipla. There was an initial knee-jerk reaction, but the stock was down 3.5%. As we speak, it's on the verge of moving into the green, and the stock that's going to keep my colleague Rima very busy this evening is Infosys. That big boy suddenly said, I want to get counted today. Let's see how the numbers are. But for the time being, that's fighting back from a bullish perspective. So the tech pack itself has made a bit of a fight back.
Yeah, TCS, the stock that Mitesh was also bullish about. So that's seeing a bit of a recovery. Tech Mahindra, Wipro is now back in the green. So that's up nearly about 0.5%. So generally, as you said, tech's made a comeback.
All right, but another stock, more products business, I think, than a services business, that's Oracle. Sources tell CNBC TV 18 that troubled global major Oracle Corp may sell a material stake in its listed entity, that's OFSS, to tide over the cash crunch. Vivek joins us. He's the one that's bringing all those details. Initially, the stock saw a bit of a downtake and now seen its bit of a recovery. But Vivek has dug out some crucial details. Vivek, take it away.
Well, that's right. Earlier today, we told our viewers about how Oracle Corp, which is the parent company of OFSS India, the listed Indian arm, and what we understand from our sources that very initial feelers have been sent out to potential buyers in terms of a stake that Oracle Corp may be looking to divest or sell part of as far as OFSS India is concerned. What we understand from our sources is that initial feelers have been sent out to go ahead and garner investor interest, and the size of this particular deal, the price at which this particular deal could be done, and the timing of the deal would all depend on how investor interest comes about for OFSS India. Now, remember, OFSS, Oracle Corporation held a little over 72% stake in OFSS India, so there's enough headroom for them to sell stake, continuing to remain the majority shareholder. And the results that came in yesterday were quite encouraging as far as OFSS was concerned. Now, in terms of one of the likely reasons why there could be a stake sale is that, remember, the parent company, Oracle Corporation, has actually had a bit of a tough time in the recent past. The stock is down almost 60% from its recent peak from September. Now, very recently, S&P Global Ratings actually went ahead and downgraded the credit ratings of Oracle Corporation, and it's now just one notch above the junk status. What is it that they're saying? They're saying that the rapidly expanding AI infrastructure business spends is something that has started affecting the cash flow, and they believe that they are expecting now weaker free cash flow in fiscal 2027 versus their previous estimates. They say that they would lower their ratings in case they do expect Oracle to go ahead and sustain leverage above the 4.5 times levels. Now, when you're talking about what we've done, we've reached out to both Oracle Corporation, the US listed entity, as well as OFSS India. We are awaiting a response. We'll update our story once we do get a response from both of these entities. But remember, OFSS India and Oracle Corporation, they've had very, very differing outcomes in terms of the stock price reaction. OFSS has actually seen a 60% uptick from its recent March lows, while Oracle Corporation has seen a 65% downtick from its September 2025 lows. A bit of a stake sale is what we understand could happen as far as OFSS is concerned.
Big story. Vivek, thank you very much for alerting. We'll have to wait by to see if it's happening. But globally, investors are scrutinizing big tech's AI infrastructure spending. Just look at the way the market reacted to Alphabet's numbers. Very strong. Revenues were up 24%. Google Cloud revenues were up 82% in the quarter on a year-on-year basis. The best growth that we've seen. Yet in after hours, the stock was down 3% because the company raised the capex spend for this year by $15 million at the midpoint of the guidance. And, the stock, in a way, got punished for it, and the stock was down after hours. So that gives you a sense of what the market leaning is. There is growth for now. There is earnings visibility. But that AI infrastructure spend, how it's going to be funded, continues to remain a watch point for most investors. But even back to Oracle Financial Services, I agree. Maybe this remains an overhang on whether the parent company will sell its stake or not, part of its stake. They have more than 70% in Oracle Financial Services. But this is a company which has been growing well. And if you want IT exposure and service, Oracle's margins have been 40-50% now for so many quarters and years. Is OFSS a buy with this dip?
So I think the quarterly results basically indicating few things very clearly. This particular quarter has been a lumpy quarter for the company, largely because of the fact that many of the North American and Japan clients in the banking and financial space, I think, have actually moved away from the completely native system to the AI-enabled APIs provided by the license platform of Oracle, along with their cloud stream. So from a perspective of looking at, I think this company on a quarter-to-quarter basis, yes, you may find that I think this quarter has been exceptionally good quarter. It may not possibly sustain, I think, in the subsequent quarter and normalize eventually. But nonetheless, I think the growth engine continues because I think their IT service business contribution in the total portfolio remains relatively smaller compared to the licensing business and the cloud business. So yes, I think the valuation wise, it's pertinent. I think they have been averaging around 18 to 20 times up till now, but in this period they are right now putting it around 28, 29 times on a trailing basis. So from that perspective, it is expensive. And if the parent wants to monetize part of the stake, I think this could be a better time because I think the valuation premium is available in the marketplace, at least at this point of time, which is not the case with most of the IT companies particularly.
Got it. Okay, all right. Devin, stay with us. Let's address a couple of other names. Then we have Ria who's joining us because the shares of SRF, they're under pressure post the weak commentary and their numbers as well. Ria, yes, when the numbers initially hit, it looked like a beat, but the internals look a little bit sketchy with regard to the chemicals business and the commentary was weak. Tell us more.
Well, that's right. The commentary in the earnings call today was weak, but just to recap what happened yesterday, the company did post a very strong set of numbers, well ahead of street estimates as well. But if you go deeper into the segmental performance, the results were led by the performance films and the foil segment and not by the chemical segment, which still continues to face pricing pressure. Now, for this performance films and foil packaging segment, the EBIT rose to nearly 508 crores this time around. Revenue also well above 5,700 crores in this quarter. Margins also saw very strong expansion to over 17% versus just about 10% what we saw in quarter 1 of last year. And in fact, the revenue share of this segment has gone up to 40% from 37% last year. And the contribution to the EBIT or the overall EBIT has also gone up to over 31% versus 20% last year. So overall, the performance has been led by this segment. Now, coming to what the management has said today in the earnings call, they've said for the overall business, quarter 2 and quarter 3 will be softer than the numbers that we saw in quarter 1. And they have highlighted that usually quarter 2 and 3 are much softer than the first quarter from a pricing and a volume perspective as well. But on a year-on-year basis, the entire performance will be better nonetheless. But because of this commentary that the next 2 quarters are going to see a weaker performance, the stock has taken a big knock today. Apart from this, on the refrigerant gas front, they have said that post the commissioning of their new HFO plant, the company will become the top 3 to 4 refrigerant gas manufacturers globally. So that remains a key positive for them. But overall, because of the weak commentary, the stock has tanked nearly 8% today.
Got it. Okay. All right. Thanks a lot for that. Devin, I wanted to ask you about a few other names. The cement pack as well is seeing a bit of a crack. You have Ambuja that's moved lower now. There was hope that maybe, in fact, there could be a pleasant surprise coming from some of them. Ambuja in particular, when Adani Group bought it, there was so much of enthusiasm and excitement. Stock has seen a big correction from the top with the promoter entity as well coming and supplying some stake at various junctures. Your take?
Well, I think on the demand side scenario for cement companies in particular, they remain absolutely convincing. No doubt, be it Ultratech, be it Ambuja as a group, I think they probably would see a larger amount of offtake as we see the post-monsoon season construction activity picking up. So that part, I think, is definitely given. However, I think the larger emphasis, I think, is always going to be on how the profitability would improve. And that's what is going to be the question. And you are right. I think the initial days, probably, I think the expectation was that Ambuja coming into Adani fold, probably with the logistic coming into their help, may improve significantly, I think, on the profitability side. But that has not yet happened so far. So we'll have to wait and see how exactly this will play out. But in my viewpoint, being commodity business, I think the input cost pressure is definitely going to play a little spoil spot as far as the outlook on the further margin in the current year is concerned. Demand scenario improves, but margin pressure will continue in my viewpoint. And that's where probably the market would not buy convincingly the cement story at this point of time.
Got that. Had a look at companies like a Gandhar Oil that's up 10%. Tanla is doing well. NTPC Green Energy again reacting to numbers. HEG. Any of these mid caps?
No, Rima, literally, I think difficult to scan through many companies at one point of time, particularly where you don't have interest in investment. I think you find it giving a second preference. I think that's where I think you can't comment on so many companies.
HDFC Bank, after the 9% dip this week itself, and stock is down 25% year to date, is it a buy?
I would like to, because I think the downside in the stock price is definitely kept at current levels in my viewpoint. The observation in the last quarterly result, the corporate loan book has started surging for most of the private sector banks, including HDFC Bank, and that's where probably I would like to bet on the private sector bank, because up till now I think the struggle was with the corporate loan book, and now the corporate loan book has started growing. This year is going to be typical year where the working capital demand from the corporate side is going to increase, and that's where some of the banks like HDFC Bank probably have relatively better performance to talk about on the corporate loan book side. So we remain convinced about it, though fully agree that I think there will not be very major jump into the stock price, even though I think FCNR deposits I think are going to play some amount of stabilization as far as the balance sheet net worth is concerned. But to my mind, I think 15-20% upside are definitely over a period of 12 to 15 months. I think can't be ruled out in this kind of companies.
Okay, let's talk about banks. IndusInd Bank is tanking in trade despite reporting a good set of Q1 numbers. In fact, even when we chatted with the management, he said that the bank is at an inflection point. So what is it that's weighing on the stock today? Ananya joins in with the details and what brokerages have made of the numbers. Ananya, numbers look good to me. So what is it?
Well, yeah, you're right. The numbers are pretty good. PAT jumped 72% year on year. But if you look at the core NIM, however, it declined 4 bips quarter on quarter, while loan growth remained largely corporate-led. But overall, the numbers were pretty good. Now, here, Jeffrey sees Q1 as a start of a sustained turnaround, and it is bullish. While CLSA and JP Morgan remains cautious on the weak retail growth here, muted fees and wholesale-led expansion. Now, here, JP Morgan also believe that much of the recovery is already priced into the stock. Now, coming to the management told CNBC TV that Q1 should be viewed as an inflection point, like Rima mentioned, and retain its guidance of industry-level loan growth with an exit ROA of 1% in FY27. It said all historical issues are now behind the bank and no financial impact is expected from the ongoing legal proceedings, while FCNRB funding could put some pressure in Q2 margins. So that will be a key monitorable here. Management believes high-yielding businesses, lower credit costs and better operating leverage should protect profitability here. But the key debate is whether the improvement can be sustained, especially after the stock has already rallied over 18% in the last 1 month and more than 20% over the past 6 months.
Got it. Okay. All right. Thanks a lot for that, Ananya. And Devin, so from the banking pack, you said HDFC Bank, right? That's the top bet for you.
Yeah, HDFC Bank definitely, I think from the valuation perspective, giving more comfort because the downside is protected. However, I think all the 4 banks, when you put together in private sector, HDFC, Axis, ICICI and IndusInd among others, I feel Kotak even for that matter, I find that I think as I was mentioning for HDFC, I think most of these banks have shown the similar kind of a trade where the corporate loan books have started increasing, and that is giving me more confidence because even till last quarter earlier period also, the major amount of thrust was coming only from the retail side. Now at least I think the double-digit growth in the corporate loan book, if it is sustaining, which in more likelihood it will, then possibly we should be seeing a sequentially relative better numbers coming in from some of these banks. So we remain distinctly careful about watching these numbers, but at the same time possibilities are that they should be definitely improving in the performance in the next 2-3 quarters.
Thank you very much for that. Markets are back again at the day's low. It's 23,815. So from in the last 30 minutes or so, we've seen the markets extend their slide. We were down about 130, 140 points, now down 180 points. So now things are getting volatile and weak. And even the advanced decline ratio, the gap between the two is widening. So the sell-off is getting more broad-based. The key is for us to hold on to that 23,800 mark. A breach of that, technically is a negative sign. Get into a break. On the other side is our alpha manager for the day, Rupen Rajguru of Julius Baer India, will join in. Stay tuned.
Welcome back. Well, the markets have dipped a little bit. We've moved closer to the lower end of the range, and that's probably because we have the Sensex weekly expiry as well that's playing out. So there'll be an element of there. So that's what could explain the last 30-minute fall that we're seeing in the Sensex as well as in the Nifty. Let's do a quick check on the F&O market though. In today's trading session, the volatility index is up 2-3%, but it's not spiked up big time. Now, this is the fourth straight session that we're ending low. It's up 2.5-3%, which is par for the course, one would say. So the fear index is not really flying away, which is okay, good. The options data, well, we're seeing an aggressive call writing, 23,900 call. Just take a look at that. Massive open interest built up out there. The premium is down to around 100 rupees now from around 201. So that's aggressive writing being seen there. 23,850 call as well. The premiums come down to 125 rupees from around 232 rupees or thereabouts. So on both those two, there's aggressive writing. Any kind of bounce towards 24,000 will be met by resistance. However, on the downside, this 23,800, which we're very close to, well, the bulls will at least want to protect that mark for the end of by the end of today, because that's going to be the important factor. Actually, if you break that, then you're looking deeper on the downside. Individual stocks, and I'm going to keep an eye out on these stocks. That it appears that Bosch is seeing solid open interest build up. So that's that one. In fact, that's for the next contract it's seen. The rollovers actually are long on for the next contract itself, and there is some delivery based buying as well. It's doing very, very well, and the structure looks pretty good. So I'll keep an eye out on Bosch and Eternal as well. After yesterday's low, some of those shots could still be squeezed into the system because it went down to 275 rupees and it's holding in the green. Now there are signs of fresh buying. So the fresh buying takes over. Those shots will actually have to squeeze out. So I'll keep an eye out on both these two names, Bosch as well as Eternal. Both those two are going to be on my radar.
Okay, let's get in. Rupen Rajguru, Head of Equity Investment Strategy at Julius Baer India, now joining in. Rupen, thank you very much for joining in. Just maybe a month back, we thought things are on the mend. Crude prices had come down to levels of $70, $71 per barrel, and we were learning to live. Crude had started moving through the Strait of Hormuz, and suddenly the picture has changed. Crude price back above $98 per barrel. The rupee has started weakening despite the support coming in from FCNRB. What are you telling your clients now? Is the Middle East risk back on the table, and therefore portfolios should be hedged for it?
Yeah, hi. Afternoon, Rima. And in fact, I think last time when we spoke, I think clearly the sentiment was had significantly improved. But as I think they say, this is like the Schrodinger's ceasefire. So we don't know till it is done. It is done. And from an India perspective, in fact, this entire year, or for that matter, last 18 months have been heavy on the news flow side, and particularly the current news flow around geopolitical has an impact on India, and it has an impact on India's macro because of the crude oil movement. So difficult to gauge, because we have seen in the past also these things change very fast. But if we zoom out and if we look through from overall, leaving aside the uncertainty related to the oil price, the macro setup actually has been improving, and we clearly are seeing signs of that. The first of all, we know some of the indicators like credit growth being, system-wide credit growth being around 17% is definitely a good sign, and because of that now. Also, slightly higher inflation, the GDP growth, which had gone down to single digits, now we are seeing a double-digit kind of a GDP growth. And leaving aside the current noise around the war, in fact, that was there last quarter as well. But if you look through the quarterly results so far, it has actually been positive. And in fact, there have been more positive surprise than negatives. And the commentary of the management has also been very constructive. So yes, there is this current issue around the oil price, but leaving that aside, I think from a overall market setup perspective, we should be doing well over next 2 to 3 years, because equity markets over last 2 years, the Indian markets in particular, has given 0 to negative returns, and historically, whenever something like that has happened, the next 2 to 3 years should give us returns which will be above the trend line, and that is what we expect.
Okay, things are a little bit rocky in the near term, but Rupen, you're sounding a little bit optimistic with regard to India's prospects with the 2-year time frame. In these volatile times, though, Rupen, you get to buy stocks you want to buy at the price that you desire, which is good. Now, give us a couple of stock names if possible, or at least a theme that you like. Stock names will be great, huh, Rupen?
Yeah, hi, afternoon, Nigel. While very rightly said that in volatile times you get stocks and themes which you like, but from an India perspective, there has also been a peculiar thing wherein the large caps actually no, if you look at the index, you get a different picture because, as you rightly said, we are closer to say 23,800 and thereabouts. But whenever we have seen, the improvement as far as the news flow is concerned, the SMIDs have actually done pretty well in India. So the small and mid caps stocks actually have not seen that kind of correction which the large caps have seen. So, and we, from our portfolio perspective, we would like to have a blend of both large cap and mid caps. At the current juncture, definitely there is value around large caps vis-a-vis mid caps. So, yeah, I'm afraid I won't be able to divulge any, disclose on the names of the stock side. But some of the themes which we like, while as a structural theme which we discussed last time around, also the banks definitely looks good. But in the current setup, if you see, and if I were to just juxtapose some of the numbers and the commentary which the banking management gave, at this point of time, we don't see the interest rate either rising or falling. No, there is no cut or a hike, at least in the immediate term, is what we expect. So the NIM compression probably we feel is more or less done. And because of higher inflation, and I think no, the previous guest also mentioned the credit growth and some of the corporate growth is pretty strong because the working capital requirements have got elongated also, and the banks are clocking pretty high credit growth. So in that era, and plus considering now FCNR liquidity will be also, we already have got $17 odd billion, and by end of September probably it might be 3 times that number. We the system liquidity being good, so in that era probably NBFCs will do better. And even while large banks do have a lot of value, but the growth will be there in the mid-tier banks. So some of the mid-tier banks whose valuation are reasonable, ROEs are near high teens, those we believe will give alpha or better return vis-a-vis some of the large private sector banks, which has value, but probably the growth there will not be as high as those. So that's one segment we like. And second segment, clearly we are seeing consumption is something which we like, and within consumption, some of the discretionary items on the consumption is what we like. So these are the broad themes that we like from a medium to longer term perspective.
These large private sector banks, you said that you prefer the NBFCs, there is better growth, but should large private sector banks be a part of the portfolio? They've given no return for the last, not just 1 year, but even longer if you stretch the horizon.
You are absolutely right, Rima, about the returns part. And frankly, what we believe, they would form part of the core. They should form part of the core portfolio. While it might not have that kind of excitement with some of the SMIDs, which is mentioned, which I just mentioned. So the portfolio should have combination of the large banks and some of the large private sector banks, which probably has seen a significant drawdown. Probably we believe that the downside is not much from current level. And I think one of the key reasons why some of these banks have seen a drawdown is because of derating. So now the question which we have to ask is that whether the derating is done. To a large extent, we believe it is done. And if suppose the ROEs inches a little bit higher over next 2 quarters or so, if we see a minor re-rating happening over next 3-4 quarters, so the returns from those banks clearly can be much higher than probably the Nifty returns, which we believe. So it should be part of the portfolio. And as a barbell strategy, you can have some of the small banks as well as NBFC on the other side, which would be a high growth and a higher ROE. And at least in this current context, we don't expect any kind of a credit cycle which will have a significant impact on their earnings.
All right. What about the larger names? FMCG names, the big boys. Happy customer doesn't mean happy shareholder. I say this because, in HUL, for example, the stock is actually down 10%, while the market has moved up in the last 5 years. Also, if you look at its revenue number, 61,000 crores has moved to 65,000 crores, while the EBITDA number has almost been flat at 15,000 crores. And that's reflecting in the stock price. But in times of trouble, some of these boys do better because of their bandwidth, because of their reach, their distribution, and their clean balance sheet. Would you be taking a bit of a bet on this underperforming but well-managed companies?
So, Nigel, pretty interesting question. And if you just step back, some of these companies while the growth has been subpar, but the stock has seen a significant decline because of the massive derating which we have seen. So yes, the company which you mentioned have had their own set of challenges, but there within that segment of FMCG also, we definitely look into opportunities. So in fact, while the company you mentioned have not seen growth, but at the same time, the largest listed foods company, so to say, has delivered phenomenal growth. In fact, the four segments in which they are, they double-digit volume growth in all the four segments, and very strong data growth. So there are opportunities there, and here what we believe in segments which is showing growth, which is adapting to the new reality, because the company which I mentioned on the food side has also been very aggressive in pushing their business through the quick commerce and through other channels of distribution, and I've been constantly innovating, at the same time working on the cost side. So a dynamic company definitely within that segment also warrants a look into it. So while at an aggregate level still the valuations are higher, but some of the companies which are adapting to the new reality, we definitely are closely looking into that, and we do like some of those in that segment.
Okay, thank you. Rupen, out of time, but thank you very much for joining in. It's time now for a segment, D Street Chat, and Nimesh is joining in with an insight into dealing rooms. Nimesh, tough session today, but we've still managed to hold on to that 23,800 mark.
Yes, Nima, but again, there are fresh challenges as far as the macros are concerned. Rupee at 96.5, crude at almost at 99 now, and that's clearly having an impact on the sentiment as well. Clearly, there is a bit of pressure in the broader markets now, and that's the space which has done well, and we're seeing a big reaction. The mid-cap index is on 1%, but I guess today's fall in the mid-cap is also to do with some of the earnings which have been a bit of a disappointment. So big reactions to earnings continue, and that's been the talking point as far as this earning is concerned. Again, from a flow perspective, I'm not sure whether there is very large selling from larger FIs. So the institutional data could be interesting to watch out for. But from a flow perspective, at least for second day running, my sense is there is a bit of buying into the auto name. So despite crude higher, there is a bit of buying into auto names. So that's a bit of a surprise. But otherwise, it's been a mix in terms of flows from large institutions. Upside is generally been talked about. There is a bit of cap on the upside at around 24,300, 24,400. So that's playing out on the upside. But now, again, the PCR has moved almost to 0.7. That's when probably from those levels you see a bit of a bounce back. So watch out for that. But I guess today's big underperformance in mid-cap is largely to do with disappointing earnings season.
Well, indeed, and the problem is also leadership. Nimesh, banks are the largest weight, and most of the banks have disappointed, barring an ICICI Bank. So the Nifty banking index is down 3.5% this week. Yeah. IT, maybe the bottom is capped, but on the upside as well, that rebound which we were seeing from the start of July has sort of petered out, flattened out. Pharma has come under fresh headwinds, and then there are earnings that we are reacting to. Reliance Industries has also been a drag. But what have you picked up? Because it's all about individual names. So tidbits about individual stocks?
So two stocks which will be focused in the very near term in anticipation because of the large blocks. So Paytm and Shadowfax both will be in focus because I'm expecting large block deals in both these names. In Paytm, there could be a clean out trade from Safe Partners. So that's been indicated for a while now that after the earnings season that block will come. So watch out for that. And even in Shadowfax, there is a private equity investor who is likely to sell out. So these two names will be in focus on the back of large blocks. So that's something to track there. The second name is Poonawalla FinCorp. Again, that's been will be in focus. The stock has been consolidating post earnings, but even there, the street is anticipating a small block. The non-promoter entity is a seller there, so at least the promoters are not selling out, but there could be a block in Poonawalla as well. The third name is Oriental Hotels. Now, this is going to be interesting. The stock is under pressure for the last couple of days, largely in line with the mid-cap underperformance. But watch out for a corporate development post the Q1 earnings in Oriental Hotels. Interestingly, Indian Hotels own 28%, so watch out for a corporate development there. And the last is Bandhan Bank. For second day running, that's under pressure. 17% fall yesterday, another 4-5% fall. And I guess a lot of institutional investors are selling out in this particular name. At least one large AIF seems to be an aggressive seller for the second day running in Bandhan Bank.
Thank you. The star for the markets, or at least some relative safety, is seen in auto names. So after TVS and Bajaj Auto came out with good set of numbers, there has been buying visible. So Bajaj Auto is up 8% so far this week. TVS Motors is up 8.5%. So these two names are driving the gains. Hero MotoCorp has moved up. Numbers are not out for Hero MotoCorp, but generally two-wheelers are doing well. So that's up 3.5%. Eicher Motors is seeing some buying this week, and M&M too, 1.8%. So money is rotating into these auto ancillary names. Thank you, Nimesh, for that. We will get into a break on the other side. A few short-term trading ideas coming up for you. Welcome back. Cipla should be on your radar. The conference call, the PC, the press conference is currently underway, and I think the stock ahead of that should come up for you on your screen. Initially, there was a negative reaction in the stock price of Cipla. Once we saw those margin numbers, they were lower than street expectation, but from there has been a bit of a recovery. Stock is still down close to about 2%. The company's revenue growth came in at 2.3% quarter on quarter. Year-on-year, 2.3%, quarter on quarter, up 6.4%. The US revenues came in below estimates, even as India continues to see a double-digit growth. Margins have seen severe contraction. So margins at 16.7% compare with 25.6% on a year-on-year basis. So that is some of the reasons why the performance has been on the weaker side, and the problem has been North America, which has declined 21%. The press conference is underway, and we'll get to Ekta in just moments from now to cover it. One stock you should watch today is Infosys, because it comes out with numbers post-market hours. And Infi ahead of that is down close to about 0.6%. So remember, for Infosys, it's the last of the large cap IT companies. So qualitatively, we pretty much know it's not been such a bad quarter, as bad as what the street had feared. Expectations were anyway low. Wipro missed the mark, but a TCS and HCL Tech largely met. And Tech Mahindra was the standout performer, and that's been on a turnaround path under Mohit Joshi. But Infi is the only company which gives you a yearly guidance, an annual guidance, so which is why Infosys may be the last company to come out with their numbers. It will be tracked very closely. The guidance for Infosys currently stands at 1.5 to 3.5%. But this is the organic growth guidance. The company has made certain acquisitions, Stratus, Optimum. So once that's baked in, the guidance could be raised. But according to analysts, if you strip out the anticipated benefits on account of the acquisition, maybe the organic guidance could be trimmed at the upper end. So Infi numbers will be tracked very closely. The stock is down 35% year to date, but this month itself is up nearly 4.5%. And generally this morning, IT is seeing some buying. So we spoke about Tanla, there's Root Mobile, but even in L&T Tech Services, for instance, is up close to about 1.5%. And Emphasis is another one you should watch because of numbers. So typically tomorrow morning, it should be out.
Okay, all right. Let's get in Mitesh Thakkar to give us a couple of fresh ideas. Mitesh?
I think I'm just going with the assumption that 23,800 might hold. So taking a buy position or BTST on HAL, that's near the base, right? So take a stop at about 45.80, look for a 46.20, 25 kind of a target. And the other one is BTST on Hero MotoCorp. Sorry, Hero MotoCorp is a BTST with a stop at about 51.16 or just below it, and a target of around 5,200.
Got it. Okay. All right. Just keep an eye out from the broader markets. There is OFSS. The stock actually has seen a bit of a spike from the day's low. So they're clarifying on the exchanges that, I think, we get that stock up. In fact, let's focus on the bottom of your screen. Cipla is addressing a call. Ekta's on that call. Let's hop across.
Both this time round, as well as your overall quarter. Just wanted to take forward that point with regards to tariffs. While you did say that it is a situation where you'll need to assess it, many of the industry people have said that it might just be an impractical move to sort of shift manufacturing. What is your sense in terms of what could be the developments in the next couple of months to maybe the next 2 years?
So Ekta, I think Manufacturing is an involved process. So to move anything is a process which takes a few years between the time you set up manufacturing, qualify everything, take batches, file, get approved. We have been on this journey on multiple dosage forms in the US itself. So currently we manufacture not just solid orals, but we're manufacturing MDIs, and we are putting up new lines as we speak. And we're also manufacturing DPIs in the US. So we've been on this journey, but that was more with a view to diversify our manufacturing base around the world and in key markets. If tariffs are driving that decision, it will definitely need time. And I think that's why we said we will need to study how this evolves and what are the details that emerge in terms of what's the expectation and how can we work closely with the administration's preferences to manufacture more products locally. But we have experience in doing that. So I think whichever way it moves, we will be able to adapt.
Okay. Do you think this is a time where companies such as yours, as well as the other companies, the larger companies which do have a large exposure to the US, might look to start diversifying their operations more significantly to other geographies to reduce the risk?
See, right now, if we look at it, this quarter, more than 45% of our business came from India itself. Then we have large South Africa, we have EMEU. So I think this question of how do we service maximum number of markets and patients around the world is more or less independent of the need to de-risk from US perspective, because wherever these opportunities lie, once you have invested in product development, manufacturing, commercialization, you would want to offer it in as many places as possible. So I don't think there's much contradiction there. But having said that, US remains and most likely will be the largest pharma market. So it's imperative for large player to have a strong play in the US as well.
Are you guiding for when it comes to North America, considering lanreotide as well as base business pressure, along with your margins for FY27?
So we're keeping the same guidance as before from a full year perspective. We're guided to 18.5% to 20% on EBITDA margin. US, you see a small improvement sequentially between what we reported Q4 and Q1. And we're expecting build up through the coming quarters as we get these big product approvals and as we're able to ramp up the supplies on each of these products. So we are, I think, looking forward to a significant movement in the coming quarters.
Okay. All right, Mr. Gupta. Thanks very much.
Thank you. Right. Well, Ekta's quizzing the Cipla management stock actually saw a bit of a recovery in today, and now it's given back most of that as well that it put on. So the stock has moved back down close to around 2%. Tell you what, slip into a short break, come back, wind down the markets for you. We'll also focus on a couple of stocks. Stay tuned.
Welcome back. Markets are defending 23,800. That will provide some comfort to the bulls. So in the last 15 minutes or so, starting 3 o'clock, the markets have rebounded from lows of 23,800 to 23,870. It's still down 130 points, extending the decline for the fourth straight day in a row. Sudeep Bandyopadhyay now joins in. 10 minutes to go before we wrap up trade. Sudeep, a flood of earnings today. Do you want to tell us your pick of the pack?
Well, I think, amongst all the earnings I've seen for the last few days, Ultratech was outstanding, much, much beyond the expectations and at such a volume. So that was outstanding. Amongst yesterday's earnings, I did like indices, though I think the market didn't appreciate and the stock is down. But indices earnings were quite impressive. The commentary wasn't that bullish, and I think market punished the stock because of that. Also, a little bit of concern on the growth in S&P and retail book probably perturbed the market. The growth was predominant in the corporate book, but that's a general trend across all banks. So I don't see much reason to be perturbed. It is a turnaround case, and I'm positive on IndusInd Bank. Some of the other earnings for the smaller companies were also quite interesting. But I must also point out TVS as well as Bajaj Auto. I think these both two-wheeler companies' numbers were and the results were very, very good.
All right. Got that. Hold that thought, Sudeep. By the way, keep an eye out on the broader markets. I'm not sure whether Sudeep tracks this name, Diamond Pass. The stock was higher, it went lower. And then, in fact, it spiked up. Now it's up closer to around 2%. Stovecraft as well is cutting its losses. The stock was down, I think, 4%. Now it's cutting its losses as we speak. And Sarada Energy is another stock that's perked up a wee bit in the last few minutes. But let's focus on another story. Now, sources say that the Adani Group is making a bit of a pitch to get into the aviation sector. Yash joins us with more details. Yash?
Well, this is something which can be termed as the group expressing its interest when it comes to entering the civil aviation space or the commercial airline market. What we've been given to understand from our sources is that the Adani Group has written a letter to the Airports Authority of India, or AAI, seeking a review of the regulations, the current regulations which restrict the entry of airport operators into the business of civil aviation or commercial airlines. What we've been given to understand is that this letter from the Adani Group was written to the Airports Authority of India in the first week of June itself, and also what it has expressed a desire to do is to explore a model under which the Airports Authority of India could also have a certain amount of equity when it comes to the airline business and the balance part of the equity with the Adani Group. If a model on those lines could be explored, as far as our sources are concerned, they tell us that Adani Group, is looking, if of course things go well, a review is done, relaxation is made in favor, then the group is looking to put this, the aviation business under the defense vertical and not the vertical which has the airports operating business under itself. The present rules, of course, bar airport operators from running airlines, and a review of that very regulation has been sought by the group. We've written to the group, but a response from them remains awaited at this point of time.
Okay, thank you very much for that interesting story so far. Interglobe Aviation has been the dominant player with, it's been the market leader without any competition, but now Adani too perhaps is looking to get into the fray. What does this mean for Interglobe Aviation and even for Adani Enterprises, which will, hold the airline business? We will get into a break. We'll come back with more on the market. Stay tuned.
Welcome back. Well, Sudeep, I wanted your view on this name, Bluestone Jewelry. Stock is up 35% in this week. It was gap up today as well. Now it's come off the top. The blue has turned into a little bit of red as we speak, but a big gainer this week. One of those result reactions. Your take?
Oh, absolutely, Nigel. I think if you look at this entire space, the affordable jewelry segment has been growing, and the big jewelers as well are banking on that. So if you look at Titan, I think the Mia and CaratLane are the fastest growing segments. If you look at Kalyan, we all are talking about how Candere performs going forward. That will determine Kalyan's growth. So naturally, Bluestone is operating in the same space. And it's more of a lifestyle rather than a wedding kind of a brand. So the growth expectation and the growth, the way they are capturing growth is quite commendable. And I'm positive on this entire segment, as probably you are already aware. And I also like Bluestone. I think the potential for growth through store expansion is significant. And I think that's exactly what they are focusing on. The management commentary post the results talked about that as well.
Okay, that's Bluestone for you. You said Bajaj Auto, you like the numbers of Bajaj, TVS Motors. Now, you've been liking these stocks. It's not the first time, and the company's been doing well. Bajaj Auto's export momentum sustaining the 2.5 lakh units month after month. But can you buy at this juncture? Because stock is already at a fresh 52-week high, and it's done well, 20% up already this year and 35% in the last 1 year.
You are absolutely right. I think that's one concern which everybody has. Between the two, TVS, I will probably avoid at this juncture because of the valuation. Bajaj, I will still stick my neck out and say it's worth buying even at current level. See, the Bajaj crossed, 51% plus income is coming from export market. The way the currency is behaving, I think there's a tailwind as far as the margin on foreign exports is concerned. It will be there. KTM, full-blown KTM performance will come in the near future. Integration is complete. So there are multiple growth drivers as far as Bajaj Auto is concerned. And somebody with 1 year kind of time horizon can buy Bajaj Auto even at current level.
Okay, out of time. So quickly, buy the 20% dip in 2 days seen in Bandhan Bank, or it's an avoid?
Well, I think I will avoid. I've been cautious in Bandhan Bank for quite some time. I'll avoid it.
Sudeep, thank you for joining in. Just winding down today's trading session. It's going to end in the red, 125 points lower, but the Nifty has defended that 23,800 mark and even protected the 50-day moving average. Mid-cap index down 1% versus the Nifty small and Sensex ending lower by 0.5%. Negative advance decline ratio. Big losers today, Adani Enterprises 4.2, Nestle 3.5, Shriram Finance, Grasim, Adani Ports, Interglobe Aviation, JSW Steel, Cipla post numbers, and Reliance Industries. And on the way up, SBI Life was the big star. Bajaj Auto continues to see buying. In fact, the entire auto basket and complex was supportive today. So whether it's M&M or Eicher Motors, and some IT names like TCS, HCL Tech in the green, though Infi ended in the red. We're going to take your leave and closing bell. Thank you very much for watching. Don't go anywhere. On the other side is Markets Forward.
Markets end lower for the fourth straight session. The Nifty manages to hold above the 23,800 mark. Financials remain under pressure, and a weaker rupee and a rise in bond yields also weigh on sentiments.
Sharp fall in US revenues hurt Cipla as it misses street estimates. India business sees double-digit growth while API segment contracts.
Oracle Corp may be looking to sell part of its over 72% stake in its Indian listed arm to raise funds. Sources are telling CNBC TV 18, and the move comes after the company's recent ratings downgrade. Oracle in its response says that it does not want to comment on market speculation. You're with us here on Markets Forward, your go-to show where we aim to get you all the key data points to gear up for the next trading day. I'm Hormuz Patakia. With me is Ekta Batra. Ekta, good afternoon. Well, at one point at 3 o'clock, it almost felt like we'll break below that 23,800 mark, but the bulls have managed to defend that level. Well, another fourth straight day of losses though, but yet again, it's this familiar trend of slowly but surely grinding lower, even as Brent is now nearing $99 a barrel.
Yes, absolutely, Hormuz. You know, fourth straight day that we've fallen. We've had the bank nifty, which has come undone along with the private banks as well as the PSU banking space. And not to mention that the mid-cap index, which had been quite resilient, came undone today as well. So the mid-cap index on a week-to-date basis is now down around 1% and the nifty, which is down close to around 2% on a week-to-date basis at current reckonings. So let's see what tomorrow holds. As of now, for Thursday, the Nifty ended below 23,900. But let's tell you what we have in store for you. We'll start with our movers and shakers of the day with Vivek Iyer and we'll move from Cipla to Oracle Financial Services. We'll get you detailed reports of the top stocks in trade. Last but not least, we'll delve into the key market events to watch out for tomorrow's trading session. Well, on to our first segment of the day. Vivek joins in from the big wall with the top movers and shakers.
Well, thank you so much for that. Another session, like you mentioned, where you actually saw weakness emerge, especially as far as the second half of the trading session was concerned. And again, advance decline ratio in the second half deteriorated quite rapidly. In terms of individual movers, well, individual stocks reacted very sharply to earnings, hits and misses. Gandhar Oil, that particular stock, very strong results, both on a sequential on a year-on-year basis. Stock ended at one point of time was at the upper circuit. Tanla Platforms, again, very strong set of numbers. The enterprise business jumped up almost 18% on a year-on-year basis, higher by 10%, cooled off a little bit, but very good volumes on this particular name as well. NTPC Green, after a while, you did see very strong capacity addition come about in this particular name, and that aided the growth in Q1. That particular stock, one of the top gainers on the NSE 500 index. And HEG, we also had the management today spoke about rising prices in H2. That stock ended higher by over 4%, but quite a few accidents as well. Dr. Reddy, one of them, earnings were quite a bit of a miss. The stock reacted quite sharply at open, but recovered quite smartly. Data patterns saw a bit of profit booking. IndusInd Bank management has guided for muted NIMs in H2. In Q2, CIE Automotive, that particular stock was another accident. A sudden resignation coming in, from one of the verticals. And lastly, SRF, the numbers came during market hours yesterday. Today, the management held a conference call. Very muted commentary coming about as far as the rest of FY27 is concerned. Stock ended lower by over 8% today.
Okay, all right, Vivek. Thanks very much for that. Well, that is on all of the buzzing stocks, and Cipla was in focus. It was under pressure after the drug maker missed its first quarter estimates. So we had revenue, which was just about higher by around 2.3% as compared to a 6% growth that was estimated. Margins came in at 16.7%. Remember, FY27, the company is guiding for around 18 to 20% in terms of margins. Profit at 789 crores, which was a decline on a year-on-year basis of around 39%. North America was the key culprit this time because that was sharply lower because they do have some supply disruptions with regards to one of their key drugs, lanreotide. But India managed to hold up quite well this time. So India was India was higher by around 12% this quarter. And we also had emerging markets as well as Europe, which was up around 16%. So overall, those particular geographies did manage to do well, but there was pressure which came in from US as well as the API segment this time round for Cipla. Well, to take this discussion forward, we have with us Sudeep Bandyopadhyay from IndiTrade Capital and Richard Jain from Motilal Oswal Financial Services. Gentlemen, thank you very much for joining in and speaking with us. Well, Sudeep, your thoughts on Cipla?
Well, I think North America revenue miss was the reason for this kind of profit coming down sharply down, and of course, market didn't like it. Also, there is this overall uncertainty regarding what's going to happen as far as the tariffs are concerned. Though I think it's not a very practical thing with Mr. Trump and the US administration is suggesting, and it's not something which is implementable, considering that Mr. Trump will be almost ending his term by the time that 2-year time limit goes out. And, not sure how that will get impacted, but sentimental impact, of course, is there. As far as Cipla specifically is concerned, I think things should start looking up once their supply issues in North America is resolved.
It's a very choppy ride for Cipla after its results announcement. But Ruchit, well, yet another day when the index has managed to hold on to 23,800. But the problem is that even though the Nifty is still at the lower end of the range, the Nifty Bank has broken down from its range. The 1,000-point range that it found itself in, from that 57,500, 58,500 range that it was, is now well below that mark. In fact, it is now well below 56, 57,000 as well. So is the Nifty Bank now the weaker among the two? What are the levels that you're watching on both of these indices?
Yeah, hi, very good afternoon. Well, the problem, if you see the market breadth, if you see on both mid caps and the small caps, definitely that gives a more better or clearer picture. Where we witnessed a consolidation of about 2 to 3 weeks on both the Nifty as well as the mid cap and the small cap indices. But last couple of trading sessions, the overall market breadth has been almost 1:2 or even more than that in favor of the declines. So this clearly indicates that the selling pressure is likely to continue. For Nifty, 23,800 is the immediate support. We almost tested that level today. But I think with such kind of market breadth, there are quite high chances that we'll break that support and will move lower towards 23,600 in the near term. Similarly, for Bank Nifty Index also, we have witnessed a selling pressure in private sector heavyweights, which has led to this underperformance. 56,000 is the key support for the near term. So 23,800 for Nifty and 56,000 for Bank Nifty. These are the immediate levels maybe for tomorrow's trading sessions. But until we see any improvement in the overall market breadth, I think it's time to stay a bit cautious only.
Okay, time to stay a bit cautious. Sudeep, what's your sense in terms of how you would approach the Nifty now, given the uncertainties seem to be rising? We have Brent crude, which is touching $100 per barrel. Rupee weakness is creeping up again.
Well, I think it's best to be extremely cautious as far as Nifty is concerned. There are too much of uncertainty as far as the geopolitics is concerned, and it's absolutely unpredictable how situations will evolve from here on. Everybody is expecting, somewhere the hostilities will be over, and the tweets which keep coming from the President of the United States doesn't help always. So let's keep fingers crossed and let's hope that things improve. But as far as trading is concerned, trading in Nifty is going to be extremely risky. It's better to concentrate on stocks and look at the performance, whatever we are getting as far as Q1 results are concerned, and the prospects and the management commentary, and go stock specific rather than index.
Stock specific rather than index. You talk about one of such names, Oracle Financial, had a very topsy-turvy day today. Opened higher, then fell to the lows of the day, then recovered as well, ending almost at the flat line. And that is after news that the parent company may be looking to sell stake in the Indian entity. Vivek is joining in with more details on the news break. Vivek.
Well, that's right. Earlier today we told our viewers, this is a CNBC TV 18 exclusive, where we informed our viewers that Oracle Corporation, that owns over 72% stake in the Indian listed OFSS India, which declared its results yesterday. We understand from our sources that Oracle Corporation may be looking to go ahead and sell part of its stake that they hold in OFSS India. Also, we understand that the size of this particular deal, the price at which this particular deal will be done, and the timing of the deal will all be decided after they go ahead and see the kind of interest that this particular block, or you could call this stake, is actually getting interest from all of the institutional investors as well as other investors. So the size, will be decided once the investor interest is gauged. Now remember, with the 72.4% stake, there is enough headroom for Oracle Corporation to go and sell the stake, without diluting the control that they have over the company. Now, one reason that we understand from our sources that could be the reason for the likely stake sale is the fact that S&P Global, the rating agency, had gone ahead and downgraded Oracle Corp, the US-listed entity's credit rating, to just one notch above junk rating. And this was on account of the fact that they believe that the large AI spend, hyperscaler spend, is something that is taking quite a bit of cash flow. And the company at this point of time is actually having trouble going ahead and servicing its debt obligations. Now, remember, important clarification even from our end. We wrote yesterday to both OFSS India as well as Oracle Corporation. We worked to the media relations team of both of these entities. We have not received a response from them directly, but Oracle OFSS today put out a clarification that the exchanges are very close to market hours. They said that at this point of time, we are unaware of any such development and that they don't really respond to any sort of media speculation. But an important development nevertheless, and it'll be interesting to see if and when this particular deal does fructify.
Okay, absolutely. Well, Sudeep, possible OFSS is what we we could see for Oracle and some amount of movement there. How would you approach the stock at these levels?
Well, the stock has done very well as far as the Indian listed entity is concerned. And one has to remember that this is essentially a products company, not a services company. So the challenge as far as the AI onslaught is concerned is on the IT services company, whereas Oracle Financial, the listed entity in India, is predominantly a products company. So their business has been doing good, and their performance quarter on quarter has been outstanding. So as far as the Indian company is concerned, there is absolutely no challenge. Of course, the parent company's problems may compel it to go for some kind of stake sale, and that we'll have to see how things pan out. But at this stage, Oracle Financial Services per se is a good company and it's worth holding on to if somebody is already invested. Fresh position taking, I won't recommend, considering the volatility and considering the news which I'm hearing.
Ruchit, on the charts, Oracle Financial, the only Nifty IT name that is trading positive on a year-to-date basis. Of course, it's not a stock that we talk about more from a trading parlance, but what are the levels that you're seeing on the charts for OFSS?
I think major support for the stock is coming around 9,500, where the recent swing lows are there. Overall structure seems positive only, but the only problem is that the stock has already seen a good run up in last 3 months. From that low of around 6,500, we have already seen the stock testing 12,000 mark. So rather than chasing the stock, it's buy on dip stock that should be kept. Any decline towards 9,500, 9,000 would offer a good risk reward ratio.
Okay. Well, Sudeep, we do have Infosys, which will be reacting to its numbers tomorrow. What is your sense in terms of the entire IT space? How would you approach it at this point in time, and even a stock such as Infosys?
Well, Ekta, I've been extremely cautious of this entire IT space, and I maintain my cautious view. Of course, there are outliers. Tech Mahindra numbers were excellent. HCL Tech have shown signs that it is kind of trying to adopt to the new AI world, and they probably will move ahead of the others. That's our reading. But as far as this AI onslaught is concerned, every other company, including TCS, Infosys, and pretty much the entire mid-cap IT universe, I think the next 1.5 years is going to be a period of extreme volatility. Their margins will be under pressure. The revenues will be under pressure. Eventually, things will settle down. But at this stage, volatility will be too much. As far as Infi specifically is concerned, we would love to hear what the commentary they give, because this is one company which gives a 1-year forward estimate. So it will be extremely interesting to hear what they talk about the 1-year estimate and 1-year numbers.
Right. Since we're on the subject of results, let's take stock of all of those numbers that came in through the day. Upasana is joining in with the earnings wrap, some good ones, some not so good ones. Upasana.
Well, first up, let me start with PVR Inox. Overall, it was a good set reported by the company. The company reported net profit of 56 crores versus the loss of nearly 54 crores same time last year. Revenue has seen also a sharp uptick of 12% on year-on-year basis, better than estimates, and margins also saw a steep improvement from 27.8% to 32.5%. Mind you, management joined us and management has guided to CNBC TV 18 that the non-movie content will contribute nearly 3% of the sales this year versus 1.5% seen last year. Now coming to other results, Chennai Petro, another weak set of numbers reported by the company. It was operationally a weak set of numbers. Revenue while was boosted by the sharp drop in the excise duty. Now, revenue has seen an uptick of 63% sequentially. Net profit saw a downtick of nearly 27%. Margins also took a sharp hit, down from 12% to 5.7% sequentially. Ujjivan Small Finance Bank, overall, it's been a strong quarter for the company. It was a beat across the board. Asset quality also improved, NIM continue to stay stable. Now, talking about the company's NII, it reported a growth of 39%. Net profit also saw a sharp surge from 100 crores to 316 crores. And GNPA also saw an improvement from 2.2% to 2.16% sequentially. Now, lastly, coming to Mahindra Lifespace, net profit saw an uptick of 5%, revenue saw a growth of nearly 44%, and it was certainly a turnaround quarter for the company in terms of its EBITDA. EBITDA stood at 94 crore versus the EBITDA loss reported by the company last year, which stood around 44 crores. Now, company has said that the pipeline in Q2 remains quite strong, giving a good growth visibility for the company for the upcoming quarters. So overall, these were the stocks on our radar today on the back of its earnings.
Okay, all right. Well, Sudeep, just wanted to narrow down on one particular counter, which was PVR Inox. Good quarter this time. They are confident in terms of the content pipeline for FY27 as well. Would you be a buyer into a stock such as PVR Inox?
Well, not really, Ekta. I think the challenges which the business faces are real. At this stage, I think recently the content has been good and there has been good footfall. But going forward, there are a lot of uncertainties and question marks. Some blockbusters are lined up, but not sure about the performance of those. So it is a bit speculative if you want to take a bet on the success of those blockbusters and the power of them to bring in footfalls at PVR. So I think I will, at this kind of valuation, not recommend a buy in PVR.
You a contributor to the challenges as well by not turning up to the multiplexes to watch films?
No, I do go, Hormuz, I do go once in a while, but the movie has to be good enough to go.
That was PVR Inox. But Ruchit, the one stock that was possibly the accident of the day, where everybody was expecting Dr. Reddy's to be that one, but it turned out to be SRF. And with the kind of breakdown that you have seen today, what are the levels that you're watching out for now on the downside?
It was not only just the price breakdown, but the volumes as well. What volumes we see on a daily basis, today's volume were much higher than the daily average. And whenever we see such volume-based selling in any stock, especially post events like results, they can tend to underperform for maybe next 1 to 3 months till next quarterly results. So I think the stock has closed below all its important 50 and 200 DMA. Major support for the stock will come around its previous swing lows, which are around 2400, 2350 zone.
Sudeep, what about you on SRF? The commentary from the management did not paint a very inspiring picture. I was just looking at the valuations as well. Still expensive in comparison to PI Industries. Between the two, if you have to make a choice?
Oh, well, definitely I'll go to PI. In fact, if I have to also look at broaden the universe, I will probably look at UPL as well. I'm not saying SRF there's any fundamental problem, but the logistics challenges because of the West Asia war, as well as the supply constraints because of the war, is definitely going to impact SRF's performance in Q2 and probably Q3 as well. That's pretty much what they were alluding to in their management call.
Okay, all right. So SRF, in fact, was steeply lower. Well, Sudeep, the other sector which really stood out this week, which started off quite steadily and has been quite resilient, but has come undone, is the entire banking space. The bank Nifty was down 1% today. We have private banks which have been under, exaggerated pressure as compared to the PSU banks. What is your call in terms of how you would approach a couple of the private banks versus PSU banks, and what is the portfolio mix now?
Well, I do like HDFC Bank, and HDFC Bank is the bank which led to the pressure particularly in the private sector banks universe. The results market didn't like much. Also, the uncertainty regarding the CEO MD appointment created some confusion, and the stock is down significantly, probably at a 52-week kind of a low level. But I think at this level, the stock is definitely looking attractive, and the downside is limited from here. Upside is significant, and it's there. So if I have to buy one private sector bank, I will go and buy HDFC Bank, not because of performance. Performance-wise, ICICI was much better, but because of the fact that the stock has corrected significantly and the upside potential from here on is there. As far as PSU banking pack is concerned, I think generally the performance was in line with expectations, and we can look at SBI from a not a very aggressive investor's point of view, and some of the smaller banks, smaller PSU banks from an aggressive investor's point of view. Fundamentally, because the market is correcting and the oil prices are going up, I think banking sector also seeing some selling pressure. But there is no structural problem as far as banks are concerned. That's what we believe.
Well, Sudeep, Ruchit, thank you for spending time and joining us on the show today. Take a short break, back with more on the other side, the top corporate voices and the key events to watch as well.
Welcome back. You're still tuned into Markets Forward. Well, some of the big corporate voices of the day, the MD and CEO of IndusInd Bank, Rajiv Anand, told CNBC TV18 that the bank sees the current quarter as an important inflection point. He said that sequential growth has been led by corporate business, while retail growth is expected to take longer to fully recover. The bank also plans to step up branch expansion going forward.
The CSB Bank expects margins to remain within its guided range. Despite some sequential pressure, the management said year-on-year the NIMs trend remains strong. Despite a sequential dip, the lender is planning to increase the share of gold loans to around 30% of its portfolio by 2030 and is actively growing its FCNR deposits.
UCO Bank plans to raise $500 million through FCNRB deposits and overseas foreign currency borrowing. Speaking to CNBC TV18, the management said it sees no significant impact of the exercise on the cost of funds. Meanwhile, the lender has retained its net interest margin guidance of 2.8 to 2.9% and is targeting an outcome better than the guided range.
And before we call time on the show, tomorrow being Friday, there is a lot that you need to keep your eyes on, and Upasana is here to tell you just that. Upasana.
Well, it looks like a result-heavy day tomorrow as well. Now, first up, let us look at some of the important results. ACC, Bank of Baroda, Bank of India, CG Power, Hindustan Zinc, NTPC, Shriram Finance, Tata Consumer Products, all these counters will be reporting their Q1 FY27 numbers tomorrow. Now, on the terms of corporate action, Jupiter Lifeline Hospital tomorrow marks as the record date for the stock split from ₹10 to ₹2 per share. Now, on the IPO front, Cube Highway Trust closes for subscription, while Caliber Mining and Logistics listing is scheduled for tomorrow. Now, let us have a look at some of the important global cues. Now, coming to UK and US, S&P
Global manufacturing services and composite PMI data for the month of July will be out tomorrow. And now coming to US, the most important new home sales data will also be out. And mind you that the Trump's 10% global tariffs are set to expire tomorrow. So we'll keep an eye out on that as well. Now coming to Europe, Eurozone manufacturing and services PMI data, that is also that we'll be keeping an eye out on. Now coming on the domestic cues, that is back home, there are several other parameters that we'll be keeping an eye out on, such as S&P Global Services PMI data for the month of July, bank loan and deposit growth data, and even foreign exchange reserves data. So looks like quite an eventful day tomorrow.
An eventful day indeed. Upasana, thank you for putting that together for us. With that, we call time on this edition of A Markets Forward from Ekta and me. Thank you for watching. More news and updates continue on the other side.
Good evening. Thanks very much for joining us on Business 360. I'm Shireen Bhan. The top stories we're tracking for you this evening. The US bombs Iran for the 12th straight day. Iran's army and Yemen's Houthi militants claim attacks on oil tankers. Brent crude prices surge, hitting $98 a barrel. Shipping traffic at the Strait of Hormuz remains subdued. The Sensex and the Nifty decline for the fourth straight day. Financial stocks lead the fall. Mid-caps suffer sharper cuts. The rupee remains flat but above the 96 mark against the dollar. Adani Group writes to Airports Authority of India seeking relaxation of rules to operate an airline. Sources say Adani Group is also willing to explore a joint venture. Airports Authority is yet to respond. That's an exclusive. The
Paychecks are shrinking across IT companies and banks. A CNBC TV 18 analysis shows wage growth has nearly halved in the last 2 years across top 500 listed companies. Lenders like Piramal and LIC Housing Finance flagged stress linked to the IT sector borrowers. India and 59 other economies stare at a new 12.5% tariff as US President Trump's 10% tariff expires tomorrow. The White House is seeking refuge under a law that allows the president to initiate a probe into any country's policy and impose tariffs as deemed fit. The US Trade Representative Jameson Greer tells CNBC to expect tariff action soon. Indigo reports a loss of 238 crore rupees in Q1 as fuel expenses nearly doubled to almost 11,000 crore rupees. Operational performance remains strong with revenues rising 20%. A sharp fall in US revenues hurt Cipla as it misses estimates in Q1. India business sees double-digit growth while API segment contracts by 28%. Shares of Google's parent Alphabet and Tesla declined despite reporting strong quarterly growth. The proposed increase in AI spending spooks Wall Street. Both companies report negative free cash flow in the second quarter. Student protests continue at Delhi's Jantar Mantar and other parts of India. Prime Minister Modi promises fast-track courts to punish those behind the NEET paper leaks, but protesters demand the resignation of Education Minister Dharmendra Pradhan. Parliament remains paralysed. Eternal's quick commerce firm Blinkit is now as big as its rivals Zepto and Swiggy Instamart combined. Blinkit's order volume in FY26 crosses 916 million. This is as much as the orders received by both Zepto and Instamart combined. But straight to the top story this evening. The US bombed Iran for the 12th consecutive day as the conflict continues to intensify. Let's bring you up to speed on the latest developments. Now, the US military claims to have struck Iranian military and coastal surveillance sites and air defense assets. US forces also claim to have redirected 9 vessels and disabled 1 ship from entering or leaving Iranian ports. Over 50,000 US service personnel are currently deployed in the region. In response, Iran targeted US bases in Jordan. According to Iranian Revolutionary Guards, the attacks destroyed the radar of an American THAAD missile defense system and also hit a Patriot system. According to state media, the Jordanian army intercepted 4 missiles and 6 drones from Iran in the last 24 hours. Separately, in a social media post, Iran's Foreign Minister Aragchi said, and I quote, "Our defense doctrine is clear, eye for an eye. Any aggression against Iran, including our infrastructure, will compel a powerful response. Those who contribute to such aggression will be also considered legitimate targets," end of quote. And in the Red Sea, Yemeni militant group Houthis attacked 2 Saudi oil tankers, claiming the vessels violated a naval blockade imposed by them. The attacks involved the use of several ballistic and cruise missiles. However, the extent of damage and casualties, if any, have not been confirmed yet. All of this is impacting the oil market, where Brent crude prices have surged to $98 a barrel. According to an AFP report, the IRGC has stopped 3 oil tankers from transiting through the Strait of Hormuz. According to ship tracker Kepler, traffic in the Strait of Hormuz is now down 31% as of yesterday. The negotiations between the US and Iran have not yielded a breakthrough since the fallout of the MOU. U.S. Secretary of State Marco Rubio claimed that Iran is begging for a deal every day. Speaking on the sidelines of the ASEAN summit in Philippines, Rubio also referenced Iran's foreign minister's post and said that Washington's policy is, and I quote, "a head for an eye."
Iran is begging us, okay, both directly and indirectly. Let's do a deal. Let's talk. Let's talk. Iran is begging every day. The problem with Iran is every time they make a deal, the people that are in charge there, they either break it or they want to change it. So it looks like they're not ready to make a deal. You know, guys, I saw Arachi, their foreign minister, who the other day say or something about their policies, an eye for an eye. The president's policy is a head for an eye. I mean, honestly, that's what it's going to be. I mean, they will pay a very heavy price for the things they're doing. They're already paying a very heavy price. You guys don't know it because you don't cover it. You're not in Iran. You're not in the street. They don't have a free media. But they're going to continue to pay a very heavy price.
Well, that is Marco Rubio. As oil prices continue to soar, India's petroleum ministry says LPG under recoveries for oil marketing companies has crossed 50,000 crore rupees as of June this year. Responding to a question in Parliament, the petroleum ministry said even for customers not covered under the Ujjwala subsidy scheme, the under recovery stands at 500 rupees a cylinder. So where exactly are crude oil prices headed? Manisha standing by with the projections from top global brokerages almost nudging 100. Manisha, what's the consensus on the street on where crude prices could be headed?
Well, the crude is on a boil. It's trading at a 7-week highs. It has gained nearly 14% on week, 30% on a month. It's gained up by more than 40% from July lows, and it's trading 58% higher in this year till time. It's been a strong run-up. It's just about nudging $100 a barrel right now, and that's exactly what the crude outlook is from various brokerages and banks who are penciling in right now the worst-case scenarios and anticipating that, yes, crude prices can go higher from here as well. I'll start with Morgan Stanley, which says that 140 to 180 is a possibility in third or fourth quarter of this year if there is a total collapse of transit there. Then there is Goldman Sachs, which is also saying 120 is a possibility, and if there is a persistent multi-week blockage of damages in the Strait of Hormuz. So there are ifs and buts of a scenarios there, but nobody is ruling out much higher prices from here on. And then there is Morningstar suggesting 100 to 120 for the remainder of this year if Strait sees controlled crisis. You have Citi and then Bank of America also suggesting that 100 to 120 is their expectation as well if there is a partial disruption that just about continues and there are intermittent the stalls that markets really look at, and there is an escalation scenario continuing therein. What we are looking at right now is that the US-Iran war escalation for a 13th straight day, and that has been supportive for the crude oil prices. The Strait of Hormuz, as per reports, is effectively closed to standard transit, and then you have Iran-aligned Houthi rebels, which also have claimed striking two Saudi Arabian vessels therein at the Red Sea. It also has to do with the US threatening strikes on Iran bridges and power facilities plants every time there is a vessel that is attacked in Strait of Hormuz. So there is these threats coming in from both the countries, and actually what's happening on ground as well is keeping the crude oil prices higher, and markets do believe that the triple-digit $100 per barrel mark is just a very slim resistance at this point in time.
Manisha, many thanks. From the crude markets to the stock markets, the Wall Street declined for the fourth straight day today. The Nifty and the Sensex ending about 0.5% lower. The Nifty closing about 126 points lower. Mid-cap index down 1%, a 600-point cut there today. Nifty Auto, though, continued to buck the trend. And even today, despite the fact that we're actually seeing crude at almost 100, Nifty Auto up by about 200 points today. So that clearly is on the up and up. Well, let's bring you up to speed now with the big story that we are tracking, and that has to do with the Trump tariffs. US President Trump is rebuilding his tariff wall just months after the US Supreme Court called his so-called reciprocal tariffs illegal and scrapped them. He has imposed a 10% temporary tariff after that court ruling, and that 10% tariff expires on 24th of July. So what is the plan now? The White House is seeking refuge under Section 301 of the U.S. Trade Act. Under this law, the president can initiate a probe into any country and, based on the findings, impose tariffs as he deems fit. Prashant is standing by now to explain to us what this means for India. Prashant.
Shriram, absolutely. And I think once the tariffs, the 10% tariffs expire, which was imposed under Section 122. And remember, when the Section 122 was used, it was very clear that this is a temporary measure. I mean, they can only use it, and the tariffs are valid only for 150 days. And the 150 days come to an end on the 24th of July. So that is tomorrow night. And, you know, the 10% is universal. But after that, what is most likely going to happen is that for India, we perhaps go to 12.5%. So let me explain why. You know, most Asian countries are seeing as you said, Section 301 investigations which are going on. Now, Section 301 basically is used for broader country-level tariffs, and there are two investigations underway for India, as for most other Asian countries as well. One is forced labor, and the other one is excess capacity, excess and spare capacity. So, I mean, the US essentially is arguing for most of these countries, in the first case, which is forced labor, that the use of forced labor in many industries puts US labor, US businesses in terms of pricing power, etc., at a big disadvantage. And because of that, what they've done is, I mean, as part of the finding, what they've done is they've put countries under two brackets, 10% and 12.5%. So countries like Pakistan, Indonesia, etc., fall under 10%, and I think about 60 odd countries, and India included, fall under the 12.5% bracket. So in all likelihood, once this expires, unless we hear something explicitly coming in from the White House or the administration, the 10% goes to about 12.5%. But that's only part one, right? As I told you, there are two investigations underway. The first is forced labor. The other is excess capacity. And the excess capacity bit is still, I mean, that clock is still ticking. At some point, I mean, they're going to come back and say, well, here's the tariff on account, here's the a tariff on account of excess capacity which we're going to impose. And the way to think about that, and of course, at this point, this is a guess. We had remember when right before the Supreme Court struck down the IEEPA tariffs, which were the emergency tariffs on India and everybody else, right before that, India and US had come to a sort of an agreement, right? It was basically the broad outline of an agreement. Under that, the tariff agreed to was 18%. So, I mean, as I said, this is at this point a way to think about this, that you go from 10 to 12.5, but eventually, once the finding of the second investigation comes through, I think the expectation, I dare say, is that the US will find a way to calibrate the tariffs from 12.5 to about 18% or so, which was what had been agreed between both countries before the Supreme Court essentially struck down the IEEPA tariffs. And what the Supreme Court striking down IEEPA tariffs did basically was that it took away the basis for further negotiations. But as we've heard from many officials in the White House, I mean, the intention would be, and this is not just true for India, but most other countries, they'd like to get to tariffs under new sections, using new sections to what was agreed between US and each of these other countries out there. So, I mean, I think we don't have to wait very long. Tomorrow night, perhaps we'll hear, or we may not. But I think 12.5%, and perhaps in stage 2 at some point during this year, that number moves higher, unless, of course, we are able to strike a deal which is much more favorable, or something else happens. So, tariffs will stay here or slightly higher is what my understanding is. But because it is not exactly clear, it does, at the margin, raise some uncertainty for businesses which are exposed to the US and which sell into the US. Back to you.
All right, Prashant. Yes, that is a crucial date, July 24th. One set of tariffs set to expire, and we will have to wait to see whether another is notified. Earnings. Indigo has reported a loss of 238 crore rupees in Q1 as fuel expenses nearly doubled to almost 11,000 crore rupees. The operational performance, though, continues to be strong, with revenues up 20%. Madiha standing by with more on Indigo's numbers. Madiha, the impact of high crude prices clearly visible.
Clearly visible, Shireen, and the numbers year on year and quarter on quarter for Indigo look completely different. So it has posted a net loss of 238 crore for the first quarter, a sharp reversal from the 2,176 crore profit it posted in the same period last year. However, the loss is significantly lower than the 2,536 crore loss reported in the previous quarter, Q4 of FY26. The airline's top line remains strong, with revenue rising to a record 24,584 crore, up 14% year on year and 3.2% quarter on quarter, highlighting resilient passenger demand despite operational disruptions. So passengers kept flying. The biggest drag on earnings came from fuel costs, which surged to 10,832 crore, almost 86% higher than a year ago and over 63% higher than the previous quarter, which is Q4 of FY26. So fuel is the big culprit here. This reflects the impact of elevated ATF prices and geopolitical tensions during the quarter, which is April, May, June. The spike in fuel costs comes after crude oil prices surged during the Israel-Iran conflict in June, pushing up aviation turbine fuel prices. On the positive side, forex losses dropped sharply to just 82 crores compared with 4,822 crore in the previous quarter, removing a major pressure that had weighed heavily on Indigo's profitability in FY26. The management commentary will now be closely watched for the impact of the West Asia conflict, fuel costs, and the outlook they have for capacity growth in the coming quarters.
All right, Madhya, many thanks for joining us. And staying with aviation, only a day after reports emerged that the government had begun discussions on easing rules that could allow airport operators to own airlines, CNBC TV 18 has learned from sources that the Adani Group has written to the Airports Authority of India. They wrote that letter in June seeking a relaxation of the existing norms. Sources say the group expressed its intent to enter the airline business. Yash joins us now with more details. Yash, so far, the rules do not allow airport operators to get into the airline business either as owner at this point in time. What are you hearing? The Adanis have asked the government to tweak that?
Well, that's exactly, how it is. You said that the current rules do not allow airport operators to run airline business, own airline business. And that's the restriction which the Adani Group seeks to get a review for as far as from the government side is concerned. What we've been given to understand is that, indirectly expressing its desire to enter the civil aviation space or the airlines business, the Adani Group has written to the Airports Authority of India or AAI seeking a review of those restrictions which, bar airport operators to run airlines business. What we've been given to understand from our sources is that this particular letter or this piece of communication from the Adani Group was sent to the Airports Authority of India in the first week of June itself. There was, more to it. What we've been given to understand is that the Adani Group was even willing to explore a model where some part of the equity or stake in this airlines business could be given to the Airports Authority of India, and that business could be run in a joint venture between the Adani Group and the Airports Authority of India. Apart from that, what we've been given to understand is that Adani Group plans to put this, of course, this is provided that the regulations or the review of the regulations go in their favor. They plan to sort of put this business under the defense vertical and not the vertical under which the airports business currently runs, possibly to avoid any conflict of interest and have an arm's length as far as those two businesses are concerned. We've written to the Adani Group as far as this particular development is concerned. A response from the company still remains awaited.
All right. Many thanks for joining us, Yash. In fact, I spoke with Jeeta Thani in December of last year ahead of the Navi Mumbai Airport launch on the group's possible foray into the airline business. Here's what he told me. What part of this business are you currently not into that you want to get into? I mean, the big question is a foray into airlines the next big plan on the Adani Group's calendar?
No, absolutely not. No? We were legally not allowed
I know,
to.
but I know you're legally at this point in time not allowed.
Yeah.
But the government's been talking about, competition. The government's been talking about the need for a large airlines, especially in the light of what we've seen happen with Indigo. Absolutely. If tomorrow the opportunity were to arise, would you consider it?
I would say there's nothing that we won't consider. But as it stands today, structurally, the airline industry is not something that we see, fitting our sort of capital discipline. We're used to high margin businesses, investing in asset, and sweating that asset well. The airline is completely opposite in every. So
from a unit economics point of view, it doesn't make any sense for you. For us, for you at this point in time, or even in the future.
Yeah.
If the opportunity were to arise.
Yes.
So that's not something that you would consider.
Not at all.
Well, will the government change the rules is the question, and Adani is clearly having a change of heart, wanting to get into the airline business. We will head into a break, but up next, the paychecks are shrinking across IT companies and banks. The CNBC TV 18 analysis shows wage growth has nearly halved in the last 2 years across top 500 listed companies. Infosys numbers also out. We bring you all the Infosys earnings headlines right after this short break. We're back in a moment. Well, straight to earnings. Infosys out with its numbers. But before the numbers, the big story coming in there, the board has approved a new CEO to take over from Salil Parekh when his term ends in 2027. Ashish Kumar Dash, that is who the board has proposed and approved as the next CEO of Infosys. Let's go across to Rima now. She's standing by. Rima, of course, we'll take stock of the earnings. But this is a surprise. Salil still has till 2027, but Infosys clearly putting a succession plan well in place. Ashish Kumar Das, the Chief Executive Officer designate of the company until the 31st of March 2027.
Well, indeed, this is very, very big news coming out of Infosys. Salil Parekh has already served 2 terms as the Infosys CEO. He took charge in, I think, 2017 or 2018. So after 2 terms, there is a succession plan announced. And Ashish Kumar Das, or Dash, we're just reading the website. He is an Infosys veteran, 3 decades at the company. He's held multiple leadership roles across delivery, operations, consulting, transformation. And I think most recently, he serves as the Executive Vice President and Global Head of Services, Utilities, Resources, Energy and Enterprise Sustainability. So he's led a portfolio which spans more than 12 industry verticals. And I think what also stands out, he's done a lot of work on AI-led transformation. So he has been driving Infosys strategy around AI adoption, innovation, future of works. There was a lot of speculation in the market on whether Salil Parekh will get a 3rd term or they will look at someone with, a fresh approach to leading the company in this Infosys era. And Salil Kumar, after 2 terms, will no longer be the CEO. And this is big, big management change coming through. Ashish Kumar Dash, and he is going to be an Infosys veteran. So no outsider. It is going to be an internal person who will be taking charge as Infosys. We are also awaiting the numbers. Okay. The other important headline is that Infosys FY27 guidance has been revised lower at the upper end. The current guidance is 1.5% to 3.5%. The company's new guidance stands at 1.5 to 3%, which means the upper end of the FY27 guidance has been lowered. This will not come as a surprise. Many believe that given the fact that the company has lost out on the Daimler contract to competitors, so the manufacturing sector has been under pressure, it was difficult for the company to achieve the upper end. So 2 big headlines as of now coming through. 1, new CEO announced. He only takes charge once Salil Parekh's term comes to an end officially from 1st of April 2027. That's his picture up there on your screen. And 2, with respect to numbers, the FY27 guidance at the upper end has been lowered. The new guidance stands at 1.5 to 3%. I think margins have come in line with expectation, approximately 21%. Just trying to get some more numbers if we have on the revenue. On the whole, it's expected to be a decent quarter for Infosys. The street expectation was for a 1.5 to 2% constant currency revenue growth. But this is not purely organic. The company had done 2 acquisitions, Stratus and Optimum. There would be a 2-month contribution on account of those acquisitions. So big breaking news coming through. Okay, we've got the top line. The dollar revenue growth at 5,082 has come in lower than expectations. So it's missed our expectations by nearly $45 million. So the top line has come in disappointing. EBIT margins remain unchanged in the absence of a wage hike. Margins remain anchored around the 21% band in the middle of the company's guided band of 20 to 22%. The EBIT is now at 1,163. But as I said, margins have come largely in line. What I'm awaiting is the constant currency revenue growth, which will give us an indication on why the company has lowered the upper end of the guidance. Rupee revenues are about 200 crores short of expectations. Rupee numbers for most companies are looking better on the back of the rupee depreciation. Rupee depreciation has been to the tune of about 8-10%. The bottom line at 7,769. So these are the numbers that we have. If we could just quickly also read out the statement coming in from the new CEO. I'm honored by the confidence that the board has placed in me, excited about the opportunity to lead Infosys into the next chapter. I would like to thank Salil for his mentorship, guidance, and the countless opportunities for growth. I look forward to collaborating with him for a seamless transition. Infosys begins the next phase from a position of enormous strength with a clearly articulated AI strategy, talent, deep client relationships.
Right. Rima, I just wanted to, get our viewers up to speed on Ashish Kumar Das and what we know about him. As you were pointing out, he is a long-term Infosyn. He's been with the company for a while now. What have been some of the previous responsibilities, to take over from Salil, especially in the AI era? How much AI-related experience does he have?
Well, I'm also trying to, find out. I'm just reading from the website that I can see. And this is what the website says. Drawing from 30 years of diverse roles and responsibility, Das Dash amalgamates various skills into straddling delivery, operational and financial excellence. In addition to driving revenue growth, he's also focused on institutionalizing innovation, AI-led reimagination and the future of work within the teams. So I think, I don't know too much about him. I've not interacted with him, Ashish. I've not interacted with him, Shireen. But I guess the sense is that, it's just a fresh pair of eyes and hands to lead the companies. It is a challenging era. It is a disruptive era. And Nandan Nilekani, if you remember, had articulated that there is a services opportunity. The application layer is still in a very nascent stage. And he spoke about a number of, I think, $300 to $400 billion by 2030 in the next 5 years. So there is that opportunity. And I think now the responsibility rests with Ashish for Infosys to capture that. It's been a difficult, last couple of years for the entire IT industry.
No, it certainly has. But back to the numbers, Rima, and just to look at the internals that we already have with us. Of course, you were talking about the guidance, but outside of that, what's noteworthy in the numbers?
Well, I don't have the deal wins, but let me just quickly recap the numbers that I have. Dollar revenue growth has come in slightly softer than street expectations. The company's top line, dollar revenues have gone up by 0.8%, lower than consensus expectations. Margins at 21%, I think, have come in line with expectations, while the profits for the company, I think, have slightly come in lower on a quarter-on-quarter basis. So these are the numbers. Margins in line, revenue slightly soft, and on account of that, the company has reduced the upper end of the guided range. It now stands at 1.5 to 3%. Just if you could give me 2 minutes, I will just try and get some more numbers in from the company. Salil Parekh also reads, I have enjoyed leading the company from a $10 billion in revenue to a $20 billion revenue in his 2 terms. He has established Infosys as a leader in digital transformation. And he looks forward to ensure a seamless transition. Okay, we've got the constant currency revenue growth. Yeah, go ahead.
And the large deal total contract value at 3.6 billion. AI firms 8.2% of the total revenue. The AI revenue is about 8.2% of the total revenue. And of course, Nandan Nilekani, the chairman, is also going to be addressing the press conference along with Salil Parekh briefly. And I would imagine that we may even hear or at least see Ashish Kumar Das, the Infosys CEO designate. But the press conference is expected to start shortly. 8.2%, that is the percentage of revenue from AI specifically, Rima.
Well, and it's the first time I think Infosys has articulated or, informed us about the contribution of AI.
I think Nandan is speaking, Rima.
Okay, so Shireen, as I was saying, for the first time, Infosys, like its peers, is talking about the contribution of AI as a percentage of the overall revenues. Broadly, for the entire industry, it still stands in mid to high single digits. But I think the press has begun.
The Nandan company is from 10 billion to 20 billion completely did the transformation for the digital era and has started the AI differentiation and transformation. But Salil's term comes to an end on March 31st, 2027. And Infosys has been looking at his succession. And today I'm delighted to tell you that the board has appointed his successor, a new CEO who will take over on April 1st, 2027. He's from Infosys. He's been somebody who is a true blue Infoscion. He has worked in Infosys for 31 years. He's worked in every part of Infosys, be it in delivery, be it in sales, be it in account management, starting a new DC in Bhubaneswar, everything. And he's someone who I think everybody likes, respects, He's an uncomplicated guy who focuses on what needs to be done. His name is Ashish Dash. So Ashish is based out of LA. He's been there for some time. He will move back to India, and he will, in the next 2-3 months, he will do some CEO coaching or whatever. And then from October 1st, Salil will take him on as his mentee and prepare him for the role so that he can take on this role of managing a complex $20 billion company in a very transformational time. So I just wanted to let you know that Ashish will be the new CEO. And I'd now like to request Salil to say a few words about Ashish.
Thanks, Nandan. So first, welcome everyone. This is an incredible time for us. As Nandan shared, I've known Dash for a very long time, working closely with him. Huge congratulations to him in making sure everything he does works well into the future. He's had an amazing portfolio, the way he's built it, the way he's crafted it in terms of the clients he's worked with, in terms of the people he's worked with. And there's a tremendous set of opportunities from that onto the overall company, the learnings from that as we apply to the overall company. Ashish Dash, also a very collaborative individual, working well with all of the various components within Infosys, and having been here for a long time, has made sure he's learned everything and also understood how all different parts of the company work. So huge congratulations to him, and looking forward to working with him as we do the transition over the next few months.
Lily. I now invite Jayesh to join Salil on stage to commence the quarter updates. As always, for this section, I will request one question from each media house. But with that, let me invite Salil for his remarks. Over to you, Salil.
Thanks, Rishi, and thanks, Nandan, for that. So good afternoon, everyone. Thank you for being here. Our revenue growth for Q1 was at 2.4% year-on-year and 1% quarter-on-quarter in constant currency terms. We had a one-time revenue impact of a client decision during the quarter. Our AI services revenue was 8.2% of overall revenue in Q1. Our large deals, 3.6 billion at 61% net new, operating margin at 21.1%, free cash flow at $955 million. Our earnings per share were up 15% year-on-year in rupee terms. We saw a strong acceleration in our AI work, as I shared earlier, with AI revenues at 8.2%. This is growing at double-digit quarter-on-quarter for the last several quarters. With this momentum, we see long-term relevance of our services for our clients, which are all driven through AI. From our delivery team, over 80,000 employees are working on coding tools such as Claude Code or Codex or several others for our clients, for our work inside. We see strong traction across the 6 areas of growth, the new growth that we see in AI, our hexagon for AI strategy. We see client work, for example, in building agents for processes, work on data, modernization, and using coding tools. We are building a team of frontier engineers to support our client work. Our plan is to have 6,000 frontier engineers over the next few years. We have built a platform, Topaz Fabric, that enables our clients to get the benefits of AI while keeping the sovereignty of their own data within their company. Our clients are able to work with any foundation model, closed, open weight, or on the cloud, on their own servers. Our clients are able to optimize token costs, which has become very critical now, to make sure it's the appropriate for the type of work they're doing and not out of hand. Overall, we continue to see the macro environment remaining uncertain. With our Q1 results and a view for the rest of the financial year, we are changing our revenue growth guidance to 1.5% to 3% year-on-year growth in constant currency terms. Our operating margin guidance remains the same at 20% to 22% operating margin. Thank you. And with that, let's open it up for questions.
Thank you, Salil. We will now open the floor for questions. The first question is from Ritu Singh from CNBC TV 18.
Thank you very much. I know you've asked for one question, but if I may, Salil, you've given us a big news in this quarter. To begin with, since you speak about how you've brought in, and, Mr. Nilekani spoke about how you brought in calmness at a time when, the company was going through quite a bit. Even now, you're speaking of this global uncertainty because of which you've had to, again, pull down your guidance as well. Why decide to leave at a time like now instead of perhaps, looking at an extension? I wanted to understand. And with the new CEO coming in, any mandate for the new CEO that you could highlight for us more clearly? And perhaps that's something the investors would also want to know. And then on the earnings, of course, the reason for this revision downwards, if you could give us a little more color on what you're seeing in the environment, where's the weakness, where's momentum picking up? Some of your competitors like TechM have been talking about irrational competitive pricing. Wipro's also, spoken about that a bit. So what are you seeing in the environment? And with a 1% kind of a growth in the first quarter, do we assume the second half will be meaningfully better if you're to reach that upper end of the 3% guidance you're speaking about? And just on AI, if you could update us, how the revenue is moving, is it proceeding as per, what your expectations were? Any updates you could share on that front as well as far as revenue contribution from AI is concerned?
So let me start with the first one. I think you had that question collectively for some time now. We have the answer. As I look at it, I'm really delighted with the role I've played here. We've taken the business, as Nandan said, from 10 billion to 20 billion. It's working very well. The digital transformation, now the AI transformation is launched. So I'm really delighted, working well with our clients and with an incredible team that we have inside. So that's what I would like to say on the first one. On the second, I think what we are seeing is an environment where a little bit sort of combining the third piece as well. AI services is growing extremely well. Double-digit growth, if you look at it like quarter on quarter, if you look at it over several quarters in the past. We see that those 6 areas that we have identified, like the process, the agents, the data, the engineering, all of those are working extremely well with our clients. So we are now looking at revenue growth in each of those areas. Our pipeline is even larger than the 8%, which is the revenue today. So we see good traction in that. Therefore, we feel there's a good long-term relevance of our services to our clients, because this is going to continue to grow as we look out into the future. Now, the question on the guidance, we had a one-time impact that I shared with a client decision. There are factors related to what is going on in the macro environment, which we talked about. There are factors related to the volumes in the quarter. But we look at the large deal number, 3.6 billion, 61% net new. So we see a lot of support in that. We see, I think there are 6 of those deals which are consolidation deals that we have been the beneficiary in, as an example. There are 4 deals which are just under the $500 million range, so just like a mega deal. So we see, really good traction. The pipeline there is looking good. So when we balance, we decided to look at our guidance in a different way. The upper end of the guidance was really based on if the macro was improving. We now see the macro, it may improve, but not at the level that we were thinking initially. And so that's how we really constructed the guidance. But we have tremendous view that this is a good place for Infosys to operate with AI the way it's looking. And all of the work that we're doing on large deals gives us continued traction.
None of those questions of why you didn't decide to stay on and what the mandate of the CEO is, and if the second half will be better. If you could clarify all of those points.
So there, I think as I shared earlier, my sense is we've had a tremendous, I've been fortunate to have a tremendous sort of opportunity and what we've done at Infosys over the last many years and having taken the business from about 10 billion to 20 billion. So it's been an incredible journey. And that, with the team we have and with the client work we've done, that's been a fantastic sort of an outcome. On the mandate, I think our AI strategy is well put together, and Dash has been part of that. So our thinking is, that strategy we want to execute on. Of course, there will be some things which we will look at in terms of fine-tuning, but that's a natural course of evolution. But the strategy is very well in place to make sure that goes into the next phase, making sure, the partnerships we have with the various models, the Topaz fabric that we built. Today, on AI, it's important that clients see that their own data remains sovereign to them. And the way we build fabric, it allows for the clients to do that no matter which model they're using. And so that's a very big differentiator we have, for example, in AI. The token cost, that will be an important factor, we think, in the future. And we have built like fabric in a way that depending on the task you are using the foundation model for, it will use the right model. So you don't have to pay for the most simple tasks like an expensive token cost and so on. So we think we're in good position in that. In terms of second half, first half, I think we have the guidance for the full year. We expect the normal seasonality that will come. We're not expecting anything unusual there.
Competitive pricing in the market that some of your peers have spoken about.
Yeah, so maybe they are seeing that. You should check with them.
Thanks, Ritu. The next question is from Rishabh Shah from Money Control.
Salil, if you could tell us your biggest achievement and what will you miss the most and what's next coming for you. On the performance, quarterly performance, how has been the TCV conversion? Because that's a worry that investors have, and the third question is, two of your peers have highlighted that AI revenue is slightly lumpy and it could be 1 or 2 quarters post which you'll have to go and get those deals again. So is that something that Infosys is also seeing? Thank you.
So let me start with the second one. I'll come back to the first. I think the TCV conversion, we see a pretty good way of converting. Now, what tends to happen is, like when you have a consolidation deal, the conversion comes a little bit quicker. When you have a transformation deal, it's a little bit sort of spread out. But that's the normal sort of conversion we see. We don't see that it's suddenly changed like in the last quarter or couple of quarters or so on. Yeah. On the AI revenue, I think it's moving so quickly that it is a bit up and down in a quarter by quarter basis. So our thought is, that's why we're saying, like, look at over the last several quarters, we see that double-digit type of growth quarter on quarter. And we will see, sometimes it could be a little bit faster, but it's growing nonetheless. Meaning, if you look at the secular trend, we see that is pretty strong. And that gives us a little bit of the view that long-term, there's a relevance of what we are doing on AI for the clients. For me, I think I'm very focused on what we have to do here at Infosys. We have a lot of things to get done. I want to make sure we remain in the leadership position. We win in the market. We are leading in AI, and I get a smooth transition done. So that's really my focus. And after that, I'll see what else happens.
Thanks, Rishabh. The next question is from Mansi Dave from ET Now.
Hello, good afternoon, Salil and Jayesh. Nice talking to you. Salil, my questions are on client spending, large deals, and competitive positioning. So talking about the client spending, client budgets remain selective across industries. Have you started seeing any improvement in discretionary technology spending, or are enterprises still prioritizing cost optimization over transformation? Talking about the large deals, Infosys has maintained a healthy large deal pipeline. So how confident are you that these deals will convert into faster revenue growth? Also, every global IT company today is talking about AI. What would you say is Infosys' biggest competitive advantage in this AI-led technology cycle? And please start with this one. Which moment during your tenure best reflects the values and culture of Infosys? Thank you.
Okay, there was a few, so I'll start with the first was a conversion of the TCV discussion. I think we see that, you know, the large deals, we see a good traction of those. The values over the last few quarters have been strong. This quarter was pretty good. We see the pipeline to be pretty good on the large deals, and we feel there's a benefit of the consolidation that we are seeing in some of the large deals, which is definitely helping us as we go through it. The conversion, whether it's faster or slow, it's more, I think it's at the same type of a level, and we will convert those into revenue. With 61% net new, it already looks pretty strong in terms of the net new work, which we'll see. And obviously, the renewals are going pretty okay as well there. On AI, I think there's a huge differentiation that I find from what we are sort of working on. First, we have a very clear AI strategy with the 6 areas of focus. We are investing in it. We've actually taken, and Jayesh has shared in the past, he'll share also today, we have invested in building out AI capability. We have, as I shared earlier, 8% revenue growing double digit Q on Q over the last several quarters. We have a good pipeline in that area. Then you look at some of the stats, we have 80,000 people working on the tools today for client work. It's not just training and so on. Then what we built with Fabric, I feel, is very differentiated because it allows clients to maintain control of their data, maintain control of what they want to do with the AI, and still use the different models, use lower costs. We have a harness through which they can leverage what they want to achieve with the foundation model. So that is a significant move up in terms of differentiation that we've seen. I think in terms of values, you know, my sense has always been Infosys has incredible values, and it's really been sort of a privilege to be associated with that and learn from it and contribute to it. So in many ways, it's a great sort of fortunate thing that could happen in the way that it has happened.
Thank you.
Okay, that is the Infosys press conference. And, you know, it's more than a CEO change. The CEO succession plan is important because Salil Parikh's term was coming to an end in March 2027. And there was a lot of speculation that after 2 terms, will he get an extension? So the fact that there is clarity and the new CEO designate, Ashish Kumar Dash, has a good 9 months to step into the role, get mentored by Salil Parikh is good. But, you know, if you read the language that from the board or from Nandan Nilekani, it does appear that this is a succession to position the company for an AI era. And this is what the press release reads. The board thinks he is uniquely positioned to lead Infosys through its next phase of AI-led transformation while building on the company's enduring strengths. Nandan says, the board was clear that our next CEO needed to combine the ability to drive bold transformation. So Ashish Kumar Dash is who Infosys has selected. He's a blue-blooded Infosian. He spent more than 30 years in the company, and he's got diverse experiences. Over the last 3 decades, he's been a part of various industries from delivery to operations, and he's also been a part of the companies and articulating the company's AI strategy. So he's been, you know, he's got the responsibility to lead the company in this next phase of AI, transformation while keeping the continuity alive. So this is going to be an internal succession. Currently, he serves as the EVP, Global Head of Services, Utility Resources, Energy and Enterprise Sustainability. But as Nandan was also pointing out, he's been in the company for 3 decades now, and over the course of many years, he's literally handled every part of their portfolio. So that's one big news. The big headline coming out of Infosys is the CEO announcement. But secondly, when you look at the numbers, it's a bit disappointing, particularly on the revenue front. So the company's top line has disappointed the street. Revenue growth has come in at 1%. This is lower than expectations of 1.8%. And I went through close to about 10 to 12 brokerages, sell-side analysts. The lowest expectation was about 1%, but the highest went up to 2.5%, which means at a 1% growth, it's come in at the lowest estimate that the street had and much lower than the average estimates or consensus expectation. Part of the reason is on account of, one client-specific issue. The company doesn't name clients, but the street says it's the Daimler deal, which the company lost. So that is impacting the company's performance. So Q1 has been lower. Margins, though, have been maintained. Remember, the company has this Project Maximus. So despite weak revenues, they have been managing to hold on to the margins. And also bear in mind that this 1% revenue growth includes a 2-month contribution from acquisitions, Optimum and Stratus. The company does not disclose what the revenue contribution will be from the acquisitions, but analysts were saying it should be 80 to 100 basis points. So basically, in a nutshell, Q1 organic revenue growth has actually been very muted. What it leads to is the FY27 guidance. Now, that's been revised lower, 1.5 to 3%. The earlier guidance was 1.5 to 3.5%. So the top end has been brought down. And when I spoke to some people, they were indicating that now, because they have some inorganic M&A which will contribute to the top line, then maybe the organic revenue guidance will be brought down. But if you include the acquisition, maybe the new guidance could have looked at 2 to 4%. So in that context, 1.5 to 3% is a miss. Margin guidance remains unchanged at 20 to 22%. And this is important. For the first time, Infosys has disclosed AI metrics. So this is a new disclosure. Infosys says AI as a percentage of revenue stands at 8.2%. And this is in line with TCS, where it stands at 8.5%. Deal wins have been strong. Last quarter, 3.2 billion. This quarter, it's at 3.6 billion. But all that has to really convert into revenue. So big headlines coming out of Infosys. It's clearly going to be a stock to watch. But I would go with red tomorrow on the back of the miss in Q1.
President Trump is rebuilding his tariff wall just months after the U.S. Supreme Court called his so-called reciprocal tariffs illegal and scrapped them. Now, he swiftly imposed 10% temporary tariffs after the court ruling. That 10% duty expires on the 24th of July. That's the big date. So what is the plan now? The White House is seeking refuge under Section 301 of the U.S. Trade Act. Under this law, the president can initiate a probe into any country based on the findings, impose tariffs as he deems fit. Now, the U.S. Trade Representative alleges that 60 countries were using quote-unquote forced labor to make their goods which are exported to the U.S. and hence proposed a 12.5% duty. India is among these 60 countries. A final decision on imposing the tariff has not been announced as of this Thursday afternoon. Now, speaking to CNBC, U.S. Trade Representative Jameson Greer said a decision on imposing the tariff is coming soon. Now, Trump has also turned up the heat on pharmaceutical companies, urging them to make in USA if they want to sell in the USA. He's warned that imported medicines could face tariffs of up to 100% after a 2-year transition period. Indian drug makers who supply roughly half of the generic drug medicines consumed in the U.S. are adopting a wait-and-watch approach as of now. The U.S. Secretary of State Marco Rubio met his Indian counterpart S. Jaishankar on the sidelines of the ASEAN summit in Manila. He said that Jaishankar did not take up the issue of pharma tariffs. Trump has also announced tariffs of up to 50% on several Canadian imports. He's also hitting Brazil with new duties. His administration is relying on a provision of the Tariff Act of 1930 that allows the president to impose duties of up to 50% on imports from countries that are found to be discriminating against U.S. goods. Many legal experts expect this to face court challenges again. But with Trump reopening the tariff front, even as tensions in the Gulf continue to roil global markets, how should America's trading partners prepare? How should India respond? Joining me now are Prashant Nair, Nimesh Shah, Ekta and Shriram. Ekta, gentlemen, thanks very much for joining us. You know, we were still dealing with everything that's going on with Iran, and here we go. He's reopened the tariff front once again. He has brought back tariffs front and center. And of course, July 24th is going to be the important date to watch out for. Prashant, let's start by talking about exactly that. Why July 24th is important, the significance of Section 301, which ostensibly is going to be the route that Trump takes to bring back tariffs.
Absolutely, Shireen. And I was looking at those visuals which we were playing up, right? I mean, it seems like an eternity ago that placard in the White House lawns caused an absolute sell-off and mayhem back in April of last year. But you know, it's just like a year ago, all of that happened. And what a period it has been. You know, in India's case, right? I mean, and I had to go back because, as I said, it seemed like an eternity ago. You know, it started with 25% for India, a penal tariff, another 25%, which is for buying Russian oil. You know, tariffs rose to 50%. Then, you know, the 25% was rolled back. We were left with 25%. Then earlier this year, if you remember, I mean, we were live on air at 12 at night. I mean, 1 o'clock in the morning when you know that the 25 the trade agreement in that sense, right, started to come through. And, you know, that the remaining 25% was supposed to be rolled back to, it looked like perhaps, you know, 18% or so. And then you had the Supreme Court, which basically knocked off the basic underlying route which President Trump used, which is emergency powers, which is this IEPA method, which kind of, again, you know, knocked off the entire basis for all these negotiations. And that's the reason why that's where we find ourselves at with these 10% tariffs, universal, Section 122. But, you know, the reason what you said, right? Section 122 allows the U.S. To impose these 10% tariffs for a period of 150 days, and that 150 days expires on the 24th of July. So what replaces Section 122? It's 100% sure that it's not going to go down to zero. There will be something. And I think it's pretty clear now, right? For a lot of countries, most Asian countries, Shireen, are basically facing two kinds of investigations under Section 301. One is forced labor. I mean, US's contention is that, you know, a lot of forced labor is being used, which undercuts, you know, American labor in terms of pricing costs and puts American companies at a disadvantage. And the second is excess capacity. So the first of the two, which is what the two sections, the two country level investigations, which most countries are facing, in Asia kick in from the 24th. When the 122 10% expires, this will kick in. For some countries, under this forced labor sort of route, the tariff, the applicable tariff is 10%. For example, countries like Pakistan, countries I think like Indonesia, and a bunch others, the tariff is 10%. But I think for the vast majority, about I think 60, 65 countries, India included, I think on the from the 25th, the tariff applicable is 12.5% or so. So, you know, I think 10 basically, I mean, the hope is unless something else happens, there's a new notification, 10 goes to about 12.5%. Shireen.
Yeah, you're absolutely right, Prashant. At least for countries, that 60 countries that we're talking about, which includes India, it is likely to be 12.5%. But, you know, we need to be clear about the timeline, whether we will see that coming into effect from the 24th. Remember, Jameson Greer on CNBC speaking to our colleagues did say that tariffs are coming, but, you know, he did point out that he will have to come back with what the date of notification will be. But the assumption is that once the 10% expires, we will see the 301 tariff kicking in. But, you know, that's the immediate overhang.
Yeah.
And we have clarity on, you know, the possibility of that coming in over the next few days. But Ekta, let's talk about the big announcement that Trump has held out on generics, and he's been at it since day one. He's of course been talking about tariffing generics ever since he started his presidency, but for the first time he's actually laid out a timeline for it, albeit a very sketchy plan, and that too on Truth Social. So it is a post on social media more than government policy. But how is industry reacting, Ekta, at this point in time? We're also talking about a staggered you know, rollout, if at all this proposal were to go through. He's saying 2 years and move your manufacturing facilities there. That also coincides with the presidential election. So on balance, now that there is some semblance of a plan, albeit on social media, how is the pharma industry in India reacting? Are they worried?
Well, Shireen, you know, interestingly, most of the industry feedback that I've got has been very measured this time. And even the pharma stocks, the way they've reacted to it has been measured, because they know how important the Indian generic industry is to the American consumer, the American medicine cabinet. Because 4 out of 10 pills that the American takes today is probably coming in from India. That can be your paracetamol, that can be your cancer drugs. So that's exactly where things stand. Now, with regards to what the industry is saying, they are currently, like you mentioned, in wait and watch mode, because there's no official policy notification, there's no clarity in terms of which products they're covering, there's no implementation timeline, and companies really want to see the fine print in terms of what he's talking about at the end of the day. Maybe it could be just about sort of aligning some national security concerns because of what happened with regards to COVID, where there was fear that there's too much dependence on China, there's too much dependence on India when it comes to drugs and API. So let's shift that into the US, and that could be a part of what his intentions are, and hence it could possibly even be piecemeal. So that's you know, some of the feedback that I've got. Now, manufacturing, like I mentioned, just can't shift to the US overnight. So, for example, Dr. Reddy said shifting to the US, he said it in plain terms, is impractical at this point. Anthem Bio told us that manufacturing costs in the US is 5 to 10 times versus India. And Granule said that the drug prices would need to increase by 50 to 70% at least, if in case there is any kind of shift. So even if tariffs do happen, the execution is going to take time. Greenfield APIs take 5 to 7 years. You have multiple regulatory agencies to go through. So it's not something that can happen overnight or in 2 years. In 2 years, what they'd probably like to see is what branded pharma did. There's some groundbreaking of a plant. There's some kind of intention in terms of investing. And big pharma has been investing from India in the US. So they're making their presence felt. That's probably what's going to happen. And if you look at it, the dependence is so much for the US. 69% of generic drugs are from outside of the US. APIs, 11% only from the US and 44% from India. So imagine shifting that supply chain entirely, or even a majority of it. It seems a little impossible. So that's why there's a wait and watch approach right now.
Yeah, and you know, you're right in pointing that out, that it seems impractical, especially given that time frame that President Trump has laid out. But you know, forget the cost on Indian companies of moving manufacturing on site to the US. let's talk about the cost on the U.S. consumer. I mean, this is, it's going to hurt them. It's going to actually punish the U.S. consumer much more than it punishes Indian pharma companies. And, you know, Shriram, as we were discussing, this kind of ties in with the elections that Trump is going to have to face.
Yeah, the deadlines that he's setting, Shireen, is not for everyone else. The deadlines are for himself. I think he has an exam coming on his head and he's reacting to it and he's trying to sort of, and, you know, more importantly, you know, he's this whole, you know, and the madman theory about Trump, the technique is, I think, kind of running out now. He's getting called out. The escalation that he tries to do and to force people into a negotiation, I don't think it's going to work anymore. It's not worked with Iran. I mean, with bombs in your hand, if you're not able to force Iran into submission, which is sort of a fraction of your military power. And similarly, trade negotiations, and especially for India, it's relevant because of the trade deal discussions that are going on. And I think we should hold our ground as we have so far. We'll come back to that, I guess, as we go forward into the conversation. But essentially, I think, like Ekta said, everybody knows now that there are one of two possibilities. Either Trump will forget or he will change the goalpost. So either which way, no action is better than, you know, acting in panic.
I'll say one thing, Shriram. You look at pharma is one, but you look at semiconductors. Who would have thought they would build, fabs, in the US? It's happening, right? TSMC.
But there is also the demand is there, right? The question.
Demand is there for
generic, but at what cost? Again, right?
It's the same thing. Building a fab in the US is far more expensive, but companies are doing it.
But people will pay.
So the
buyer has the purchasing power.
The point
as
is
Shireen pointed, the drug buyer doesn't have the purchasing power that a tech company does.
Absolutely, but the point is somebody down the line is paying, right? The smartphone user will pay the cost, right? The point is that, as Ekta said, dependence that US has on generic outside drugs made outside of the US and Indian drug is very large. But think about it the other way. How profitable and lucrative is US for? I mean, the reason he's able to do all of this is because US is the largest.
The point is that the way Trump thinks is very interesting. He basically looks at your P&L and says,
and by the way,
I'm saying it's very interesting.
In no way suggesting that we are,
actually took me
companies
to
are going to move. I remember our conversation with Lupin, right?
I just want to also add
just one. I want to close that loop. Like, you took me to a very interesting place. How does Trump operate? Trump looks at your wallet, says, you have made this much money from me, I want a share of it. Yeah. This is hafta vasuli, okay? Now the point is, if that is the case, the point is that the moment you force people to set up shop there, that wallet shrinks. So then what are you left with? So it's a bit of a self-goal that he clocks every now and then.
Exactly. So I just want to point out that if in case you move manufacturing, your paracetamol, which costs $2 to $4 for 100 tablets in the US, which is a generic paracetamol, that goes to $4 to $7 if you move manufacturing to the US. Now, the other option is that you don't do anything and you pay the tariffs and you increase your prices there. So you're any which way going to, the Indian pharma company is any which way going to have some kind of price increase scenario, which is possibly going to take place. And if in case it is a price increase and that you're paying the tariffs, it could actually be beneficial eventually for margins of companies because they suffer from such low margins in the generic space in any way.
I do want to go back to Prashant's point, and I think it would perhaps be a bit naive to suggest that, look, he'll back out or this will be another instance of TACO. I think what is very clear, whether you look at the semiconductor example or you look at even within the pharmaceutical space, you look at the branded example, companies are now putting down dollars to say we are going to invest in setting up manufacturing in the US. And even if there were to be a regime change come the elections, a muscular industrial policy is the way that the world is moving. And I think that is the reality that one is going to have to accept. Will the next government go as far as President Trump? Should there be a change? One doesn't know. But will they do a complete U-turn? It's hard to imagine because that, we're seeing it happen in country after country, this muscular industrial policy saying if you want to sell to our market, you've got to build here, you've got to manufacture here. That is the current reality.
That is absolutely the point.
I think Indian pharma is going to have to at least be mindful of that reality and put a plan B in place.
So even before Trump, Biden administration imposed a similar forced labor tariff on China. Even Trump didn't do it, Biden did it, and it continues now.
Yes.
And it is very likely, and the point is that if there is a regime change, the one thing that we can possibly expect, I'm saying rationally thinking, is that, a consistency in terms of the policies, right? Then what is applicable for China will become applicable on the same grounds for other countries as well. So a lot of these things may not go out unless Trump chickens out himself, right? So that is still a possibility. But yeah, if he prevails, then...
And I'm just saying that Indian industry is going to have to be watchful. Indian industry is going to have a plan B in place as things progress. But, Prashant, I want to go back to the 301 issue. And we are still in the final stages. By all accounts, we've heard from the U.S. ambassador, we've heard from our own commerce minister. Yesterday, we heard from Marco Rubio in his statement saying that, it's at the point of finalization, the U.S.-India trade agreement, the trade deal. But one of the things that, was an impediment was this 301 investigation, because if India were to be slapped with a 12.5% tariff under 301, then what becomes of that trade agreement? And I think the hope on the Indian side is, and there was time for public consultations, etc. I would imagine the hope on the Indian side is that this goes away and then we can sort of move forward as far as the deal is concerned, because officially what we've heard from both sides is we're in the last stages. It's almost finalized. It's just a question of inking it. So, I'm wondering whether we could see perhaps, I don't know, some relief on the 301 front, which could then lead to that deal finally getting done.
Actually, Shireen, you're absolutely right. One hopes that happens. But I would say, if I had to stick my neck out, I would say that we perhaps will not be at 12.5%, we'll be higher. Because, what we've heard from the White House and other officials, not directly, but what we've heard is what they want to do is, the reason 122 is just sort of, holding the fort, right? This 10%. And then the current 301 is just to kind of be there, this 10% and 12.5%, depending on which country it is. It is that when the 10% expires, it should not go to zero. Correct. So that is just it's like an interim thing, right? But correct. I think the intention is that, 120, the 12.5%, which is 301, will it be 301 or will it be back to AIPA? Remember I think the intention is for all countries, the tariff level should be back to what it was negotiated in the trade agreement. What it was, and that was 18%, right? So so my assessment, I would think, of course, it's up to both sides and how it'll happen, but it'll be 12.5% now. And as I said, there is one investigation, which is the forced labor investigation. That is the first 301. The second 301 is excess capacity. That is still underway. We don't know how. They can conclude it as fast or as late as they like. Yeah. And when they use that, I think they will calibrate it in such a way that that actual tariff, the declared tariff, moves to what it was, at 18%, which was now.
Dinesh, from a market's point of view, as Ekta was pointing out, the pharma stocks have more or less taken it in their stride as of now because, it's a 2-year window. We don't know what's going to happen. But outside of that, some of the other export-related sectors who are going to be looking at what happens come the 24th of July, how's the market reading into all of this?
Shriram, market will not like this uncertainty for sure. Whatever, whether it's 12.5 or 14 or 16, whatever. But it's an uncertainty which is not going to be, something which the street will like. And unlike, pharma, which is very dominant now and which is something where US can't do much, for other sectors, it might be a bit of a challenge. And market may not like it and punish as well. I'm saying it because markets have seen a bit of a reaction to these stocks as well. The 4 big sectors which have, huge exports to the US, textiles, gems and jewelry, rice and shrimp. Okay. And across all these 4 sectors, I was just looking at the stock prices of all within all those 4 sectors. Look at textile first, which is a big sector and something where there are meaningfully sizable companies, right from Pearl Global to Gokaldas Exports to Welspun to Arvind. All these stocks have rallied between 10-15% to all the way to 55-60% as well in the last 2 months. So given that there was a bit of a relief rally, the fact that now it looked like the tariff is behind, we saw a bit of a rally in these names. So textile was a big sector which saw a big pullback. And even from a market point of view, now a lot of investors, a lot of fund managers were looking at this sector as a next 5-year call. Not like a temporary call, but a strategic, because of the FTAs being signed, the fact that tariff was behind. It looked like it's a more of a structural sector to bet on for 1, 3, 5 years. So now again that will be a bit of a question mark. So that's one. Gems and jewelry, again big move in those sector stocks as well. Something like a Bluestone is of 60%. PN Gargill is of 35-40%, Titan is up 25%, Kalyan Jewelers, Senco Gold, all have rallied pretty hard in the last couple of months. And of course, there is a bit of India angle to this as well. The numbers were quite strong, but also there is a bit of relief that there will be no big shocks from the export point of view. Similarly, with rice companies, all the stocks are up between 15 to 35%.
Also gold prices.
Of course. So there is a domestic angle, but of course there is an export angle as well. Similarly, rice companies, everything is up between 15 to 35% in the last 2 months. Similarly, the shrimp companies, all are up between 15 to 25%. So
all of these 4 categories are part of that list where US suspects India has a forced labor problem.
So that's what I'm saying. It's not only about tariffs, but also the uncertainty which can again creep in. And maybe that's the reason why the street will go a bit nervous as well into the export sector. It was seen to be a sector to bet on from here. Again, there is a bit of a damn squib. The fact that there are fresh tariff concerns.
Yes,
on
the uncertainty doesn't
one
help.
One point I want to highlight with the graphic that we, Abhishek, if we can show that, which is the 2 list of items which are under suspicion, like under forced labor investigation from India and China. And if you see, there is very minimal overlap. I'm not exactly able to, I'll have to wrap my head around what the implication of that is. The point is that if you have if you sort of discourage import of a certain product from one country, you should have an alternative supplier. And we are a big supplier in all of these 4 categories, and China is not that. So to what extent will he be able to successfully do this without hurting his own voter base is a big question. Whether it is rice, whether it is gems and jewelry, whether it is shrimp, right? All of these cases, what is your alternative?
We all are worried about what will happen to the US and the US inflation will go up. I don't think Trump cares about all this, right? I mean, he's on his own. It's putting out the tariffs whichever way he wants to. So,
he only cares
farmer prices will go up or the truck price will go up.
But,
I mean, who cares? He doesn't care for anybody,
I want to talk about something that is top of mind right now. And of course, speaking of uncertainty, crude. I mean, crude prices now nudging closer to $100 on account of what is happening, of course, with Iran, but also now with the Houthis coming into the Red Sea, and that has caused its own sets of problems as far as the crude markets are concerned. And add to that, now this threat, this sword of this Russia sanctions bill, Prashant. The late Lindsey Graham was at the forefront of that bill. They started with 500% tariffs on anybody who's buying energy from Russia, including China and, of course, India. It's now down to 100%. But Trump seems to be suggesting that they're going to move on that. And this even as our exports of energy from the US have gone up exponentially in the past year. But that's the other Damocles sword hanging over our heads.
No, again, if I had to take a guess at this, right, who knows what will happen? I think that risk is now is perhaps not as prescient, I would say. And there are 2 reasons for it, Shriram. You mentioned one which is that one of the most hawkish politicians who was kind of sort of proposing the bill, which is Mr. Graham, is no longer sort of around, right? I mean, he's passed away. That is one. And the second is that pump prices in the US are $4, back to $4 once again.
Yeah.
We've been focused on what's happening in the Middle East, but look at what's happening with Russia, Ukraine. Ukraine has managed to take out so much of Russian refining capacity. So Russia is still pumping out the oil, but there are fewer and fewer options for them to actually process the crude that they're pumping out. So there is a product shortage. I mean, there are reports out of Russia saying long lines for gas and all kinds of things, right? I mean, basically oil derivatives. So what do you do? I mean, it's a situation where Russia is sending oil to us to refine, and we're actually sending product back to Russia now, right? So I think this very directly ties in with, if you are going to do this, you're essentially, the oil is of course higher, but I think what matters for the common person is product prices. If product prices, diesel and aviation turbine fuel and everything, that is essentially what you and I pay for, directly or indirectly. We don't buy oil, right? And I think if they were to sort of put sanctions on India for buying Russian oil, I mean, I think significantly impact the market.
What happens on 301 come the 24th of July is the big question. But do you know where you are going to have to tune into for all the updates and the action, the insights and the perspective? CNBC TV 18 will keep you posted on what is happening with tariffs and what is happening with the markets. And of course, we will continue to track the crude market action and the US-Iran current conflict. But Ekta, Nimesh, Prashant and Shriram, thanks very much for joining us. Kal ho na ho, but we'll be back again tracking everything right here on CNBC TV 18. From all of us here on the Editor's Playbook, thanks very much for watching.
Let's Talk Money.
Hello and welcome to a brand new edition of Let's Talk Money. I'm your host, Surabhi Upadhyay. Now it's the end of July and you know what that means. Yes, I'm very sure many of you are thinking taxes. It is that time of the year when we have to file our income tax returns with the tax authorities. So just a couple of days to go. And for a lot of people, usually this is something that we push towards the, just towards the end of that deadline. So we are here this week with a very quick step-by-step guide to ensure that you are checking all the boxes, making sure that nothing gets omitted, all the disclosures are in place, and most importantly, that you're picking the right forms and doing everything that you need to do to ensure that that tax return is filed carefully, correctly, so that you have peace of mind. And helping us do all of this is Mr. Suresh Surana, who's the founder of RSM India. Dr. Surana, thank you very much for joining us. It's a pleasure to have you back on Let's Talk Money.
Yeah, it's a pleasure as well for me.
So, so much has changed. So I want to start by making things very, very simple, because we've also seen a brand new, Income Tax Act of 2025 get introduced, which is effective this year. But first, let's just go over and, clarify that we are talking about filing tax returns for FY26. So which act, first of all, is governing our taxes?
No, I think it's a very valid question and there's a lot of confusion because a new act has come into play. But for the financial year ending 31st March 2026, the returns have to be filed under the old Income Tax Act of 1961. So all the provisions, sections, everything is applicable as per the previous act. This will be the last return under the old act, which served us for almost 60 plus years.
Yeah, I know. So it's going to be like a fading away, and then next year onwards, it's going to be only about the income tax of 2025.
Yes.
But before we get started and talk about the nuts and bolts of it, there have been a fair amount of income tax changes as well.
Yeah.
Over the last two budgets. The move towards the new tax regime, which is now the default tax regime, changing the tax slabs, changing the rebate structure. So, some opening thoughts and observations maybe.
So I think first of all, the number of tax filers has increased dramatically in the last 10 years. So last year, for example, financial year 24-25, 9.19 crore tax returns were filed, which is the highest ever in India's history of tax compliance. However, for financial year 26, the number might drop a bit. And you may be surprised. Why is that? I think there are two main reasons. One is that the basic exemption limit under the new tax regime has been increased from rupees 3 lakhs to 4 lakhs. And secondly, the standard deduction under the new tax regime has been increased from 50,000 to 75,000. And there are a very large number of tax filers who are in that category, although the tax collection may not be significant. So therefore, due to that, this year we might see a same number or maybe a marginal dip even in the number of filers. The second point, as you very rightly said, that the new regime has not only become the default regime, like last year, for example, 88% of the people opted for the new tax regime. I will not be surprised if the number grows even much beyond that, maybe 95, 97%. Because really speaking, if you look at now the liberalized slabs, which you up to rupees 24 lakhs, and the tax rebate, which is now 60,000 rupees, which means up to 12 lakh rupees of taxable income, you don't have to pay any tax. And if you add standard deduction to that, up to 12.75 lakhs rupees for salaried people,
there's no tax.
There is no tax. But while there is no tax, they still need to file the return.
Yeah.
So many people think that no tax liability, so no return. But that is not the case. You need to file the return. Secondly, for people up to 24 lakhs rupees of income also, the slabs now are much more liberal under the new regime. And finally, at the top end also, people who are more than, who are having income of more than 2 crores. Now the tax rate is 39%, which are earlier in the old tax regime, still it is 42.74%.
That's because the surcharge rates in the new regime are a lot more favorable than the old regime.
Yeah,
right?
so the last slab of surcharge, which is 25% as against 37%.
Yeah.
So really you have taken the bottom given benefit much more under the new regime. And similarly, you have at the top end also people benefited. So there might be few, very, very few cases which might be, still eligible.
I'm one of them. And I need to still file my tax returns. So I'm going to pay a lot of attention to everything that you're going to say. But, before we, go on, I want to place on record here the point that you just made, that even if you don't have a tax liability because of the exemptions and the thresholds, you still have to pay, you have to still file your ITR.
Absolutely.
So just tell us, the rule around this, who all has to file ITR and who all are the people who can be exempt from filing a tax return, if at all?
So if your income, which is like if you are under the new regime, and if you are having taxable income before Chapter 6A deductions. So there are deductions under Chapter 6A like which might be still eligible.
So that's the old regime.
Yeah, so generally most of them are not eligible, but if in case something is eligible, then you if you are up to 4 lakh rupees and basic exemption limit, then you don't need to file the return. Unless you are covered by, there are some other categories also that even though, for example, you don't have income which is taxable. For example, if you are a director of a company or if you have shareholding in an unlisted company, whether you have any income or no income also, you still need to file the return.
File tax return.
So that is a separate category. But other than that, if you are above the basic exemption limit, then only you need to file the return.
Sure. Okay. So make sure you go ahead and check this with your CA.
Yeah. And I think the most important category is the people who are eligible for rebate.
Yeah.
Because when you talk of 4 lakhs to 12 lakh rupees or 12.75 in case of salaried employees, that's a very vast number of people.
Correct.
They all need to file the return.
So up to 4 lakh, you don't need to file.
Yeah.
But if you are enjoying the benefit of zero tax because of the rebate, you still need to file. So that's a thumb rule. Make sure you check this with your CA in the next couple of days for sure if you haven't filed your ITR. Okay, now let's talk about what's new this year.
Yeah.
If there's anything new, because in between there was a lot of talk about additional disclosures, more granular declaration of your trades, you know, what you're doing in the market, your investments. So fill us in.
So one, of course, major change which is there is about the particularly which is in terms of trading on the in terms of F&O. So F&O you need to report now separately. What is your F&O trading volume as well as the income or loss on that.
Is that above a certain threshold?
No.
I mean, if I'm a small trader, I do a few trades in a month here and there. Even then, I have to report?
Even then. So there is no threshold there. Similarly, if you are doing intraday trading, there is a separate disclosure on that.
Okay.
Yeah, because these are all subject to tax under as a business income, and therefore you might get more tax because then the due date of filing the return also may be later.
Okay.
So instead of 31st July, it could be 31st August.
If you are
if you have business income.
If you're doing intraday trading or if you're an F&O trader, that income could be business income.
Could be business income, in which case the filing date may not be 31st July, maybe 31st August if you are not subject to audit. And if you are subject to audit, it may be.
Okay.
So that.
So that's very, very important, extremely important. If you could tell us a little more about these disclosures, what kind of trades have to be disclosed, and is it very complex now with this new compliance?
No, it's not complex because it will all be reflected. If you go to your stockbroker, it will be all reflected in your account. But you need to report that. So that is one important point. The second thing is ITR 1, which was earlier only applicable if you had one house property. But if you had two house properties, ITR 1 was not eligible. Now, even if you have two house properties, which in any case, as you know also, that for two house properties, self-occupied property, there is no notional income, it is exempt.
Yeah.
So you can still file form ITR, even if you have two house properties now, which was still last year was only one house property.
Right.
The other thing which is there
whether or not they are let out, deemed to be let out, whether you are actually generating income from that house property or not, you can still go ahead and use ITR.
So up to two house properties, if they are not let out, now there is no deemed income.
Okay.
Which earlier, so that is one obviously thing is that, and many people have houses maybe at their native New Delhi, wherever they are living. So two houses, no notional taxation is there.
Okay.
And then in case you have let out, still up to two house properties, you can file the form.
So you can use the simplified forms. If you're under 50 lakhs of total taxable income, you can still opt for either ITR 1, which is Saral, or I think ITR 4, which is
So ITR 1 is Sahaj.
Sahaj,
So Sahaj means simple. But actually the criteria for filing are not that. Because there are a number of qualifications. For example...
So okay, wait. So let's go step by step. We'll come to the forms in a second. But right now we're still talking anything that's new with respect to this tax filing season. So one is the F&O,
then you have intraday trading, then you have two house properties, you can still file form.
Anything else?
You have ATG donation if you are making. You have to give the transaction reference number and the bank IFSC code. Because a lot of abuse was there, so they want to track that if you have given the donation to charity, it has gone properly and that charity is identifiable. So that is another change which has come. You have to also give now secondary address as a mandatory requirement. Although you can fill the same as the primary address, but you have to fill up that.
What does this mean? You have to make
give
a secondary address.
Secondary address in case you want to make sure that any communication or anything else is at least the department has a second address as well for communication.
If you don't have a secondary address, then
you can still fill up the primary address as well.
Okay.
So, but it is a mandatory field. You cannot skip it.
Okay. All right.
So if you just have one address in secondary, you can fill up again the primary address.
Okay. You know, one more thing I remember a couple of months back when the forms came out, and you know, over the last few months, we've had a lot of talk around how the whole filing process will be more simple. Forms will be pre-populated.
Yeah.
Is that happening?
Yeah, that is happening. So, and I think also because a lot of information is already there, even for your, for like in case of financial year 25-26, you can revalidate a lot of things which we can talk a little later.
Okay.
For example, your tax credits, your income, what is appearing on the tax portal, and in terms of auto population, so that you avoid the possibility of you being getting picked up for scrutiny. Because if there is a mismatch, then which we can also
we'll talk about. Okay, so now we've understood broadly what's new in this tax filing season. Let's come to the forms. Forms remain more or less the same?
More or less the same, except for this additional disclosure what we talked about. So there are primarily, if you are not in business income, there are 4 forms applicable: ITR 1, 2, 3 and 4. ITR 1 and 2 is for those people who are not having business income. And 3 and 4 is for those who are having business or professional income. So that is the first part. Then now if you are not having any business income, and in ITR 1, if you are able to fulfill all the conditions, like what you described about that having taxable income which is below rupees 50 lakhs, also it is only applicable to residents. Non-resident, resident but not ordinary resident, as well as HUFs are not eligible to file form ITR 1.
Okay.
So that is an important
only
point.
Resident, largely salaried people with a taxable income of less than 50 lakh rupees.
Not necessarily salaried people. You can have other income as well.
Okay, but not business income.
But not business income.
Yeah.
So you and even capital gains up to 1,25,000 rupees, you can still file. But if it is more than that, you will not be eligible for ITR 1.
Okay.
Similarly, if you have any in case of, if you are having a sale of house property and you are reinvesting, it may be exempt. But then still you may not be eligible for ITR 1 because capital gains, except for that 1,25,000 rupees,
right,
you are not eligible for ITR 1.
Then you have to look at a different form.
And then we also earlier spoke about, if you are having shareholding in unlisted company, if you are a director, if you are having foreign assets, foreign bank account, foreign securities, like ESOP. Many, for example, employees get ESOP of their multinational parent company. So that is a foreign asset.
Okay. So your income might be lower than 50 lakhs, but if you have ESOPs from your company and your company is a foreign national, not ITR 1, you have to fill one of the more complex.
So there are a lot of such, conditions which we cannot go through.
I know, but it's good to know broadly.
So please check, make sure that you are eligible for all the conditions for filing ITR 1.
Correct.
And there is a long list there.
Like you said, it's called Sahaj, but maybe not so Sahaj. Make sure you check the fine print.
At least the eligibility is not very simple.
Got that. Okay, so that's ITR 1. Now, let's move to ITR 2.
So ITR 2 is for all those people who are not having business income and who are not eligible for ITR 1.
Okay.
Very simple.
Okay.
So it's like the second part.
The second category. If you can't fulfill any of these conditions, you have some, foreign equity ownership or your income
bank
is
account
above
outside.
Bank account outside.
So
income is above 50 lakh rupees.
Income is above 50 lakhs.
So you move to ITR.
Or if you are HUF, you are a non-resident, all those things. There are a number of things.
Correct.
And you don't have business income, then you fill up for ITR 2.
ITR 3, I remember, that's a very comprehensive, very complex form for those who have business income, right?
Yeah.
And ITR 4.
So just like ITR 1, exactly. So just like ITR 1, ITR 4 is supposed to be, which is called ITR Sugam, for those people who are having business income, but smaller businesses, which are taxed on presumptive basis.
Right.
So for example, up to 2 crores of income, you have an 8% presumptive, income.
Right.
So those cases, similarly in professional cases also, up to certain level, 50% is deemed to be income.
Okay.
So those cases, as long as again their taxable income is below rupees 50 lakhs, and similar to ITR 1, they are not covered by any of those restrictions.
Right.
Then they can fill up ITR 4.
Right, rather than going for the more complex.
So there one change which has come, we must talk about that, that if you are having more than, if you are having assets of more than 1 crore, which earlier used to be 50 lakhs, then you need to disclose all your assets and liabilities.
In ITR 4?
ITR 3 and 4.
3 and 4, okay. So if you have business income, and earlier the threshold was you have to disclose everything above 50 lakhs, but now that threshold is 1 crore. Where you have to disclose all assets.
All your assets and liabilities.
And all liabilities. In this, it's called Schedule AL.
Yeah.
Okay.
Yeah. Asset and liability. So AL.
Okay.
Yeah, Schedule AL.
So that's where the disclosures have to be made.
So therefore, even if, for example, you have jewelry,
yeah,
which may not earn any income, but you have to disclose there.
Sure.
Any shares which may not have dividend income also you need to disclose. If you are having taxable income of more than 1 crore rupees.
But the threshold this time, earlier above 50 lakhs, everything had to be disclosed.
Yeah.
This year, up to a 1 crore limit, you don't have to worry about missing any disclosure. So that's to some extent that's a relief.
Yes, that's correct.
Okay, we'll take a quick break. We've just gotten started because when we come back, we will simplify all of this down into a quick checklist. The mistakes to avoid and the things to keep in mind when you're filing your income tax return. Back in a moment.
Let's talk money. Let's talk money.
Welcome back. You're with us on Let's Talk Money, and this week it's all about making sure that you file your income tax return on time and, of course, accurately, so that we can have a peaceful sleep for the rest of the year. We're in conversation with Mr. Surana. Now, speaking of the deadlines, the deadline for at least the salaried class, it remains 31st July, right?
Yeah, 31st July, unless as we talked about, you have, under business income because of your share trading or because of, then you may have 31st August. Otherwise, yes, it is 31st July, which is for a very vast number of taxpayers. When we talked about 9 crore plus taxpayers, almost I would say 85 to 90% of them would be covered by this deadline. So it is having a very vast application for people.
Sure. So, Dr. Surana, tell us about some of the very basic mistakes that people end up making, omission or just forgetting. What are those mistakes that we need to watch out for?
Absolutely. I think the first one, as we already discussed, was that to select the correct ITR form. And there are a lot of conditions for having ITR 1 and ITR 4. So make sure that you don't file the wrong form. Otherwise, it is treated as a defective return or as an invalid return, which can have its own implications. The second is that make sure that your information, what you are submitting, your return is consistent with what is already there with the department and what is, like for example, Form 16, which you get from employer. Will have details of all your salary income, exempt allowances, your whatever tax deductions and tax paid by the employer. It must reconcile. Similarly, there is a Form 26AS, which will reflect all the tax credit which you are eligible for. So including TDS, tax collection at source, advance tax, self-assessment tax, refunds, and any tax demands. Then you will have AIS.
The annual
information
statement.
Which will, so suppose you have done any property transaction, you have done any high value share transaction, you have all your debit card, credit card payments, so those
and
things.
all of this information is automatically captured,
it is available.
Because it's all
of course, you have to log in. When you go to the e-filing and then you go to the tax returns and then there is a view AIS or view 26AS. You go there, you can see it. And if you, for example, in AIS, if you do not agree with something, for example, somebody has given your PAN number and that transaction is appearing in your name, then you will get a notice from department that you have not reported this. So you have an option, there are drop-down boxes. You can ask them to correct it, that this is not my PAN or this is an exempt income or this is basically already offered for tax in earlier year or will be taxable next year because I have received advance. So you can please make sure that you get it as close to what your return filing. So you will avoid any notice and demand. Otherwise.
So that's a very important point. If I notice some discrepancy in Form 26AS or this annual AIS, the annual information statement, and I don't agree with it,
you have option there itself available of drop-down boxes and you can give your response there, ask them to correct it.
No, correction is one thing, but because of these discrepancies, if let's say my tax liability for the year appears to be higher, that there's like any unpaid tax, do I have to pay it?
No, you can still file as per what you think is the correct working. But then there is a very high probability that you will get a notice from department. Then you have to explain at that point in time. But why to go through that? If you can correct it right now, please do that.
All right. So
that is the second part. The third important part is that many times people don't report exempt income. So for example, if you are having agricultural income, if you are having any gift from relatives, and many times people in modern context misunderstand relative to be if you are having a spousal equivalent or you are having a live-in relationship. In India, still tax laws do not recognize such a relationship. So if you receive such a a kind of gift, it is taxable in your hands.
And is there a threshold that defines?
So there is a threshold of 50,000 rupees. If it is beyond that, which I think most of the spousal equivalent will not accept a gift below 50,000 rupees. So most cases it may become taxable.
So this is controversial for other reasons beyond tax, are you saying? Gifts, Okay, basically to simplify this, if you've received an iPhone as a gift from your live-in partner, it needs to be disclosed in your income tax return,
and not only disclosed, it will be taxable also.
It will be taxable also.
So any shares, securities, anything, any property, anything else. Then the other point which is there is that there are sometimes non-monetary transactions which are neither there in the bank statement, like for example redevelopment of property, or there is an inheritance, or there is a gift received, so it is not appearing anywhere in your bank statement, and not appearing on Form 26AS also because they don't have information on that. You still need to make sure you report all that. Because like redevelopment, there is a deemed taxability because you are giving up one house, getting another in exchange. So it is not like it is exempt altogether.
So if your house is going in for redevelopment, please report. I'm just trying to recap, everything that we might miss reporting, and that leads to complications later.
And then tax demands and all those things.
So let's recap that, what we may end up not reporting, and it could cause trouble.
So like in case of non-monetary transaction, like for example, redevelopment of property, any gift which is received from either relative which may be exempt, but you need to disclose, or gift which is from non-relative above threshold, it will be taxable. So those things you need to consider. And then similarly, you might have in any case of inheritance, somebody, might have, whether it's shares or property or something else, you need to report that.
Even though it's not taxable, but you still need to report it.
Yeah. Okay. So you need to report. And that may not appear in your bank statement, may not appear on tax portal, but you still need to report that. Then similarly, foreign income, foreign asset, because the internal consequences are very severe, because under Black Money Act, it gets impacted.
Right.
And then the last point, which is also very important, is to make sure that you give your correct bank account number, which is valid. So refund comes to the correct account.
Sure.
And also you do the e-verification. Within 30 days, you need to do e-verification, either using your digital signature or using OTP with Aadhaar card. So there are 3 or 4 methods by which you can do it. Please make sure it is properly verified.
Only then will it be as a valid
it
return.
as a valid return. Yeah.
Ooh, okay, lots to think through and lots to keep in mind, but this was very, very helpful, Dr. Surana. I think it gives us a good framework and a way to think about it. Make sure you sit down and have this discussion with your CA. Make sure all those boxes have been checked.
Yes,
as they
absolutely.
say, dot the I's and cross the T's.
And I think it's much easier to avoid than getting a tax notice or getting a tax demand, because then you will be probably spending a lot more time trying to resolve it.
Okay. All right. This was, exhaustive, and very helpful checklist. So thank you. For joining us. I think I should run now and have a conversation with my CA. With that, it's a wrap on this week's edition of Let's Talk Money. Hope you found this conversation useful. Keep sending us your feedback. Tell us what you think. Follow us on social media. And of course, we'll see you next week with another theme that impacts your money.
Let's Talk Money.
Welcome to a special Economics. In the past 5 years, public sector banks have gone from strength to strength, even as the large private banks have somewhat lost ground. As of FY26, the bad loans, gross NPLs of public sector banks was actually less than that of private banks as a percentage of total loans. Now, PSU banks' loan growth has also been faster than that of private banks in the last 3 years. PSU banks have recaptured lost ground. They were losing the market share for decades. Now they have regained market share. And the stock market too has rewarded public sector banks. The PSU Bank Nifty has risen by 242% in the last 5 years, while that of private banks rose by only 55%. So the questions we are asking today, does this represent a structural improvement in PSU banks? Or is this just a temporary improvement because of the heavy cleanup and the recapitalization that happened from 2018 to 2020? Joining me to discuss this are former Bank of Baroda chairman and, more importantly, former Deputy Governor of Reserve Bank, Mr. S.S. Mundra, the former Managing Director of Punjab National Bank, Sunil Mehta, and he was also chairman of IBA, and Mr. Harsh Vardhan, one of the best banking experts from Bain, and more importantly, independent member of the Karur Vaishya board. So very much an insider. Gentlemen, good morning, and thank you very much indeed for your time. Mr. Mundra, this has to begin with you, since you have been there and seen it all as regulator and banker. Like I told you, gross NPLs, which were at double digits in 2018 for public sector banks, has fallen to like 1.4, 1.5, just like private sector banks, sometimes even better. And like I told you, they are grabbing loan growth back. Does this look like a structural shift?
Thank you, Lata. And you have picked up a very interesting topic to discuss today. First, I think I fully endorse what you are telling. If you look at the figures, and particularly in last 2 years. Now, see, what is the general discourse? General discourse is normally you pick up a time frame of last 4 to 5 years and then talk about it. If you take that framework, obviously it looks like that compared to, let's say, 21 or 22, the public sector banks have lost the market share, private banks have gained the market share, the performance, profitability, operating profit, etc., all the parameters will look negative. But what is interesting is to look at the period of last 2 years. If you look at the period of last 2 years, that is the 25 and 26, which is completed now, you would realize that almost in all the parameters, I would say a couple of parameters, deposit growth in private sector bank is still better than the public sector banks. Other income, private banks have still a marginal advantage over the public sector banks. And let's say the CASA deposit, probably there is a better performance by private sector banks compared to public sector banks, and which ultimately results into the operating income. But interestingly, in last 2 years, the market share gain of private sector bank is almost muted or in decimal points, let's say 0.4 or 0.5%. And whereas advances, the public sector banks has grown better than the private sector banks in last 2 years, and also catching up on the other income, operating profit, etc., etc. So I would say now with the consistently for 8 quarters or 2 years performance cannot be brushed aside as something which has happened by accident, or it has happened accidentally. It's not so. I think it is showing a structural improvement in the performance of public sector banks. And last thing which initially I would like to mention, see, we should remember the period before this 21, 22, 23, 24 was marked by 2 things. Cleanup was continuing of the balance sheet, capitalization was underway, and moreover, a lot of big consolidation happened in public sector bank, which take its own time, to settle down and then move towards the growth. So I would certainly say it still is a mixed bag, but there is a structural improvement. Public sector banks are recording good performance, but there are few areas where they would need to really still focus on, so that this trend not only continues, but it strengthens and they don't again slip back. Let me stop here.
I think you very comprehensively covered the fact that they have made advances in many places, but on deposits, on CASA, the private sector banks are still showing higher, better growth. Mr. Mehta, let me focus on the structural part. There were 2 things that were not there in the, in the previous decade, which has come in now. One is huge digitalization in public sector banks, probably started under you in PNB. And secondly, the acrylic has come in Reserve Bank. So even if we go through a bad period, that structural improvement should prevent loan shopping, corporates kind of loan shopping between banks. So do you think, therefore, this is a permanent improvement in PSU banks?
So thank you, Lata. It's a very interesting point you have raised. Let me give you 4 major factors which have brought structural changes into the performance of public sector bank. One of them is implementation of public sector bank reform agenda. We commonly call it EASE. This is EASE. This was like in 2015, there was a Gyan Sangam, which was followed by a Manthan in 17. And the entire public sector bank has undertaken a reform journey so that they can stay in line or ahead of the curve in reforms. And that reform has helped in creating the stress asset management verticals in each bank and has really brought focus back on recoveries, corporate governance, and the profitability. That has really contributed. Another important reform which the government introduced was IBC. So IBC, because the cleanup started in 2016 with asset quality review, and that impact lasted for 4 years. Like from 16 onward, the entire cleanup started, and by 2020, most of the banks have provided for their all bad loans, which were cleaned up during this process.
Got it.
So the provision coverage ratio of most of their banks has gone as high as up to 90%, and on an average more than 75%. So that has created a gold mine for them.
I think we will get back to you, Mr. Mehta. There's some connection problem. Ms. Harshvardhan, now as the neutral party who has not worked in a public sector bank, do you think this is an action replay of 2004 to 2008? Mr. Mundra would remember this very well. We saw public sector banks go from strength to strength. I mean, they were shining balance sheets and P&Ls of public sector banks in 2006, 2007, 2008. But come one, excess period, and we saw them decline again. Do you think there are structural changes now that even if there is a loan boom, they will not go back to the kind of problems they saw between 2016 and 20?
So, Lata, I would be somewhat more circumspect compared to the other two panelists. And let me give the reason. If you're right that the public sector banks have performed very well, but if you pass the performance, there are three main factors. One, you mentioned the growth has been strong, not just for the public sector bank, for the whole system.
Yes.
We are growing 16% last year. This last month, we did 18% year on year.
Yes.
And it's been driven by a lot of this growth is under guarantee of MSMEs, the MSME guarantee scheme, gold loans, and so on and so forth. But there are two other important factors you have to keep in mind. Our credit card provisioning levels are at historic low. You know, I looked at 25-year data from 2000 to 2025. Average credit cost provisioning to assets is about 1%. We are below 50 basis points right now. In fact, public sector banks for the last 3 years have been below private banks. They are at about 30 to 40 basis.
Yes.
This is unsustainable. Structurally, we are not such a low credit cost banking system. This is going to inch up. The other important thing you must realize is the pre-provisioning operating profit has been basically stable. It has not improved. So there is no gain on margins. There is no gain on operating costs. In fact, operating costs have set. So there is no productivity gain despite consolidation. What has added is a lot of recoveries that have happened of written off and bad loans. This is effectively the capital government put in coming back as profit. And so two of the three factors that are driving these extraordinary performance, to my mind, are structurally not sustainable. Or at least the jury is out. We'll have to wait for another couple of years to see whether this is... because the stock of bad loans are decreasing, so recoveries are going to go up.
Mr. Harshvardhan, you're touching a very, very relevant point, because I'm not asking a philosophical question or a political science question here. There are people who have loaded up on public sector banks because of their extraordinary performance of the last 5 years. But in the last 1 year, actually PSU shares have fallen a little more than private banks, because the feeling is exactly what you said, that all the provisioning, all the credit cost lowering, everything is over now. That is what I want to ask, whether you see structural reasons for the private public sector banks to continue at least the strong performance, if not stronger. Harshvardhan, very quickly, sir.
So even the loan market share gain has been marginal. And it has happened in things like mortgages, where public sector banks are doing all low margin kind of prime mortgage. They are going at 15%, private banks are going at 5%. So I'm not sure about the margins or the provisioning operating profit maintained at this level. And clearly provisioning costs are going to go up. So I would want to watch for another couple of years before declaring this to be a victory and a structural shift.
Okay.
For me, a significant outperformance is because of one-off factors.
Yeah, fair enough. And I have another relevant issue for all three of you. And let me start again with Mr. Mundra. So, the recruitment issue, it is still open exams, national exams. And people who are immediately, you see someone and you want to recruit them, This is a freedom private sector banks have and public sector banks don't have. I know of instances, I don't want to reveal it, in banks where you bring an outsider and they are really made to feel uncomfortable by the old boys club because this lateral entry is not very welcome. So therefore, do you think this outperformance in financials is difficult for PSU banks in the age of AI?
Okay, Lata, of course, I will respond to the question which is in a particular context, but I can't really restrain myself before reacting to a couple of the things which were mentioned earlier.
Okay.
I agree with Mr. Harshvardhan on some of the things about the guarantees and the MSME and gold loans and operating costs and the provisioning level, and they are unsustainable. My only caveat is everyone is on the same bandwagon. If one is committing sins, all are committing sins.
Yeah.
So private sector banks are no different in that respect. Yes, I agree. If you look at the end of 26, the total capital and reserve, which public sector bank as a block and private sector bank as a block are having in their books is almost equal. But this capital is supporting a different level of business. The private sector banks it means they have the cushion of capital,
Yes.
they have the luxury of capital, and they have a better operating income. So I don't dispute that. And you talked about 2004 to 2008. I think we all remember what happened, where these things went wrong. The head office banking was happening and the large ticket loans were done. But one thing I can tell you very convincingly that I think the public sector banks have learned their lessons well. Balance sheets are much better diversified, and they have started looking like both. Okay. Coming to your question about the lateral recruitment and people feeling uncomfortable, yes, in the beginning it was always so. But I would tend to feel that gradually this has become an accepted factor, and the now acceptance and the freedom to work is much greater than that. When we are talking about, interestingly, if you look at PSB and if we talk about 5 years, you will observe that the market share of all public sector banks put together has fallen comparatively more than SBI. SBI has been almost able to defend its market share even throughout the last 5 years. So, and digitalization and the apps and all that, I think they have put a very brave one. So I would say there are issues, but it's not that suddenly that it's a 2-year wonder and now it's going to change. I don't agree with that.
Okay, actually, Mr. Harshvardhan has a point, sir. Where the advances have grown is in home loan and auto loan. A product which private banks are not touching because the margin is very low in home loan and somewhat low in auto loan. You look at you look at personal loans, you look at credit cards, their percentage is increasing. So they are in a high risk, high return.
Sorry, Lata. Don't pick up the time frame selectively. If you pick up for home loan and this thing a time frame of 1 year and for the other things 5 years, then it is selective.
Fair enough.
You look at that, and you will be surprised to know that we don't know who is following whom. Whether private sector banks are following PSB model or PSBs are following the private sector model. It's a very mixed bag.
I agree with you entirely. And I can tell you that you mentioned SBI by name. SBI bankers are held in very high regard in private sector banks. They know they can't match some of their skills. So, I agree with you that there are times when private banks pick up the hint from public sector banks. And I don't want to run anyone down. I'm only very happy with the PSU performance. And so are a lot of investors, like I showed you the stock price. So, Mr. Mehta, this is clearly a stock market question. Do you continue to bet on PSU banks, or have they run their course, as the stock price seems to indicate? In the last 1 year, the outperformance has ended.
Lata, there is a large gap between the market reward to the public sector bank and what is there for the private sector bank. If you take terms in terms of market dynamics, you'll observe that the multiples available to private sector bank is as high as 16 or 14 times, whereas in public sector bank it's 1 time or 2 times. So where the multiples are still at a lower level, there is a scope for the market to provide further appreciation because the performance has really improved during the last 5 years because of the certain structural changes, right from fees, that is a reform agenda, to the IBC, to the consolidation, to the digitalization that is being undertaken. So all these processes are bringing a future value to the public sector bank, and I hope they will continue to perform in future. They'll continue to perform in future.
I like that word you say, hope, sir. Unfortunately, stock market does not look at hope as a data point. You know, the more important question I want to pursue with all of you is that within private sector banks, the old private sector banks have done much better than the new private sector banks. For example, RBL, Federal and Karur Vysya. There is a Karur Vysya representative over here. That is one of the best performing stocks in the last 5 years. So that question we're going to discuss threadbare after the break. Welcome back to a special Indonomics where we first discussed whether PSU banks have stolen a march over private banks and that advantage is here to stay. Now we are saying that old private sector banks have stolen a march over the new private sector banks, and will that continue? I have been speaking with former RBI DG, Mr. S.S. Mundra, also former BOB chairman, Mr. Sunil Mehta, former chief executive of IBA and managing director of PNB a few years ago, and Mr. Harshvardhan, member of independent board member of Karur Vysya and the banking expert from Bain. Well, since we are talking about old private sector banks and Karur Vysya is there, Mr. Harshvardhan, that question is really to you. RBL, I mean, it was Ratnakar Bank and completely not in the map of anyone. And it has given a huge return in the last 1 year. It has become a foreign bank. Federal, you ask any of the young banking analysts, they will actually count Federal as a new private sector bank. They will forget that it was once an old private sector bank. And Karur Vysya likewise has given the best returns in the last 5 years. So do you think that's where the gains are going to come? People who are young in spirit and flexing their muscles.
Yeah, so I'll put a slightly different spin on this, Lata. It is not old versus new, it is small versus large bank. See, once you become a very large bank, you are strategically homogenized. All large 4-bank, 5-bank look alike. If you're a mid-sized and small-sized bank, you have strategic choices, which, for example, at KVB, we have exercised, we have focused on some business. When you're a large bank, you can't do that. You look at the business mix of all the top 5 large banks, State Bank and the 4 private, basically marginally different from each other. So their only difference that they can bring about in performance out of execution. Whereas a small and mid-sized bank banks tend to have strategic choices, which, for example, in KVB, were very thoughtfully exercised and executed well. So even within public sector, you would see smaller public sector banks have done better in terms of their stock performance. So I think overall, to your earlier question, what you see is a convergence of performance and valuations of public and private sector. Now, whether we are at the end of that convergence or not is, I think, still an open question. I'm not willing to say that ultimately they'll all be true. There are still some very serious issues with public sector banks. But their valuations have moved from below 1 time book to 1 to 1.5, and private sector banks have come from about 2 to 1.5 to 2.
Yes.
So there's been a conversion of that sort. But I think the large versus small banks also is an important distinction you have to keep in mind.
Fair point, sir. They're more nimble. But but when AI comes in full force, it's already there, and we hear from the large private banks. My colleague Ritu Singh even gave the numbers. They have stopped recruitment and actually reduced their workforce in the last few months. Mr. Mundra, as we tackle this new force of AI, and another new force, that deposit cost is going to be very high. As you mingle with these new forces, who do you think is best placed?
Okay. Yeah. So Lata, but just to, again, I think if you look at old private banks as a block, needle has hardly moved. Their market share, what it was 5 or 6 years back, remains the same today.
Fair point.
There are exceptions which you mentioned, but even within that exception, RBL Bank is no more can be called as a old private sector bank, as we all agree. So I think the larger issue is that in all the 3 so-called blocks, whether it is PSB or private sector banks or old private sector banks, time has come when you have to look not as a block or as a sector, but as the individual players. I think something which Mr. Harshvardhan was also mentioning. And so within the blocks, there would be winners, there would be stagnant, there would be losers. So I think market would have to look at it a different thing. Coming to your specific question, see, AI, of course, for every kind of industry, it is something which one has to critically look into. I only look from one viewpoint. If you, what you talked about before we went for break about the, head count and all that. See, private sector banks have increased their head count very significantly in last 2-3 years.
Yes, sir.
In fact, the head count in private sector banks put together is now more than public sector banks. And it was looking like that public sector banks are losing this race. Now, the point is with AI, if you are bringing AI and if you are able to, use it efficiently in backup operations, whether this kind of head count which have been accumulated can really be redeployed meaningfully, or it would become a burden. I think it would be something interesting to watch for as we move ahead in less 6 months or 1 year.
Okay, that's great. Out of time, Mr. Mehta, what are your thoughts as a public sector banker? Do you think this HR issue and the fact that, again, the CVC and CAG, those issues remain, structurally you are more constrained than the private sector banks. Will that burden come back to visit you, or do you think public sector banks are structurally better off?
So 2 things, Lata. First thing, all the 3 major banks which you have said about the old generation private sector bank, they are led by leaders from the public sector bank.
Exactly.
That is so it means public sector bank has got the bandwidth to tackle these issues. Another issue I would like to flag is regarding manpower. The consolidation has offered a very great opportunity to the public sector bank to merge the existing branches because the multiple banks were having branches at the same place. And 3 banks have merged to their branches. So they can close some of those branches and redeploy that manpower for opening of the new branches. So without increasing headcount, they can increase the number of branches and they take the advantage of economies of scale, which they are taking for deployment of the AI in the technology.
Okay. No, that is there. And I think that period is over, the consolidation and the reorganization of branches. But I would think that in an era when we are going to have unknown and very difficult challenges from technology, I'm a little worried that the legal structure of the PSU banks and the constraints we put on the CEO and the HR may perhaps make them slightly more constrained to meet the challenges. But that perhaps discussion has to be done in a more detailed fashion. Thank you very much, out of time, on what I think was a very, very useful discussion. Thank you, Mr. Mundra, Mr. Mehta, and Mr.
Thank you. Thank you. Thank you, Lata. Thank you very much.
I would have never written a book, but after this AI mumble jumble started coming in, and I said I need to throw my hat in the ring
and set the cat among the pigeons again.
Yes, so now I will be enemy number 1 for my industry once again. You're still paying that 25,000 rupees salary, which I used to pay 15 years ago. That has not changed.
Yeah.
Investment in people has not changed. Somebody has dropped this Coke bottle called AI or machines on us, and we consider it as God.
You do believe that there is a 33% chance that this is a bubble. You're very specific. Why a 33%?
No, it is a bubble. No, there's no 3% chance. It is a 100% chance. The reason Indian IT is as big as it is because FC Kohli and all these guys did stuff which nobody else imagined could do, despite the fact they had no money. Whether I'm pessimistic or optimistic depends on what Indian IT decides to do.
You're saying partner with startups?
I'm saying, why don't you invest 5% of your profit by incubating startups inside your organization? You're having your single malt sitting at home. That guy is sitting at 12 o'clock in the night and delivering that service. Motivate him and do, for God's sake, tell him I love you. Shireen, to what extent it is logical for you to send a 7 a.m. mail to 13,000 people and saying you don't have a job? You're dealing with humans. You're dealing with people with families.
Is regulation an answer?
No. I think the government should keep away. Imposing AI on our children in our schools, stop it, for God's sake. Teaching knowledge school is a waste of time. Knowledge skills is a waste of time because the ChatGPT or Claude can give you that knowledge in a jiffy. We created Sampark Didi, who teaches only through song and dance. People, instead of 9 o'clock, they are coming at 8 o'clock because they want to compete.
Because they want the Gana Bajana. From employees first, customers second to humans first, machines second. One of Indian IT's most unconventional leaders is flipping the much talked about jobs debate. Hello and welcome to Young Turks Reloaded. I'm Shireen Bhan. Now, long before AI became the boardroom obsession that it is today, my guest transformed HCL Technologies with a philosophy that challenged decades of conventional management thinking. His employee first, customer second approach became a Harvard Business School case study and helped redefine leadership for a new generation of businesses. Now, as businesses race to become AI first, Vineet Nair is making a different argument. In his new book, Humans First, Machines Second, he says the biggest challenge isn't smarter machines, it's humans losing confidence in what makes them uniquely human. He believes AI should amplify people, not replace them. So will AI replace jobs or simply automate tasks? What happens to leadership in the age of AI, and how should businesses prepare for what is coming next? Joining me now is the former CEO of HCL Technologies and the author of Humans First, Machines Second, Vineet Nair. Vineet, it's great to have you back on Young Turks. Thanks so much for joining us, and it's good to see you.
Thank you. After decades, I was talking to you that one of my first interviews with you was Young Turks.
Exactly. So and here you are setting the cat among pigeons 15 years on. And that's what I want to address with you. When you wrote your first book, which again flipped the debate where in this notion of customer is king and customer comes first, you said employees come first. That's what you're attempting to do with this one as well. You're not saying the technology is not important or not transformative, but you're saying people will still matter.
I think the argument is about the same, right? In terms of if you increase the clock speed of your organization by having inspired, motivated employees, your revenues and profitability will go up. As you said, we saw that in HCL Technologies, and many other companies are following the suit. Now we are in a position, I don't know whether you have seen this movie called Gods Must Be Crazy.
No.
The Gods Must Be Crazy is a movie where there is a plane which is going on and it drops a bottle of Coke on an African village which had never seen a Coke bottle. And they suddenly start worshipping the Coke bottle as God. The bottle becomes the devil. I think that's exactly what is happening to the humans today. That somebody has dropped this Coke bottle called AI or machines on us, and we consider it as God. We say it'll replace us. We'll say it is more intelligent than us. We say it is, all that stuff may be true, but we are completely forgetting that God created the humans and humans created these machines. So instead of worshiping the humans, have some respect for yourself. And therefore, when I talk to young people, they're losing belief in themselves. They're getting pessimistic about the future. That is the time I said, hey, we should stop and re-energize human beings and tell them that everything new was created by them. Everything disruptive was created by them. All revolutions were headed by humans. Believe in the human. And then I gave 30 principles of how humans can rediscover themselves and use AI to create disruptive ideas in disruptive companies.
I'll come to the 30 sparks in a second, but you started work on this book 3 years ago. 3 years ago, AI was not the kind of global obsession that it is today, and there was certainly not this kind of fear factor involved. What made you want to write this book? Why did you think about writing this book 3 years ago?
I think I have been involved in advising a lot of companies on AI implementation, and AI has been there for many, many years. And as newer and newer companies started talking about technology, not necessarily AI, I could sense the direction in which is going, and I could sense that people are stopping to matter less and less, over a period of time, and that is the time I started working on this book.
Let's get into the nuts and bolts now. From the business that you came from, the Indian IT services industry, and there is a big question mark yet again on what will happen to the Indian IT services industry. You believe that 50% of the tasks that the Indian IT services do today will be automated, will be done by machines, will be done by AI. What then happens to Indian IT services companies? Are you pessimistic? Are you optimistic?
I think we have to start with the fact that will the investment in technology go up or go down as a percentage of revenues? Throughout the world, it will go up. that means the opportunity side is only going to go up, which it has gone up like that for the last 30 years. So the only way Indian IT is going to continue to be relevant if they become relevant to that new spend. Now, on one side, your old spend of Indian IT services are going to be taken away by the technology, whether it is robotics or whether it is AI. Are you willing to kill your revenues faster than the market kills it and invest in opportunities of building AI capabilities, AI services, AI models, so that you can grab that opportunity? Or are you going to lie back and wait for the inevitable to happen? So let me remind you what happened. Indian IT got created because of the lethargy of global companies. EDS, Dell, HP, IBM were lethargic in responding to the fact that there is a new way of delivering services, and Indian IT jumped ahead with that relevance. So the point I'm making is the answer to that question, whether I'm pessimistic or optimistic, depends on what Indian IT decides to do. Individual companies decide to do. Take the risk, grab the opportunity, and kill your existing business to a certain extent. Go to 100 customers, say 30% off for the next 5 years, and this is the way we're going to execute it. Or focus on quarter-on-quarter results and wait it out. That will depend whether it is an opportunity or it is a disaster.
If you were in the CEO's position...
I'm glad I'm not in that.
You're glad that you're not, but if you were, would you be able to go to your customer and say, look, let's run down the current source of revenue and look at the opportunities for the future? Is it possible for us to make that significant pivot today?
I think, Shireen, the answer to that lies approach it from two angles. The first angle is strategic, right? In terms of the revenues are going to go down, that is inevitable, right? There is nothing you can do to prevent it. The customer is smart, and therefore, if you are, like in recession, what happened? The customer said that if you don't give me a discount of 30%, 40%,
I'm walking.
So what did all of us do? We gave 30 or 40% discount up front, but none of our revenues, none of our margins, none of our profitability went down because we were proactive about it. Why were we proactive? Because the environment forced us to do it. So in my mind, our response in recession was easy because the environment forced you to do that. Now it is difficult predominantly because the environment is not forcing, it is touching and feeling and saying, hey, behave properly, but it is not forcing you. So strategically, if something is inevitable, prepone it. Because if you prepone it, you win the relationship. You are with the customer, because in the end, it is a customer relationship. So strategically, this strategy is the only strategy which makes sense. Number two, this is an opportunity where your competition is sleeping because their boards are quarter after quarter. So if you go aggressively, which is what we did aggressively with no HCLite left behind, everybody was sacking people in recession. We said no HCLite left behind, because of which we gained market share. This is a mega opportunity for you to gain market share, while the other competition is sleeping. So from a strategic point of view, I would say this is a godsend opportunity for you to be counterintuitive, not saving today, but investing for tomorrow. But there is another point, Shiri, that this country has a contribution in building your company to whatever extent it is, multi-billion dollars, whatever it is. Do you owe something back to this country? Do you owe something back to the employees who work to make this country?
I mean, you're paying taxes, you're paying salaries. One would argue that you could do better on paying salaries, at least as far as the IT services companies are concerned. We haven't really seen any significant change as far as the entry-level salaries are concerned.
I don't want to go down to that socialist argument. I want to go down to the strategic argument. When we say India as a competitive country, who is India? India is Indian companies. So if Indian companies are going to put their shutter down and be protective about yesterday rather than in taking risk about investing tomorrow, then how can you call India competitive? So the point I'm saying to all these leaders is there is a responsibility for us to be competitive. There is a responsibility for us to take risk. There is a responsibility to put that $1 billion, multiple $1 billion at use. All these, the Premjis, the Nadars, the Murthis of the world, actually took risk when there was no money. And the reason Indian IT is as big as it is because FC Kohli and all these guys did stuff which nobody else imagined could do, despite the fact they had no money. Now you have the money. Put your capital at risk, because that is the only way India will be competitive. You are India. There is no India outside you. So please, focus on your responsibility and make us competitive.
Okay, so you're saying it is India Inc.'s responsibility to make India competitive.
Yes, 100%.
And you're also suggesting a third thing. You're saying partner with startups, nurture Indian startups, and that could be your way of paying it forward.
So, I'm going to get into trouble by saying what
Please
I'm going to
do.
say.
I want you to get into trouble.
So,
for all the right reasons.
Yeah. So what happened was we created these middle managers who were very good in managing people rather than inspiring and doing creatively completely new things. I'm not generalizing it, but I'm saying, let's say an X percentage of people belong to that capability. Now suddenly the opportunity has changed. Managing is only going down. Creating new, reimagining a process, reimagining company success is coming in. That capability doesn't exist. So if that capability doesn't exist, and you cannot teach people how to reimagine, you cannot teach people how to go into GE and tell them, hey, this is how AI can completely revolutionize the way you manufacture engines. If you don't have the capability, what is the next best thing? There is capability in young minds coming out of IITs and IIMs, right? So I'm saying, why don't you invest 5% of your profit by incubating 100, 200, 500 startups inside your organization, not outside your organization. Give them capital, but that capital is not too much. Give them customer access. Give them HR capability. Hire people for them. Give them facility to sit. Put 5% of our profit back into the startups. Give them access to everything. Keep the middle managers out and let them innovate and let them fire independent of your bureaucratic organization so that they reimagine, they recreate, they create something which doesn't exist. And that is the only reason they're going to work in your company.
But will it also have to be in a new organization?
Yes.
You know, because I mean, these are large legacy incumbents that have a certain culture, that have a certain style of functioning. Will this kind of incubation, this kind of sort of, breakout, moonshot culture be able to exist within those organizations, or will you need to look at a spin-off?
So we need to look at this. So what I'm saying is this is debatable, but I personally believe, having run an IT organization, that these organizations are damn good because they run like machines, right? They run on systems and processes. And the moment you start upsetting it, if the whole house of cards will fall, predominantly because there is a machine which is running it.
Yeah.
Now, those set of new innovative ideas you can't bring into this machine. Neither you can change this machine to be innovative overnight. So it has to be through osmosis. So that is the reason I'm saying create a completely new company. Do it in a way, give them equity share, call them something else, don't call them your name, call them something else, take a risk, give them everything, and it's fine. It is fine. That is what. And over a period of time, through osmosis, the entire organization will change. And these guys will get an opportunity. These guys will say, I want to go there. You says, okay, if you want to go there, show me 1, 2, 3. And if you show me 1, 2, 3, you go there. So I think that is how we did in HCL also. Whenever a new technology come in, we'll create a new business. That is the way you do it. If you try and build the new into the old, it'll suffer. If you try and change the old into new, house of cards will collapse.
Reimagineers is what you're calling for. You believe that there needs to be a movement to create reimagineers instead of plain engineers within the education system that we currently live with. And this is an education system that has been built on decades and decades of ratta or rote. How do we, now that you've dirtied your hands, you've been in the trenches in the education system for the past 15 years, how do you create reimagineers?
Yeah. So I think let's break this into 3 parts. One is, what is the need of the hour? The need of the hour is that the knowledge assimilation through AI is going to be faster than anything we have seen. So therefore, teaching knowledge school is a waste of time. Knowledge skills is a waste of time. Teaching how to apply that knowledge and how to reimagine a process or reimagine a problem or reimagine a solution is going to be the skill which we need to teach. So point number 1. And if you don't teach that, our manpower is going to be obsolete. Once you understand that, now let's talk about whose responsibility is to create these reimagineers, right? I would say that the first set of people who are failing our children are the parents. The parents are the most people who are invested in their children. And I tell from parenting point of view, and I do these parenting workshops, you will laugh. And that is the reason I was telling I loved your recording the children storybooks, and more people should do it. In the parenting workshop, I ask parents in terms of what kind of conversations do you have at the dinner table. Does it create curiosity? Does it create experimentation? Does it create reimagining? And the answer to that is no, it is only instructive. My father did this and I had 100 rupees and, this is instructive and you're destroying the, and he's spending more time with you than he's spending with the children.
Yeah.
The first point, responsibility of creating reimagineers of the parents before you say government is bad, this is bad, that is bad. The second is the schooling system. Now, the unfortunate truth of the schooling system is exactly what I say about the IT services organization. It is wrong-stepped. And therefore, the ability to change it, because our teachers are not capable of of imparting outside knowledge. Technology is not going to help. AI is not a solution of school education or college education. It will take a decade of the relentless pursuit of creating reimaginers in an education system. That is the reason I'm saying let's go back home, right? In home, let's create reimaginers, and that is where the future of India will really belong.
But, what has been the experience? And you're working with government schools across 8 states in India. 2 crore children have been part of Sampark Foundation's programs that you are running across the country. What do you take away as the big insights, as the big lessons? What are those schools telling you? What are those children in those schools telling you?
So first is, I think these children are brighter than I initially anticipated, anything I've seen in my schools, point one. We came up with a very small experiment that we tell a story and we stop it midway and we don't complete the story. And we had massive resistance from the teacher, massive resistance. And now the teacher is saying we don't want full stories. So the moment the children are waiting for the half story.
So that they can write their own story.
They can write their own stories.
Yeah.
So that is changing. And I love the fact that the teachers are accepting and making that happen. If we intelligently leverage technology to reach the children, I think we're going to see a new India soon.
Well, I certainly hope that we do see a new India soon, but let's talk about the 30 sparks that you want to ignite in this AI era. And let me start by asking you, where would you make the beginnings within an organization? You need to acquire the skills to whitewater raft, and rapids are coming at us, and perhaps AI is one of the biggest rapids that we're going to have to deal with. Where do you make the start?
I think trust. The trust in our leadership is going down, predominantly because employees feel that the leadership interest and my interest are not aligned. And the moment that happens, then you get 50% of the employee or 30% of the employee, you don't get 100% of the employee. And the question I ask is, why does an employee spend his own money, go to a mandir, mosque or a church, feel excited about it, fulfilled about it, and then come on Monday to my office, get the salary and feel pretty bad about it? And the reason is because there is lack of purpose and there is lack of trust. So the first step for you to create a competitive organization is to make sure that there is trust between you and the employee by being honest. Number 2, create a sense of purpose. What is the purpose? What in the end are we attempting to do outside profits? Where is it going to go? Number 3, create innovation through reimagining what is possible. Why restrict within? See, all magic happens outside the box of reason and logic, right? So expand the boundary of logic and reason by creating a culture where people reimagine and then amplify. Anything which is good is not your responsibility, right? Is the responsibility amplify wins, amplify employees, amplify. So the more you amplify, the behavior will become culture. So the 30 sparks are nothing but how potentially a mid-manager or a CEO can go about creating this culture in the age of AI, because AI is a mega opportunity to create magic.
Let me throw back to you that we're talking so much about how culture is going to be important and culture will drive the organization. But, people would argue that we're now talking about having billion-dollar companies with one employee. What culture do you need for that?
I think, pardon my saying it, but those guys should be sent into, the word I can't say. Somehow I truly believe we are obsessed with profits. Shireen, to what extent it is logical for you to send a 7 a.m. mail to 13,000 people and saying you don't have a job? You're not dealing with, you're dealing with humans. You're dealing with people with families. You're dealing with people with aspirations. You're dealing with people with emotions. Yeah, if you have to let 13,000 people go, but there can be a better way of doing it. They can be telling them that we are getting into trouble. There can be some roadshows about the fact
that most of these companies are not in trouble. They're
making billions of dollars. Yeah. But so somewhere, Shireen, I hope through this book and through my saying this, I'll be hated in the industry. I'm raising my voice that there is a way of dealing with employees. And some of us have to raise the voice that you have to treat people as people. You made all the money because of people. So some responsibility. I'm not saying don't get rid of people. No, I'm not on the union camp. But I'm saying there has to be some amount of respect, some amount of thought, some amount of, even when you deal with a customer and the customer walks away from you, there is a roadmap. When you walk away from a customer, there is a roadmap. So why is there no roadmap with the employee? Why don't you make that attempt? And the point is, if you make that attempt and you have that culture, magic will happen, profit will happen. But if you do this, see, the point is, you fired 13,000 people at 7 o'clock. 13,000 people are gone, but all the people who stayed back, what are they thinking? Mera number aane wala hai. And do you think he's going to work, she's going to work hard for your success? The answer is no. It's completely illogical.
You do believe that there is a 33% chance that this is a bubble. You're very specific. Why a 33%?
No, it is a bubble. No, there's no 3% chance. It is a 100% chance. It is a bubble from a valuation point of view. Right.
But not from a technology point of view.
Technology, technology, AI will move into robotics. This is only accelerating. And it is good. It is good. And some regulations will come in, as we are already seeing coming in, to make sure that the bad elements of the AI is not used. But I'm less excited about AI, more excited about the robotics, which is coming just behind it. Use of that technology to create value. So what is Amazon, right? Use of technology. What is Facebook? Use of technology. What is Google? Use of technology. So the future belongs to creating value by the use of technology and not the technology alone.
So let me end by asking you, what is it that you would like to caution a CEO about today? I mean, of course, some of the risks are obvious, some of the risks we've chatted about, but something that is unknown, what is it that you would caution CEOs about
I
today?
think if a CEO is listening to this, I would say that you are amongst the smartest of the lot. And the reason you are a CEO is because you're very smart. Now the question is, what is your responsibility of being smart? And responsibility one is the fact that you need to grow faster than when you came into the chair. And number two, you need to carry your people along. Now, how do you combine these two? By being counterintuitive, by doing something which is not traditional, by not being incremental, by being innovative, by thinking outside the box. And as long as your mission is to do something which nobody else could do, you will create magic. India will gain, India Inc. will gain, India employees will gain, the world will gain.
Vineet Nair, it's always a pleasure. Thank you so much for joining us here on Young Turks Reloaded. We look forward to the next book, but we look forward to more conversation. Is there another one coming?
No. I'm done.
You're done.
Thank you. This itself is a risk. I don't know how it will go. And
do you feel you have a target on your back?
No, I have a target on my back. I don't know why I'm doing it. Shriram, I really don't know why I'm doing it. It is, my family tells me you're being naive.
Well, I hope it sparks many, many conversations, important and relevant, timely conversations. Thank you so much for joining us here on Young Turks Reloaded. With that, it is time for us to wrap up this edition of Young Turks Reloaded. As always, do send us your feedback. We love to hear from you. We'll see you again next week. Till then, from all of us here, goodbye and thanks for watching.
Artificial intelligence is rapidly becoming the defining investment theme for global capital, and Temasek is among the investors that's putting the biggest numbers behind that conviction. The Singapore investment giant now wants to more than double its AI exposure to as much as 15% of its portfolio in the next 5 years, betting across the entire AI value chain. But what does that mean for India? Where does Temasek see the next opportunities here? And how importantly is it navigating an increasingly uncertain global environment? To answer all of that and more, joining us now is Ravi Lamba, the head of strategic initiatives and the head of India at Temasek. Ravi, thank you so much for taking the time out to join us here. And let's start with that AI theme, because clearly that's become your biggest strategic bet. You want to double your investments there in the next 5 years. Where do you see the biggest opportunities today? And, are we still in the early innings of this AI investment cycle? And where in this entire picture does India fit?
Yeah, thank you, Ritu, for having me. It's an important thematic right now. I mean, AI is clearly not just the flavor of the day, but it's the future in terms of how enterprises and people will interact. with artificial intelligence. And I think what we're doing is currently, as you said before, we are looking to double our portfolio globally, but more importantly, it's just the beginning. So as I recall back in the late 90s when, software was emerging, everyone was trying to figure out how to adopt software, and then, fast forward 10, 15 years later, every company became a software company, and all of us use software without even realizing it's software. So we see AI as simply that in the next many years to follow, and maybe adoption will be much quicker. AI will become the next sort of infrastructure. It'll be the next infrastructure utility for across enterprises. So I think as you think about that as a thematic, and as we invest in that thematic, I think from an India perspective, we see the opportunity in India around the application layer, because adoption is needed. Adoption takes time, and adoption needs certain skills, and we think India will play well when it comes to the application layer for AI.
Okay, I'll get back to India in just a bit, but one of the interesting things about Temasek's AI strategy is you're invested in both of these big AI giants, OpenAI, Anthropic globally. I mean, does that reflect the view that it's too early to pick a winner, or are they fundamentally solving different problems and serving different markets? What's the strategy there?
I think the strategy simply is to invest behind AI companies that are at the forefront of what's happening today. And a portfolio is best served, just given the fact that the journey has just started. And there'll be many winners. And therefore, if you can get a chance to invest behind people who are doing cutting-edge AI work, it's a great place to be from an investment perspective.
Well, your review also talks about this turning point for the global order. There's tariffs, there's protectionism, there's geopolitical fragmentation. All of that is reshaping capital flows. Again, today you had, comments from Donald Trump on pharma and whatnot. How is that changing the way you think about investing today versus what you'd, do in terms of allocating capital 2 years ago? How are you ring-fencing your portfolio?
So as an investment house, we do not allocate by sector or geography. We are agnostic. We are very bottom-up driven for opportunities. And frankly, all these factors that you say, we will factor that into our investment underwriting thesis. So a tariff, for example, is another cost element that we will add, just like we'll add other costs. It could be raw material, it could be anything. So we look at these as inputs to our investment process. We are very long-term in our investment orientation. And we look at it over the long term. And frankly, if you get the cost structure right, whatever it contains, you underwrite the value accordingly. And that's how we look at it, Ritu. There's nothing specific that we draw from the current thing. We simply make sure that we are able to the best of our ability, to capture what it takes to understand the value of a company before we invest. And we're driven by intrinsic value when we think about investing and exiting. So that's the test that drives us.
Well, I was just zooming into India then, because India has been one of your strongest performing markets in the last decade, but still its share has eased a bit from 8% to 7% now. Is that simply because of what's happening on the currency front, or are valuations here making it harder for you to find attractive opportunities?
Sure. Let me give you some perspective on that. I think firstly, we had said a few years ago that we would try to deploy between $9 to $10 billion in India over the next 3 years. And we're on track. I'm happy to report that, in the last 3 years, we've deployed close to $9 billion. And it's not like we're slowing down. We are happy to keep looking for opportunities and deploy more capital. What happened last year was actually quite specific. We were approximately $50 billion US in exposure to India in 2024-25. In 25-26, we had two events. One was the exit of our investment in Schneider, India, which was north of $6 billion, and then there was, of course, some sell down by Singapore Telecom of their stake in Airtel. I think they sold close to $2.7 billion, of which we account for about 50%. So if you add those two up, there was those are the two main reasons why the sort of close to $50 billion has come down to about 42, and the 7% is simply just an outcome. We don't manage the portfolio by country or sector. We're driven bottom up, and that just so happens to be the percentage. From our perspective, we keep looking forward to deploy, what we said we would, and if opportunity presents itself, we can even deploy more than what we said in India because we like the thematic. India's been a great performing market for us, despite all the headwinds we've seen on the currency, and we're very happy with our portfolio performance in India.
So if you were to, Ravi, then deploy your next $1 billion in India today, what are the top 3 or 5 thematic or sectoral themes where you'd put your money? Perhaps a theme that's still underappreciated by the market you'd like to call out?
I mean, given what we own today, we would like to double down on what we own firstly. So, we own stakes in financial services, in healthcare, in consumer, in industrial. So I think those are all great sectors, and we will keep finding more investments in that. And we'll keep finding, and we'll keep peeling the onion. So what I mean by that is, we first started investing in banks and financial services. Then we moved that to investing in insurance, and then we moved into asset management. We did some fintech. So in that sort of journey, we will keep putting more capital in these sectors that we understand well and we believe play very well to India's thematic and India's growth. Healthcare services is something we like a lot. We have several investments in India. We have investments in Manipal, in Medanta, in Dr. Agarwal's, in Cloud9, for example. We have investments in some pharma businesses. We have investments in some consumer businesses. We took a stake in Haldiram last year because we see a significant growth in that sector, and we'll find more opportunities in that sector as well because we think investing behind great brands that can serve a 430 million and growing middle class, where the ability to spend is increasing, is a very good place for us to be. It plays very well to our thematic.
Since you're talking about peeling this onion, going deeper, and let's look at your financial portfolio. That is one of your largest. If your playbook is pretty much on the entire financialization story. I mean, there's banks, there's insurance, there's exchanges, there's asset managers, even fintechs. But if you had to pick the next decade's biggest value pool beyond banks, where will it come from?
If you think about where India is still early in this journey when it comes to financial services, one, of course, is insurance. The other one is asset management. And we find both these thematically very attractive. Obviously, you have to choose well, and you have to manage the balance sheet well. But the demand is there. It's growing. Wealth management, for example, is a space where we will see a tremendous amount of opportunity. And it comes down to how you pivot your business, use AI, use data to try and grow and grow what I would call a scale business. And when we find management that can play to that thematic, we will invest behind them.
But on banking itself, you built a pretty significant exposure, especially to private banks. Just looking at the recent performance, underperforming the PSU peers, even NBFC, and if you look at the latest numbers, it's been pretty underwhelming. What's the biggest risk, you'd say, to your long-term thesis on the banking sector?
Yeah, I think it's a good question. Look, I think we're not. Again, I would say that we're not faced by 1 or 2 years of volatility. We will invest in the banks for more than 20 years, and we see banks as a great proxy to economic growth. We see banks can have the ability over the long term to compound equity value north of 15%, just given the way they're structured. Asset quality is very good. Capital adequacy ratio is strong. Yes, there is some near-term volatility, which we're happy to ride through. And as we think about our intrinsic value test, and we feel that the long term is still positive, we will put more capital in this space because we do fundamentally believe that banks play a very important role in the growth of India. The Indian economy is growing amongst the fastest globally, amongst the larger economies, and credit growth will be a big part of that growth. And therefore, investing behind that, that theme is an important aspect for our investing thesis in India.
Well, let's talk about the big one that's upcoming. You've been a long-term shareholder in NSE, and the exchange appears closer to a listing than it has been in years. Is it an exit opportunity for you, or do you still see value creation ahead because India's markets are continuing to deepen, more and more new investors are coming in?
I mean, it would be unfair for me to comment on any particular company that, any of in our portfolios in that specific way. But what I would say is the following, which I think will answer your question, that we see the IPO of a company as one more element of its life cycle. We don't look at the IPO as an exit opportunity. An IPO is an opportunity for unlocking value of a private business. And an IPO happens when conditions are right, market, companies ready, et cetera, et cetera. So as far as we're concerned, we have had many companies in our portfolio that have gone public because we are agnostic to private and public. So when we've invested in private businesses, we can continue to hold them. An example is Eternal. We came into Zomato back in, it was called Zomato then in 2015, and we still have most of our shares in Zomato. We haven't sold on much. Similarly with Policy Bazaar, and there are many such examples, companies like Lenscard and Dr. Agarwal, et cetera, and Medanta that went public. We continue to hold most of our stakes that we had. And to the extent we need to exit, it'll come down to what I described before was our intrinsic value test. If it says these companies, it's a good time to take some money off, having a listed asset obviously is great because you can be agile with your investment holding. But again, that's a decision that we would take at that time, but it's nothing to do with the IPO of a company. IPO is just one more event in the company's life cycle.
Take a break on that note. Don't go anywhere. We'll be right back and continue this conversation. Welcome back. We're in conversation with Ravi Lamba from Temasek. You spoke earlier about healthcare, and that's become one of your biggest India bets from Manipal, Medanta, Dr. Agarwal's that you were just telling us about. Would you say that is now India's next structural compounding story? And as assets like Manipal, they prepare to go public, how are you going to balance on one hand, monetizing what's been a successful investment or, staying invested for the next phase of growth in the long term?
Yeah, I think healthcare services we see fundamentally very attractive as a sector, and I'll tell you why. Because there's the population in India grows. You need good quality healthcare. You need medical excellence, and you need scale. So if we can be invested in a platform in healthcare services which caters to all of these demand requirements, then it's a no-brainer. The question is, can you scale? Can you scale profitably? At the same time, can you provide the best possible medical care? And what inputs do you need to provide that? And that's where we are very focused right now. In everything we own, we want to try and see how we can use the data that we have, improve the quality of healthcare, improve the output of healthcare services so users will benefit, use AI so we can improve the interaction and the way healthcare is provided. And we see that as another big driver of growth. So it's a great sector to be in. We have doubled down often in the companies that we own, and we will continue to do that as we see the opportunity expand. And the opportunity is coming from both ends. It's coming from organic expansion and inorganic expansion. So when opportunity presents itself, we will be happy to back our portfolio companies to do M&A as well.
All right. So more M&As perhaps in the healthcare space. We'll watch out for that one. But let's talk about your consumption bet as well. I mean, you've invested close to $1 billion in Haldiram. You have Lenskart, Healthcart, Rebel Foods, CureFit, Licious. I can go on. But if you look at the data, consumption has been a bit patchy. Yet several of these businesses I just named, they're IPO candidates as well. So, is the consumer story strong enough today to justify both the private valuations they're commanding and this next wave, another wave of tech listings as well?
Yeah, I think, Ritu, what I would say is, if I look back 10 years, and 10 years is a reasonably good time frame for us as we consider our own portfolio performance, India has been the best performing market for us globally. This is despite the fact that the currency has depreciated 30% of the Sing dollar in the last 10 years. And why has that happened? That's happened because obviously we were fortunate to have picked great investments, companies to invest in and great management teams and partner with good families. But more importantly, the underlying growth has been pretty solid. India is amongst the fastest growing economies globally. You've seen, if you look at the per capita spend on a real basis, it's actually grown almost, I think, 12.5%, 13% in the last 2 years. So yes, consumption has been weak in certain sectors. It's been strong in certain. It is our job to pick the best investments possible and then continue to stay invested in them as they grow. We don't see that slowing down. Yes, there will be cycles. There will be, as you mentioned, there are a few years where it's been slow, but we will invest through the life cycle. We're not a fund. We don't have any fund life issues. We can stay invested through cycles. And more importantly, when we see weakness, because we believe in the long term, we will double down on our investments as we have before too. So this short-term volatility does not faze us. What we are focused on is the long term. We want to increase our stake, our investment exposure in India, and we're looking for those opportunities.
Well, Ravi, to me, it sounds you're not taking any money off the table. You want to double down and stay invested for the long term in pretty much every company and sector that you're currently in. But let me then get to quick commerce. I mean, you're an eternal shareholder. You brought up how, you've stayed invested in Zomato. But you're seeing quick commerce evolve from that cash burn story now. Thankfully, a bit more of a profitability debate coming up as well. But, at the same time, competition is getting quite tough. You have Amazon, Flipkart, Zepto, all of them scaling pretty aggressively here. Does it become a winner-takes-all market, or do you think these multiple players can, generate attractive returns? And any of these companies that I listed, for instance, Zepto, that's coming to the market, Are you looking to make additional investments, look at any other companies in this space?
Yeah, it would be unfair for me to comment on any of our particular portfolio companies in that manner. But what I would say to you is that we believe in the underlying growth in quick commerce as an example. It has only just started as a few-year-old phenomenon. There's a lot of value to be created. Of course, you have to execute well. You have to use the right cost structure, and you have to plan the technology in such a way that it can help you scale profitably. And as we see that happening, we will stay invested in this space because it's the beginning. It's just the tip of the iceberg. And we think the sector's got a long runway. E-commerce had a long runway 10 years ago. Quick commerce is part of e-commerce. We've invested in e-commerce not just in India, but in China, in the US, in Europe, in Asia. So this is a space that we understand very well.
Okay, the other space is mobility that I wanted to talk about. I mean, you're present all the way, through the spectrum from Maruti to Ola Electric, O2 Power. Ola Electric, for instance, still loss-making, well below its listing price, losing market share. Why not back someone like Ather? I mean, is that something you'd looked at? Any regrets at all? You think Ola Electric could still come out on top? I mean, what's the thesis there?
Yeah, again, I will not comment on any particular company, but I think the trend, we like the trend a lot. I think the transition to clean energy is important. Our investment in Mahindra, for example, in the EV space is part of that. We came into Mahindra a few years ago, and we're seeing some great outcomes there. And look, it's a matter of investing behind a trend that's here to stay. As we find success, we will double down. And we have to be watchful where things don't go according to plan. We have to work with management and see how we can pivot the business to try and move it to the right direction. And as shareholders, where we want to sit at the table and add value with our partners, that is what we will seek to do.
Okay, let me end by asking you about your exits as well. I mean, you spoke about Schneider Electric at the start. That was one of your best exits here, so far. India's IPO pipeline, of course, is as strong as it's been in years. Are you more likely to start monetizing some of your mature bets here? Or are you still, like you've been repeatedly telling me here, primarily a long-term owner? I mean, how's the year shaping up in terms of exits for you?
I think exits is an important point. Maybe I'll rephrase it in a way that puts better picture on this, on how we think about exits. Firstly, we're driven by intrinsic value. That's one. I will not go more into that, but that's what drives us to determine whether we should hold or sell a particular investment. The Schneider situation was excellent. We invested it at a time when, during COVID, when things were a little uncertain. We came in, we partnered with Schneider, and there were two options. We could have stayed invested, and that company could have gone public, but Schneider decided that they wanted to consolidate the holding, and we got a great exit. So it was a win-win for both sides. Now, did we exit because our intrinsic value test had played out? No, it was a factor of working with a partner and trying to get the right outcome, which could be a win-win for both sides. And that's exactly what happened there. When it comes to other investments where we're invested, again, we will look at the same lens. If it makes sense to exit, we will. But if it makes sense to hold, and we are compounding equity in a market that's delivered so well for us, with management that we know really well, we will stay invested. And that's ideally what we will do.
Okay, finally then, the outlook for the year, 2026, going into 2027, what are you most excited about for the India market today? What do you see shaping up as the biggest opportunities and also some of the biggest risks, regulatory or otherwise?
Yeah, I think the risks are important. I mean, look, there is clearly a global impact of what's happening in the war in Iran and what's happening with oil prices. And that's driving volatility in the currency as well. I mean, there are risks here that we have to be cautious. And when there's risks, you just have to be cautious, which is what we're doing. We're being cautious. We are being selective. As we look forward, we are looking forward to continue to find opportunities in the sectors that we know well. And it'll be the same ones I highlighted earlier. I hope we can do more in financial services, in different parts of financial services when it comes to, the onion peeling that we were talking about. I think healthcare continues to be a place where we will deploy capital if we can find the opportunity to do, more acquisitions if they present themselves. And we will also grow our portfolio in the whole area of green energy and transition, where, we had a great investment in O2 Power that we exited along with EQT. I think going forward, if we find more to do there, we would like to grow that portfolio in line with our sustainability objectives. So there's a lot to do. Pipeline is strong. We are being cautious only because the environment from a global impact of the environment is affecting certain things, and we just want to be cautious about it. But we see this being a strong investment year if we can find the right opportunities. We are very keenly looking at it.
All right, a strong investment here for Temasek here in India. Thanks very much, Ravi, for taking the time out to speak with us. Always a pleasure having you here.
Thank you. Thanks, Ritu. Good talking to you.
Okay, on that note, we'll wrap up this special conversation. Thanks very much for tuning in, but stay with us. More news and updates will continue right here on CNBC TV 18.
Well, this is Sriharikota, India's physical gateway to our space ambitions. So we are coming to you, and behind me, as you can see, is Vikram 1, which is the rocket which is ready to go up into space. The reason it is special is because it is the first orbital rocket which has been developed by a private company. The company, of course, which is doing this is Crude Aerospace. It's, by the way, also a unicorn. I mean, the private space industry is really taken off over the last couple of years or so. Remember, Skyroot has sent a rocket up before late 2022. Vikram S was the name of that rocket, but that was a suborbital rocket which was sent up. It went into space and, of course, then came back. This will put a satellite into orbit. The mission name is interesting. It's called Mission Agman. Essentially, it means arrival, and I think what it suggests is the arrival of the private sector as far as the Indian space industry is concerned, which, of course, so far has been nurtured meticulously over the last over 40 years by the agency ISRO. That's a government agency. This is a special moment. We've done deep dives before as far as the private sector efforts in the space industry is concerned. We've had companies from the sector on the program on CNBC TV 18 before as well. But I think this is really putting, testing whether, and I think the mission name is pretty apt. This is the success of this particular rocket will really truly, mark the arrival of the private sector in what is, the frontier of technology, which is, of course, space in that sense. The industry, of course, so far is small. There are a few companies, as I said, but of course, it's fast expanding. Private capital no longer a problem. And I think Skyroot, of course, has shown that and has been in the frontier, as I said, a unicorn, the first private unicorn. All of this, of course, in the backdrop of the giant SpaceX IPO, which has recently happened, putting it right up there as one of the most valuable companies in the world, and making Elon Musk, I mean, of course, he's been the space poster boy, but I think it really put the spotlight on what is possible right at the edge and the frontier of technology, the last frontier, some would call it, which is, of course, space. So, I mean, lots to report from here, but those visuals are important, and I think they're historic as well. From Sriharikota here, from the launch pad of Vikram 1, this is Prashant Nair for CNBC TV 18. Hello and welcome to this special program. We are here at Sriharikota, which is basically